Novo is going to be up this morning. We're asking who won here. We'll let the market decide. Also, of course, watching the autos, looking for a relief rally after China confirmed yesterday it's taken steps to exempt Nexperia chips intended for civilian use. And JTC, keep that one in view as well, Guy.
Absolutely. Right, here we go. Let's figure out exactly how strong this rally is going to be this Monday morning. I'm expecting that we're going to see a lot of green on the screen. You're going to see the FTSE 100 popping as we come through. There you go. We're up by 0.4%. We're climbing. We're expected to be up much more than this. We're going to see other European markets opening strongly to the upside. That's the level that you need to think about. But actually below that, and in the context of what we saw last week, you need to think about kind of what is driving this. And I think, therefore, the stock story, the individual sector story is going to be really interesting here to tell us actually what is the market signaling? What is the market telling us this Monday morning about what is going on here? So the stock 600 is up by 0.8%. The FTSE 100 is up 0.7. The CAC 40 in Paris is up by 1.2%. The IBEX in Spain is up by 1%. These are decent numbers. This is a good, solid bounce back. But why, I think, is the question that I think we need to ask ourselves. It's maybe too simplistic to say this is just because maybe we're going to see the end of the shutdown. Is it more than that, or is it simply by the dip? There are lots of factors coming into the market this morning that we need to digest and try and separate out to get a better understanding of what is going on here. Lizzie, what do you got? Tell me about these single stocks. Tell me about these sectors.
So we've only got one sector in the red at the moment, and that's telecoms at the bottom of the basket, but the rest are in the green, and basic resources is actually leading the gains this morning, up 1.9%. Paul Dobson was talking about how commodities have been gaining off the back of the optimism that the US government shutdown is coming to a close. It's tech behind basic resources, and we were flagging that we should keep an eye on the likes of ASML because of those NVIDIA comments, but also the Nexperia news. And then we had an eye on Novo, so they're up 3.2% at the moment off the Metsera news. So really kind of pleased with the way things worked out there with Pfizer buying Metsera, actually. Are they wondering if they, are traders wondering whether Pfizer overpaid here? But ASML, I should say, up 2.7% at the moment, Critty. Yeah. Lots of relief here for the chip makers.
Unwinding the Novo trade, 100% classic M&A. There's kind of a tale of two stories when we look at the healthcare space, because your biggest index contributor to the downside is Novartis. And I think that one's really interesting because you have AstraZeneca, you have Roche that are both higher this morning. They're also getting bids. That is unrelated to the Novo story, unrelated to the drug story as well. They're meeting endpoints, getting drug approvals. That's a different conversation. ASML is interesting, of course, but Prosus is actually your biggest and best Europe 50 performer, higher by almost 4% this morning. There's definitely a tech theme running through this.
Absolutely. There's also a China theme as well. You could argue that maybe the inflation, I know it's only 1 month, and I know tomorrow, Singles Day, etc., but the luxury stocks are up this morning. Is that on the back of China? Maybe that's less to do with the government shutdown that we've been talking about this morning. Can I just go back to the Novo trade? Take a look at the Novo trade over the last few days, Monday, Tuesday, Wednesday, Thursday, Friday into Monday. So this is a 6-day chart again. I'm sorry, Chrissy, to talk about 6-day charts. On a 6-day basis, whole of last week and this Monday morning, we are still negative by 5% on Novo Nordisk. So we're not filling that story in terms of what we're getting coming through this morning. But it is pharma stocks that are down the most this morning, which I think is interesting in terms of what we are seeing. Is that, and why is that? Is that related to what we're seeing over in the United States? Is it related to, I don't know what it's
But
related.
they were up so much last week. Like last week, they were the outperformer.
So is that the reverse of the defensive trade?
Yeah.
So are we basically buying what we sold last week and ditching what we bought last week? Is it as simple as that this Monday morning? And all this kind of chat about shutdowns, maybe that's just the catalyst and the spark. But is it really that is what, is it maybe just a simple story, but we're buying the dip this morning?
Yeah. We should also mention, just because we talked about it in our stocks to watch, UniCredit is also one of your biggest index movers to the upside, higher by almost 2% this morning. They're appealing that decision. We were talking about the M&A unwind when it comes to Novo and Metsera. This is kind of interesting that they're appealing the decision and the shares are up. Maybe it tells you that maybe the narratives aren't actually driving this market. Everyone thinks just on autopilot this morning. Let's see if I'm right. Caroline Robb, Deutsche Bank's research cross-asset strategist, joins the program this morning for a little bit more analysis. Pleasure to have you this morning. Thank you so much for your time. Is that how we should be thinking about this with some of the markets closed around the world tomorrow? Is today just a rotation day? What do you think?
Yeah, I think after the past couple of days where we saw quite a negative sentiment today, that's a combination of multiple things driving the markets up. We've already seen more positive sentiment in the US on Friday on the back of the first positive news on the shutdown ending, where Europe was already closed. So we're seeing a bit of a catch-up effect in Europe this morning. We got some positive news on the chips front. So that should also help markets today. And I guess a bit of that is also dip buying after past weeks were quite negative, while the macro environment actually remains quite encouraging. So the overall sentiment for equities is improving again.
Well, what is driving that? I mean, it feels like we're waiting for this kind of narrative, at least, that we're seeing so much of this fund flow go back into the States. When it comes to Europe, do we just follow the tone that the States is setting, especially when that tone is largely tech-driven? How are you thinking about that for this region specifically?
Yeah, so if we look at Europe, actually, the past couple of weeks, we had a lot of earnings coming in that were pretty strong. And I think investors are really looking for a broadening out of your U.S. tech stocks. We're seeing a lot of concentration risk in U.S. tech. So with quite positive earnings sentiment in Europe, I think it gets more and more attractive for investors to also move back into Europe. And we're seeing that sentiment really improving. And it's also backed by more positive macro data. We've seen PMIs improving. So I would say a lot of factors feed into that more positive environment for European equities.
Well, did European equity earnings change your outlook for what sectors you like, actually?
We didn't change our sector views based on earnings. Actually, I would say the earnings season confirmed our sector recommendations. So we're still quite positive on banks, and it was once again one of the sectors which delivered the strongest beats. Although we have to say that beats within banks declined a bit. So of the past 10 quarters, we saw massive beats in the bank sector, on average about 10% beats. In Q3, beats slowed a bit to 8%, which is still very strong. So we're seeing that the positive surprises from banks are becoming a bit weaker, but we're still on super positive levels. NIIs are holding up quite well. Earnings growth is holding up quite well. So that's one of the sectors that is still standing out positively. And financials overall have been one of the largest drivers of European earnings growth this quarter.
I'm looking at the autos names all bouncing back this morning, Caroline, partly to do with the Nexperia news. But do you think that the pessimism over the European car makers has peaked now?
Yeah, it's a very good question. So, of course, the positive Nexperia news is helping the sector this morning. If we look at earnings from autos, I mean, it has once again been the sector with the most guidance downgrades. We've seen basically all European OEMs downgrading guidance at the beginning of the earnings season. We still see negative earnings revisions for autos, actually. But there have been also some green shoots. So actually, for the first time in 5 quarters, autos have surprised to the upside during the earnings season. Of course, that has to do with expectations really weakening a lot. I mean, we've seen negative earnings revisions of about 60% for autos this year. So expectations are just very, very low. And now for the first time, we've seen autos earnings beating consensus estimates. So there may be a few bright spots on the horizon, but I wouldn't say it's yet time to buy autos. So we're still neutral on the sector.
Caroline, I'm really surprised coming out of this earnings season, and we're only just out of it, that I'm not seeing more upgrades for next year. Why are we not seeing more upgrades for European corporates for next year? Why are the analysts being as cautious as they are right now?
That's a really good question. I mean, we are also thinking that analysts are too cautious on next year. We've basically seen earnings revisions being slashed the entire year. And that's also a big difference to the US, right? Where in the US, earnings revisions have started to recover and we are now back at pre-Liberation Day levels. While in Europe, earnings estimates have never really recovered from the decline they've seen after Liberation Day. And just over the past couple of weeks, we're seeing a small uptick in earnings revisions. The earnings revisions for estimates for next year have increased by 1% over the past couple of weeks, which is it is a bit of a positive news. But of course, compared to how much earnings estimates came down over the past months, that's not really a lot yet. But we think that thanks to those strong beats we've seen in the Q3 earnings season, sentiment is really improving now. And we are expecting, and we're also hoping for, this trend of slowly recovering earnings expectations continuing. So we're seeing double-digit earnings growth next year. So that is still quite a bit higher than consensus.
What does that do in terms of getting European indexes higher? How much, if that comes to pass, what are we going to see in terms of the performance next year?
Actually, we're pretty positive on European equity markets into next year. It's a bit hard to compare that to consensus because we don't have that many brokers out with their year-end targets for next year yet. If we look at valuations in Europe, we are a bit above the long-term average, but we don't think that valuations are too stretched. And with double-digit earnings growth, we're actually seeing quite some potential for European equities up by double digits next year as well. So we really should see that recovery. And don't forget that we will also see the fiscal stimulus from Germany finally kicking in next year. We have seen the first positive impulse already in Q4, but markets have got a bit impatient on that fiscal stimulus. But we, with the next year budget from Germany being approved probably end of this month, early next month, we should really see that stimulus kicking in, and it should also help earnings, and it should help positive sentiment on Europe again.
Great stuff, Caroline. Thank you very much indeed. Caroline Raab, Deutsche Bank Research Cross-Asset Strategist. Thank you very much indeed. You're getting a rotation in the market. You're getting all the stuff that was beaten up last week coming back. You're getting all the defensives that did well last week giving back some ground. So what the core six looks like, this is the kind of story that we are seeing across Europe. Take a look at the right-hand side of the screen. Look at what Nestlé's doing, down by 0.2%. The defense names are back. The chip names are definitely back. Luxury is bouncing as well. Novo's up. I think Novo is a bit idiosyncratic this morning in terms of what we are seeing there. Let's dig into the details. Chloe Melly is here with all of that.
Good morning, Guy. We have got some positive movement in ASML this morning, which is up 2.3%. That is due to positive read across from strong sales growth at TSMC. So ASML is one of the key suppliers to TSMC, and that could potentially boost the demand for that semiconductor equipment, those lithography machines that ASML makes. And so on the back of that, we are up 2.3% this morning. Moving on to Diageo, which is also up after naming a new CEO. So Dave Lewis, who was the CEO of Tesco and was also the chair of Alien, will start on January the 1st, and he has to kind of turn around the maker of Guinness after a lot of weakness in the last few quarters. Diageo lowered its outlook just last week because of weakness in China and the US, and so he has a big task ahead of him, but it seems that the market is quite confident in the fact that he can turn things around, and we are up almost 7% for Diageo this morning. Moving on, but staying in the UK, JTC, which is a provider of fund solutions and corporate services, is down this morning on the news that private equity firm Permira will be buying it for £2.3 billion. So we are down 4.6% on the back of that deal. Moving on to Siemens Energy, the company has been upgraded to a buy at Jefferies. We are up 4.6% on the back of that. The analyst said that the shares were significantly undervalued because the portfolio was addressing all the main challenges that we have got in the energy sector, including those massive grid investments. And so it is up on the back of that upgrade. And Commerzbank was also upgraded at Deutsche Bank this morning. The Deutsche Bank analyst said that the net interest income guidance looks quite conservative, and there could be more growth going forward. And so we are up 4% for Commerzbank on the back of that upgrade this morning.
Okay, Chloe Melly from our equities team, we thank you so much. And coming up, we're going to dive into some of those single stock stories. We'll check in on Novo Nordisk, the Danish pharma giant, of course, walking away from Metsera after Pfizer agreed to buy the obesity drug startup. That's coming up next. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi Zahran, and this is Bloomberg.
A little bit of churn in the markets, but equities are absolutely powering higher this morning. Look at it in the context of the last few days, and I think you probably get the story. What we are seeing is a reversal. You're getting all the stuff that was beaten up last week coming back. Now, we're not there yet, and we haven't completely filled the gap, but it looks like we are certainly having a decent effort at it this morning, and maybe getting halfway there. Let's talk about some of the single stocks that are on the move. Novo Nordisk is certainly one of those. That stock is up by circa 3% this morning. The Danish company bowing out of the tumultuous bidding war to acquire the obesity drug company Metsera, clearing the way for Pfizer's $10 billion deal. Now, Pfizer didn't start there. It has significantly had to raise its offer. Let's join now Bloomberg senior pharma reporter Naomi Kresge. Naomi, let's talk about kind of how this all came to pass. Pfizer looks like it's come out on top, but has it? It's had to pay more. Its relationship with Metsera has changed. What does this mean in terms of A, Pfizer, and B, Metsera?
I mean, I think for Pfizer, Pfizer's CEO, Albert Bourla, this deal was a must-win deal. They had tried to get into obesity several times via their own pipeline, their own projects. It did not work out for them. And this was, a way that they could make a deal to get into this huge market. Birla needs additional revenue. And so for them, this was just something that they had to push through. On the other side, for Novo, I think, we're seeing the share rise this morning. I think that reflects some degree of relief that they did not continue to pursue this bidding war and bid even higher. I think, they've now bowed out at a level that they felt was the maximum, fair value for the asset. And they'll now look for other potential acquisition targets.
But will they? I mean, what is next for Novo in this space? Because obviously they've been trying to keep up with Eli Lilly. Does Mike Doustar keep pursuing more deals in this space?
Yeah, I mean, he sent out an email to his executive team over the weekend saying that he would continue to pursue deals in the space. They'll look for assets that are complementary to their portfolio, look for deals that could be around diseases that are associated with obesity, as we saw them do this fall, with the liver deal that they did earlier in the fall as well. So they will continue to look, and I think they'll continue to look at everything that's out there.
But is that, I mean, you lay out kind of widening the drug portfolio specifically, Naomi. When it comes to the obesity space, are there other candidates in the U.S. that Novo might have their eye on, or is Metsera kind of it?
We're hearing from some market observers that Metsera was certainly one of the best options out there. Now, are there other things, other assets, dealing with comorbidities that Novo could bid for potentially? I think we'll have to see. We'll have to see how they approach this, and we'll have to see also how some elements of their internal pipeline shake out.
All right, lots to keep an eye on. Bloomberg's Naomi Cressio walking us through some of the dynamics behind Novo Nordisk's decision to walk away from their bid for Metsera. We thank you so much. Pfizer, of course, getting that for a whopping $10 billion. Sticking with some of the deals that may or may not happen, we're now watching one that is. JTC shares are moving quite a bit this morning, down about circa 5%. Interesting, given there is an actual M&A offer here. Why is JTC selling off? Premier has agreed to acquire the London-listed financial firm, outbidding rival Warburg Pincus. For more, we're joined now by Bloomberg Deals reporter Manuel Bagori. Manuel, can you just walk me through this share price reaction? When you have a deal like this, the target tends to move higher, not lower. Why is JTC selling off right now?
Interesting share reaction, Kriti. I couldn't agree more with you, but it's a good reminder that we never know what the reality is going to be when trading starts on a single security, despite the news of JTC being acquired by Permira. So the short answer is we don't know when and how stock will react. Obviously, there is different factors that come into effect, the premium one of them, the growth prospects, also the plans that the buyer has with the asset, and also investors sometimes could be pricing in the effect of a potential bidding war. We've seen in this case Permira prevailing, competition from other private equity firms. Perhaps there was also, the expectation that, who knows, maybe an industry player would come in and pay an even higher price. The expectation always, it's a little bit unpredictable, and how the market could react, it's a bit unknown when there is a deal announcement.
In terms of what's driving the story in London, here's another bid, here's another offer coming through for a UK asset. People are perceiving London as being cheap right now. Just give us the kind of sense of whether or not this process is going to continue, and if so, for how much longer?
Valuations are definitely attractive in some sectors. Some companies, as you will say, have seen the value of their stock compared to earnings falling dramatically to a level that it's more attractive for potential buyers. That obviously depends on the sector, depends on the company. But it is true that we've seen a number of examples in the UK that would suggest that there is a bit of a theme there. We are definitely watching it closely, especially particularly attractive for private equity firms that can make the numbers work and lever up these businesses, potentially paving the way for an exit down the road. But the reality is we've seen a number of such deals in other jurisdictions, across different continents. We've seen a number of those in the US. Here in Asia, corporate services is also an interesting industry. We've been actually tracking down other similar businesses in that space, which, by the way, has always been a very interesting field for transactions in the private equity industry. Take Vistra, Tricor, for instance, a climb here in Hong Kong as well recently. So it is one to watch, and definitely the UK has become a more appealing field for potential takeovers of publicly traded companies.
Yeah. Well, go on, Manuel, tell us. You're on the team that first revealed the takeover interest here. Who's next likely? Who might be the next takeover in London?
Oh, that is, the million-dollar question. I wish I could answer that, but, us as reporters in the deals team, we are constantly, obviously, trying to, break the news first for our clients, for our readers and audience. So we'll continue to chase. And this field, corporate services, is definitely an attractive one that is worth keeping a close eye on, as in whether and when the next sizable target will come in. It's still, hard to tell, remains to be seen. But definitely, I would make the following statement, which is deal-making activity in the UK, in Europe, in the US, and here in Asia too, has been booming. We are seeing a radical increase in the volume of deals across sectors, across geographies. That's very encouraging, very exciting for investors, for deal makers, and with such backdrop, is likely to expect more interesting deals like this one in the future for sure.
Well, great stuff. Thank you very much indeed, Manuel Baragori, on the latest M&A stories around the London market right now. Quick check on the chips, if I can get that out, to see what is happening this morning. As you can see, ASML up quite nicely, but just take a look at the context of last week. A little bit of dip buy, maybe creeping into this market this morning, Lizzie.
Yeah, and I'm also watching Unicredit. You flagged this, Kriti. Republica reporting that they're going to appeal the court decision on Banco BPM, this court decree over the Italian government's conditions on the takeover. This is going to be in the Council of State, so it's the highest administrative court in Italy, and it's that July 12th ruling that they're going to be appealing.
I'll throw one more into the bucket to watch. Diageo having a really good day, a surprisingly good day for really just announcing who's going to be at the helm of the company. Here's how I get this: a whopping 7%. Dave Lewis, a former Tesco executive, is going to be taking the helm of Diageo. He's focusing on those core brands, maybe away from premiumization, and that's something that Diageo desperately needs. Lizzie.
Well, coming up, we're going to go to the micro. China's macro consumer prices surprising to the upside. We'll talk about what it means for the economy with Phoenix Carlin, Global Head of Emerging Markets Research at SocGen CIB.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time we went to Peru, trying to culture food. I never had this ingredients never used in Japan. Kind of like a wow, and cilantros, chili, garlic, and olive oils. So a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi. But Peru use fresh fish make the called ceviche, cooked with lemon juice. Never use soy sauce. First time I eat this, wow. So then after this one, my open eye more, my cooking style that change. Combine to Japanese style and another country food, then make novel style.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade about 30 minutes into today's session. Green on the screen across the board. Your outperformer this morning, though, is the DAX, higher by 1.3%. We opened almost 2% higher, so starting to see some of the momentum come out of these markets, but still not too shabby for 8:30 on a Monday, Guy.
Okay, let's talk about the details of what we're seeing. In terms of the breakdown within the market, we are definitely front foot. 461 stocks up, only 132 down. All of last week, we were reasonably balanced. Volume's not there, though. Pay attention to that. So you're not seeing a pickup in volume on the back of this story that is taking us higher. So just bear that in mind. The other thing I want you to bear in mind is that basically what did well last week is not doing quite so well this week and vice versa. So ASML, the chip stocks are definitely up. You're seeing the story coming out of China. You're seeing the story around what is happening with NVIDIA, all boosting the story. So ASML is up by 2.4%. Siemens is also climbing higher as well, as is Roche. So some of the, you see some of the pharma stocks are doing better and some of them aren't. So Roche is up by 1.7%. Let's just flip this around and give you an idea of what is going on the other end of the story. So Novartis is down by 0.5%. So it's interesting we're getting a little bit of kind of differentiation within the pharma space. But look at the defensive names like Unilever, down by 0.8%. Defense did well last week. National Grid, take a look at Friday's session on National Grid. Had a huge day on Friday. We're reversing some of that this morning. We're down by 2%. So that's the kind of the story. A little bit of rotation within this market, Lizzie.
Yeah, here's what else you need to know this morning, Guy. The US Senate has taken a major step towards reopening the government after several Democrats broke with party leaders to side with Republicans to pass a deal aimed at ending the shutdown. The bill would provide full-year funding for some departments, fund other agencies through to January the 30th, and pay for furloughed government workers. But its passage in the House is not guaranteed due to opposition from Democratic leaders. Elsewhere, TSMC reported slowing growth in its revenue in October, potentially another indication that AI demand is moderating as this market turns frothy. Sales in October rose 16.9%, the slowest pace since February 2024. Still, though, TSMC shares have gained about 37% since the beginning of this year. And China's consumer prices unexpectedly increased in October as holidays during the month boosted travel, food and transport demand. However, economists see the price increase as likely fleeting, with deflationary pressures remaining entrenched. Guy, is it going to last? That's the question.
That is the key question that we are going to be talking about next. Phoenix Kalin, Global Head of Emerging Market Research at SocGen, joins us now. Good morning. What do you make of the data?
I think it's better than expected and certainly exceeded our forecast in terms of we're expecting for CPI year on year to improve 0.1. It was 0.2 instead, so mildly better than expectations. But I think in terms of the deflationary pressures that persist, that is still going to be a medium-term problem for China to tackle.
So how does it tackle it? Are we going to see more liquidity being pushed in? I keep going back to the kind of the M1, M2 charts that we're watching in China. They are going up pretty sharply at the moment. What have we got in the pipeline? What is still to come?
Well, what is still to come? We really want to see two things in terms of the two pillars. You have to support consumption, and that's via, one, stabilizing the housing sector. We're still seeing an acceleration in intensifying pressures in terms of housing prices going down. New sales going down as well. So there's still a contraction going on there. And your rental yields are not even meeting their borrowing costs, so there's not much incentive for people to actually buy houses. So there's a lot of pressures in the housing side, and we don't see much support coming out of there, especially from the fourth plenum a few weeks ago. And then on the other side is around supporting things like social safety net. So wanting to support that, and we have seen some announcements around that in terms of wanting to support pension payments and so on. But I think those policy measures need to be fleshed out fully, and we won't get those details for a few months.
I keep looking at the money supply data in China, and it is going up sharply. Where is that going? What is happening there in terms of that money? Because Simon White here at Bloomberg's been writing about the fact that a lot of that liquidity is going to leak out of China and end up in other markets. Is that what's happening? What's the convergence looking like between M1 and M2 in terms of what it's telling us about future deflationary forces? Like, what is happening with the forces that have been unleashed thus far?
So I think in terms of M1 and the liquidity that's being unleashed, I think, yes, it's inevitable that some of that will leak out, because if you've got low real rates in China, negative carry, and growth prospects that are still quite muted, money is going to want to look for better investment opportunities outside of China. And so that's inevitable that that's going to leak out. But we are starting to see some convergence between the M1 and M2 dynamics, which I think is positive, and that's kind of a leading signal for credit growth in the future. So that's something that we might see try to feed through to kind of the underlying dynamics around corporate lending, and that might start to stabilize soon. So I think in terms of the picture that we have around deflation, the sequential moment might start to ease in the level of negativity, and then it should turn over the coming months.
Guys, there's talking about the leak out when it comes to kind of the market plumbing and, of course, how this shows up in the U.S. markets. When it comes to the European markets, though, would this compound the issues of overcapacity when it comes to some of the exports that are getting rerouted to Europe away from the United States? Are you seeing this as kind of a double-down effect?
Yeah, so we're seeing that there's huge amounts of export diversification outside of China, away from the U.S. and toward the EU in particular, and Brazil and South Korea. Those are the main destinations where exports from China have been basically dumped. And yes, we do have a problem with kind of the deflationary pressures that exerts on the EU. And so that is something that policymakers are contending with, and will try to push back against the dumping pressures.
Is that just a China story? Or are you seeing that for the other competitors in Asia, in Korea and Japan, et cetera?
To a lesser extent, the other players as well. But China has been kind of the main force of pressure, being in terms of the high amounts of tariffs that it's faced from the U.S. So that's where we're seeing the most amount of exports dumping.
So let's put China to one side. Let's say whether or not it's an anomalous print, this CPI number. We've seen this sharp slowdown in inflation across emerging markets compared to developed ones. If that means that central banks can be more supportive in emerging markets, how much more of a rally do you expect in EM bonds?
So I think one dynamic that we have to differentiate is, like, over the past year, we have seen that big divergence in inflation between EM and DM. But going forward into next year, I think that starts to fade away. So we won't see as much in terms of disinflation in EM. We're actually seeing some of those pressures come back online in terms of inflation's expectations going higher, especially in the CE4 region and in LATAM. So that's becoming more concerning. Inflation expectations are getting much more de-anchored. And I think that's going to pose a real problem for central banks to be able to ease much more into next year. We are expecting still a continuation of easing cycles, but a much more moderate pace, a more modest pace. And so that means that growth can be supported less into next year. But at the same time, it does mean that because they won't be cutting rates so aggressively, the currencies will be supported to some extent.
And what about if the AI bubble bursts? Which EM currencies are going to be the most vulnerable in that situation?
It's going to be kind of the Asia bloc. The tech-sensitive EM are around Asia, so Korea, Taiwan, China as well. And those are the ones that have been getting hurt over the past week when we saw kind of the equity wobble in U.S. markets.
How significant could that be? The Korean equity market has been crazy over the last few weeks. Like, the performance has been absolutely massive. Now, we have seen some reversal within that. What's the relationship between like equity market flows and what we're going to see in terms of the currency, the AI trade back into the Korean won?
I think that's probably the biggest risk out there for the valuations at this point because of how much they've risen over the past year. Kind of huge, double-digit, almost triple-digit kind of gains. And so if the AI bubble does burst, which is not something that we have in our core scenario.
Might happen, though.
But that would have a huge impact on those equity markets where we have seen such huge valuation gains.
Is there an EM safe haven? If so, what is it?
So right now, for me, the safe havens are the places where currencies haven't appreciated as much as they should in kind of a real format. So places like Brazil, South Africa, Chile as well. So I think those are good places still, where it's relatively actually shielded from the tech bubble, and still there's currency gains to be had, there's carry to be had in substantial amounts. And I think that's probably the best plays over the next year.
It feels like you just named three really interesting countries. Brazil, though, I'm going to focus in on Brazil, although I have questions on Chile as well. For Brazil, is there a tariff risk for Brazil that needs to be factored into the currency picture?
So there's already kind of the tensions ongoing between Trump and Lula. But what we've seen over the past several weeks is they've had more conversations, in-person talks with each other, wanting to resolve some of those diplomatic type conflicts around Bolsonaro and so on. So I think there's probably going to be some progress toward those mediation efforts, and we're likely to see that materialize in actually some resolution around tariffs.
Despite the Chinese purchases of Brazilian soybeans and that kind of partnership that's growing?
Well, I mean, there are lots of issues to work through, of course, which is why this is not resolved yet. But I think we should see a trajectory of progress over the coming months, even if Lula stays in power.
Lots to digest. We got to bring you back on for another round of Latin American drama. Phoenix Kalin, Global Head of Emerging Markets Research over at SocGen Corporate Investment Banking, joining us around the table. Coming up on the program, we put our focus right back to what's going on in the States. U.S. airlines bracing for more turbulence as storms and a shutdown cripple flight schedules. We're going to bring you the latest coming out of the region next. Stick with us. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in in improving.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. We are 43 minutes into today's session, and you're looking at green across the screen. It's risk on this Monday morning. The stock 600 up more than 1%, and futures pointing much higher stateside too. S&P evening up 0.8%. Why? Well, there are signs that we may be getting towards a shutdown breakthrough. We had a little one over the weekend, and the US, though, continuing to experience flight chaos. More than 10,000 delays and cancellations on Sunday alone. We can come through some of these consequences now. Bloomberg's Lean Rashdan, joining us for more. Lean, just talk us through the scale of this disruption here. Is it that people are not going to get home for Thanksgiving?
Well, it seems that Sean Duffy thinks, the U.S. Secretary of Transportation, says that, if the shutdown continues, it's likely that travel during Thanksgiving will come to a virtual standstill. And we're still 2 weeks away from that. In the meantime, today, to give you a bit of context, yesterday, Sunday, had the biggest cancellations, the 11th biggest cancellations in flights for this year, 2025. And that's because, of course, the air traffic controllers are not getting paid, so they're not coming in, and that's likely to get even worse. And there's been decades of hiring shortfalls in these airports. Chicago, one of the biggest airports, is also they're facing a snowstorm. So there's a lot of factors making these disruptions worse.
Lena, how long do we expect the cancellations to last? Do we have any insight on that?
Well, as long as the government shutdown continues, it's unlikely that air traffic controllers are going to start coming back if they're not getting paid. And as we go into the holiday season, they're more likely to just stay at home, and that's something Sean Duffy said as well. A4A, an airline trades group, estimates that the U.S. economy is losing between $300 to $600 million each day that we're having these disruptions, and airlines are going to, of course, there's going to be some impact on them because of having to rebook all these people, having to deal with all these delays. It's not clear, and it will all depend on the government shutdown.
Lean, say it ended today, how long would the effect be? Because I was also listening to Sean Duffy talking about the fact that ATC controllers are quitting. We're seeing a lot of retirees. That's picking up. That it's going to be harder to get back. How long could the effects of this be if we see even the shutdown ending this week? How long would it affect the airline sector for? Weeks, months? Give us an idea.
Well, this is kind of unprecedented, situations. This is the longest shutdown, but it is also coming, off of COVID. We don't have that many air traffic controllers in the U.S. They're suffering from it. It's going to take some time for the airlines to be able to recover, and we're going into the busy season. So it's, these situations are kind of unprecedented, and we're just going to have to see how things work out. It's unlikely that the second that the shutdown, if they end the shutdown, that it's all going to get resolved. There's still people who have to be booked again. There's delayed flights, and there's a ripple effect on the aviation, sector in general in the U.S.
Very nice, Lean. Thank you very much indeed. Lean Al-Rashdan joining us from Dubai on what we are watching in terms of the US aviation sector, part of our fantastic aviation team. Let's talk about what is happening actually in Washington right now. The US Senate taking a step towards a reopening of the government. Several Democrats breaking with party leaders to side with the Republicans to pass a deal aimed at ending that shutdown. So we've got a procedural vote which happened yesterday, which means that basically we can get the main vote coming through. Now, President Trump says both parties are getting very close to ending the shutdown. Let's figure out just how close we are. Bloomberg's Jill Desis joins us now. Jill, what did we learn yesterday, and what does it tell us about how close we really are to an ending of this shutdown?
Well, Guy, there's certainly some obstacles that they have to overcome, but it does seem like they're at least on track to potentially end the shutdown. This procedural test vote that took place late last night in the U.S., so this was the Senate voting 60-40 on something, they'll ultimately revisit it Monday morning in Washington, but it does seem like the Republicans have garnered enough votes from moderate Democrats in the Senate to ultimately move something forward. After this, of course, it would have to go to the House, where Republicans already have majority control. So maybe not as big of a hurdle there, but I do think the big thing that you have to watch out for with this upcoming vote that is potentially happening Monday morning is whether there's any kind of an action from even a single senator that could potentially delay things through some sort of a procedural vote. They couldn't necessarily stop the vote altogether, but there may be some sort of procedures in place where it could take another couple of days as they kind of drag this out. We'll see whether that actually happens, but again, it does seem like, all things considered, maybe they've actually sort of reached some kind of a breakthrough here where they could be on track to have the government reopen.
So how hard could it be, Jill, to get this bill through the House? What would be the obstacles there?
Well, I mean, at this point, you'd have to be looking for if there's any reason from any, I guess House Republicans really to not pass something through. There's obviously different factions that you'd ultimately, want to take care of here. I think probably less so again on the Democrat side, just because it is those House Republicans that do have control of that chamber of Congress. But again, I think we're still kind of looking for any kind of an action, particularly as we await the Senate vote that could upend things, because at the end of the day here, remember the moderate Senate Democrats that ultimately came over to pass this procedural test vote last night, I mean, they didn't really get a whole lot in terms of major concessions. You've had a pledge from Republicans that there will be a vote on a bill sometime in December on some of the key issues that they're looking for, specifically that issue of extending those Obamacare premiums. That's some of those benefits that was really kind of at the heart of one of the major issues that Democrats were pursuing here that led to the government being shut down. So I think we're all going to have to wait for Washington to wake up and kind of see where things ultimately continue there. But again, it does seem like, without, knowing whether there's going to be any kind of an extra hitch there, that they are taking a pretty meaningful step toward bringing this government shutdown to an end.
Jill, you mentioned one of the concessions or potential concessions that Democrats had set out to actually achieve, these ACA or Obamacare extensions. It felt like economists, at least day 20 into 41 days of a shutdown, were saying that if we don't get these extensions, some of the healthcare costs would show up in the inflation data. Here we are, day 41 of the shutdown, talking about potentially not getting the extensions at all. Do we need to be more worried about inflation in 2026 that's stemming from the healthcare?
I mean, that does continue to be a concern, right? Because I think at the end of the day, too, it's not entirely clear whether or not that vote, one, goes forward or whether it passes. I mean, this was something that, was a sticking point for Democrats just throughout the duration of this shutdown as they were trying to bring up these negotiations. Getting a pledge for a vote doesn't necessarily mean that you actually see those premiums extended, right? So that does, I think, will continue to be a concern there. Whether that ultimately leads to continued negotiations or what a vote actually looks like or further discussions look like in December, I think remains to be seen. But yeah, it is something that I think kind of lingers in the background there as a major policy concern, as we head forward.
All right, Bloomberg's Jill Desis walking us through the state of play over in Washington. We thank you so much. In the meantime, let's get a little bit of a check on what's going on in the week ahead, because there is actually plenty. It feels like kind of a slow start to the week, but there is plenty going on. On Tuesday, we have Veterans Day in the United States, Armistice Day here in Europe, but you are seeing the U.S. bond markets close. That's going to be significant, plus UK jobless claims on Tuesday as well. On Wednesday, German CPI, the Treasury Secretary Scott Bessent's going to be making some comments as well, plus votes in France and at the EU level as well when it comes to the budget. So maybe potentially some market action there on Wednesday on this side of the Atlantic. Thursday, it's all about the UK. UK GDP with a fun combo of Disney earnings. Guy.
Can't wait. Disney earnings. Always a highlight.
I'm tempted to ask you what your favorite Disney princess is, but I feel like you wouldn't have an answer.
Don't give him that out. Come on, Guy. What's your favorite Disney princess?
Yeah, Guy.
Can you name one?
This is what happens when you anchor with three girls.
Not going down this road. Plead ignorance. Yeah, it's Frozen, isn't it? That's the way we go. Is that Disney?
Elsa? Yeah. Oh my God, I'm so proud of you.
I'm really impressed.
This is excellent.
We'll leave you alone now.
Excellent. My job here is done. See, Valerie Titel's just sat down and been a little mean, so I'm wondering where we go with this. Okay.
Well, perhaps maybe to talk about what was not on the week ahead and what could potentially be, and that could be a non-farm payroll release on Friday.
You're really excited about this, aren't you?
Yes, I am. Data.
This is like, I forget Disney. This is data. Data is Valerie's Disney.
I don't know how you've lived so long without payrolls. Your favorite day.
Favorite Friday of the month, right? And we could get a resumption not just of that October release, but we could also get two at once from the BLS. If they are in a rush to get this data backlog done, especially given we have the Fed meeting on December 12th, they probably want to clear that backlog in a decent slate.
Are you going to believe the
decision.
data?
Well, okay, this is the big question, right? We know that the first payroll release that we're missing, the one from October 3rd, was done before the shutdown, so it wouldn't have anything in there.
Ignore that.
And then possibly could be some errors in the previous month's shutdown. So that could potentially be a reason why they would want to release more than one at one time, right? In a way to try to catch up the market, so that on December 5th, when we do get the November release, maybe the market would believe that was a clean set of data. But it's not just NFP we're waiting for. We also have retail sales. That's a good indicator on consumption. GDP for the third quarter has also been a missing one as well. And then the weekly jobless claims. You know, we have been tracking those state level ones. It would be nice to see.
Are we going to get some volatility around all of this, though?
I guess that.
Yeah. That's why we love it.
Yeah, and also keep an eye on the private numbers as well at the moment. But loads of Fed speak this week too, because we're not sure if we're going to get a December cut.
No, I think that was the real key thing from last week. Yes, we did have the equity market disruption. A lot of that could be tied to the fact that the Fed was surprisingly hawkish, and perhaps if we don't get a clear picture on this data, if this data backlog isn't relieved before December 12th, the bar for them to be incrementally dovish, I think, really isn't there. They need more data in order to sound dovish. Now, remember, also the Fed is tracking CPI, but the November CPI is something we are now not unlikely to get. The BLS hasn't been collecting the data, and I highly doubt they'd want to just extrapolate from the online data that they've been able to scrape instead of those knocking on shop doors asking for prices, that kind of data. So we could get a lot of interpolations in the next few months CPI print, and that could be something, again, you know, the market could use to its advantage to argue which way it wants.
Yeah, always does. So my question is also, if the tariffs get tossed out, what does the Fed do with that? Is it inflationary? Is it disinflationary? Is it like, it just adds to the confusion?
Especially when they're now ramping off or taking their foot off the pedal of the QT story.
Yeah, well, I think the Supreme Court decision really isn't black and white. It's not just a yes and no when it comes to this. It's how are the repayments going to be handled. It's whether they chuck some of these decisions back down to the International Court of Trade. Yeah. There's a lot of unknowns that could come out of this, but we have seen estimates from some researchers. Evercore ISI was out saying that nearly 80% of the tariff revenue could be covered by other means outside of IEEPA. Now,
but there's going to be some churn within that.
That does vary differently across the street. So I think this is something to keep an eye on. It's just, if we do get a disruption to the tariff, just how much percentage-wise can the Trump administration still collect?
Bloomberg's Valerie Titel bringing us a little bit of optimism and a little bit of gloom.
You haven't answered who your favorite princesses are, by the way. I'm just going to point that one out.
We'll hit that in the next show. In the meantime, don't miss an exclusive conversation. St. Louis Fed President Alberto Mussolem, 2:30 p.m. London time. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress-testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Well, the U.S. Senate takes a major step towards ending the longest government shutdown in history as a group of Democrats breaks ranks to support a deal. TSMC adds to the uncertainty around the AI boom as chipmaker reports slowing growth in monthly sales, plus Chinese consumer prices rise unexpectedly, boosted by holiday spending. Analysis by Bloomberg suggests that deflation is worse than officially data shows. Now, this is the picture across the board. Look, it's going to be a busy week. It's only Monday, but there's a little bit of optimism out there, so you can see it cross-asset. S&P futures gaining some 0.9%. There's also quite a lot of movement in a lot of the commodities, including gold, silver, and copper, all a little bit higher. U.S. Treasuries falling across the curve. Now, there is that optimism simply because lawmakers are moving, we understand, closer to a deal ending the longest shutdown in U.S. history, and that's definitely spurring demand for some of the riskier assets. The European markets map, let's get straight to that to see what the difference is, for example, between a CAC 40 and a DAX. You can see the CAC gaining some 1.1%, the DAX 1.5% higher. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone. Happy Monday. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. Senate took a major step towards reopening the government after several Democrats broke with party leaders to side with Republicans to pass a deal aimed at ending the shutdown. President Trump sounded an optimistic note on making progress.
Looks like we're getting very close to the shutdown. We'll never agree to give any substantial money or any money to really prisoners, illegals that come into our country. And I think the Democrats understand that. And it looks like we're getting close to the shutdown ending. You'll know very soon. Thank you very much.
Well, very own Rosalind Matheson now joins us to make sense of all of this. So, Roz, thank you for being here. What are the key provisions of the deal?
Well, as you were saying, a group of Democrats has broken ranks to see if they can get this deal through. And what it would do is ensure funding for key agencies and departments, including Congress itself, but also Department of Agriculture, Department of Veterans Affairs for the full year, and other agencies through the end of January. It will pay those furloughed workers. It will recall employees of agencies who've been laid off during this shutdown. It would resume federal spending for state, which is obviously very important. So what it would do, in essence, is start to ease those pain points that we've been seeing across the US, across workers, their families, and the economy during this shutdown so far, which, as you say, has become the longest one in history. But what's missing from this bill, and this might be the tension point really in getting it through the House, is there's nothing that's baked into this bill about extending those tax credits for Obamacare, and that's kind of the medical insurance credits that people have been getting and are relying on, and that's been really popular with US voters. There's nothing in this bill about that. There's a promise, apparently, to have a vote on it in December, but a promise is quite different to having something baked into a bill, and that's the biggest omission.
Roz, what comes next for the legislation, and could the shutdown actually be over this week?
Well, possibly, but there are some steps to walk here. So first of all, it has to get through the Senate. There was a procedural vote that obviously cleared the way. We don't know exactly when that vote may happen. Maybe it happens on Wednesday, but then it's also got to get through the House, and the House has to be recalled for that. And there it's obviously much more tricky because you've got a lot of Democrats who'll be unhappy at where it leaves, again, those extensions for the tax credits for Obamacare, perhaps aggrieved at their own colleagues for breaking ranks on it. Could they hold things up? I mean, even one senator can, in procedural ways, hold things up for days in the Senate. So there's no guarantee it will get through by the end of this week. There's obviously a goal to get it through as soon as possible, but you've got a number of potential roadblocks there along the way, and it's not guaranteed at all to get through the House.
Rose, thank you so much. Rose Matheson there with the very latest on the shutdown. Also on point when it comes to close. Now let's turn to the markets and bring in Bloomberg senior equity strategist Mikael Msika and Sophie Hune, portfolio manager and strategist from BNP Paribas Asset Management. I love that everyone on TV today is wearing red, which of course means that the market's seeing risk on. They're all in the green. Sophie, first of all, there does seem to be a little bit of hope actually on the markets that the government shutdown comes to an end, and then we can, I guess, go back to focusing on AI valuations. What do you think will support the market going forward?
I think there's the risk that we could have the right tail risk materializing. So we've been through monetary easing for a year and a half now. Fiscal support is still ongoing. We haven't seen any fiscal tightening anywhere. So there's a risk that start to feed into the system through the interest rate sensitive sectors, but also through consumer recovery. And we're actually starting to see green shoots of recovery in Europe, Sweden, for example. But what if it's going to be broader and we have like upside surprise in the next quarters?
So when you look at the K-shaped recovery, which everyone's talking about in the U.S., what does it? Does it have an implication for AI and AI valuations?
So the K-shaped recovery is basically, at the moment, some people have been left behind because of this AI technology innovation and what we're going to see. I think the fact that we still have a K-shaped recovery is actually a positive sign for AI valuation, meaning that we haven't seen AI yet feeding throughout the different sectors and throughout the economy. So I'm more hopeful on that than I would say the street.
Mikael, you focus a lot on all of the earnings and a lot of the companies. Like, what are you seeing overall?
So, especially in the US, the earnings season has been really good. It's been really good in Europe as well. The bar was lowered again before the season, so it's not so much of a surprise. What's interesting is valuations now, you were talking about that earlier, they're a bit stretched, especially when it comes to the tech sector in the US. But actually, like every single time, bubbles, that there is one when they pop and not before, and it can go on for a very, very long time. At the moment, they're delivering earnings, and the growth is there. So we still see signs of stress on the earnings side. I mean, if you look at capex commitments from the AI hyperscaler, for example, they're huge. It's expected to be like 80% of their cash flows next year. There's a point where it's going to be stretched. It's already looking a little bit stretched.
Sophie, I mean, you also have an interesting point when you look at tech and financials. You basically argue that S&P 500 profit margins should have been flat for the past 2 years, but then everything's kind of changed because of AI investment.
Exactly. So if you look at profit margins, we're nowhere where we were back at the peak of the tech bubble. So if you try to calculate the 12-month forward P for the S&P adjusted for profitability, the S&P would be trading only 17 times. Versus the 22 times that is used as a comparison for the tech bubble. So I think for now everything looks good. But it doesn't mean that some stocks are showing signs of like frothy valuation. But at the same time, I also feel that if you're not on board with this AI innovation and also transformation, there's a bigger risk to be left behind than overspending.
Sophie, I mean, overall, how important, the Fed is also having these like stabs in the dark because they don't have the data. So I know we've been relying a lot on the private data, but is this going to be the biggest game changer if we have the end of a government shutdown? Is finally we'll have to get proper data, and that could really change what we're expecting from the Fed because of the U.S. consumer.
So if you look at U.S. consumers, so through alternative source of data, so consumer credit card or the equity market, so consumer discretionary core weight versus the market, or consumer confidence, it's also quite low. So I don't know how much the data could bring on the table and say it's much higher or worse. So we are going through these ongoing non-recessionary cuts that is going to keep feeding into the system. So I just think that unless we have consumer demand feeding into banks' credit risk, for now it's still looking good.
Michele, what can you tell us in terms of earnings season? So Sophie says the bar was low, so we'll get to that in a second. But actually, was there a material difference between being a U.S. company and a European company?
So the big thing was tariffs, like how the tariff would feed into earnings and how a company would navigate that tariff, that new thing, which was tariffs. And actually, from what we see, from what we hear, they've been managing pretty well, whether it's in the US or in Europe, through different things, price hikes, cost cutting. Generally speaking, it's been okay, and I think that's what's been reassuring investors over this earnings season, both in the US and in Europe. So at the moment, we don't see a lot of stress. There was like we said, the bar was low. There was a lot of pessimism about European earnings this season. There was supposed to be like -1% or like 0. Actually, we're tracking low single-digit growth. In the US, it's stellar thanks to all the tech sector. But yeah, overall, pretty positive.
Pretty positive, but you think, Sophie, that the bar was low, which I like the way you put it. So we weren't expecting too much of this earnings season overall.
The bar was very low. So if you look at for Europe, the expectations were really low. So if you look at EPS surprises for US, the US market is beating by 7%, Europe by 1%. I think the point that Michael was saying, as in like cyclicals have beating defensive in terms of earnings, I think the impact of tariff have been a bit overestimated. I think we're starting to collect a bit the benefits this year.
What's your take, Sophia, on the energy sector?
So the energy sector, in my view, is one way to potentially play the right-tail risk. So much pessimism there. Everyone is bearish on the sector and also on the oil price, where the OPEC supply hikes, I think, is very embedded in the price. There's no geopolitical premium that is reflected on oil price. Yeah. So that's how I started. If you start to have the right-tail risk feeding into the economy, we have some mini cyclical recovery. The energy sector and the oil price will be the start to reprice higher.
Has this changed also a lot of the outlooks for the companies? So do you look at it, Michael, through this sector, or is it actually just how much energy costs will have to go up for a lot of companies?
So there's two things. The low oil price is a positive. It's a tailwind for a lot of companies like chemicals or companies that are like use a lot of oil to produce their products. But at the same time, as a market, energy earnings are very important for Europe, and so low oil price is not a really good thing. And that's actually one of the reasons why Goldman Sachs strategists are more pessimistic than the consensus for next year. That's because they forecast like between $50 and $55 a barrel for next year. And that will feed into European earnings negatively on that side, just because oil companies are important for Europe.
Michele, also Diageo, I mean, it's gaining the most in 5 years. They have a new CEO. Feels like a big deal.
Well, you know, there's one thing. We're talking about defensive and cyclicals. The defensive stocks, all those beverage companies, they've not doing so well lately. So at the moment, like there's a lot of switch between cyclicals and defensives. And any good news on the defensive sectors, whether it's beverage, foods, are creating a lot of demand. Just like either it's short covering or like rotations. We see a lot of that.
Okay, and finally, Sophia, what do you do with gold?
We're still long. We've been long since July 23, so it's been an amazing call. So we have this multi-year trend view in mind, but we want to play the short-term ranges. And it's clear that the fact that it has become a much more financialized asset, there's much more volatility, so we want to leverage that too. But yeah, we're long.
Okay, fabulous. Thank you both for joining us. Bloomberg Senior Equity Strategist Michele Msika and Sophie Hune, Portfolio Manager and Strategist from BNP Paribas Asset Management. Coming up, world leaders left COP30 in Brazil, agreeing efforts to tackle climate change are moving too slowly. We'll be joined by Goldman Sachs' EMEA Natural Resources Research Head, Michele Della Vigna, to discuss the energy transition. That's next, and this is Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Season is here.
It is a busy week for earnings.
More buybacks, more dividends, margin compression.
Bloomberg is first to break the numbers.
We have some earnings crossing. We'll bring you Deutsche Bank, UBS smashes Santander, beats on net income. Investors brace for more earnings.
Let's get the reaction and context.
With the smartest insights.
Maybe this German fiscal stimulus is going to start to hit the economy and come through in corporate earnings.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, Novo Nordisk shares are higher this morning after it bowed out of a race to buy the American startup Metsera. The obesity drug maker has agreed a $10 billion deal with Pfizer after a tumultuous bidding war. Now, for more, we're joined by Bloomberg's senior healthcare reporter, Naomi Kresge. Naomi, so good to speak to you. So was this a must-win for Pfizer, and what does winning mean for the company?
Yeah, this was really a must-win for Pfizer and for Pfizer CEO Albert Bourla. But he's facing patent expirations that will probably cost the company $15 billion in sales by the end of the decade. And he really is in the market for assets that can help him recoup that and grow despite this. And they have tried several times to develop obesity drugs inside their own pipeline, and each time it hasn't worked out. So this was really a deal that enables them to vault back into a market that they had failed to enter under their own steam.
So, Naomi, where does this leave Novo? And actually, will Novo's CEO keep doing deals?
He has signaled that he will. He sent out a letter to senior managers over the weekend to his executive team saying that, they will keep on looking for assets, keep on looking for things that could be complementary to Novo's portfolio in obesity and diabetes. I think we're anticipating them to look at deals that could help them address diseases that are linked to obesity, to comorbidities. So definitely they'll still be looking in this space, looking at everything in the space.
Naomi, thank you so much. Bloomberg senior healthcare reporter there, Naomi Kresge. Now, COP30 is underway in Brazil, and over the next few weeks, negotiators from nearly 200 countries will be thrashing out how best to cut emissions. A topic central to discussions will be the AI boom, which poses a new challenge, with the power demand from data centers expected to quadruple within the next decade. Well, joining us now is Michele Della Vigna, head of VMA Natural Resources Research at Goldman Sachs. Michele, thank you so much for joining us. I know you're also here to actually work on a conference called Carbonomy, which is see how do we get to net zero. First of all, are we on track? Are companies willing to do what it takes to be on track?
I think the focus is completely changing. I think we've mostly spoken about energy transition in the last 5 years. I think when we look at the next 5 to 10 years, it's more likely to be energy addition. We need more and more energy. We can't yet give up hydrocarbons, but we need to add renewables. We need to add new ways to be off-grid for some of the big data centers with things like fuel cells, with nuclear. I think the focus is shifting away for the moment from pure decarbonization to growth. It needs to be sustainable growth, but the focus is clearly growth for the coming years.
What does that mean, Michele, in terms of changing the perception or the investments that company put in place?
I think it changes completely the way we look, especially at some of the incumbent energy companies. It's no longer about how do you shrink your core business. It's about how can you grow it, because energy security is paramount, and on top of it, create new businesses in low-carbon power. And it's extraordinary because energy always used to be movement and industry. Now energy is becoming intelligence. And that is a completely new world. And I think companies need to adapt for it and have growth strategies for it. And that's why I think the sector is so exciting at this point in time.
Michele, how do you see it changing exactly?
Well, first of all, we haven't had power demand growth in the West for a decade, and now it's coming back. That means new grids, that means storage, that needs new power generation, and all of that will require also more natural resources, gas especially, but also oil, uranium. All of this, I think, creates a new growth mentality that, by the way, still needs to come through for a lot of these companies that have mostly just focused on dividends and buybacks for the last 5 years.
But Michele, first of all, do we have enough of the stuff? Because actually, if we're going to keep up with the AI demand, it doesn't look like we're going to do it right now, especially not in a sustainable manner.
Yeah, I agree. I think we have the resources, but the problem is we've underinvested. Look, for instance, in things like oil. On our analysis, the reserve life of oil companies is down 25% in the last decade. They haven't explored. Look at things like grids. We need a major step up in investment, and we need much faster permitting. What I find fascinating, for instance, when I look at the US and different states, is that in some way, in the energy transition, a state like Texas has been more successful than others because they have quick permitting. I think it all comes back to permitting and the ability to build the infrastructure.
So where do you see, with OPEC actually making decisions that always get questioned, but in the end, it always feels like they didn't mess up. They actually always got it right.
Absolutely.
How do you see demand for oil products going forward?
Demand keeps growing. I think the view that peak oil demand is this decade, I think has to be totally retired. We think peak oil demand is well into the 2030s. And for that, we need more resources. We need more production. We've seen a very resilient oil demand growth this year. I think we will see it again next year and the one after. Unless there is a recession, oil demand will continue to grow. But the problem is when we look at non-OPEC supply, it's growing this year, it's growing next year. But after that, we think it goes into permanent decline. And that poses a serious challenge to the market and an amazing opportunity for OPEC.
But is this because of shale in the U.S.? I mean, you have so many factors, right? There's Russian oil that now got sanctioned even more.
Yeah.
But also we don't really know what to do with the U.S. shale because they have to break even at a certain point.
Yeah, I think it's two things. Shale, like every basin, after 15 years is maturing in a very graceful way, but it's maturing and is going ex-growth. But also the rest of non-OPEC is now bringing on stream all of the big projects that it committed to pre-COVID, delayed, coming on stream, but it didn't replace that pipeline of project, which means that after this big growth in the next 12 months from Brazil, Norway, Guyana, etc., there really is only decline from 2027. And that will be challenging, especially in a world that keeps growing.
I mean, what does it mean? I mean, if you look at this equilibrium, can actually renewable energy take the mantelpiece, right? So if there's less of, fossil fuel or oil, can they make up for it? But at what cost?
I think at the moment, renewables work perfectly with natural gas. That is a stable system that manages intermittency and seasonality and is lower carbon than any power system we have at the moment. I think that is the system of the future. And in many ways, again, a state like Texas has shown what a success story it can be. But we need both. If we only push on renewables and forget natural gas, we have intermittency problem. If we do the opposite, it's expensive and higher carbon, which is why I think the two very much go hand in hand.
But even if you look at renewables, is there enough of the natural resources that need, right? So rare earths, again, they're not that rare, but it's quite rare to mine them in a certain way, but also copper.
Yeah, there is, but it's very dependent on few countries, especially China. There's no doubt that the solar revolution of the last decade has been almost entirely reliant on China. Are we happy for that to continue or not? That is a key question. We've done an analysis to look at what tariffs would be needed for a local industry to be developed in Europe and the US that substitutes China on some of this equipment. And it would be big numbers, like 50 to 100%. So clearly this is a material question.
Would we have the money?
Yes, but it would make decarbonization 30% more expensive. So this is a give or take. We can build a local supply chain, but then decarbonization is 30% more expensive. There's no win-win.
What's the right way to frame COP30? What do you think can actually be achievable from leaders in a meaningful way without making promises that never come to anything?
I think in this period of political division, I think it's very important to be very practical and focus on practical solutions. So first of all, I think carbon markets are very important, and especially giving a new life to the voluntary carbon market and enabling the money from the West to be spent in really cheap decarbonization projects in emerging markets, I think is absolutely key. Second, I think focusing on the efficiency of the current industrial plants, especially on things like methane emissions, making natural gas lower carbon, more reliable. I think those can be practical wins that can get us at least a few steps closer to net zero.
Michele, thanks so much for joining us. Michele Della Vigna, they're head of EMEA Natural Resource Research at Goldman Sachs. Now, coming up, we discuss how the German machine tools and laser tech company called Trumpf is handling the geopolitical uncertainty. We hear from the company's chief technology officer next, and this is Bloomberg.
relief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. Senate takes a major step towards ending the longest government shutdown in history as a group of Democrats breaks ranks to support a deal. TSMC adds to the uncertainty around the AI boom as the chipmaker reports slowing growth in monthly sales. Plus, Chinese consumer prices rise unexpectedly, boosted by holiday spending, but analysis by Bloomberg suggests that deflation is worse than official data show. So snowy weather is adding to the air travel chaos in the U.S. 10,000 flights were canceled or delayed on Sunday alone as bad weather in Chicago compounded the disruption caused by government shutdown restrictions. Well, Bloomberg's aerospace reporter, Leen Al-Rashdan, joins us now. Leen, thank you for being here. So how bad is the disruption and how much of it is actually tied to the FAA staffing crunch from the shutdown?
Good morning, Francine. So we have over 10,000 flights canceled or delayed for yesterday. Today we're seeing over 1,400 flights are canceled. A lot of it is due to the government shutdown. Air traffic controllers are not being paid, so they're not coming into work. And this is coming on decades of staffing shortages in control towers. This is an issue we've faced since COVID. And like you mentioned, on top of that, we have unfavorable weather conditions, especially in Chicago, where we have a storm, and that's one of the biggest airports. Delta is really struggling in their hub in Atlanta. It doesn't seem like things are getting better, and we're just waiting to see if the shutdown ends or not, and how that will have a ripple effect on aviation the next few days in the U.S.
So how likely is a Thanksgiving travel meltdown, and what is actually the potential economic hit if these cancellations continued into Thanksgiving?
Well, the U.S. Transportation Secretary Sean Duffy thinks that it's very likely that travel during Thanksgiving and the holiday season will come to a virtual standstill. Air traffic controllers are even less likely to come in if they're not getting paid during the holiday season. And this is going to have, the Trump administration said they would expect a negative fourth quarter, and A4A, an airlines trade group, said that they estimate between $300 to $600 million in losses each year, and clipped from the U.S. economy, each day that the shutdown continues for.
Thank you, Lena. I'll rush down there with the very latest on this U.S. air traffic situation. Now, geopolitical uncertainty and the slowing global economy have dragged on a revenue at Trumpf, a market leader in machine tools for industrial manufacturing. Now, the German company see cautious signs of recovery and adapting some of its strategies, including a pivot into the defense sector, using its laser technology to help defend against drones. Well, joining us now from Berlin is Bertolt Schmidt, the company's Chief Technology Officer. Bertolt, thank you so much for being with us today. So first of all, how's the company doing? What are you most excited about in the next 12 to 18 months?
Yeah, good morning, Francine. It's a pleasure to be with you. As you know, Trumpf is a technology-driven, family-owned high-tech company that is around for more than 100 years. And for the last decades, our key drivers were the machine tools and industrial lasers. And over the past 10 years, we have added what we consider another pillar in our growth strategy, which is the semiconductor market. And here we provide systems and subsystems to key technology players in this industry. And we have grown this section to around 1 billion euro in sales, which makes something like a little more than 20% of our overall revenue. And our clear plan here is, in this market, to outpace the general growth with our key customers. And I think with the technology we have developed over the years, we are well set up here.
Mr. Schmidt, can you give us a sense of actually, what happens with defense? I know it was end of October that you signed or you announced a partnership to try and develop your laser, solutions for defense purposes. This feels like a sea change. So what kind of timeline do you want to have these systems in place to actually protect against drones?
Yeah, I think first of all, I need to point out that going into this activity is not for fundamental business reasons. It's really a core belief that also Trumpf has to provide his share in making our country, Europe, more protectable against attacks, and therefore we decided to make that step. Just a pure timeline on developing these systems, as was pointed out during our last press conference, with more than 2 to 3 years, shows that this is not a reason for making fast money. It's just a fundamental belief that we want to play an active role in this area.
Trumpf has also come up with a new semiconductor strategy this year. What's new and what can you tell us?
I mean, the semiconductor strategy, in contrary to defense activities, is really a core part of our growth strategy. Here, we are working with the core players in the market, like ASML or Applied Materials, to drive the next generation of hardware systems that will power the further surge of the AI industry. And I think that's something we continue to focus on. We work with our key customers. We have our engineers at their R&D labs. We try to push the boundaries of technology forward. And when you think about, we have more than 150 different projects in this field currently ongoing. It's quite a significant part of our growth strategy.
When you look at, the rare earths export controls, which are looming, although they're relaxing a little bit, what are the possible effects on your supply chain? How are you dealing with this?
Yeah, I wouldn't say it's neglectable, but we have only a limited exposure to these rare earth materials. Nevertheless, we need to naturally look at the current developments in world economy here. We try to protect ourselves by having an increased stock build. We try to establish multi-source agreements. We continuously monitor with our supply chain organization the actual developments in this industry. And therefore, I personally believe that, in particular, Trumpf is well protected to cope with fast changes in the market. If there is a fundamental, totally change, naturally, we also have a new situation. But looking forward at least to the next 12 months without any significant changes, we feel well set up here.
Mr. Schmidt, I mean, it's so interesting, hearing you talk about the fast change. It feels like everything is changing on a day-to-day basis. So how difficult is it to set strategy and priorities when things are moving all the time?
That's a good question, Francine. I think when you play a significant role in the semiconductor industry, then you're used to fast changes. I mean, we always see this industry going up and down in fast-changing cycles. So this must be part of our general business strategy. We tackle that by implementing high level of automation in our production lines so that we can breathe with the requirements of our customers faster. These systems, meanwhile, are AI supported, and I think in that way we create a very sufficient supply chain on top of being really on the edge with our technologies to help our customers to bring the leading products into the market.
Mr. Schmidt, when you look at the ability for TRUMPF to actually build on your own supply chains, how does that change? Are you looking to be more self-sufficient? I know, for example, one of your customer is a Dutch chip maker, ASML, and they're constantly being taken in all of this. So I wonder also how your relationship with them is.
Yeah, I mean, with ASML, we have a very tight relationship here. If you think about that, ASML provides this EUV lithography system, which is considered being the most complex technology system in the world into the market. And our share is not insignificant. I mean, we are providing the laser light source here, which is a very complex technology by itself. The laser by itself weighs 20 tons and consists out of 450,000 piece parts. So you can imagine that is quite a significant share we are providing here. And this is naturally putting us on some challenges regarding the supply chain, but we are really able to cope with that. By the way, that's not the only part. We have here multiple very complex systems we are supplying to other wafer fab equipment manufacturers in this industry, which have similar challenges. But so far, I think we have a very forward-looking technology and supply chain roadmap that helps us to cope with these challenges.
So interesting. What a pleasure to speak to you. Mr. Berthold Schmidt there, the Chief Technology Officer at TRUMPF. Now, consumer prices in China rose unexpectedly in October, but economists say it's likely to be fleeting, with the deflationary pressures remaining entrenched. For more on this, Bloomberg's Jenny Marsh joins us now from Hong Kong. Jenny, so why is CPI up for October?
So, yeah, it was a big surprise. CPI went back into inflation in October. I think economists agree today it's probably not going to last. China had a big national holiday in October, the Golden Week. So all of the country was off work, out spending, sort of traveling, visiting relatives, and that's really driven up the prices just for that month. And also, interestingly, economists are saying today as well, the surge in the price of gold is also having a big impact on core CPI here. So there's sort of a few kind of underlying factors. When you look at PPI, so producer prices, that was its 37th month of deflation. And so what we are seeing is, the industrial side of the economy saw very much an entrenched deflation. And unfortunately, these consumer prices are still experiencing problems. And I think that the October uptick is just sort of a fleeting sort of bit of good news.
Jenny, Bloomberg's big take today is on the true cost of China's falling prices. So what's the story there, and how does this fit in the overall data picture?
Yeah, so the big take today really is looking at that sort of contradiction between the official numbers sometimes and how deflation actually feels on the ground. And so CPI has sort of been hovering around 0 or slightly below for a couple of years now. But, we're seeing these sort of brutal price wars in China. And so what we did was we looked at about 70 everyday items in China that maybe the consumer price basket doesn't capture. And what we found there was sort of price drops far, far deeper than what the CPI sort of reflects. So cars in this year, 27% cheaper than they were just in 2023. Q3. The price of pears is down 31%, eggs 13%. So you can see there how things feel so cheap sort of on the ground. And that could be a good thing, right? Like, inflation is obviously a very big political problem, and things being cheap could be a good thing. But what it actually sort of does mean is it's transferring through to companies who are sort of having to slash prices to stay in competition. And our analysis showed that 25% of listed companies in China made a loss this year in the first half, and that's a record for this century. So it's really spelling a lot of problems for the Communist Party in terms of sort of job growth, job sort of stability. And so this is a really big problem now ahead for policymakers that they're going to have to try and tackle in the months ahead.
Jenny, thank you so much. Jenny Marsh there with some great reporting on things that you need to know about. Now, coming up as TSMC's sales growth slows, is the AI chip boom finally starting to cool? We'll have more of that next, and this is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Well, the conversations that matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, the BBC's Director General, Tim Davie, is, well, to resign amid allegations that the broadcaster misled viewers by editing President Donald Trump's remarks in a documentary. Wow, the clip made Trump appear to say that his supporters should, quote, walk down to the Capitol and fight like hell. In fact, he said they should cheer on our brave senators and congressmen and women, while the fight like hell remark was from a different part of the speech. Well, News Chief Deborah Turness has also quit over the controversy. So to discuss what that means next for the media landscape, let's bring in Rosa Prince, a UK political commentator from Bloomberg Opinion. Rosa, thank you so much for joining us. So what happened with the BBC and why?
Well, there was a report into the BBC's conduct, not just on this documentary about Donald Trump, but on a range of issues, including the BBC's coverage of Israel, including its coverage of trans issues and other kind of hot button topics that you might say are part of those sort of woke wars. And basically it accused the BBC of bias. There was a bit of a head of steam building. And over the weekend, as you say, Tim Davie and the head of news, Deborah Turness, have both now quit. And it really plunges the nation's broadcaster into a state of crisis, because the BBC is such a national institution here in the UK, but also around the world. So I think a lot of people will be looking to see what happens next and whether the BBC can get itself back on track, restore its reputation as a source of trust and honesty.
Rosa, what are the consequences of this?
Well, big consequences, as I say. Here in the UK, the hunt is on, obviously, for new leadership, and the BBC is due to have its charter renewed. It's at the moment funded by quite a unique source of funding, which is from subscription by pretty much everyone in the country. That has been undermined as the BBC's reputation has been undermined. But I think globally there are other consequences too. The BBC is a voice, it's supposed to be a voice, a beacon of freedom and something you can trust, a trusted source globally. I think that needs to be restored. And then there are broader consequences. For example, Donald Trump, who was very happy about the latest developments. The BBC documentary was perhaps raising some questions, maybe some valid questions about his conduct on January 6th, but instead it's the BBC that has come into the firing line. And I think that's a product of these own goals. I think there were criticisms to be made of that Panorama documentary. Certainly, those were not editorial standards that any news organisation, Bloomberg, would not have done what the BBC did in that case. And also its honesty and approach in other areas. So I think the consequence here is that the BBC really is going to have to work hard to restore trust, and I'm sure that there will be lots of people globally who will be watching what happens.
Rosa, thanks so much. Rosa Prince, our Bloomberg's UK political commentator. Now on to corporate news, and Taiwan Semiconductor Manufacturing has reported slower October sales growth, hinting that red-hot AI chip demand may be losing steam. Now, shares are still up 37% this year, but with valuations stretched and supply tight, investors are watching for cracks in the boom. Well, we're joined by Bloomberg intelligence analyst Matthew Bloxham. Matt, thank you for joining us. So first of all, is this the first sign that AI demand is plateauing? I feel like we ask ourselves this every 2 days, and it's plateauing and then it's not. But could this be really it?
No, I don't think it is, to be honest. I mean, I think if you put it in context, I mean, revenues are up about 17% in local currency, about 22% in US dollar terms for October. It's trending in line with the guidance they gave when they gave the Q3 update. So I think this is where we're expecting it to be. And it will be, well, it was the single largest revenue month for the year to date. So, you know, things are still growing, things are still very good. If anything, you know, for TSMC in the next 6-12 months, it's a capacity constraint issue. You know, we saw that Jensen Huang's been visiting Taiwan, you know, making overtures to TSMC to make sure that they're, you know, still at the top of the pecking order when it comes to the kind of order book. And so that's the big issue for them next year, I think, is bringing enough incremental capacity online quick enough to meet the demand out there. And I don't think they're going to be able to do that.
Matt, we've also heard from the NVIDIA CEO saying, you know, he still sees strong momentum. How are executives kind of reconciling this optimism with these soft numbers?
Yeah, I mean, look, I wouldn't necessarily characterize them as soft. I think what we're seeing, and I think what there's no doubt about, is that companies like OpenAI, Microsoft, Google, Meta are spending huge amounts of real money on real infrastructure, and the biggest part of that infrastructure spend, or one of the big parts, is the NVIDIA and other AI accelerated chips that are going into them, and TSMC is critical to that. So I think, you know, whilst that CapEx spend from the industry is high, which I think is going to be through the next 12 months, possibly longer, then I don't think there's any issues for TSMC here, really. Beyond that, where companies like OpenAI have to start generating revenue, demonstrate there's a business model, that's where perhaps the CapEx model starts to change, and that's where there's a bigger question mark.
But in general, there seems to be like rising competition, right, in the space. That's fair. Yeah,
that is fair, but I'd say that kind of affects more the NVIDIA level than necessarily the TSMC, because all of NVIDIA's competitors, emerging competitors, are also TSMC customers, and so there's a bit of a, you know, bigger battle, if you like, now for the TSMC capacity. It's not just NVIDIA that's demanding it, it's others too.
Okay, thank you so much. Of course, our Matt Bloxham there with the very latest on AI and some of the things we're watching, including TSMC. Now, global stocks rallying following news of a potential end to the longest U.S. government shutdown in history. Let's get more from Bloomberg MLive strategist Venram Ven. So what would a shutdown resolution mean for Treasury yields?
Morning, Francine. I think that, I think a shutdown would potentially have the power to uncork higher yields. But if you look at the swaptions markets, they are kind of pretty muted volatility there we are seeing. They're thinking that, look, I mean, while we are bound to get more data, I think the biggest data point that we've got in the past week is a Challenger Gray report, which showed that, look, the layoffs are the highest in more than 2 decades. So that is weighing on the markets, and the markets are assigning more than a 55% chance of a rate cut in December. To the extent that that pricing shifts, the market volatility will be uncorked. But even if that pricing shifts and the markets say, okay, you know what, the economy is doing okay for now, and we don't need that rate cut, I think that the upside to the 2-year rate is just about 10 basis points from here, because if it goes beyond 368, 370 levels, then that would negate the Fed's easing cycle, which is unlikely. So I think that the 2-year yield is going to be capped at 368 no matter what in the short term.
So risk sentiment overall seems to be recovering. This is partly due to the shutdown, but where do you think then stocks go from here?
Well, I think that stocks have proven that every time there is a dip, there's dip buying, and I think that investors are kind of overlooking the risk of frothy valuations here. And I think that the longer they keep kicking the can down the road, the worse it's going to end. I think this is a bit like the Cinderella story, right, where investors think that, everyone knows that it's going to turn into pumpkins and mice at some point. My only problem, as Buffett says, is that there is no clock in the room, and everyone thinks that they can make a rush to the exit before the stampede begins. And we know from history that's not how it works out.
So, Ven, how do you think it'll work out? I mean, again, this is the impossible question, but I guess with the shutdown closer to an end, we have some more data. So you could also see a repricing of expectations from the Fed, or do you think that what we had in terms of private data was enough?
Well, I think that, if the Fed pricing is priced out, as we were discussing earlier, I think that would give kind of reality check to the markets about higher rates, about the prospect that they can't take lower rates for granted. And also, the markets are overlooking the stress from the credit sector. I think that we have had innumerable headlines in the past month about, things in the credit market not going quite right. And the credit market is priced for perfection. There's just no scope for any disappointment. And that same story kind of translates through into stock earnings, where, we have had many of the stocks priced at 60 times multiples and forward multiples, which is just not sustainable.
But then overall, is there also a big difference between the U.S. and Europe and Asia? I know we keep on talking about, K recovery, but I always love hearing your thoughts on things that may be a little bit idiosyncratic.
They are actually quite different. I mean, quite starkly different, if you ask me, Francine. Because if you look at Germany's aggregate market cap, it's like 64% of GDP, whereas in the US, it's more than 200%. So investors have thrown caution to the winds and chasing US stocks. But here's the stock market. Okay, it's not going to grow as much as the US stocks are in terms of market capitalization. But in terms of growth, if you look at Germany's performance, albeit an economy that is kind of growing below trend, the valuations are so compelling that investors can't overlook them. The same is pretty much the case in the UK as well. UK's aggregate stock market capitalization is just about 100% of GDP. So those are two reasonably priced markets in Europe, whereas you've got US markets running up and away. So I think that, there's going to be a bit of rebalancing between the geographies. And as the froth in the US market comes off, I think Europe will do better.
So interesting. Ven, thank you so much. Bloomberg MLive strategist Ven Ram. Now, there's also an exclusive conversation with the Fed's Alberto Musalem. That's on open interest at 2:30 p.m. London time. Up next, Bloomberg Brief.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Based on the data that you've seen, do you think it's a good idea now for the Federal Reserve to lower interest rates?
The Fed doesn't want to lower rates and appear to be kowtowing, if you will, to President Trump's language. On the other hand, I think there's actually room for them to lower rates. If you look at the Fed's Beige Book, which the Fed reacted to last year when they started lowering rates, I think there's room for them to take action now. And if I were the Fed, I'd start thinking about going ahead and lowering rates. Real rates are very high right now relative to history, and of course we have a pretty significant term premium built into the term structure of interest rates right now.
So let's talk about the Fed's goal, which is 2%. Is that too low a rate to really get to at this point? And does it have to be at 2% or in sight of 2% before the Fed should lower?
They have a credibility issue right now. The Fed has to get to 2% because that was the target that they set. Although they've already started to project that they're willing now to target a range of inflation, which I think is the approach they should have taken all along. But they're going to get to 2%, and I think the trajectory is still in favor of the Fed's 2% target. And what we're seeing on a shorter-term basis is that's where rates are actually going to in terms of the inflation level, and I think the trajectory is their friend.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. An end in sight. Democrats concede on healthcare, setting up for a potential government reopening. Those headlines improving risk appetite, plus Visa and MasterCard adding to market optimism this Monday. And mixed chip signals. TSMC's October sales grow at the slowest pace in 18 months, even as NVIDIA asks for more chip wafers. So after a down week last week for stocks, we have a lot of rebounding to do, and it looks like we might be just trying to do that this Monday. S&P futures pointing to a gain of 1% at the open, NASDAQ 100 futures 1.5%, and more than 1% for the Russell 2000 as well. In fact, we have strategists already talking about next year's earnings season, with just 8 companies this week set to report. Plenty of Fed speak, though, so let's take a look at the bond universe, because we are seeing a little rise across the curve in yields. The 2-year yield still below 360, but that 30-year yield back up to almost 473, and the 10-year yield firmly above 412, close on 413 right now. We also have gold back above $4,000 and Bitcoin rallying once again this Monday morning. All right, let's get to some individual movers. Over to London and Valerie Teitel. Good morning, Valerie.
Good morning, Bonnie. Let's start with a check in the tech space. NVIDIA up 3.5% so far in pre-market trade on this optimism around the U.S. shutdown ending this tech slide of last week. NVIDIA was down some 7% in last week's trade. It's undoing half of that loss with this pre-market move up 3.5%, but broadly, tech is in the green across the globe. Next, let's move on to some M&A activity. Pfizer is set to buy Metsera for a deal that could be valued as much as $10 billion. Now, this is a very interesting price action that we're seeing here. Pfizer is little change, up just 0.6%. Novo Nordisk, who they did beat out for this deal, those shares are up 1.7%, but Metsera in the red, down 15%. Bonnie, I think there was some expectations by the market that Novo Nordisk would keep this bidding war going for the obesity startup Metsera, but with the lack of a counter bid from Novo Nordisk over the weekend, we're seeing those shares of Metsera in the red, down 15%. Lastly, let's talk about the tech trade Rumble. This is a conservative-backed video hosting company, up some 16.5%. They have agreed to acquire a German AI cloud company called Northern Data as they're looking to boost their global AI capabilities when it comes to cloud hosting. Remember, Rumble does host Truth Social. That's Donald Trump's favored way of telling us his opinion and his views on things. But Rumble shares up 17% on the back of this acquisition. Bonnie?
Yes, that Rumble, not to be confused with the boxing franchise. Valerie, thank you so much. Valerie Teitel there in London. And later this hour, Sonia Martin of DZ Bank joins us to discuss the market's pretty pessimistic view right now of the economy. The shutdown offering no relief for treasuries as they rise across the curve after the Senate plans to vote on the plan. Joining us now is Bloomberg's Morwenna Coniam. So, Morwenna, we're looking at a positive reaction in equities. Does that continue even as we await plenty of procedural votes and potential hurdles?
Yeah, so far it has been a very strong reaction in the equity market. Over here in Europe, the Stock 600 is about up 1.4%. That is led by tech, as we often see on these more bullish days, but also really all of the sort of economically sensitive sectors are rallying this morning. So financial services, a lot of commodity-linked sectors, so miners and energy shares are all higher. Positive across the board really as well. We're seeing that reflected in US futures as well, so we are expecting that rally to continue this morning as well.
We're seeing it in Bitcoin too, although Bitcoin might be a separate story. It rises pretty much every weekend, it seems. Gold, though, rising again above 4,000. It's normally a haven asset. Is this a little hedging as well, just in case?
Yeah, that's an interesting one because, as you said, I mean, haven assets like treasuries are actually falling this morning. I think with gold, it has suffered a little bit with a pullback since it reached those record highs. So we're seeing a bit of that coming back. Particularly as with this shutdown potentially out the way, traders are starting to look towards, well, what's next? And that is the prospect of a Fed rate cut, because once we get this next tranche of data that people have been awaiting, really not quite sure what's happening, you know, if it shows a weakening labour market, then that could put that really on the table. Markets now currently pricing in more than a 50% chance of a rate cut in December. So I think obviously as gold is not interest-bearing, that plays into gold's favour. And we're also seeing silver creeping back up again as well. So quite a strong performance there in precious metals, and that is also being reflected in those precious metal mining stocks this morning too.
Yeah, so the VIX is back below 19, but you know, any one senator could potentially force delays for days on this, Morwenna. Is the market being a little too optimistic? Would we see a meaningful retracement, say, of any equity positivity we see this morning if this goes into next week?
I think there is that certainly a bit of a sudden reaction this morning because, as you say, some of that uncertainty seems to have been potentially removed, but it does still linger. You know, there is no absolute certainty of when this will happen or that it will happen, and that is something we may see a bit of a pullback, and, you know, the volatility is likely to, you know, creep back in potentially. I think certainly people will not only be, you know, waiting to see any signs that this is definitely going to happen next week, but also what that data shows, and that's obviously a whole other load of uncertainty as well. So it's certainly, I think, too soon to be completely certain of what's happening. But we'll also have further earnings coming in, which could bolster that equity market further. You know, everybody's very hotly anticipating an update from NVIDIA again, and that could become the driving force once again.
Yeah, plenty of catalysts once again this week. Morwenna, thank you so much. That is Bloomberg's Morwenna Coniam. In Washington, President Trump's suggested tariff dividend of at least $2,000 being clarified a little bit by Treasury Secretary Scott Bessent on ABC.
The $2,000 dividend could come in lots of forms, in lots of ways, George. You know, it could be just the tax decreases that we are seeing on the president's agenda. You know, no tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, you know, those are substantial deductions that, you know, are being financed in the tax bill.
Joining us now is Bloomberg's Brendan Murray. So, Brendan, it doesn't sound like we're going to get checks or anything for $2,000 in the mail unless the Supreme Court overturns these tariff rules, right?
Yeah, exactly. It sounds like Treasury Secretary Bessent was surprised at what the president posted on social media on Sunday about this $2,000 rebate to consumers. Of course, this follows the Supreme Court hearing in the middle of last week, where a lot of skepticism was thrown on President Trump's ability to deploy these tariffs that he has around the world. And so it sounds like to a lot of observers that the president is feeling a bit insecure about his ability to use those tariffs going forward. He sort of lashed out and called anybody who opposes tariffs fools, and is trying to sort of sway public opinion back in his direction by floating this $2,000 tax giveaway to consumers.
Elsewhere, let's move to China, because things are moving on a number of fronts related to China, one of them being these drug precursors to North America that are so contentious, obviously, fentanyl and so on. But it's now telling companies they need to be aware of laws when exporting chemicals. Is that going to help?
Yeah, exactly. So I think what we're seeing is this trade showdown between the world's largest economies is slowly de-escalating step by step. And this is another issue that the Trump administration has been pressing Beijing on. These chemicals that go into making fentanyl, they put a specific tariff. It was initially 20%. Today it comes down to 10%. And so this is just another step in the direction of the two sides carrying out the pledges that they made a few weeks ago in Asia, the two leaders, toward this one-year-long truce that begins right about now.
You have to wonder if these 13 precursor chemicals are all bad, or if we actually need some of them as precursors to some drugs that get made in the United States. But moving to shipping, because China has also stepped back from shipping investigations, tensions easing there too.
Yeah, exactly. These were skirmishes in the broader trade dispute between the U.S. and China, and the U.S. imposed tariffs and fees on Chinese ships and Chinese cranes, and investigated Chinese shipping industry, and Beijing did the same. And so what we're seeing is those reciprocal reactions being unwound now, and a bit of the added costs of shipping to the U.S. and to China being lifted, at least for the next year, while this truce is carried out.
So that's good, at least, Brendan. It should help in terms of inflation and so on eventually. Where should we look to next? What's next in the improving relations, as you say?
I think the main thing to watch for now is how does the trade relationship fundamentally change, if it does at all. We are looking at statistics today that show that U.S. imports, overall imports, not just imports from China, are going to decline in the double-digit percentages for November, December, and into the first quarter. So the question is, the tariffs, many of them are in place. Some of them have been brought down, and there are exclusions to others, but the President Trump has set these tariffs in place, and they are going to have an effect on the overall volume of trade. Now, the big question then is, what does the Supreme Court do? We'll get a ruling from them probably in the next several weeks. By year end is what some of the attorneys involved say. So that could throw a whole new layer of uncertainty into the equation as to how would President Trump carry out the trade policies that he wants to without those reciprocal tariff authorities.
All right, Brendan, thank you so much. That is Bloomberg's Brendan Murray, Trade Czar there in London. Now to other top stories trending on the terminal this morning. Diageo has named former Tesco and Unilever executive as its new CEO. Dave Lewis, who is known for his turnaround of British grocery stores Tesco, will begin in the role on January 1st. Shares of Diageo, maker of Johnnie Walker and Baileys, surged on the announcement. Visa and MasterCard are said to be close to reaching an agreement on a 2-decade spat with merchants. According to sources, the deal would involve making changes to lower interchange fees and loosen rules that require merchants to accept all Visa or MasterCard credit cards. Both companies declined to comment. And the BBC's Director General, Tim Davie, is resigning amid allegations the broadcaster misled viewers on remarks by President Trump. The remarks were in a documentary that aired in October of 2024, where sections of a speech Trump made on January 6, 2021, were spliced together. The controversy comes ahead of critical funding talks with the UK government. Coming up, US shares of TSMC climbing despite a slowing monthly sales number as NVIDIA chases more chip wafers. More on all of that next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Earnings season is here.
Earnings season begins once again.
So much going on.
Bloomberg is first to break the numbers.
From Snowflake, from Pure Storage, from Urban Outfitters, and yeah, from NVIDIA.
Coming up, we'll talk about some of the other earnings that are coming out.
With the smartest insights.
Third quarter numbers are going to be really important. The commentary is going to be important. It's all going to be about margins because margins lead to earnings. And if earnings come down, we have a problem.
You have to come back again soon. This is really excellent.
Continuing coverage on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. TSMC higher in U.S. pre-market trading, even as the Taiwanese chip maker posted slowing monthly sales growth. That's all after NVIDIA's CEO said he had asked TSMC for more chip wafers to meet strong AI demand. For more, Matt Bloxham of Bloomberg Intelligence joins us now. So Matt, walk us through these monthly numbers first. We had been seeing numbers in the 30% and 40% growth range, and we're now down to 16.9, which still isn't terrible, it seems to me.
No, it isn't terrible, and it's consistent with the company's Q4 guidance. So I don't think there's any kind of change in momentum here relative to what the market's expecting. And when you look at it in isolation, October is their single largest ever quarter of revenue. So, this is a company that's kind of growing substantially. And kind of as you referenced there, there's still a huge amount of demand from companies like NVIDIA. So, there's nothing here I don't think to be particularly concerned about.
So just curious about these wafers. Why is NVIDIA still short of these wafers? It doesn't have enough to make the chips it needs?
Well, the way TSMC makes the chips on the wafers, and so then ultimately those chips then get plugged into NVIDIA products. I think that's what Jensen's kind of referring to. And TSMC is essentially capacity constrained. And they're going to increase capacity maybe by 60 to 70% next year, but that still isn't going to be enough for the anticipated demand. And so NVIDIA's now in a kind of a bit more of a kind of bidding war, if you like, for that TSMC capacity, because there are more up-and-coming competitors in the AI accelerator space, including, for example, AMD. So, he's having to kind of make sure that his relationship with TSMC remains strong and that TSMC continue to see them as their priority customer, so that as the NVIDIA demand grows, TSMC can kind of meet that with their own capacity.
Yeah, that's what I was going to ask. I mean, he's going to have to be a little bit more attractive now, I guess, to TSMC, but TSMC is going to want to keep a broad customer base and keep many of them happy. So, you know, how does it prioritize who it gives these wafers to?
Yeah, I mean, it's a bit of a juggling act, isn't it? But I guess ultimately it comes down to, I guess, a mixture of kind of price and existing relationships. So, you know, I think clearly TSMC does have some strong pricing power here, and it's going to be looking at the kind of longer term and, you know, which customers it thinks have the kind of most solid foundation to kind of be partnering with, investing in, and how they can expand that partnership perhaps beyond just a kind of straightforward customer-supplier relationship, and, you know, maybe help to kind of invest in additional capacity, whether that's in Taiwan or, for example, in the US, where obviously Donald Trump's administration is pushing even the likes of TSMC to kind of have local fabrication capability.
Matt, can we move to Apple, because we're reporting today that it's readying a new major satellite feature suite, let's say, for iPhones, and it's going to have that pretty soon. It sounds very exciting, but what kind of things could we be able to access via satellite that Apple is ready to offer us?
Yeah, so this whole kind of so-called direct-to-device trend, basically being able to kind of use satellite connectivity from your regular phone, is a really hot area across the world right now. We've got similar developments in Europe, for example, Vodafone and AST Space Mobile doing something. So Apple has had a long-term partnership with Global Star, which is one of the big satellite providers. Now, their capacity doesn't allow you to do a huge amount. And so I think, you know, there's perhaps the constraint here is perhaps more on the satellite connectivity side than it is on the device side. But, you know, for sure, Apple needs to do some development. You know, right now, there's enough bandwidth to allow them to kind of send short bursty SOS messages, which is an existing feature on the phone. The aspiration, I think, here would be able to kind of give you kind of much more kind of high bandwidth services, you know, kind of so you can kind of use social media, for example, or ultimately do video calls. So I think, you know, there's kind of an evolution to go there. Certainly, if they continue with Global Star, they have limits in terms of how their satellite capability works. Compare that to AST Space Mobile, whose capacity as a satellite provider is specifically designed to work with existing 4 and 5G smartphones. But I think this is a trend we're going to see a huge amount of news about in 2026.
The post-AI trend, perhaps. Matt, thank you so much. Matt Bloxham of Bloomberg Intelligence joining us there. Let's take a look at how we're shaping up early this Monday morning. Well, it looks like we're in for a rebound. S&P Future is pointing to a gain of 1% at the open in just more than 4 hours. We have the dollar index just slightly lower, the 10-year yield rising across the board. We're seeing yields rise, the 10-year yield just above 4.12 right now, as the market perhaps starts shifting its attention to that potential December Fed rate cut. Coming up, we're going to have a look at what else was making headlines in your front page news. That's next. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up on the New York Times, an appeals court ruling against Trump officials who were digging in on cutting food stamp payments to states. The move adding to the chaos surrounding the nation's largest anti-hunger program during the shutdown. Well, late last night, the court denied the administration's request to put on hold a district court order to fund SNAP in full for November. Next up, The Washington Post reporting more than 10,000 flights were delayed and 2,800 cancelled Sunday alone. It was the worst day of disruptions this shutdown. The Post cites Airlines for America, saying that more than 4 million passengers have been disrupted since the start of October.
2 weeks out as we get closer to Thanksgiving travel. Listen, I think what's going to happen is you're going to have air travel slow to a trickle. As everyone wants to travel to see their families, I think we're going to see air traffic controllers, very few of them coming to work, which means, yes, you'll have a few flights taking off and landing at our different airports across the country. But the thousands of flights that happen every day to move people around the country for this great American holiday, it's not going to happen.
And on the front page of the Financial Times this morning, the U.S. broker Robinhood planning to give amateur investors access to a new fund. It'll consist of 5 or more private AI companies whose valuations have vastly increased. Robinhood CEO Vlad Tenev telling the FT he's more interested in giving, quote, normal people exposure than worrying whether a bubble is forming in the sector. All right, let's take a look at your markets this Monday morning. Futures very definitely pointed higher. S&P futures, Dow futures, Russell futures, NASDAQ futures, most importantly, pointing to gains of 1% or more. We do, though, have gold back above $4,000 as well. This shutdown story potentially ending this week if all the votes go in order and if there are no obstacles thrown up, if no senators say no. A lot to get through, but there is a potential path to the president signing the government reopen by Friday. Yields up across the board. With that said, the 2-year yield still below 360 as the market potentially turns its attention now to the next FOMC meeting. 8 companies left to report this week. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. An end in sight. Democrats concede on healthcare, setting up for a potential government reopening. Those headlines: improving risk appetite, plus Visa and MasterCard adding to market optimism this Monday. And mixed chip signals. TSMC's October sales grow at the slowest pace in 18 months, even as NVIDIA asks for more chip wafers. So lots to be positive about this morning, it would seem, because we have futures pointed well higher. Now, we did have a down week on equity indices last week. It was the first down week in several, so lots of rebounding to do if the market so decides. S&P futures pointing to a gain of nearly 1%, and they've been pretty stable all morning. Still 4 hours to go, but we have NASDAQ 100 futures up 1.5%, and plenty of the major tech companies up big in pre-market trading. As for the bond universe, those shutdown ending headlines, and that's only potentially this week, they have bonds really just down ever so slightly, with yields up about 3 basis points across the board. And of course, the FOMC meeting now firmly in markets, on markets radar. We get plenty of Fed speak as well later on today. I do want to point out that we have gold rising as well as Bitcoin rising. It's above $106,000 a coin this morning, so make of all of that what you will. All right, let's get to some individual movers now for some stocks to watch. Here's Valerie Titel.
Good morning, Ivani. Let's start with a check in the tech space. NVIDIA rallying back from last week's losses, up nearly 3.5% in pre-market trade. And this comes after NVIDIA had its worst week since mid-April. It was down 7% last week. We are erasing half of that, and that comes along this optimism that this U.S. government shutdown could be ending. We are seeing chip stocks, at least globally, trade positively so far this Monday morning. Let's now move on to M&A. Pfizer has agreed to buy the obesity startup Metsera in a deal that could be valued as much as $10 billion, but it puts to end a bidding war for the company. Pfizer was beating Novo Nordisk out for this deal. Now, Pfizer and Novo Nordisk, those shares are in the green, following the general optimism of the market, but Metsera is in the red, down nearly 15%. Bonnie, I think this is showing us that perhaps the market expected Novo Nordisk to amp up their bid this weekend. They did not. They declined to do so, meaning perhaps that bidding war is coming to an end, and that valuation for Metsera perhaps not going any higher. Next, let's move on to the video AI company Rumble. This is competitor to YouTube is more popular in the conservative spaces. The shares are up some 17%. They've agreed to acquire a German AI cloud company called Northern Data in a move that looks like that they're trying to boost their global AI capabilities. Rumble does do a lot of website hosting. They do host the more conservative-leaning social media network, Truth Social. So again, this could be seen as they're amping up their efforts in that AI-boosted space. Bonnie?
Yeah, could be turning out to be a deal Monday in the end. Valerie, thank you so much, Valerie Teitel there. Well, as risk appetite returns this Monday, Sonia Martin of DZ Bank writes this. The market is starting to rethink its pessimistic view on the U.S. economy, which is benefiting the U.S. dollar. As long as official data is not being released, this may continue to support the currency. Once the data does start coming out again, we may well be in for a big reality check. Sonia joins us now. She's head of FX and monetary policy research at DZ Bank. So Sonia, why might we be in for a little bit of, a reality check? What data are you expecting to be disappointing?
Well, I think before the shutdown, we had quite a lot of data that pointed clearly towards a cool down of the U.S. economy. And in particular, I think we have to mention the labor market data here. So we had seen some definite weakness in the labor market. And that's, of course, unlikely to have improved over the course of the last 40 days. So I do suspect that once we get official data, particularly from the labor market, the market may have to reassess its current view on the U.S. economy, which I still feel very much they're operating on the assumption no news are good news. And I think that may well turn out to be wrong.
The Fed chair talked about slowing down and foggy conditions, and we've seen plenty of Fed speakers sort of put the brakes on. Why is the market so convinced that we will still get a December cut?
Well, I mean, obviously, we're all moving in this sort of really weird data vacuum right now, and we're looking at alternative data. There's obviously private data providers that we can look at, but we're sort of really operating in a vacuum here. And I think the Fed, what they're really doing is keeping its options open because they have this problem that, on one hand, there are inflationary pressures lurking. We all know that tariffs will result in higher prices and already do so to some extent. On the other hand, the weakness of the labor market. And I think the market is sort of flipping back and forth between a view on a December cut, yes or no. That's been priced in and out a few times now. I'm still not convinced that they will cut in December. They may wait until the beginning of next year to do so. But I think the core message here is that the Fed will continue to cut rates well into next year.
Sonia, there's several political uncertainties out there. For one, the shutdown, it may end this week, paving the way for a reopening, next week. It may not. We also have the Supreme Court tariff decision, which, may come down on one side or the other. And we have this $2,000 dividend check that's not going to be a check, but maybe a tax cut. So much of that. How much of that will impact actual economic data?
Well, I mean, the shutdown, as we all know, will have an impact on growth in the U.S. And there's various estimates out there of how much that impact will be. There will be an impact. But I think as far as financial markets are concerned, the main goal is for this shutdown to be over. And normally what happens in these situations, we end up having a solution that will only last a while and not long term. But usually that'll be enough to appease the market who has taken the shutdown in stride anyway. I think the real question is how much, other policies that Trump has implemented, particularly, of course, with regards to tariffs and, of course, the labor market, harsh immigration laws, and, of course, the tax policy. How much will that impact the U.S. economy? That's where we really have to look at. And I think it's, for many investors, currently very difficult to see a clear path ahead when it comes to this.
How much are you keeping an eye on the bond market for signals, Sonia? I mean, if, for example, that Supreme Court decision were to be against the administration, that would leave a bit of a hole, right?
Well, I'm not sure if the Supreme Court decision against Trump will make a huge difference, to be honest, because he may then have to cancel some tariffs that he had implemented previously. But I mean, we can, I think, rest very assured that he will find other ways to implement new tariffs. There are other ways he can do this. This Supreme Court decision, if it does go against Trump, it's not going to change the trade policy of this president. That is not going to go away.
Yeah, the trade policy definitely is here to stay in some form or another. So what does that mean then for the US dollar? Because we have seen, plenty of US dollar strength at times. And now there's also these other cross currents, the Bank of Japan looking at hiking and so on.
Yeah. Yes, it's been a very difficult environment. We had a very, very clear move, the first half of the year, euro dollar rising rapidly on the back of a weaker dollar, somewhat stronger euro. And of course, since then, we've had some more volatility. I think the dollar longer term will come under pressure again. I mean, for one, because I do believe that the shutdown, when it's over, will show that the U.S. economy has continued to deteriorate to some extent. Also, I'm not bullish on the euro per se, but we have a massive fiscal package in the pipeline that's going to have an impact on growth in Europe, and sentiment there currently is very, very negative. So I do think euro dollar still has the potential to rise towards 120 or above when we look into the next year.
What about the yen? Because we're trading above 154 today. That's sending the Nikkei surging, for example. I'm sure companies are not too displeased, but at the same time, the Bank of Japan must be watching this very closely.
Yeah, it's a really difficult situation for them because they do want to hike rates. They have a very difficult situation when it comes to domestic inflation and the labor market. So it's a really tough time for the BOJ. They will not want dollar yen to continue to rise. There has been some verbal intervention already, and we expect there to be more should dollar yen continue to rise again towards 160, let's say. I think that's definitely an area where we have to watch out for the BOJ and the MOF to become more proactive. At the same time, obviously, they will want to be cautious. Donald Trump will be quick to point at any currency intervention as manipulation. So, we'll have to see how that goes. But I think ultimately, when you look at dollar yen, I think that the medium-term view is still that it's going to decline.
Just bringing it back to the US, Sonia, I mean, if we don't get that cut in December, are we in for a bit of a market jolt?
Yeah, I think you might have some short-term reaction, definitely. But again, if the story is still that the Fed will cut rates and it's just a matter of timing, then I think we don't have to worry so much about a massive market reaction. I think the market currently is sort of unsure how far the Fed's going to go. And I think what people have sort of lost sight of a little bit here is I think it's the political component. There's a lot of pressure on the Fed to cut rates next year. There'll be significant changes when it comes to personnel. Powell will go. Lisa Cook may or may not stay. We don't know. Stephen Rahn has to be replaced. So there's a lot of changes next year. And I think we can all agree that the Fed under Trump will be more on the dovish side. So I think that's going to shift back into focus as we enter 2026.
So we can assume, I suppose, that it's going to be more on the dovish side, as you said. But what about independence in general? Will that still be a market concern? Because it seems to have gone away a little bit for now.
It has. To my great surprise, I have to say, I am surprised how complacent the market is about this. And in my view, what happens with Lisa Cook is absolutely crucial here. The Supreme Court will decide early next year on whether or not her firing was legal or not. If Trump gets away with this, firing her for something that happened, 25 years ago, I think that would set a very, very dangerous precedent and would open up the Fed to a lot more political influence going forward. And at that point, yes, the independence of the Fed will be definitely an issue that we'll be discussing next year.
And as we know, these things can turn on a dime in the marketplace. Sonia, thank you so much. Sonia Martin of DZ Bank. Now to other top stories trending on the terminal this morning. Diageo named a former Tesco and Unilever executive as its new CEO. Dave Lewis, who is known for his turnaround of British grocery Tesco, will begin the role January 1st. Shares of Diageo, maker of Johnnie Walker and Baileys, surged on the announcement. Visa and MasterCard are said to be close to reaching an agreement on a 2-decade spat with merchants. According to sources, the deal would involve making changes to lower interchange fees and loosen rules that require merchants to accept all Visa or MasterCard credit cards. Both companies declined to comment. And the BBC's Director General, Tim Davie, is resigning amid allegations the broadcaster misled viewers on remarks by President Trump. Those remarks were in a documentary that aired October 2024, where sections of a speech Trump made on January 6, 2021 were spliced together. Now, the controversy comes ahead of critical funding talks with the UK government. Coming up, a step closer to the end. The Senate will vote for a plan to stop the government shutdown. We'll discuss details next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
On this vote, the yeas are 60 and the nays are 40. 3/5 of the Senate duly chosen and sworn, having voted in the affirmative. The motion upon reconsideration is agreed to.
The U.S. Senate voting 60-40 on a plan to advance a bill to end the government shutdown, with a group of moderate Democrats supporting the deal. With us now in Washington is Bloomberg's John Harney. So that was a procedural vote, John. That was late Sunday night, just a few hours ago. What can we expect this Monday morning?
Shutdowns, while they begin for different reasons, all seem to end the same way, in that the party that started it, in this case the Democrats, pretty much don't get what they want. Now this accord deal had been more or less on the table for some time. The Senate and House, which will have to come back now, it's been away since September out of Washington, will vote to fund for a full year several departments, namely Agriculture, Veterans Affairs, and Congress itself, while other agencies will be funded through the end of January. There's also an agreement in which the Senate Republicans have agreed to vote on the health care subsidies that led to this shutdown in the first place, but there's no guarantee that those subsidies will be enacted.
And I guess, even if everything goes smoothly, the earliest that President Trump could be signing would be Friday. I guess that's the math at the moment. Now, elsewhere, President Trump suggesting a $2,000 tariff dividend to Americans. We had Treasury Secretary Scott Bessent speaking about those particular comments on ABC. Have a listen.
The $2,000 dividend could come in lots of forms and lots of ways, George. It could be just the tax decreases that we are seeing on the president's agenda. No tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, those are substantial deductions that, are being financed in the tax bill.
It does seem like we're parsing words a little bit here. I mean, we know that all those are there already. Where is our $2,000 then, John?
That's a very good question. It certainly suggests. I mean, we don't know at this point. There could be some sort of money handed out, or maybe not. But what this does seem to suggest is that the administration is getting the message, reflected in last Tuesday's very bad elections for the Republicans, that affordability, the ability to pay bills, pay for daily expenses is very much on the minds of Americans right now. And many voters who elected Donald Trump last fall, just a year ago, feel that he has perhaps not lived up to his promises to bring down inflation, bring down prices, as he promised to do.
Yeah, exactly, and you can see that in his Truth Social. So the other thing that we got was that federal layoffs have now been barred temporarily under the bill to end the shutdown. So does that mean that federal workers are safe, or is there a way around this potentially for the administration?
Well, there certainly could be. I mean, at least for now. I mean, the term "for now" seems to come up again and again and again with this administration. But for now, the workers will be coming back to work. Presumably, they will be the ones who are furloughed, that is, and those who, of course, continue to work without being paid will be paid and will be allowed to come back to their jobs. You know, other payments these vast number of payments that the government makes will begin flowing again. But, you know, this Russell Vought and others in the administration have shown that they have said openly that they're determined to reduce the size of government and that they're not done yet.
Yeah, exactly. So as you say, for now seems to be the watchword. The court system is also adjudicating a lot of these decisions, and late Sunday night we had an appeals court ruling that essentially makes the administration give the money to states that would pay SNAP benefits. They had been really digging in on this. They hadn't wanted to pay out that money to states, but it looks like that money will now be given out and will get to those who need it, right, John?
Presumably. I mean, I think my understanding is that this could still go back to the Supreme Court. But yes, it looks like the payments will be made. Now, here again, we see how, you know, the shutdown is ending as it begins, as other shutdowns did, as it begins to affect the lives of American citizens. In this case, the 42 million people who rely on the Supplemental Nutrition Assistance Program, otherwise known as food stamps, for food and food aid. So the administration has, as you point out, tried to either say they didn't have the money or they were going to pay part of it here and there, but a judge said no, the payments have to be made in full starting now.
I read an incredible statistic. 1 in 8 Americans use SNAP benefits for grocery shopping. John, thank you so much. That is Bloomberg's John Harney in Washington. Turning to tech, TSMC shares higher in U.S. pre-market trading, the ADRs that is, even as the Taiwanese chip maker posted a slowing monthly sales growth figure. That's all after NVIDIA CEO said he had asked TSMC for more chip wafers to meet strong AI demand. For more, Matt Bloxham of Bloomberg Intelligence joins us now. So Matt, how should we read TSMC's October sales? Good or not so good because it's slowing?
Yeah, I think it's still pretty good, and it's consistent with the Q4 guidance they gave. So growth was about 16.9% in local currency terms. Quite a big slowing from the previous month, where it's more like 30%. As I said, that kind of 16 to 17% year-on-year growth is what's expected for the Q4 as a whole. And you have to kind of remember that October was their single largest ever period for revenue. So, you know, momentum is still there, and it's still a rapidly expanding business.
You know, NVIDIA's CEO asked TSMC for more wafers. It seems like there is just no end to these requests. I mean, at some point, are we going to find boxes of unused wafers or unused chips and, you know, some ports somewhere? Or are these all going into devices?
It's all going into AI accelerators. You'll see NVIDIA's main product, but also Apple smartphones and various other devices. And right now, the biggest issue that TSMC has is not demand, it's supply. They're really struggling to keep up with the capacity they need to deliver on all of the orders they're getting from NVIDIA and Apple and everybody else. And I think that's going to continue into next year, even though they're planning to increase capacity by 60 to 70%. And so, you know, there's a lot of people trying to curry favor with TSMC to make sure that they get as much of their orders fulfilled as possible. And as we've heard from NVIDIA, you know, they are seeing huge amounts of demand for their AI accelerators from the likes of OpenAI. So there's a kind of strong demand pipeline from them too in the near term.
Well, you mentioned Apple. Apparently, it's readying this major new satellite feature now for iPhones. Should we be getting excited, Matt? What does this mean?
Yeah, I mean, I don't think you're going to see any huge transformation in the capabilities in the near term, but this so-called direct-to-device idea that's evolving quite rapidly, has already become part of the iPhone. So, you can make emergency SOS messages over the phone. You've been able to do that for a few models now, I think since the iPhone 14. I think, the plan would be to kind of extend beyond that to kind of more high bandwidth capabilities, but that needs their partner Globalstar to have a lot more capacity. So this is a multi-year project.
All right, exciting to watch out for. Matt Boxham of Bloomberg Intelligence. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Jumana Versace in Vienna, and this is Bloomberg.
Now a look at what's ahead for the week. Start your week off with a little Fed Speak, why not? St. Louis Fed President Musalem is speaking to Bloomberg today. That's at 9:30 a.m. Eastern. Tomorrow, of course, is Veterans Day, honoring all U.S. veterans, and the bond market does close in the U.S. for the Veterans Day holiday. And Disney is reporting its earnings before the bell on Thursday. That's one of just 8 companies reporting this week. A lot of eyeballs will be on Disney. Let's take a look at some micro movers. A lot of bouncing going on today. NVIDIA, one of those companies alongside other chip makers after its worst weekly performance since mid-April. Then, of course, you have Metsera. It is down, although it had risen substantially. Pfizer agreeing to buy the weight loss drug startup for up to $86.25 a share. And Rumble up 26% after reaching a deal to acquire German AI infrastructure firm Northern Data. Here is your macro outlook for the day. This is Bloomberg.
such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
The risk on trade has been very strong, very long.
Positioning is very crowded, and people have already priced in most of the good news.
I don't think the bull market's over.
Earnings have been rock solid.
At the end of the day, it's going to be the earnings that is going to drive this market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday following a weekend of travel chaos, putting the Senate on course to help end the gridlock in Washington. As the White House says we could be risking negative growth this quarter, President Donald Trump is planning his next move, proposing a $2,000 tariff dividend for American consumers.
Look, this goes to the heart of the moment. People are very worried about cost of living. You saw that in the latest elections. You've seen this with respect to a lot of different sentiment polls. And President Trump is trying to convince them that things will get better and that any kind of deterioration in their cost of living does not come from tariffs, but comes from Biden policies of the former regime. What these rebates are is really up for debate, whether this is just sort of renaming some of the tax credits that already have been passed or whether this actually is a rebate. And if it is, it raises questions about the national deficit.
The Treasury Secretary, Scott Bessent, doing a very good job of dancing around this issue over the weekend after not talking to the president directly about it, but offering some solutions to that $2,000 giveaway. It's not just that, though. There's a populist twist over the weekend coming from the White House. There's the $2,000 checks plus 50-year mortgages in the mix as well, looking to address the issues that everyday Americans have.
Bill Pulte is making the FHFA great again and making it relevant. Look, there are a lot of questions and obstacles for a 50-year mortgage to get off the ground. Nonetheless, you'd have to have some sort of 50-year treasury probably also. How would the Federal Reserve manage with this? There is a focus, though, on cost of living. And you have to really think about how this was the referendum on cost of living in the latest election. President Trump trying to pull out all the stops to say things really aren't as bad as you think they are and prices are actually coming down. What you are seeing from the sentiment survey is a huge pushback from that. And this is really speaking to a lot of these proposals.
Apart from one group, I went through you, Mitch, so you don't have to. The one group that feels okay right now are the people who hold the most stocks. Equities close to all-time highs. Equity futures again up 1% this morning.
Yeah, this speaks to the idea of how much can the Fed really do if it continues to prop stock markets and fuel some of the gains that we're seeing in sentiment and spending power at the upper echelons of Americans. You're seeing this across the board. You're seeing this across earnings. I think that the question really comes down to, and I know that John Williams of the New York Fed addressed this, there is an ultimate question of how much is that concern about cost of living an endemic problem with something that's a softening in the economy versus a separate subset that doesn't necessarily offset the incredible optimism you're seeing in the wealthiest.
The San Francisco Fed President Mary Daly joining us a little bit later this morning, joining us at 8:30 Eastern Time, so look out for that. Assuming this government shutdown ends, got to make some assumptions here. Let's just assume for now, play along, this thing ends. How quickly do we get the jobs report, and how long do we have to wait for all the other data points we still haven't collected the data for?
So my questions this morning, how quickly do we get all the data releases? How much could these releases buffet markets? How much do people care, given the fact that they are delayed and possibly coming out? How quickly does air travel get back to normal? How much will any delayed holiday spending get back? Right, there's so many questions that people have been swirling around with. Respect to the data, how much do people actually think it's credible, given the fact that people are going back and saying, how did you feel 3 weeks ago? I don't know how I felt yesterday.
How many times has Anne-Marie said 1 weekend of travel chaos and this thing's over? 1 weekend of major travel chaos, and it looks like this thing might be over.
Well, and Transportation Secretary is saying that on Thanksgiving, transportation would move to a crawl, that you wouldn't have anyone showing up, because why should they? Because they're being paid $100,000 and not even getting paid, and they have to work other jobs. You start to wonder, if these are such crucial members of our society, why don't we pay some of these agents a little bit more and maybe have a different mechanism that doesn't get shut down every other year?
That's what I'd be saying in my year-end eval.
100%.
If I was them. Stocks are up this morning. Bonds are down, yields are higher across the curve. 2s out to 30s. 10s this morning up 3 basis points. Your yield on a 10-year maturity 4.13. Coming up this hour, we'll catch up with Laurie Calvasina of RBC as stocks look to kick off the week on a firmer footing. We'll speak to the former Congressman Patrick McHenry as Democrats reach across the aisle, and Dana Peterson of the Conference Board with consumer sentiment falling to a 3-year low. We begin this hour with stocks rising as lawmakers take a major step towards ending the government shutdown. Laurie Calvasina of RBC writing, we continue to think earnings are providing a solid foundation for the equity market, but the best part of the earnings story may be behind us. Laurie joins us now for more. Laurie, good morning.
Good morning.
What's in front of us?
What's in front of us is we've got to still contend with peak valuations. We've got earnings sentiment that's pretty good, but not nearly back to where it was in August when we were, baking in this much, much better than expected tariff environment. And I do think, as Lisa mentioned, we do still have some uncertainty on the data. I know that the data release I'm waiting for is not NFP, it's not CPI. I want the CFTC data on U.S. equity futures positioning. So CFTC, if you're listening, please get that to me very quickly, because we've, had this march up to new highs. There's a lot of thunder kind of rumbling in the distance, as we put it in the weekly today. I know you're going to have Dana on later, but the Conference Board data, they had an interesting question as well on stock market optimism, which was not back up to the tip-top highs, but was basically back up to levels that often mark the peak. So I think we do have to, sort of see, do we have sort of peak optimism around stocks right now in consumers? The CFTC data won't speak to the consumer side, but it'll give you a lens in terms of how the institutional investor community is looking.
You've cautioned this for a while, Laurie. This is not a one-way ticket to a year-end melt-up.
Yeah.
Is that falling on deaf ears?
It's interesting, because if you look at a lot of these stocks that have reported, we're having these big gaps down. So it feels like we're getting that garden variety pullback in individual names. It hasn't manifested the surface yet. I think the worst, kind of day on the drawdown, it's been down a little more than 3%. We think that should be at least like 5, probably no worse than 10, frankly, maybe closer to 5 than 10. But I'll tell you, John, we watch the valuation levels. And if we look at the S&P 500, just that top 10 market cap cohort, we had gotten up to 30 at one point. That's basically been the ceiling of the last 10 years that we just can't break through. And we've fallen back down to about 28 in our latest update. But it's still just not giving you a whole lot of room.
Is this the problem of the Mag 7 of the tech names, or is this a problem more broadly of the index?
It's a problem broadly. I do think the Mag 7, these kind of rumblings have happened as jitters over AI have manifest. That seems to be the only thing to really generate our bad down days. But if you look at S&P 500 X the top 10 names, I think that PE is trading at around 17.8 right now. It got up a little bit over 18, and 18 has basically been its ceiling over time. So whether you're looking at top 10 market cap names, a good proxy for the Mag 7, or even just the rest of the market, it looks like we've got a problem with hitting valuation ceilings everywhere we look.
So this raises a question of how much we could actually talk about the market in aggregate versus according to sectors, given that it's a K-shaped market. I mean, it's a cliche at this point, and everyone kind of rolls their eyes, but there's a question here of, if you get Mag 7 or the tech stocks maybe plateauing here, you could get an index level that doesn't advance much, but actually looks healthier with that kind of broadening out, and some of the other names really seeing a boost from, say, Fed rate cuts, from, say, more stability. How much do you see that as a realistic proposition?
So look, I think the Mag 7, they just have to sort of behave, right, in order for the market not to have, kind of one of these major scares. The rest of the market, though, it's interesting. You've got slightly better valuations in terms of the headline level. Again, the trend versus history is not fantastic. They're more at the epicenter of the tariff issue right now. And if you look, say, at the industrial sector, we've seen margin expectations come down again in this reporting season. And that's actually, along with a few other sectors, dragging down the aggregate S&P numbers. I think that with rate cuts, one of the things our economist talks about is maybe the economy is not quite as rate sensitive as it used to be. Now, that speaks to kind of higher income consumers, right, who are doing more of the heavy lifting on spending, having cleaned up their own balance sheets. But we also know corporates have cleaned up their balance sheets as well. I know one thing we heard at our industrial conference a few months ago was one rate cut was not going to be enough. They didn't sort of weigh in on like what exactly two gets you. But the idea that, just doing a little bit of relief on the rate side is going to like get you off to the races. We've seen that kind of poo-pooed in both corporate earnings calls and, public events by companies.
I want to build on the Lori Calvasina pushback. The other pushback we've had from you over the last several months has been on small caps. Yeah. And that's the first back-to-back weekly loss we've had for the Russell, going back to April, believe it or not, down by 2% on the Russell just last week. Is there more pain to come, do you think, for the small caps, even if we get additional rate cuts?
So look, I will say small caps do have some room on valuation. It's maybe the one corner of the market. It's about 16.5 times. 17, 18 tends to be your peak, so there's not a ton of room. This is also why I want to see the CFTC data, because they were so out of favor on that data set. That was the best thing around the Jackson Hole timeframe to tell you to look for a trade along with this idea of rate cuts. But I'll tell you, John, even small caps have cleaned up their balance sheets relative to history. A lot of people don't believe that, but if you go back to the period when the Fed was hiking rates, a lot of small cap PMs were telling me that on their earnings calls with their companies, the companies were making the case that their balance sheets weren't as bad as they'd been in the past. So like, what kind of pop are you going to get? I think at the end of the day, you still need the hot economy, and we'll see what the data shows when we start to get it again. But all this alternative data we're getting doesn't tell me that we're in that hot economy period. And I'll give you one last little tidbit. We did some work. We were talking through this issue with clients over the last few weeks. And if you look at some of the quantum stocks that are big weights in the Russell 2000, when they were surging in October, that is what took the Russell 2000 up to its peak relative to the S&P 500. And since those quantum names have faded, you've seen that Russell give back a lot of that outperformance versus S&P. So we said in the weekly this morning, how much of this was rates and how much was it just these quantum names juicing things?
Are you suggesting it's all just the one trade, the same trade?
I think to some extent, it is. Lori. I mean, I think you were even getting that kind of tech froth optimism seeping into small cap, and everyone thought it was rate cuts.
Out of all the issues right now, Stuart Kaiser at Citi lists them: consumer earnings, AI sentiment, Fed policy, limited macro data. What's the one that's flashing red for you? What's most problematic out of that list of four?
I mean, I think the one that's probably most important is the AI sentiment. I don't know that that's flashing the reddest, like maybe it's a little bit yellow right now. We've just heard consistently people who have been bullish on that theme are starting to get some sticker shock. So it's not that people are fighting the trade, it's people who have been there that are starting to get worried.
Lori Calvasina of RBC. Lori, always good to see you. Pushing back against that one-way ticket to a year-end mount-up. Plus, I think a lot of cold water over the small-cap trade over the last several months from Lori and the team over at RBC.
The idea that there are such great valuations, maybe a little bit of pushback there, and then a question just of what can propel it, given the fact that you have seen some margin compression, and we've heard that from a number of them.
Things are doing better this morning. Equity futures up big time, higher by 0.9% on the S&P 500, just off session highs. With an update on stories elsewhere this morning with your Bloomberg Brief. Here with us now, Yahara Anand. Hey, Yahara.
Good morning, John. Treasury Secretary Scott Bessent says President Trump's suggestion of a tariff dividend could come via the tax cuts in his signature economic policy bill. Bessent making the statement when asked about Trump's social media post where the president said each American would receive a dividend of at least $2,000 from that tariff revenue. Meanwhile, tensions between the U.S. and China are continuing to show signs of easing, with China adding more than a dozen fentanyl precursors to a list of controlled exports to the U.S., Mexico, and Canada. The move represents a step in fulfilling China's pledge to combat the flow of synthetic opioid ingredients to the U.S. And NVIDIA CEO Jensen Huang says he's asked TSMC for more chip supplies to keep up with booming AI demand. Speaking at a TSMC event in Taiwan, Huang says NVIDIA's AI memory chip suppliers have scaled up capacity to support the company. TSMC CEO confirmed Wang's request, saying the chip maker expects record sales every year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, finding a resolution.
After 40 long days, I'm hopeful that we can finally bring the shutdown to an end.
This agreement will give Democrats control of the Senate floor for a vote on one of our top legislative priorities.
That conversation up next with the former House Financial Services Committee Chair, Patrick McHenry. Live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Tech earnings doing better so far this morning. Check it out. Nvidia up by 3%. Alphabet up by 2%. These big names performing better in the pre-market. Microsoft has not had a positive day since it released earnings 2 Wednesdays ago. Microsoft this morning positive by about 1 full percentage point. That's the story at the single name level. At the index level, we look like this. On the NASDAQ, the S&P, and the Russell, positive territory up by 0.9 on the S&P. On the NASDAQ, up by 1.4. On the Russell, up by 1.1. Under surveillance this morning, finding a resolution.
After 40 long days, I'm hopeful that we can finally bring the shutdown to an end. All of us, Republicans and Democrats, who support this bill know that the time to act is now.
This agreement will give Democrats control of the Senate floor for a vote on one of our top legislative priorities, extending the Affordable Care Act premium tax credits. This is important when Republicans control every branch of government.
So here's the latest this morning. The Senate advancing a bill to reopen the government after 8 Democrats broke with party lines to vote alongside Republicans. Bloomberg's Mika Sona joins us now for more. Mika, welcome to the program. Are we close to ending this thing?
Yes, this is the first time in several weeks that we've seen some significant action taken to end the government shutdown that's now wreaking havoc on the airline industry and starting to really impact people's pocketbooks when it comes to the federal workforce. But the Senate did vote to pass in advance this new compromised version of a continuing resolution, and the House is going to come back this week after several weeks in recess to take a vote on it as well. So we're seeing huge progress, but it's still could be a few days.
What's pushed the change, Mika? Was it just one weekend of travel chaos that pushed the Democrats to cross the aisle and get this done?
Well, I think that there was a lot of pressure growing on, particularly on Senate Democrats that, were really starting to feel the heat. I know that a lot of the blame was taken on the Trump administration Republicans, but Republicans really never wavered in their position throughout this fight. So there was a bipartisan working group that really came to a compromise. They're guaranteed a vote on a package that could help extend the Affordable Care Act subsidies that were at the heart of the fight here for Democrats. as well as some reel back of RIFs and federal workers that were laid off will be reinstated, and federal workers are guaranteed back pay. So that's really the crux of it.
Making some progress. Mika, thank you. We'll catch up with you in the next hour. Typically, markets don't care about any of this. They look right through it. It's growth deferred, not growth derailed. And we catch up later, we bounce back, all of that. This felt different towards the end because of the data blackout, Lisa, that this was holding back the Federal Reserve from reducing interest rates. And therefore, just the idea of the government reopening gets you a little bit more clarity. Those on the committee that were worried about cutting without the data are going to have the data potentially in several weeks' time.
There's the fact that data is affecting policy. There's also the fact that everyone says that the longer that any kind of government shutdown goes on, the more economic pain there would be. And this is the longest government shutdown in history. People talking about the potential for it to stretch back past 40 days. So all of a sudden, you start thinking $1.5 billion a day. It starts to add up. You're seeing in the airline stocks this morning in particular because they are the ones that are on the front lines of any kind of ramifications.
Tough weekend if you're at an airport this weekend. Absolutely brutal. To build on that conversation, the former House Financial Services Committee Chair, Patrick McHenry, joins us now for more. Patrick, welcome to the program. Are there any potential wrinkles down in Washington because this market has decided this one's over?
There are always potential wrinkles. Look, we're talking about human beings trying to do hard things with major disagreements on policy and approach, as we've seen highlighted over the last 40 days and then actually in recent years. So the wrinkles here are that you had just enough Democratic votes in the Senate to break the filibuster that enables a vote to reopen the government. The mechanism to that is as outlined by our correspondent. This is the same deal that the Democrats could have had in the first week of the government shutdown, the beginning of October. So nothing changed other than political pain and political calculus. It also gave the Democratic Party the opportunity to highlight an issue where they have strength, healthcare. They highlighted that for 40 days. That didn't move the political narrative. That didn't bring the president into the game on negotiations. And this remained a congressional fight while the president was actively engaged on economic policy and foreign policy. So hard to see that much changed here. And in many respects, you look at Washington, the markets look at Washington and say, same as it ever was. And that is in fact the case today.
Well, which raises this question in particular about Chuck Schumer, the Senate Minority Leader, who is one of the defections to a vote for the reopening of the government. You said that this doesn't look a lot different than it was earlier. What do you make of that decision, given the fact that some Democrats were saying there was actually some unity in the party for a bit to fight back or keep the government shut? What does this signify about that?
Well, two things. One, there's a divide within the Democratic Party. We saw that highlighted by two moderate governors elected in Virginia and New Jersey. That was a highlight that the Democratic Party wanted to make. But you also had the election of a socialist mayor of New York, which I know we've talked quite a bit about, with Mandami. And that also highlights the progressive left, where there's action activity in the Democratic Party, but major dividing point when it comes to Israel, when it comes to whether the definition of anti-Semitism highlighted within the Democratic left. And this shutdown, this cave at the end of the shutdown for Democrats highlights the divide within the party further. The second piece I would remind my Democratic friends is when Republicans moved to shut the government down previously, it was dumb policy and dumb strategy. And what the Democratic Party did was buy that dumb policy and dumb strategy and double down on it for the longest government shutdown ever. Not really adept, and showed really a missed opportunity for the Democrats here.
At the same time, you have to wonder how the Republicans are responding to what the government shutdown really highlighted in a lot of circles, which is the cost of living concerns that really have become the preeminent economic and, frankly, political issue. How are they addressing it? How sufficient do you feel like some of the moves on that side have been?
Well, look, the party in power always has the onus on them to perform for the economy and to deliver on the pledges of the last election. President Trump rode a wave, winning all the 7 battleground states, winning the biggest election he's been a part of, and getting a mandate on cost of living, addressing the cost of living in the last election. 1 year in, we still see that highlighted from the populace, from the voting populace. This is the work that Republicans have to be focused on in order to be successful in the midterms in a year. And so I see that as a recurring theme that the Republicans are trying to address. They try to address it with tax policy. They've tried to address it with healthcare policy. The president's very focused on this with pharmaceutical costs, as well as overall costs that he's working through at the administrative level. So that is really the key issue. It is the hottest issue in America today, and it has not subsided because we've not seen the economic results that the president outlined. But he has more time before Republicans are back on the ballot 1 year from now.
What's your reaction to some of the proposals so far? We opened up the program by talking about the $2,000 tariff dividend, plus some conversation over the weekend as well about 50-year mortgages. What's your reaction to those proposals?
Look, I mean, to affect the cost of affordability, you have to address the cost of affordability. These are things that the administration can take an approach to, but it doesn't actually have a net effect in a long-term systemic way. We've got to actually get our economy going in the direction the president pledged during the campaign. The tax cuts have to start having an effect. The regulatory policies have to be more aggressively put in place, deregulatory policies, to get this economy moving again. And those are the things that are gonna have the positive impact on the American people. The two issues you outlined here would be helpful in the short term, but also that doesn't get to the substance of the issue of affordability, which tax policy, regulatory policy can have a better effect on.
Patrick, appreciate your take. Thank you, sir. The former House Financial Services Committee Chair, Patrick McHenry there. Shout out to Jared Seaberg of TD Cowen, who put this note out just last week. We expect Democrats will make the economy as the key message heading into the midterm elections next year. This may represent a risk to financials as the president may respond by embracing populist policies, including some he raised during the campaign. Something to watch after the developments over the weekend.
Which also speaks to the $2,000 rebate from the tariffs. I do want to clarify something, correct something that I said. Senator Chuck Schumer did vote no. After wobbling, there were some conflicting reports. This, though, to your point, this health crisis is so severe, so urgent, so devastating for families back home that I cannot in good faith support the CR. So there is this question of how both parties are going to make this the preeminent issue.
There's certainly questions about his leadership right now anyway. Jared Seaberg, just to pick up on that quote, Jared's talking about the potential to revisit some of the conversations they were having about maybe putting a cap on interest rate cuts on credit cards. Do we go back to that in the coming weeks and months? Now, the way you heard Patrick McHenry describe things was a shift towards deregulation. I just wonder if things might go in the other way.
You know, there's this political circle that when it goes far enough, it unites on one end, and it feels like we're very much at that level. The problem is there is a real cost of living concern and crisis, and so there's a real question of how does that get fixed? And what you're seeing is a lot of companies are absorbing cost increases, which tells you, you know, we really are in an economy where you are getting pushback from consumers. Can you have the hot economy that everyone is talking about without the participation of a pretty significant part of the U.S. economy?
Got a hot market this morning on the S&P 500, higher by 0.9%. Up next, we'll catch up with Brandon Oglensky of Barclays following a weekend of travel chaos. Plus, Danny has your morning movers. NVIDIA leading a tech stock rally. That stock is up by 3%.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bouncing back this morning on the S&P 500, higher by 0.9%. Bouncing back from these losses, the biggest weekly loss since early October on the benchmark. On the Nasdaq, down by 3%, the worst week since early April this morning, up by 1.4%. In the bond market, 2s and 10s, those yields look like this. Higher by 3 basis points on 2s to 359. 10s up to 412.58. Last week, basically unchanged on the week. But Lisa, we talked about this so many times. Unchanged on the week, but so choppy from one session to the next. Bouncing off bad data points, good data points, Fed doves and Fed hawks. That tension in that tug of war is really building going into next month.
This is a bond market without an anchor. We don't understand the data because we're not getting it, and frankly, we don't understand the reaction function. Right now, there is a 65% chance being priced into markets of a December Fed rate cut. That is down from 92.3% the day before the Fed rate decision last month. So it shows just how much you have seen a reassessment in value and what the Fed could potentially do.
Getting closer to ending this government shutdown in Washington, D.C. Bring on the data. There's a view that in the next couple of days, if it ends, you get the payrolls data from September almost immediately, and then the tough work starts. You've got to actually collect the information to put the data together for all the other months we've missed so far.
If you had questions about the credibility of data before, start looking at backdated data where people go around and say, well, did you have a job on this date? How did you feel about it? It raises a question of how much you can actually trade off this and whether the Fed's going to look at it at all, or whether they have other metrics. They're looking at the alternative data, like the Challenger job cuts, University of Michigan sentiment survey, to really get a gauge of what they should do.
If you're building Fed policy on Challenger and you match, we've got a problem, haven't we?
Well, what else are you going to build on right now?
100 basis points, if that's all we've got.
Well, fair point.
2-year bond yields this morning up by 3 basis points, 3.59 as we count you down to the opening bell. The cash open 3 hours away with your morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Leading the charge in the general positive sentiment for equities markets this morning is NVIDIA shares up 3%. So you have hopes maybe a government shutdown closer to coming to an end. But you pointed out just how poorly markets did last week. NVIDIA was the poster child for that, too. Fell 7%. Its worst week since early April. So there is some dip buying going on this morning. Elsewhere, Robinhood, also one of the biggest gainers in the S&P 500 this morning. Vlad Tenev, the CEO, giving an interview to the FT where he said that they're going to be launching a new platform on Robinhood where retail investors can buy pieces of private AI companies. He didn't name which one. He didn't say whether they'll have OpenAI on there, but they'll have something. He basically said he's not worried about a bubble in AI. He just wants to give everyday investors access to those kinds of high-growing companies. So those shares are up just under 4%. Finally, the saga over Metsera, the obesity pill startup, has come to an end. The bidding war has finalized with Novo Nordisk bowing out. Those shares, ADRs in the U.S., are rising after that. Pfizer had matched Novo Nordisk's price target for it, which is about $65. Because we're not getting this bidding war unfolding, and because that price that they're going to be paying for Metsera is below where we are right now, we're just under at $71. You're seeing Metsera shares fall about 14.5%, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, the Senate taking steps towards ending the government shutdown. 8 Democrats crossing the aisle, supporting a deal to fund multiple departments and pay furloughed workers. The deal must be approved by the House later this week. Elsewhere, TSMC reporting slowing growth in monthly revenue. The slump coming even as NVIDIA CEO Jensen Huang is seeking more chip supplies from TSMC to meet high demands. And finally, President Donald Trump floating the idea of a tariff dividend of at least $2,000. The Treasury Secretary, Scott Bessent, weighing in.
The $2,000 dividend could come in lots of forms. You know, it could be just the tax decreases that we are seeing on the president's agenda. You know, no tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, you know, those are substantial deductions that, you know, are being financed in the tax bill.
The president posting that every American would be paid, not including high-income people. The Treasury Secretary is getting very good at this game, isn't he? Over the weekend, dancing around that post by the president.
So what President Trump was talking about was actually a $2,000 check. And then what we heard is maybe this is going to be a marketing ploy where some of the initiatives that have already been passed get rebranded as a President Trump tariff rebate. So it raises a question, which is it, right? Which is the preeminent concern? Is it trying to get people to understand that, yes, cost of living is a concern for this administration, or is it to try to plug the deficit and the revenue-driving aspects of some of these tariffs? That was clearly a nuance within what Treasury Secretary Scott Bessent was talking about as he continued to say, longer term, this really is about bringing competition back to the United States, but it also can be beneficial for you with a tax benefit.
I think it's fair to say, based on that response from Treasury Secretary Scott Bessent, what he'd like this to be, right? I think it's fair to say.
There is not a mathematical way to make this work without causing a real problem in the bond market. Treasury Secretary Scott Bessent has said repeatedly, he is very much a pro-American policymaker with respect for the markets. So he understands how far he can push, and the market pushback will put that into some perspective. Right now, this is not a bond market that would be accepting of a $2,000 check to every single American, especially given what happened the last time that we had a policy where people got checks. What do? They go out and spend it. What does that do? It leads to inflation. And oh yeah, by the way, it also increases the deficit, not a bond-friendly kind of recipe.
Yeah, it would make that Fed decision even harder in about a month's time. Plus, of course, we've still got a Supreme Court decision about the tariffs themselves still to come maybe before year end. Let's turn back to the government shutdown, the longest ever. The Transportation Secretary, Sean Duffy, warning of major disruptions to air travel as Thanksgiving approaches.
You're going to see air travel be reduced to a trickle. We have a number of people who want to get home for the holidays. They want to see their family. They want to celebrate this great American holiday. Listen, many of them are not going to be able to get on an airplane.
Joining us now, Brandon Oglensky of Barclays, covering the major airlines and has been following the news over the weekend. Chaos. Can you offer us some data? Just how bad were things over the weekend?
Yeah, good morning, John. Thanks for having us on. I mean, the stats are still not final, but I think it was close to 1 in 10 flights canceled yesterday, and 1 out of 3, if not even more, delayed. And I think that actually buries the fact that a lot of these delays were running in the 2 to 3 or 4 hours. We're even talking about your colleague that was like switched between many hubs in the U.S. So I really feel for anyone that had to travel, over the weekend. And we think, oh, it's like just for fun. But no, there's lots of things that you actually have to do, like from a family perspective, if someone unfortunately passes or you have a wedding.
Yeah.
But these events don't move. And unfortunately, we can't get our federal government employees paychecks. So I think what we're seeing is the compounding issue that these folks have gone now, about a month and a week or even longer without paycheck. I think for a lot of folks in this country, that would be a really difficult situation.
It's super difficult to assess, but based on your high-level assessment over the weekend, how much of that disruption was travel related to weather disruption and related to the government shutdown?
You know, it all gets blurred lines because what initially happened, the FAA came out, I believe, on Wednesday and said, hey, we're going to cut 10% of flights at the top 40 major airports, which effectively means a 10% cut system-wide because everyone flies into or out of the 40 major airports. But then they walked that back and said, we're only going to do 4% for the weekend. So we saw about a 4 or 5% cancel rate on Friday. That stepped up a little bit on Saturday. But the issue is once you get crews, planes, and everyone out of place, then you add in a little bit of mix of weather and TSA lines that were looking really terrible at most major airports yesterday. And that's what can really then spiral out of control.
Let's say the government does reopen on Friday.
Yep.
How quickly will it take for air traffic to normalize?
I would think you give this maybe a day or two, because generally you can recover pretty quickly. It takes about a day or 2 days to figure out where all your crews are, to get the pilots and the planes and the flight attendants in the right place. And assuming that TSA and FAA can get back to full staffing levels.
You know, Transportation Secretary Duffy was talking about how air traffic controllers work long hours, They have very stressful jobs. They make about $100,000 a year. We've been talking about recruitment issues. We've been talking about staffing issues for a long time. Why can't this be fixed where people maybe are paid a little bit more, given recruiting bonuses, trained, and maybe paid by an entity that's not going to occasionally shut down?
Well, it's a little bit antiquated the way we train FAA controllers in this country, and I think it takes about 2 or 3 years just to get certified to then be an actual controller. And that's where there's a lot of washout with folks that say, this isn't really cut out for me. So I think pay could be a piece of that. Now, remember, it's a unionized job, so it's contractual. But I think more importantly, we need to really look at the modernization of our ATC system. If we could walk into a control tower today, you would actually see paper slips, which is how we manage flights even today. And I think everyone remembers the Newark headlines from this past summer when we had control scope outages and things like that. That doesn't mean the system isn't safe. It just means it's running on technology literally from the 1950s and 60s. We still haven't gotten really beyond that.
How much was the slowdown really due to the mandate from Transportation Secretary Duffy versus what actually was going on the ground?
Well, I should be careful in the way I answer this because I did speak to a few of the airlines, and I think they're trying to be very quiet politically. But I think the view is that the system was actually holding up through mid last week. And so potentially maybe this initial 10% and then they walked it back to a 4% cut was maybe more of a political negotiating tool.
Brenda, just to pick up on the airlines that you cover, who's doing well right now? Who bounces back from this quicker than others?
Well, it's going to be difficult for all the airlines to recover because when you start looking at 10% schedule cancellations again, you're moving your crews and planes out of place. But I can tell you the good operators have really been Delta and United. Now that's both operationally and commercially. And it's a little bit easier for the large network airlines because between American, Delta, United, and Southwest, they each control roughly 20% market share here in the U.S., especially for the 3 network airlines. They have regional jets and regional airline partners. That's where a lot of the cancellations have been focused. So it minimizes impact on their passenger counts. That just means it's a little bit easier for those networks to recover.
On the S&P 500, we often talk about the MAX 7 and everyone else. In the airlines business, it just feels like Delta, United, and then everyone else. Is that the way you summarize things?
Yeah, I mean, we're not even talking anywhere close to MAG 7 valuations.
No, of course not.
We're talking 6 times EBITDA if we're lucky. But yes, I think Delta, did it first. They said, look, we're going to decommoditize travel. And they've done a pretty good job of that. United said very quickly, wow, we actually have a bigger network globally. Why aren't we doing the same thing? So I think 2 maybe slightly different cultures, but Scott Kirby in Chicago at United and Ed Bastian down in Atlanta has really got both those organizations trying to win.
Is American catching up?
Robert Eisman team down in Fort Worth, I think they're trying their best, but the profitability just trails those 2 pretty significantly. And I think there were some product and commercial decisions made years ago and a lot of stock buybacks that leaves them with a lot of leverage that puts them in a little bit more challenging spot.
Brendan, it's good to see you. Thanks for dropping by. Thank you. Brendan Oglensky there of Barclays, and a shout out to any of you who suffered from the fallout over the weekend because the delays. I heard from a couple of people who were at airports for like 6, 7 hours waiting for things to progress and move along.
Yeah, and that is if their planes took off and weren't canceled midway. So we were talking about whether, you mentioned this earlier, John, whether it would just take one bad weekend for the government to reopen again. And it really does raise a question. Was it trying to up the ante earlier, get it done before Thanksgiving? Because ultimately, this is typically the key negotiating factor.
Look, we don't know what was in the minds of all these people who were involved, but certainly that's how things played out, right? One weekend, and it looks like things are moving along and getting done.
My gut feeling is that air traffic controllers are pretty upset because they feel very devoted to their jobs. And if you actually speak to any of them, they're very assiduous about it. So the fact that they're getting blamed for calling out sick makes them very angry.
They're right to be angry and frustrated. If you're just joining us, welcome to the program. Equities bouncing back. We're higher by 0.9% on the S&P with an update on news worldwide with your Bloomberg brief. Back with us. Here's Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump pardoned people who were allegedly involved in the attempt to overturn the 2020 presidential election. Those pardoned included Rudy Giuliani, Sidney Powell, Mark Meadows, and several 2020 campaign aides accused of sending false elector lists from 3 states to Congress in an effort to keep Trump in power. Meanwhile, New York Fed President John Williams warning that the widening economic divide is a serious threat to U.S. resilience. In an interview with the Financial Times, Williams notes that while the stock market is up at record levels, high inflation and housing costs are forcing many to live month to month, calling the Fed's December rate decision a difficult balancing act. And Jeff Bezos-backed Blue Origin postponed planned second flights of its New Glenn rocket due to weather conditions and unspecified ground equipment issues. The mission aims to send 2 spacecraft on a trajectory toward Mars for New Glenn's first NASA mission. It's seen as a crucial test for the company in its quest to challenge SpaceX. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, consumers cutting back.
We have seen softer performance or softer demand from lower income consumers. We're really seeing evidence that it's broadening out and rising up the income spectrum to more middle income households as well.
Up next, we'll catch up with Dana Peterson of the Conference Board. Live from New York City this morning, you're watching Bloomberg TV.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
So here's the bounce this Monday morning. Equities higher on the S&P by close to 1%, on the NASDAQ north of that, higher by 1.5. More to come, according to Mike Wilson of Morgan Stanley. Quote, while overhangs from Fed guidance and the shutdown have weighed on recent price action, these are temporary headwinds on the way to a solid 2026 driven by earnings growth.
Yeah, talking about how this earnings season has been much stronger than expected. S&P companies posting a nearly 15% jump in third quarter profits. This is what he's pointing to, saying maybe the headline level won't necessarily reach the heights that some people are expecting, but the broadening out will be substantial and there'll be a lot of opportunity there.
It's quite phenomenal, isn't it? Double-digit earnings growth. Can you imagine having that conversation at the start of April when the president rolled out that tariff policy, that we'd be sitting here 6-7 months later talking about double-digit earnings growth?
People would have said you're insane, and that had to mean that everything was walked back, which, I mean, it did come down from the highest levels, but it was not walked back. You just wonder how much that can be continued, particularly in consumer-facing businesses, given the pushback you are seeing from consumers. This is not an even economy, and how much does that unevenness matter on a more macro level?
Let's talk about that right now. Under surveillance this morning, consumers cutting back.
We have seen softer performance from, or softer demand from lower income consumers. That's been happening probably for the better part of the last 2 years. And now we're really seeing evidence that it's broadening out and rising up the income spectrum to more middle income households as well. The middle income consumer, we know that cohort transactions have also declined.
So here's the latest this morning. Consumer sentiment sinking to near the lowest on record as high prices and the government shutdown weigh on spending. Dana Peterson at the Conference Board writing both present situation and expectations indices continue to edge downward as consumers persist in worrying about business conditions and the labour market. Dana joins us now for more. Dana, welcome to the programme. You follow consumer confidence and, of course, business confidence as well. How well aligned are the two at the moment?
They're pretty well aligned. Both businesses and consumers are wary about the economy going forward. Businesses are deciding that they're going to continue to just wait and see what happens regarding tariffs, as well as regulatory issues and fiscal policy. Meanwhile, consumers, you know, we saw a big drop in consumer confidence earlier this year, and that's our measure, the Conference Board's measure, and it's kind of stabilized and moving back and forward over the last few months, but it's still much lower than it was pre-tariff announcements.
Dana, how unusual is it to see this level of anxiety about the labour market from consumers, whilst we run GDP at the levels we're running at right now, close to 3%?
Well, this is actually a new thing, apart from the pandemic, where over the last few years, consumers were mainly complaining about inflation, but not about their job prospects. This year is very different. Many consumers understand that tariffs can lead to higher prices, and also those higher prices might mean that businesses cut their workforces. And so we're just seeing like the natural progression of a pullback in consumer spending, similar to most recession threats. Now, most consumers think that there's probably a lower likelihood of recession going forward, but still now they're very much worried about what their job prospects are now for those who have been let go, and then also what job prospects might look like in the future 6 months from now.
Dana, how much dispersion are you seeing in the income groups with respect to confidence?
Well, it's interesting. Overall, the younger groups tend to always be much more confident than the older groups. And all three measures, meaning, you know, under 35, between 35 and 55, and over 55, dipped this year. But we're seeing a little bit of a recovery, I think, as there's been some clarity, especially along the fiscal policy front, in terms of what spending and tax cuts will look like over the next decade or so.
One thing that we've seen over the past couple of years is that confidence and sentiment hasn't always cohered with people's spending patterns. They might feel terrible, they'll still go out and buy a big meal or buy a new handbag. How much are you tracking any kind of breakdown in that kind of dissonance? Because that really has been one thing people have continued to say. Watch what they do, not what they say.
Absolutely, and we do keep track of various spending on goods and also services. When it comes to goods, we're actually seeing a pickup in desires to purchase homes, cars, and electronics. And that could be a reflection of the fact that consumers are anticipating lower interest rates going forward. Certainly, the Fed did cut a couple of months ago, and once the shutdown's over, we anticipate they'll continue to cut. So we're looking at lower interest rates that might boost goods spending. When it comes to services, we are seeing a shift where consumers are engaging in cheap thrills like takeout or streaming over more expensive types of activities like travel. Also, we're noticing that consumers are focusing more on necessary services. So, for example, healthcare or car maintenance, while they're forgoing more discretionary and/or expensive types of activities like going to museums or sporting events and even childcare.
Cheap thrills. The idea of taking out Chipotle, woo! It's just a hilarious kind of example. I am curious going forward whether you do see any ramifications from the government shutdown, whether you think that any of the political dysfunction has made its way into some of these surveys, or if that's really just noise for the most part.
Well, we do ask consumers a question. It's kind of a fill in the answer type question where we say, what do you think right now is impacting the economy? It's not, we don't ask up or down or for the better or the worse, we just say impact. But people do write long things and certainly long answers. And certainly there's still a big focus on inflation. Tariffs have moved down a little bit, but we did see a pop in people mentioning the shutdown. And the sentiment on all of those things from people who wrote longer answers were all pretty negative.
Dana, just want to wrap up by some of the proposals and bring up some of the proposals over the weekend from the president. $2,000 checks, the prospect of maybe a 50-year mortgage as well. As an economist, how would that change your assessment of this economy if we started to see those kind of policies implemented in Washington?
Well, they do sound inflationary, and I'm not sure how many people would take out a 50-year mortgage. I mean, you're still trying to pay it when you're 100 and in a nursing home. So I also think that $2,000, you can spend that in a day for a lot of lower income and even middle income consumers. That's rent for many people. And so it doesn't address the issue that price levels are still going to be elevated because you're seeing these tariffs being pushed through by businesses. So it's kind of a short-term solution, but not really a long-term solve.
Dana, appreciate the update and the reaction. Thank you. Dana Peterson there, the conference board. I see this from politicians all the time, from both sides of the political spectrum. I've seen it in the UK with the housing market repeatedly. You need to do something on the supply side. You need to do something on the supply side. Look at this, I've got a demand-side solution. Look at this, I've got a demand-side solution. And we're hearing the same thing from Washington over the weekend.
Give more money, have a better mortgage situation, not necessarily build more houses, because ultimately it has to come through the building mechanism. Look, this is going to be a question, and it's not just the $2,000 rate rebate idea, but there will be cash that will be given back to consumers in the beginning of next year as a result of some of the recent legislation. So you have to wonder what that's going to do, both on the inflation side, but also on the just economic activity side. And this is the reason why so many people who come on this show have been bullish. They're saying, wait for next year. It's going to be a pop.
Speaks to the divide on the FOMC right now. We'll have more on that divide in the next couple of hours on this program. Up next, we'll catch up with Sarah Hunt of Alpine Saxon Woods, Jeanette Lowe of Strategas, Megan Swiber of Bank of America, and Lindsay Piegza of Stifel. The second hour of Bloomberg Surveillance. Up next.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
A cidade estava sitiada.
Nisso eu começo, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision
of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The picture for the economy on a go-forward basis is actually pretty decent.
We're still very much subjected to that K economy.
Inflation is still around 3. The labor market is still okay. What is the argument for cutting rates?
Our base case is for further easing.
There is only so much that monetary policy can do.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. We're bouncing back up by 0.9% on the S&P 500. On the NASDAQ 100, up by 1.5%. In the bond market, bonds down, yields up across the curve. 10-year bond yield so far this morning higher by 3 basis points, 412.58, as this government takes a big step towards ending a record-long government shutdown.
So the idea here maybe is that consumer activity will pick back up. If people were planning not to go on their Thanksgiving trips, maybe they can reinstate those family plans. They don't have an excuse not to see Aunt Becky, so good luck. But there is this question of how much this is going to potentially add to optimism that can also fuel some sort of Santa rally, which a lot of people have been expecting.
How orchestrated were the events over the weekend just to push these politicians to get something done?
I was called cynical last week for suggesting this, so I don't want to suggest that this was all political machinations. However, we just had a guest on who said that a lot of the airlines quietly are suggesting that there was capacity to deal with all of the flights that they had planned. Look, either way, it highlights that this always has been the pain point. There does seem to be some resolution to possibly move this forward and then to potentially get a vote. If there is a vote to reopen the government, what happens next? A flood of government data? A flood of questions around what that means for the Federal Reserve.
You hope, and I hope too, maybe a drip to start, the September payrolls report, and then you've got to do some real work. Do some real work to collect the economic data, all the little data points, to finally release the economic data to the general public.
If you ever were worried about the credibility of markets and the credibility of labor market data, or just market data in general, this is the time to do it, because not only have you had staffing cuts of some 30% in some of these agencies to collect the data, but you also are going back and asking people what they felt a month ago when they were getting laid off, and it's a different kind of story. A real question here about the accuracy and whether the Fed needs this, whether they already have all the data they need to make a decision.
The data blackout, I think, became market negative last week for 2 reasons. Point 1 would be we started to put emphasis on lousy data when we typically wouldn't put emphasis on this kind of lousy data. Third-tier data like challenger job cuts suddenly became important. That's point 1. Point 2 is also, I think there was a consensus coming into this government shutdown that even without the data, the Fed wouldn't deviate from the median dot. think Chicago Fed President Austin Goolsbee poured some cold water on that in the last week, and the bias started to shift. The view became that actually, because we're flying blind now, maybe they'd just wait. Maybe they'd wait another meeting and wait until we get some more data.
A real question around if inflation is running hotter than expected and we are getting such messy noise around the labor market picture, maybe we shouldn't cut rates in December. I keep going back to Fed funds futures, a 65% chance of a December rate cut right now priced in, down from 92% the day before the Fed meeting. So definitely cold water poured by Fed Chair Jay Powell, but the ongoing run of Fed speak has raised further questions about just how disparate the opinions in the Fed are.
Bond yields up today by close to 3 basis points, 10s at 412.38, equities higher by 1% on the S&P 500. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as investors look to recover losses. Jeanette Lowe of Strategas with the Senate taking a first step towards ending the government shutdown, and Megan Swiber of Bank of America predicting a December Fed pause. We begin this hour with stocks gaining some ground. Sarah Hunt of Alpine Saxon Woods writing investors are seeking refuge in companies that demonstrate financial resilience, prioritizing steady dividend growers and firms with the strong free cash flow needed to weather a downturn. Sarah joins us now for more. Sarah, good morning.
Good morning.
There's some tech companies determined to eat into that cash flow, aren't they?
They are definitely determined to eat into it, and I think that between that and the fact that they're raising some debt is what's given some people some pause on the story right now. So I think you mentioned earlier today sticker shock that people are getting from some of these investments, so I think that there is an issue there.
So it's AI, the consumer slowdown. I mentioned that note from Stuart Kaiser of Citi. There's been a range of reasons for the pullback. What do you think is the dominant one in the last week?
It's interesting. I think it's really the and of all of it, and I think the government shutdown didn't matter until it started to matter. And when you start to see those pain points, people start thinking about when do we get this resolved, how do we get this resolved, and how bad does it make things going forward. And I think all of a sudden that started to matter. Again, you start to layer in enough things, and it's the totality of them, I think, more than an individual one.
Is it noise or signal, the sell-off that we saw last week? Is it something that is viable and just a blip that offers opportunities, or is it signaling that there is some weakness under the surface that needs to be paid attention to?
I think the magnitude of some of the declines on the misses gives you a little bit more pause than you would have normally. I think, there's nothing wrong with having the market stabilize and or have some sort of a downdraft for a while after hitting record highs, some massive change underneath. But I do think that there is some willingness now to look out and say these earnings better grow into some of these valuations, and or these valuations are on a high level. Markets don't generally correct because of valuation, but it certainly could give things pause. And I don't think you've seen a major downdraft here, but you definitely have seen some under the surface. You've seen a lot more percolating and bigger drawdowns than you normally would in individual names.
One thing that's raised some concerns, at least in conversations that I've had, is that one of the biggest players in this space is OpenAI. And OpenAI is a private company that's expanding very rapidly and has circular deals with all of the big tech players, and you don't have visibility into what they're doing, who they're hiring, how they're spending, or what their plans to grow in terms of specific new programming. How much does that give you true pause and actually make you lighten up some of your exposure to the AI players?
I think the real question is the functionality and how we are going to use everything. I don't disagree on the OpenAI, and I think that part of the issue was the sort of discussion around whether or not there needed to be guarantees or needed to be this or needed to be that. In the end, we're going to need a lot more power. Are we going to need as much as we think we are? I'm not sure. I think that there will be efficiencies in there. But I think that the overall build is going to continue. The emphasis on ChatGPT of all of the different large language models is one, but there are other ones out there. But I do think that the circular financing started to cause people to question it. And every time the questions come is when you start to see that NASDAQ wobble.
One reason why this has been such a difficult economy and market to call is because you have this sort of secular tech trade, John's talked a lot about this, overlaid on what could be a cyclical shift in the underlying economy. How much are you seeing a cyclical shift to the downside in some of the recent earnings reports, whether it's fast retailers, fast casual restaurants, or whether it's some of the other margin compression we've seen in other stores versus a sort of bottoming out in some ways, like the Mike Wilsons of the world seem to think?
Well, this is going to come down to, and this is where the data being not available is tricky. It's going to come down a lot to the labor market in the near term, because what is happening there is going to, I think, inform both the Fed and some other areas of what's going to happen next. And I think it's hard to figure out right now if that's an AI problem, if it's an inflation problem, if it's a cost problem. All those different pieces are swirling together, and without data, it's kind of hard to get a gut check on that. But I don't know that you're having a major change until we really start to understand how to use the tools. So I'm not sure that it's a secular shift in the labor market as so much as we have some cyclical issues going on and some higher costs.
Sarah, something's going on though. Earnings growth is fantastic, so corporations seemingly are making money. Employment growth is terrible. GDP is tracking really well at the moment. Could change given the government shutdown, but at the moment tracking quite well. And yet employment growth is pretty terrible based on various indicators. What gives? What explains that?
I think it's a combination of there's still some scar tissue of letting too many people go and people not wanting to let people go if they think there's going to be some growth. But I think that the movement in jobs is part of the problem. It's sort of like the movement in houses is part of the problem, because unless you can get, you know, it's interesting, they were talking about making mortgages assumable again, which they weren't for a while. Unless you can keep somebody's old mortgage, there's a lot of stuckness in the housing market. There's some stuckness in the labor market because people don't necessarily want to let people go and see what happens next. And I don't know how that resolves itself. In the near term, it's harder to get a job now than I think it probably was a few months ago. It's certainly from a younger person's standpoint, very difficult to get a job, because when I talk to my younger people, they are quite worried about that.
50-year mortgages, that's the proposal over the weekend. Do you buy it? Does that make sense to you?
I think that your previous guest made a great point about the fact or you made a great point about the fact that that's a demand response and not a supply response. We need to be able to build more houses. So there's either a regulatory push that needs to change, something needs to happen where you actually get more affordable housing built, and that is the problem right now. Making mortgages go out to 50 years, sure, it's like car loans to 10. It makes it cheaper, but does it make sense? And is that what you want to do to yourself from a financial standpoint?
Makes it cheaper on a monthly basis, but over the term of the loan, makes it a whole lot more expensive.
And you're paying all the interest up front. So at a certain point, you're just paying the interest up front to pay the actual mortgage back when you're, 304 years old.
Congresswoman Marjorie Taylor Greene pushing back against this proposal as well. Where is she on the political spectrum right now? Really pushing back.
The circle, as we've been saying,
right?
It unites on the other end after it gets to a certain place. There is a populist tilt right now, and we have to keep pointing to what it is responding to, and it is the cost of living, it is some structural issues, and the real debate needs to be exactly what the best way is to fix those.
Sarah, I just want to finish on tech. You can do single names, so I want to bring up a single name. Meta and Microsoft have had a really lousy 30 days, and sitting out all this spending is Apple. And Apple has had a really, really good 30 days. Is there a story there?
I think that the difference between Microsoft and Meta on the spending is that Meta's had more of a checkered history on money spent versus Microsoft, where I don't think you can make that argument. I think that they're stuck in a problematic, we need more capacity than we have. And I think for Apple, there's been another story too, because it's whether or not this is going to be a refresh year finally after all the years of hoping that it was going to be. So I think that there's some differentiation there. But to the extent that it's not putting any strain on Apple's balance sheet, this goes back to the argument about balance sheets and cash flow, right? You want to make sure in an uncertain environment that those companies are running through the proper amount of cash and everything else. I don't think that's a problem for Microsoft or Meta, but I do think that on the edges, that's starting to make people more wary, which is why we like to look for lots of cash flow.
A month ago, though, the bias was so different. Everything with AI related was up and to the right and up and to the right aggressively. And a month later, we're talking about Apple as if it's spending discipline. And a month ago, we had people coming on the program saying they're missing a moment, they're not spending enough. Is it a feature or a bug, the discipline of Apple?
It's both, depending on exactly what the psychology is. And I will say that this year has not been rewarding the people who are more cautious with their dollars as much as it's been rewarding the people who are spending like crazy. But when people start to worry that that spending like crazy can't go on, they go right back to the folks where they think that there's some discipline there. So it could be a little bit of a back and forth. I think it's an and not an or.
Sarah, it's good to see you. Thanks for being here. Thank you, Sarah Hunt there of Alpine Saxon. Words on a tech story. Tech story's better this morning. NASDAQ 100 higher by close to 1.5%. The S&P 500 up by 0.9. Let's get you an update on news worldwide with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. The government shutdown may be coming to an end. The Senate voted 60-40 to advance a bill that would fund most of the government through the end of January. 8 moderate Democrats broke with their party leaders to advance the bill. The House also needs to approve the measure before it goes to the president's desk for his signature. Meanwhile, Pfizer won the bidding war for the weight loss drug startup Metsera. It secured the $10 billion deal after Danish drug maker Novo Nordisk said it did not plan to increase its offer. Metsera cited a call from the U.S. Federal Trade Commission regarding potential risks from proceeding with the proposed Novo deal structure. And President Donald Trump became the first sitting president in almost 50 years to attend a regular season NFL game yesterday. The president watched as the Detroit Lions defeated the Washington Commanders 44-22. There were loud boos from some spectators when Trump was shown on the video board standing in a suite with House Speaker Mike Johnson. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next, Democrats divided.
Democrats will not back down. Fighting to lower health care costs is a righteous fight.
It was our judgment, after 6 weeks, going on 7 weeks of this shutdown, that path wasn't working.
That conversation up next with Jeanette Lowe of Strategas, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
This week is set up to be an absolute snooze. Check it out. As much as I love Governor Waller, these are the headlines for you. Governor Waller's coming up later this week. On Wednesday, he speaks. G7 meeting for Foreign Secretary, so look out for that, I guess. Some media earnings, Disney, Paramount. I'm not trying to sell this. There's nothing to sell. It's very, very quiet through the trading week, at least on the schedule.
I might get excited about a couple things.
Over 3s, 10s, and 30s.
There's 3s, 10s, and 30s in terms of the auctions. There are a couple of earnings that will be very interesting. CoreWeave out later today. I think that'll be interesting for the AI trade. Disney coming out. A host of others as well. So we do get, you were talking about some of the entertainment sphere. Fascinating. We get a lot of Fed speak, and we can really dive into some of these deep issues because we have the time, because there really isn't a lot else.
If the shutdown ends and we actually get some data and they put the payrolls report on the calendar, then I'm all in. Things will look interesting.
So, do you hear that? Jonathan Farrow would like you to just put the payrolls thing back on and then he can get excited again. Otherwise,
might happen.
He's going to strike.
You know, might happen by Friday. We'll see. And then everyone will say it's dated. We don't want September. We want October.
No,
I want October too, but let's start somewhere.
They'll say it's dated, and then it will come out, and it will move markets dramatically. So, watch what they do, not what they say.
Equities bouncing back this morning, up by 0.9% as we take a major step towards ending this government shutdown. The Nasdaq higher by 1.4. Under surveillance this morning, Democrats divided.
Democrats will not back down. Fighting to lower health care costs is a righteous fight.
Those of us certainly participating in the Democratic caucus are 100% committed to working on the issue of the ACA premium tax credits. It was our judgment, after 6 weeks, going on 7 weeks of this shutdown, that path wasn't working.
So here's the latest this morning. The longest U.S. government shutdown moving closer to an end. 8 Senate Democrats breaking with their party to advance a funding measure with Republicans. Bloomberg's Mika Solner joins us now for more. Mika, is Minority Leader Schumer losing control of his party?
Well, there's been a lot of criticism of how Leader Chuck Schumer has handled this whole debacle. I think that he's facing a lot of pressure and critiques from not just his Senate colleagues privately and publicly, but also the House progressives, and the majority of House members, Leader Hakeem Jeffries, even moderate members like Angie Craig of Minnesota, for example, are furious at this deal, saying that they're not going to vote for this when it comes to the House. You know, granted, it's likely to pass with just Republicans anyway. But yes, definitely Schumer has taken a lot of heat for not being able to keep his caucus together.
Mika, what are the next steps? Can you describe the process over the next few days to really end this thing?
Yeah, absolutely. So I think, once the Senate gets through here, all eyes are going to be on the House, who has been out of session for the past few weeks. Speaker Mike Johnson has to give 36 hours notice to members, and that means a lot of members will become flying in back to DC and or even taking long drives due to delays. But they're going to have to pass this, and then we're going to have to see what happens in the next couple of months too, when some of the funding levels expire on January 30th. But that's a fight for another day.
Yeah, let's just leave that there for now, Mika. I don't want to think about that. Mika Solner there of Bloomberg down in Washington, D.C. We're going to do this all over again very soon.
I really hope not, because that would really devastate a lot of people who are depending on this income and depending on these programs. So let's hope that that's not the case.
Jeanette Lowe, strategist, joins us now for more. Jeanette, welcome to the program. A significant step. Any wrinkles you'd point out, potential wrinkles down in Washington that might delay this from ultimately ending?
Well, yeah, thank you for having me. So I would say, first of all, we had seen that over the past 2 weeks, members of Congress on both sides of the aisle had been moving towards figuring out how to end the shutdown. The pain had definitely been growing with federal workers not being paid, with SNAP benefits not going out, and then the FAA restrictions on airspace beginning on Friday really started to put some additional pressure on members to get to a deal. So we thought that coming into last week, there was a deal on the table. Both sides were looking to see what would happen in the Tuesday elections, see who would have the upper hand. Obviously, Democrats felt emboldened after that. But at the same time, the additional pressure of just what is going on with flight delays, people still not getting SNAP benefits, has definitely put pressure on members to come to a conclusion. And we basically have a very similar deal that was advanced in the Senate yesterday that was very similar to what we were seeing at the beginning of the week. There are some potential wrinkles here. Obviously, the Senate could uphold, or certain members of the Senate could uphold the vote and slow it down. So they're going to be looking to get unanimous consent to stay and see if they can actually get it out of the Senate today so that the House can then move. But that could be a potential issue and potentially delay it longer. Could House members have difficulty getting back into DC? That could be another issue. But they only need a few probably Democratic votes in the House to get this across the finish line, and there are probably enough to do so. So I think overall we do think it's going to be done hopefully by the end of the week, but there could be some wrinkles along the way.
Jeanette, has anything been accomplished in more than a month that the government is shut down in terms of understanding what the issues are, moving policy forward, preventing this from happening again?
Right. I mean, so one of the things that's always been an issue with a shutdown is the party that puts the shutdown into place generally does not win the concession that they were looking for to get the shutdown in the first place. So Democrats did not get an extension of the Affordable Care Act subsidies. Yes, they got a promise to have a vote in December or by December to do an extension. And that may be unsuccessful, particularly in the House. So that's not necessarily a win here. I think for Democrats, the one win that they can point to is pulling back some of the layoffs during the shutdown. That was an agreement. I think appropriators here are happier because at least they are starting to get some of these FY26 appropriations bills across the finish line, but generally the shutdown does not create a lot of movement. Democrats might also be able to point to the fact that they've raised the issue of healthcare affordability going into the 2026 midterms, but to your point, not a whole lot has been accomplished.
There's also a question politically of whether the tone has shifted, whether it was the elections that just took place or whether it's the government shutdown highlighting some of the issues that galvanize American voters. How much will cost of living concerns shape the remaining couple of months of this year heading into early next? The idea that the next few months are going to be dominated by proposals to try to cater to people who are worried about cost of living.
Absolutely. So, I mean, I think one of the things is that just, again, people not being paid, food stamp payments not going out, that has definitely put a lot of pressure on members to get this shutdown ended. And that is going to continue to be an issue going into the end of the year. Once we get into 2026, there is actually a lot of fiscal policy support for the consumer. There's about $150 billion of tax refunds that's going to come out in the February through April tax refund season. It's actually a 44% increase from what we had last year. So there is a lot of support for the consumer coming. But in the meantime, a lot of consumers are concerned about prices and affordability, and Democrats and Republicans have also kind of been noting this issue as well and talking about healthcare premiums and SNAP payments and grocery bills and things of that nature. So you are going to probably see more talk about how can we help the consumer long term, whether it's figuring out some other solution for the ACA subsidies, whether it's the talk of the tariff refunds, things of that nature. But I think that that is going to be a big concern going into 2026 and the 2026 midterms. But we do want to highlight that there is obviously a lot of consumer stimulus coming from the tax bill that Congress passed back in July.
Jeanette, in moments like these, politicians attempted to do bad things. And I wonder if we revisit some of the things on the campaign trail. For instance, TD Cowen raising this proposal, maybe the president thinks about going back to thinking about capping interest rate costs on credit cards. Jeanette, could that come back on the table?
You know, I don't think that is necessarily something that they're going to be more focused on. I actually think that if they were going to do anything, it would probably be another tax rebate. You know, Trump obviously brought up the idea of these tariff rebates. Secretary Bessent kind of indicated over the weekend that it may just be tied to these tax refunds that are coming next year as part of the One Big Beautiful Bill Act. But I think they'd be probably more likely to do direct payments to consumers, that talk about the ACA subsidies not being subsidies anymore, but being direct payments to maybe like a health savings account for individuals, putting the money directly back into people's pockets. I think that's more likely at this point than some of these other proposals.
Jeanette, appreciate it. Thank you. Jeanette Lowe there of Strategas. Bramo, watch this space.
Yeah, this is going to be the node of all debate politically going toward the midterms, given the fact that this is the galvanizing factor. Ultimately, the incumbent party always suffers the blame for any economic woe that is experienced in real time, and this time is no different. People feel the overall price increase. So trying to convince them that inflation, the rate of increase is coming down, is very difficult, which is why you're hearing some politicians, Scott Bessent, President Trump, coming out and saying, actually, prices will go down. How are they going to do that? The idea of deflation, outright prices going down, unless you get a China-like shock, similar to what we've been seeing over there.
The President Biden handbook of how not to do things. Don't pretend it's not happening, and then don't offer demand-side solutions to something that needs a supply-side solution. That's what I would say is the don't do things handbook from President Biden, how not to do things. There is a risk that they're tempted to reach for that handbook and do exactly the same thing. And that's a problem.
That's been the proposal so far, because that ultimately is the quick fix.
Up next on the program, we'll catch up with Megan Swiber of Bank of America, predicting a Fed pause in next month's meeting. Plus, Danny has some morning movers for you. Taiwan semi shares rising despite slowing revenue growth. That stock is up by 2%.
coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
A much better tone to this market. Equity futures higher by 0.9% on the S&P 500. On the Nasdaq 100, higher by 1.4%. The Nasdaq bouncing off a 3% loss last week, the biggest weekly loss since early April. In the bond market, 2s, 10s, and 30s shaping up as follows. Risk on. That means bonds are lower, yields are higher, up 3 basis points across the curve. 2s up to 3.59. 10s this morning up to 4.1277, going into a week full of bond auctions across 3s, 10s, and 30s.
That's pretty much all that there is, so we're going to really ramp this up. We've got $58 billion of 3-year notes being sold today at 1 p.m. Tomorrow's Veterans Day close, so really nothing going on, but we'll be here. Wednesday, we've got $42 billion of 10-year notes being auctioned, and Thursday, $25 billion of 30-year bonds. At some point, maybe you'll get pushback. The biggest takeaway from these auctions has been the incredible demand for income. And frankly, there is so much cash still sloshing around the system looking for income that has been the full story. Does that change? Can that change? Or is that continuing to be the theme?
Don't you think this show should follow the Treasury market calendar?
You know what I think. You're just baiting me. You're rage baiting me right now.
Should we be on air tomorrow? You know, Treasury market's closed. What are we going to talk about?
Should the weather be nice? I mean, come on, obviously. But we're going to be here, and we're going to find lots of things to talk about, and probably it'll be one of the most exciting days that we could possibly imagine.
Snoozy week ahead for you.
Oh, come on.
If you didn't know.
Really?
If you look at the calendar, hardly anything on the schedule.
Watch, something amazing is going to happen tomorrow.
Danny's going to make it exciting with your morning movers. Danny has more. Hey, Danny.
I'll do my best, John. I guess if you own NVIDIA, you're making money today, which is pretty cool and pretty exciting. That wasn't the case last week. Shares of NVIDIA fell 7%, its worst week since April. So we are seeing a rally in the big cap tech stocks. Maybe some optimism over the government shutdown, too, helping things along. So much optimism. Even TSMC, the U.S. ADRs, are rallying despite the fact it reported earnings that saw some slowing growth. But Jensen Huang, which NVIDIA, their biggest supplier, is TSMC, said that they're growing stronger and stronger every single month. So again, both those shares are higher this morning. We also had earnings from Barrick Mining. The gold miner, obviously doing very well considering what the price of gold has been doing, so well that the CEO flagged the strong amount of cash flow they had meant that they could up their dividend. It's now going to be 12.5 cents quarterly, and they're going to do a 5-cent special dividend because of that cash flow performance coming in. And they're going to increase their stock buyback. Another $500 million have been authorized so far this year after $1 billion already. So that's 4.5% rally for Barrick Mining. Finally, ending things with HCA to the downside, the biggest loser in the S&P 500 pre-market, down 5%. This looks to be off the back of Dems getting closer to an agreement on the government shutdown, going forward with that procedural vote. The fear is that the extension of government subsidies when it came to the American Affordable Care Act was good for a company like HCA. Have Dems caved on this point? Sure, potentially reporting suggests that there will be a vote on this in December, but for now, those shares are falling, John.
That development behind a lot of market moves this morning. Danny, thank you for the update. More from Danny in the next hour. On our radar this morning, the Senate advancing a bill to end the government shutdown with the help of a group of moderate Democrats, but the passage of the short-term funding measure in the House is not guaranteed due to opposition from Democratic leaders. Elsewhere, Federal Housing Director Bill Pulte confirming work towards President Trump's pitch for 50-year mortgages. The administration making an effort to make housing more affordable, critics arguing the loans are more expensive with less equity. And finally, the New York Fed President John Williams saying financial strain on lower and middle-income Americans could threaten the U.S. economy. Williams telling the Financial Times the December rate decision will be a, quote, balancing act. Coming up at 8:30, so about an hour from now, we'll be speaking with the San Francisco Fed President, Mary Daly.
Yeah, and she came out with a blog post earlier this morning echoing some of the concerns that John Williams was talking about. And she asked this question: are we in the 1970s or the 1990s? We can't ignore the 1970s or the post-pandemic inflation run-up, but we can't ignore the rest of history either. Talking about trying to take into effect the overlay of the technological changes of AI versus a potential cyclical shift in how to identify either.
Do you point to the 70s or the 90s? What are you coming down on?
Honestly, I don't know the answer. I think that this really is a question in terms of how big of a shift is AI, and how much does that really increase efficiency in a dramatic way? And how much do we implement proposals that lead to price increases and inflationary forces that start to accompany slower growth? And that is a similar kind of smell as the 1970s.
If we get $2,000 checks, it might make that decision a little bit easier.
Well, if that continues with anything else, right. So there is this question of how do you deal with the fact that wages are not increasing very quickly at the lower end? And Torsten Slok pointing to that this morning, that's really falling behind. We were talking about that last week with Bank of America. And that really is, to me, one of the key questions. If you're not seeing wage growth and you're not seeing job creation, well, then what are we looking at a time where inflation is still elevated, but potentially what's the node for it to continue to increase if people aren't getting paid?
That's the tell right now. If you look at the labour market, what's behind this massive drop-off in employment growth? Is it demand cyclical, or is it supply? Is it structural? And is wage growth the tell at the moment? Because of the industries that we depend on, immigration, you'd expect to see wages push up to attract that talent. Mary Daly's point, the San Francisco Fed president, is actually, that's not what you're seeing. So that would lean me more towards cyclical factors than structural ones holding this labor market back.
She's saying it's a demand issue for labor. It's not a supply issue if you're not seeing the wages really go up commensurate with what you would be expecting, which makes her think, okay, hold on a second, there's something else going on, and maybe the labor market needs more support. On the flip side, other people point to the inflation rate and the fact that it still has been high, and a lot of people are worried about cost of living issues. So at a certain point, you balance these two, it's a very difficult moment. And I'm not sure that 1970s or 1990s are the right corollary. Maybe it's the 2020s.
55 minutes away from tying ourselves into knots with President Daly. Let's stick with the Federal Reserve. Megan Swiber at Bank of America writing, our house view is still that the Fed holds off on a cut at the December meeting and indeed doesn't cut again until the middle of 2026. Megan joins us now for more. Megan, good morning.
Good morning.
You're essentially saying that Chairman Powell's last cut as Fed chair was last month. He's done.
That's indeed true, John. You know, ultimately, the Fed reaction function that we see right now, and we're hearing this from a number of voters, is this caution around inflation. And, you know, I think to help answer this question of is it demand, is it supply related, look at some of the claims data. Claims is still quite low, which is a pretty decent sign to me that people are not being fired at large, at least in the private sector right now. And what we see in our B of A card data is still this resilience of the U.S. consumer and the importance of the consumer. We see, generally speaking, in terms of that leading what we look at from a labor market perspective. We usually see consumption lead labor, not the other way around.
So the last time they put out forecasts, which was September,
yes.
They conceded the outlook hadn't really changed, but the risks around the outlook had. Let's cut risk management. When they get together in December, the middle of December, and they have to put out new forecasts, are they going to say the same thing again? The outlook hasn't really changed.
Well, I think, John, it's really about this balance of risk assessment, and what changed in September and why they penciled in this additional cut at the December meeting is because they were viewing this risk more to the downside on the labor market, and we're thinking that that would drive more of a downside shift in inflation. But if we look at some of the inflation data right now, we're still seeing a lot of strength in services inflation. That tends to be more of the cyclical component of the inflation basket. And then again, we are also in, importantly, this absence of data from the Fed. Probably one of the first data points that we're going to get out once the government reopens is the September labor report. And in our view, that's going to be above consensus expectations.
Why aren't wages increasing more then, if this is the demand picture that you're talking about?
Well, while we are certainly seeing this cooling in hiring, we're not seeing companies turn to be outright firing folks. And so the reason why we're not seeing this uptick in wages is largely because we're seeing this shift from a supply perspective. AI may be one factor that's slowing the growth of employment overall, but we're not seeing this turn the other way around in terms of net firing right now.
If the Fed does cut rates, does that make you less likely to go into duration? I mean, how much does that affect the longer-term inflation backdrop?
Yes, and this is exactly the question that we're asking ourselves right now, Lisa, is how to think about December and the path for the Fed near term versus what some of these risks are for a Fed more medium, longer term. We understand Powell's reaction function pretty clearly. We have a nice indicator from a lot of the Fed speakers right now in terms of how they're thinking about this balance. But we worry about a new Fed chair that's going to be thinking about the balance of risks differently, namely not considering 3% inflation to be meaningfully above target. We're hearing some of those comments from Myron and Bowman right now that 3% is okay, or discounting that 3% inflation rate. And a new Fed chair may be more concerned about the slowdown that we're seeing in hiring, which we think is more supply-driven. They may be overweighting from a demand perspective.
Why isn't the current Fed also tacitly saying that 3% inflation is fine? Because essentially that's where it's been for quite a while, and it's been above that 2% level for more than 5 years. So at a certain point, maybe they're saying they're still going to get down to the 2% target, but at what point are they going to say it will get down maybe in 2073?
And this is a big issue for the fixed income market, because if you look at what the market's pricing for inflation in the medium longer term, they're giving the Fed full credibility on this. You look at where 10-year breaks are priced, considering that 30, 40 basis point differential between CPI and PCE, the market's giving the Fed full credibility on this 2% target. And if you do have a Fed that's getting more comfortable with 3% inflation, cutting alongside that, we see more upside to being long inflation. And we like that at the 10-year part of the curve.
It's kind of strange how well anchored market-based inflation expectations have been. How credible this pursuit of 2% seems to be when it's anything but based on reality, how the data's come in and how the Fed's behaved over the last few years.
It's something that I check almost every single day. Honestly, the five-year break-even rates and the 10-year break-even rates. And I've just been looking at where is the breakout going to come? It just has not come. And I wonder how much people are looking at disinflationary forces, whether it's from AI and accounting for that, before accounting for some of the inflationary aspects or other things. I don't really have an answer.
I've said this week would be super snoozy, with a caveat. I did say this in the last hour as well, that we might get some economic data. So let's talk about the data. You said above consensus expectations on payrolls once it's released. What's above consensus right now? What's good for the labor market?
A good number is just still steady job creation that's modestly above break even. And break even right now, the market thinks is probably much lower than what we had been seeing previously, call it around 50K or so. And a lot of that comes back to what Lisa's point was related to the supply balance that we have in the labor market right now, the slowdown in hiring. So any number that doesn't indicate an uptick in the unemployment rate, I think is pretty decent for the market right now.
So 60s, 70s is enough to keep the Fed on the sidelines?
I think so, John. And again, it's going to be this decision in the absence of us likely getting any more inflation data through the December meeting. We very likely had the last CPI print that we're going to get until the December Fed meeting. CPI was slated to come out the second day of the December Fed meeting, but inflation is not something that they can actually calculate retroactively. They do this survey throughout the month, and we're still now part of the way through November. Going to be a tricky one.
This is really important because I'm not sure how many people are quite aware of this. So you're suggesting that even if the government reopens like tomorrow, we move along, that they might not have CPI by the December meeting?
They may not, because oftentimes when the government's closed for a while, it takes them a while to actually get back to a normal production schedule in terms of publishing the data. So it's very likely that we won't get any more inflation data through the December meeting.
Megan, thank you. Megan Swiber of Bank of America, thank you very much. It's been too long. We'll have you back soon, I'm sure, no doubt. How long is it going to take to get that economic data? Because there's a lot of Fed officials trying to put together policy, and they need it right now.
And how reliable will it be? Are we looking at the right data? And I think that this was what Mary Daly was talking about also. Are we looking at the typical metrics if everyone can't agree exactly what they mean? And I think that needs to be an increasing part of the discussion, because even if we get that data, does it create more clarity about the path of this economy? I don't know. Every time we get the data, people just double down on their opinions and explain why they think that this absolutely supports that.
Confirm their priors. 100%. I mean, there's nothing too new about that, is there?
Well,
they become married to a view.
Yeah, but it feels more disparate right now because the view is less clear.
We said a few times, cherry picking season. in both the economics profession and in equities as well. Equity futures on the S&P 500 positive by 0.9% with an update on stories worldwide with your Bloomberg Brief. Back with us is Yahira. Hey, Yahira.
Hi, John. A Paris court is deciding whether to release former French President Nicolas Sarkozy from prison. The appeal comes less than 3 weeks after he began serving a 5-year sentence for conspiring to use campaign funds from Libya. Sarkozy spoke in court this morning, reportedly saying his life in prison was very hard and once again proclaiming his innocence. Meanwhile, BBC Director General Tim Davie and News Chief Deborah Chernus resigned amid allegations the broadcaster misled viewers by editing Donald Trump's January 6, 2021 remarks in a documentary. Speaking after she stepped down, Chernus said mistakes are made, but the BBC's journalists are hardworking people who strive for impartiality. And a new court order says the Trump administration must fully fund November food aid benefits for low-income Americans. A U.S. appeals court chose not to block a judge's order requiring the release of full SNAP payments. The Trump administration wants to continue making only partial payments during the shutdown, arguing it doesn't have enough funds. That's your Bloomberg Brief. John.
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next on the program, the shutdowns, economic strain.
Thanksgiving time is one of the hottest times of the year for the economy. It's, Black Friday and all that kind of stuff. Right. And if people aren't traveling at that moment, then we really could be looking at a negative quarter for the fourth quarter.
That conversation up next with Lindsay Piegza of Stifel from New York City. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum or we will never create the solutions that we need.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Just one weekend of travel chaos, enough to push the Senate closer to ending the government shutdown and helping to unlock these gains here this morning. Up by 0.9% on the S&P, on the Nasdaq up by 1.5%, on the Russell. Small caps up by 1.2%, following the first back-to-back weekly losses for the small caps since April. In the bond market, 2s, 10s and 30s, yields higher across the curve by something like 3 to 4 basis points. 10s up by close to 4 to 4.13, 2s at 3.59. A lot could change between now and the Fed's next meeting on December 10th, a month away. Andrew Hoddenhorst of Citi putting this out, that the Fed will likely have 3 additional jobs reports in hand by the time they meet a month from now.
Yeah, looking forward to having that open and some of the data. They might have the labor market reports, but as we were just talking about with Megan, that we might not have the CPI report. So how much can they actually weight what we get from the labor market? I am curious about whether the fact that holiday shopping is not going to get disrupted by the government shutdown is really giving people a boost to the overall economy, and we're seeing that this morning.
You know we love to spend in this country, Bramo.
Never get between...
Get out there and shopping.
Yeah, never get between an American and their credit card.
Exactly. A few weeks away. Thanksgiving just around the corner. Equity futures then doing better on the S&P 500, higher by 0.9%. The Fed debate continues. Special programming, 8:30 Eastern time, about 41 minutes away. We'll catch up with the San Francisco Fed President, Mary Daly, at 8:30 Eastern time. That conversation just around the corner. Under surveillance this morning, the shutdowns, economic strain.
Thanksgiving time is one of the hottest times of the year for the economy. It's, Black Friday and all that kind of stuff. Right. And if people aren't traveling at that moment, then we really could be looking at a negative quarter for the fourth quarter. I'm comfortable with 2% inflation. Inflation is like the Queen Mary, my friend Alan Greenspan used to say. And so when you go from the almost 4% that we had in January down to the mid-2s, then that's a trajectory that usually has momentum.
So here's the latest this morning. The shutdown adding to economic uncertainty as the White House estimates losses of $15 billion per week. Lindsay Piegza of Stifel writing investors will be listening closely to any indications of a growing divide among policy opinions, the threshold for additional rate cuts, and broader expectations for policy going forward. Lindsay joins us now for more. Lindsay, welcome back. What is the strongest argument right now for this Fed to sit out the December rate cut decision?
Well, I think right now, when we look at the broader pace of economic activity trending near 3%, coupled with inflation still elevated well above the Fed's 2% target, I think it's going to be difficult to justify any further policy easing and really solidify the need for the Fed to take a pause, sit on the sideline, allow further data to evolve, and give the Fed a better sense of where we're headed going forward. But right now, not only is that justification not there, but the sense of urgency is far from there as well.
Lindsay, when we've been looking at other data points to try to backfill what we haven't been getting from the government, everyone seems to focus on the labor market. What metrics are you watching for inflation on the other side of things?
I think one of the key metrics that we're focused on right now is inflation expectations. Despite the fact that the Fed continues to vocalize a desire to get back to 2%, as we've seen over the past several years, they've failed to take the needed steps to ensure a return to price stability. And the market is seeing that. When we look at the latest inflation expectation calculations, near term still up near 5%, but longer term, so we're talking 5 years and out, still up near 4%. So there is a lot of concern that despite where the Fed is right now, further inflationary pressures may be coming down the pipeline.
Lindsay, you're talking about, I believe, the University of Michigan sentiment survey, because when I look at, say, break-even rates, it's still around the 2.2% over the next 5 to 10 years. So when you take a look at the market-based inflation expectations, they haven't risen. How do you explain that sort of a discrepancy?
Well, I think right now it goes back to the telltale story that we're feeling more inflation from a consumer standpoint than maybe the market calculations are presenting. That 2.5-ish to 3% range, consumers are feeling 20% increases, 30% increases, at least over the past 5 years across a number of key categories, from transportation, household energy, to your morning coffee. This has been compounding pressure on the consumer. And of course, as we know, inflation expectations feed directly back in to the realized inflation calculation. And this is something that the Fed has historically kept a very close eye on in order to not allow inflation expectations to be on a further underlying inflationary data, this is one key data point to suggest the Fed needs to take a further, more direct focus on taming price pressures in the marketplace.
Lindsay, the last time we had a big moment with inflation was, of course, coming out of the pandemic, but it was easier for the Federal Reserve that time. Even though they took their time, it was certainly easier because the labor market was so tight. What's interesting about this moment, Lindsay, is that they feel not great about inflation, but they also feel pretty lousy about the labor market as well. And you see that across sentiment surveys. And Lindsay, I'm curious why you believe we're tracking so well with GDP and yet attitudes about the labor market are so lousy.
Well, I think when we look at some of the labor market conditions, we have to be careful not to put too much stock in one data set or one data point for that matter. First off, top-line job creation has slowed markedly over the past couple of years, but this is somewhat expected in an aged recovery, not to mention an ongoing structural shift with businesses increasingly relying on technology and the adoption of AI. So we no longer need 200, 300,000 jobs to reach that full employment level. Second, just because we see that one data point, again, top line job creation is slowing, other metrics suggest we're on more solid footing. When we look at the unemployment rate, still near-ish 4%. When we look at wage growth, still up at 4%. When we look at jobless claims, still very range-bound as they have been for the past couple of years. So just as there's some indications of cooling, there's vast other indications that the labor market is far more solid than some of these more dire predictions.
So, Lindsay, just to follow up, because we've gone over this ground a few times throughout summer, Chairman Powell appears to have shifted his view on the labour market and the way he anchors his view around the labour market. He took your view of things at the start of summer. He anchored his view of the labour market around the unemployment rate, and then things changed through the summer, and he appeared to anchor his view around the deceleration we'd seen in overall payrolls. Where do you think we'll be by the time we get to December?
Well, I think it was pretty clear. We saw in this statement that the Fed downgraded their assessment of the risks on the employment side, but not necessarily in terms of forward-looking thinking, but as justification for the September and October rate cut. But Chair Powell clarified during the press conference saying that he does not expect any further deterioration in labor market conditions, suggesting that we may have reached this point of stability, further justifying then a position of policy on the sideline.
Lindsay, thanks for the reaction. Thank you very much. Lindsay Piegza there of Stifel. That's two guests back-to-back that appear to think this Federal Reserve should and will sit this out over the next few meetings.
People are concerned about the fact that inflation has remained higher than the target for more than 5 years. And there is this dissonance right now between how people feel about the overall price increases they felt over the past few years and the rate of change, the rate of increasing prices now. And that, I think, also is tying into people's minds. I just wonder how you explain that with the pushback that you're seeing from corporates in terms of what consumers are willing or not willing to pay with price increase absorption.
I will say this, many lessons coming out of the pandemic, many, but here's one. When the consumer tells you they're not feeling good about the labour market and or the broader economy, take them seriously. Because I'm not sure they were taken seriously enough with regards to the inflation story of a few years ago. And I think this time around there is a temptation to excuse this away. There's clearly a problem. They're telling you there is one.
And that's the reason why people are looking at tertiary data to try to understand the whole story.
Whether it's the Fed's role to fix it, that's a different question altogether. Coming up on the program, Greg Bowdle of BNP Paribas, Anisha Sherman of Bernstein, San Francisco Fed President Mary Daly, plus Peter Supino of Wolfe Research. The third hour of Bloomberg Surveillance up next.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
The risk on trade has been very strong, very long.
Positioning is very crowded, and people have already priced in most of the good news.
I don't think the bull market's over.
Earnings have been rock solid.
At the end of the day, it's going to be the earnings that is going to drive this market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures bouncing back higher by close to 1% on the S&P 500. On the Nasdaq, up by 1.5. A better start to a trading day as the government takes a big step towards ending a record long shutdown. In the bond market, bonds down, treasuries lower, yields up across the curve by 3 basis points. 10s at 412.77 into a week full of bond supply. Lisa running you through the numbers, 3s, 10s and 30s coming throughout the week. And watch this space on this calendar right here, because at some point when the government reopens, we're going to get a strong indication of just when you'll get that delayed payrolls data.
We believe that the September labor market report was already drafted, so it won't take that long for that to come out. If we get the data and it does confirm either strength or weakness, how much do people suddenly get a new anchor around the big question, which is, will the Fed cut in December? But more broadly, what is the longer-term neutral rate, and how is the balance of risks shaping up on the FOMC?
Important conversation coming up 29 minutes from now. Fed President Mary Daly checking in with us here at Bloomberg Surveillance to break down what she's seeing in the labor market and whether the 70s is a decent way of describing this moment, or for that matter, is it the complete opposite? Is it the 90s?
Is it a question of stagflationary doom and a doom loop that you saw during the 1970s? Or are we looking at something that is a productivity boom on the backs of a technological revolution? And that would be the 1990s, albeit with some excesses built in economic from a stock market perspective. Nonetheless, it changes how they respond to policy. And there really is a key question of how do we even understand a labor market that does seem to be really softening amid GDP that's growing at a really healthy rate. It has been the mystery for so many people out there.
So many different points of tension right now that we're still trying to reconcile. I don't think a month's worth, 2 months, 3 months worth of data is going to address that problem. Just how are we tracking at 3% GDP? with employment growth this low? Just how are companies doing this well with employment growth this low? And for how much longer can that story persist? And I've been asking that now for several months, and maybe it goes on well into 2026.
This is the reason why you're not hearing Fed Chair Jay Powell, or perhaps this may be the reason why you're not hearing Fed Chair Jay Powell say, this is data-dependent Fed. You didn't hear that last time. Of course, we're not getting data, but how are you dependent on data that everyone interprets slightly differently? This is the key question. What is your framework? And I think that goes to the stock market too. This question of, are we in a bubble? Are we not in a bubble? Do you see this as a huge technological shift, or do you see this as inflated valuations that are inflating everything and destined to maybe get deflated a bit?
We've certainly seen Labour decouple from the broader economy. I'm not sure how much longer that can persist, but it's been going on for a while. But the S&P were bouncing back by 0.9% for the broader equity market. Better than good so far this morning. Coming up this morning, over the next hour, we'll catch up with Greg Battle of BNP Paribas, with stocks rising to begin the trading week. The San Francisco Fed President, Mary Daly, on a divided central bank, and Peter Supino of Wolfe Research with earnings from Disney and Paramount Skydance on deck. We begin this hour with stocks rising as the possible end of the government shutdown opens the door to resuming the release of official economic data. Greg Battle of BNP Paribas writing, the Fed, in our view, remains on course to continue the cutting cycle at the December meeting. We think this sets the stage for higher equities, but also high volatility. Greg joins us now for more. Greg, good morning.
Good morning.
If you've been tracking the program over the last 30 minutes, we've had back-to-back guests saying the Fed will sit this out in December. Why do you think they'll be cutting interest rates?
Well, obviously the macro data is not only delayed, but it's going to be messy once we get it. We've obviously had one cut for this cycle, and I think that if we view those as insurance cuts, the Fed trying to act preemptively for what may happen in terms of the labor market, then I think there's little reason to think that they won't act again in December.
Is there more space to deliver another risk management insurance rate cut with inflation closer to 3 than it is to 2?
I think it feels like it. I think the question is which part of their dual mandate do they focus on? And if people are worried about cracks emerging in the labor market, we know these things can get non-linear very quickly. That maybe is the part of the mandate that they'll be more focused on.
John mentioned some of the other people who were on the show talking about the Fed sitting this out, and they drew comparisons that sounded somewhat more similar to the 1970s than the 1990s. You say this is a market regime that is much more similar to the late 1990s. Why do you say that?
Well, as an equity market person, I think what we have going on there clearly looks more similar to the 90s than the 70s, at least at this point. And with the macro data such a mess, maybe the best thing to do is to focus on the micro data. We've just seen the bulk of Q3 earnings season, and I think Q3 earnings were undoubtedly good. You know, across the large cap tech space, we saw strong earnings that resulted in analysts upgrading their 2026 numbers. If we look further down the market cap spectrum, away from just that narrow mega cap tech, a lot of the industrial cyclicals posted pretty good earnings as well.
Is this just a story, though, of the AI build-out? Is this a story where you have a sort of technological shift overlaid on an otherwise weakening economy?
It could potentially be, but if that technological shift is one of the biggest pieces of the economy and the biggest piece of the equity market, and it remains on course for at least the medium term, the next year or so, then that can continue to drive the market higher.
Issue that we've got, Greg, is this is not just a technological shift per se. It's a corporate strategy shift. The way these companies are being run is changing as well, from asset light to asset heavy. What does that mean for how you value them?
I think it creates more uncertainty, and I think that is really at the core of our view, that we think we could see a higher market but higher volatility. The idea of these super cash-rich companies, you know, having these incrementally higher capex spends that eventually have to become debt-funded certainly increases the risks. But that kind of increase in leverage, that arguably more efficient balance sheet, can also drive the market higher.
Are we beginning that debt cycle now? And how are you explaining that to investors about how they should navigate this moment?
Yeah, I mean, it certainly feels like we are moving on to the next stage of the cycle, but the question people have is that the late stage, is that the last stage of the cycle? And it doesn't feel like it. It still seems that we're in this environment where we're going to get really strong earnings growth, and we're seeing upgrades to those earnings forecasts, but an increase in leverage, an increase in debt, we think manifests in equities as an increase in volatility.
So it could be a bubble, but ride the bubble because you've got a lot of gains before it pops. Is that right?
Yeah, exactly. So we're looking back at things like the late 90s, and one of the lessons from the late 90s was if you got really bearish in something like 1998, that was a very painful lesson. And if we think back to 1998, it was the kind of mini Fed cutting cycle which was the precursor to the strongest and most volatile period of returns from 98 into 99.
So wouldn't that be an argument that it would be a liability potentially and destabilizing for the Fed to cut rates now to just fuel a bubble that is developing and that a lot of people seem very worried about?
It could be, and that's the challenge for the Fed. There's a ton of crosswinds, an inflated equity market versus a weakening labor market, and the question is, which do they choose to solve for? And our view is that for US equities, if we do have this very strong earnings outlook and this AI capex cycle plowing on, and the Fed do choose to solve for the labor market and cut rates, that almost creates one of the most bullish and volatile scenarios for equity.
What's your credit team saying about this? Are they saying the credit market will accommodate this debt cycle, this leverage cycle?
Yeah, I mean, it's something that's obviously emerging for them with corporates that have incredibly strong balance sheets. So I think it's a story that the credit team are going to have to get to grips with, and it's going to be something that changes their market and is a kind of evolution.
Are they suggesting the credit market's wide open for it?
So at the moment, the credit market seems in a place where spreads are very, very tight, and there was huge demand for this issuance. So I think that for them and for us, it's more a question of kind of watching that stage of the cycle start to emerge and see where we are there.
We've seen the early signs of it, Lisa, at least over the last few weeks. Meta, Oracle, Alphabet with a monster one last week as well.
I'm struck by something that Bob Michael of JP Morgan Asset Management said. He said there is so much cash sloshing around right now, and there is so much money looking for income. And you have to wonder, when there's a lot of cash looking for a product, Wall Street will create it for them. So at a certain point, how much is the fact that there is a lot of cash in the system looking for some income going to fuel behavior just like this? To your point, John, earlier, rewarding the behavior that so many companies seem to be engaging in with releveraging.
I think you kind of alluded to this, but doesn't that make the equity story slightly more compelling, even more compelling?
I think so, absolutely. So that's where, when we talk about bubbles and cycles, the irony is if you think we're in a bubble, the right trade might be that we're at that expansionary trade of the bubble where risks do become larger, leverage becomes greater, but that's often where some of the best returns, albeit with some of the highest risk, occurs.
How would you characterize the pullback of the last week then, if we can call it that, a few percentage points?
Yeah, I mean, it's one of those things where going into this, we think things got very overextended. So we saw Bitcoin rally, gold rally, the most shorted names rally, NASDAQ rally, and we saw an explosion in call option volumes. So it felt like things were getting stretched. And I've described it as a healthy correction, where we've seen all of those assets kind of come back in concert, and we've seen some of the equity positioning metrics that we track kind of wash out. And as I said, this has come as against the backdrop where corporate earnings have been very strong. So I don't think this is really a fundamentally led correction, and obviously we've had the backdrop of the government shutdown and other noise in the background that's maybe contributed to that. But bigger picture, it seems to be more of a technical washout versus fundamentals that seem stronger.
Just to be clear, the correction that you're talking about is less than 3% last week.
Exactly, it's a tiny
so this is not
correction,
exactly a correction, but I just want to make that very clear. I want to point out, though, that right now you're talking about all the reasons why you're getting more and more bullish. What would you see that would make you pause, that would think maybe this is not the story that I thought that it was?
The key driver of the bull market has been this boom in AI-driven capex. And if something happens to put the brakes on that, I think that could be something that could end up terminal for the bull market. But we don't see any signs of that happening in the short term.
Greg, this was thoughtful. It's good to see you.
Thank you.
Thank you, sir. Greg Battle there of BNP Paribas. Just as the equity market might have started to push back, debt market opens its doors and says welcome, and they issue a ton of debt.
And guess what? Everyone seems happy. The only people who don't, people will say, it's just you guys who are nervous Nellies who are raising concerns about this. At a certain point, when you have a lot of cash in the system, it is looking for some money back. And guess what? Wall Street will find ways to give that to them, at least in the short term.
Futures up this morning by 0.9%, some outperformance on big tech. On the NASDAQ 100, higher by close to 1.5%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent says President Trump's suggestion of a tariff dividend could come via the tax cuts in his signature economic policy bill. Bessent made the statement when asked about Trump's social media post where the president said each American would receive a dividend of at least $2,000 from the money tariffs are generating. Meanwhile, NVIDIA CEO Jensen Huang says he's asked TSMC for more chip supplies to keep up with booming AI demand. Speaking at a TSMC event in Taiwan, Huang says NVIDIA's AI memory chip suppliers have scaled up capacity to support the company. TSMC CEO confirmed Huang's request, saying the chip maker expects record sales every year. Meanwhile, Tyson Foods shares are rising 3.6% in the pre-market. The nation's largest meat packer said it expects results for 2026 to be little changed despite record high prices for beef. Tyson's beef profits have been under pressure from a severe cattle shortage that's driven up prices and constrained volumes. Higher chicken demand has been able to offset some of those losses. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, the morning calls, plus Anisha Sherman of Bernstein warning of cautious guidance ahead for retailers. That conversation up next, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Both businesses and consumers are wary about the economy going forward. Businesses are deciding that they're going to continue to just wait and see what happens regarding tariffs. Meanwhile, consumers, we saw a big drop in consumer confidence earlier this year. It's kind of stabilized and moving back and forward over the last few months, but it's still much lower than it was pre-tariff announcements.
It's close to rock bottom. That was Dana Peterson of the Conference Board. Consumer sentiment not great, but this market does better as we open the door to ending the government shutdown and potentially the floodgates for economic data in the months to come. S&P 500 futures up by 0.9% on the Nasdaq, up by 1.4 on the Russell, up by 1.25. That's the equity setup. Let's get you some morning calls. First up, Citi raising its price target on Nvidia to 220, expecting a beat and a raise in its next earnings report. That stock is up by 3%. Your second call from Stifel, raising its price target on Hyatt to 158, forecasting high unit growth. And finally, JP Morgan cutting its price target on Target to 100, expecting a mixed earnings report next week. That earnings report next Wednesday. Target this morning positive by 0.2%. Let's stick with the consumer sentiment sinking to the lowest on record as the government shutdown and high prices weigh on the economy. Joining us now to discuss is Lindsay Dutch of Bloomberg Intelligence. Lindsay, just tell us where the consumer is based on what you're hearing from fast casual restaurants and what we're seeing from some of the retailers elsewhere.
Yes, thanks for having me. You're right, the sentiment indicator is low, but there are some positive signs coming from other sources. CNBC NRF Retail Monitor came out today with positive momentum in October, heading into the pivotal holiday season. And when I think about some of the hardlines retailers that I cover, there is some positive commentary coming from those companies, a Tractor Supply, a Somni Group, basically saying demand is resilient to improving, and that's really boosted mostly by a higher income consumer. But those consumers are still very selective and very value focused heading into the holiday season.
Lindsay, you talked about the high income consumer. What explains the divide between something like the travel stocks, which seem to be flying, excuse the pun, doing very, very well, and what we're seeing elsewhere, some of the worst performers this year, the likes of Lulu, the likes of Deckers?
Yeah, I think some of the retailers, the stock movement is in a reaction to, profit, which is reflecting tariff costs in this back half of the year. It also can be reflecting, outlooks. And a lot of the retailers are issuing, remaining very conservative on their outlooks. I cover Elf Beauty. They reported last week a very low outlook for the year, and the stocks do react to that, a lack of confidence that this back half of the year, could be solid.
Lindsay Datch of Bloomberg Intelligence. Lindsay, thank you. Appreciate it. Anisha Sherman of Bernstein writing the following: going into third quarter earnings, off-price retail is holding up. However, we see a risk of cautious fourth quarter guides accounting for macro headwinds. Anisha joins us now for more. Anisha, let's go straight to the calendar. So next Wednesday, we should hear from Target. The day after, I believe, we hear from Walmart. What are you and the team expecting to see?
Across retail, as your correspondent just said, we are seeing some improvement in October. And so, August and September were weak. October looks a little bit better. However, I think as you put the quote up, I'm worried about Q4 guides. We had a very strong Q4 last year. The consumer was resilient. We had strong data up and down the spectrum, all the way up from Lululemon down to the hard value retailers. And they're now going to be anniversarying those numbers with a much weaker consumer, sentiment dropping now for 4 months in a row, especially for middle income consumers, and pulling down towards value. So my concern will be very cautious guidance from those management teams in a year where there's a lot of uncertainty and consumer sentiment doesn't look great.
Anisha, when you do your channel checks, how much are a lot of retailers going for volume, trying to squeeze their margins or not raise prices too much and try to attract the greatest number of people into their stores versus try to pass along some of those price increases and make up the difference on high margin items?
That's a great question. Going for volume has not been a winning strategy for retail. All it does is lead to a price war and a race to the bottom. And so, and this year, retailers are trying to do the opposite. They're trying to find ways to pass on some pricing. They've been burdened by tariff costs. So they're trying to find ways to pass on pricing on products that are working. They're not doing it peanut buttering a price increase across everything. They're doing it on select items that are selling well, new product launches that are doing really successfully, or items that appeal to higher end consumers who are more inelastic on demand and can absorb some of those price increases. So they are trying to salvage some of the margin that they've lost from tariffs. They're not trying to race to the bottom and cut prices on volume. Though if we get a really weak holiday season, we could end up in that situation in January. And so that's part of the concern around holiday guidance.
How much are you seeing a real kind of bind for some of the lower income or the discount stores in particular, given the fact that they don't have the same kind of flexibility to raise prices on key items to pad their margins?
They are doing some price raises. So the off-pricers, for example, are raising prices on select items. They're maintaining those price value gaps. And I think what protects them is they've seen full price retail take pricing up significantly, high single digit to low double digit across the apparel, footwear, and accessories sector. That's been the typical price increase for the last 4 or 5 months. So they now see room to catch up a little bit. They're not going to exceed that level of price increase, but they're going to maintain those gaps, or maybe even keep those gaps a little bit wider, but still take some increases. So they are doing it even at lower price points.
Lacey, another word I hate the most when it comes to retail earnings.
What's that?
Choiceful.
Oh, yeah.
Choiceful. Yeah. It implies they have choices.
Well, it also is a really nice way of saying picky,
right?
Because they have to be picky because they have a limited budget, and that's why they're going out and trying to make their dollar go the furthest
their
it possibly can.
Their choice is constrained
exactly
by their budget. Why do we say choiceful?
Because it sounds nice. It's like they're full of choices. Yay, democracy.
But they're not. Anisha, I have a problem with that word. Do you see a choiceful consumer or one that's constrained by tighter budgets?
I completely agree with you. I think choiceful and constrained are two very different things. You could see a high-income consumer being choiceful in the sense that there's a lot of new innovation and they're being choosy about what they want. we're not seeing that. We're seeing a constrained consumer now. We're seeing people that are trading down because they have to, and they're making difficult choices, cutting back on holiday spending, not because they're being particularly choosy or picky, but just because they're constrained. And that continues to be what pushes consumers down to those value retailers. So I think it will be positive for the value retailers, but everybody is going to see a tougher consumer making more difficult choices this holiday.
We saw so much of that play out with Walmart. Quarter after quarter, they talk about trade down. Anisha, is that story largely played out?
I think there's more to it. I mean, they are trying to attract a higher income consumer base, particularly through the Walmart Plus membership and so on, and then keep that consumer sticky spending on across the portfolio. So they are continuing to do that. I think they will continue to be able to do it because they continue to have better assortments as well and better price points because of their size. So I think that trend continues, and it comes out of maybe more middle-income retailers or smaller retailers that maybe can't keep up with those assortments and price points.
Anisha, to that point, is Walmart still the bellwether for the U.S. economy and the U.S. consumer, particularly on the lower end? Or do you have to look elsewhere? Are there other retailers that are better bellwethers?
That's a great question. It is the bellwether in general across retail, across the consumer. But when you're talking about low-income consumers specifically, it used to be very much so. And now there are other retailers that are more representative. If you look at the off-price retailers, the dollar retailers, some of the hard value retailers, they will probably tell you more about the lower-income consumer than Walmart necessarily will anymore. Walmart has become more broad-based and pulling more from high-income cohorts. So it's not a very low-income indicator anymore.
Anisha, just heading into the holiday season, one thing that we've been focused on is how much holiday hiring there actually has been. And there have been signs that some of these retailers are not hiring as much to fill their stores as they have in the past. What are you getting the sense of in terms of that particular hiring spree?
They are being very careful. They're trying to manage their P&Ls. They're trying to manage their labor costs. This is not a holiday season where they're going all out. So yes, they're being very careful, tightening the belt, not just on hiring, but even on kind of marketing into the holiday, visual merchandising. Everything is managed very tightly because they are expecting the consumer to come in with a tighter wallet. And so they are responding in kind and trying not to make the compares too difficult year over year versus a very strong holiday period that we had last year.
Anisha, one final question before you go. Two of the worst performing names on the S&P 500. I know you've got calls on both, Lulu and Deckers, both down around 50 to 60%. Dreadful year for the stocks. Into 26, what's your message to anyone tempted to step in, pick up the pieces, and buy these names?
Short term, I wouldn't. I have a neutral on Lulu and I have a sell on Deckers. I think they've both had self-inflicted mistakes that have driven this terrible performance through the year, and numbers have come down through the year. I think medium term, I'm more optimistic on Lululemon because they have had such a tough year. On Deckers, I'm inherently negative. I mean, I think they are not prepared enough to pivot into other areas. They're very focused on running, which is a super competitive sector. And I haven't seen indications that management are thinking more long term.
Anisha, thank you. It's always good to see you. Make sure on the call you start, criticizing some of these CEOs about the word choiceful and all that kind of thing. Anisha, thank you very much. Anisha Sherman of Bernstein doesn't need me to tell her what to do.
I was about to say,
call,
this is your lobbying call. You're like, please represent me.
I should dial in on the media call and say that.
Let me just tell you.
Yeah, I just hate that word.
I know, it does imply. It's
ridiculously misleading.
It's a very positive spin on an otherwise cyclical call on exactly where we are and the power of the consumer.
I'll take a step back. Coming up on the program, San Francisco Fed President Mary Daly. I'll take a step in on what a divided central bank means for interest rates. Plus, Danny's going to join us with your morning movers. CoreWeave, a name that Lisa's looking at this morning as well. Shares bouncing back after last week's double-digit plunge. That name is up by 5%. That conversation just around the corner.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
60 minutes out from the opening bell, equity futures shaping up as follows. A bounce back in this market off the back of weekend developments in Washington, D.C., taking a significant step towards ending a record-long government shutdown. On the S&P, higher by 1%, on the Nasdaq up by 1.5%, with some single names. Your stock movers this morning. Here's Danny with more. Hey, Danny.
Hey, good morning, John. You're seeing CoreWeave after shares falling 22% last week in the whole fear of the AI trade. Has it gone too far? That's starting to reverse thanks to the fact that, one, there's a more positive sentiment today, and two, CoreWeave will be reporting earnings after the bell tomorrow, so those shares up today, rather, so those shares up 5.2% in anticipation of that. We also have some deal news that developed over the weekend. The bidding war between Pfizer and Novo Nordisk over Metsera. They are developing an obesity pill. You had Pfizer match Novo Nordisk's bid price for it, and then regulators came out voicing some uncertainty about what it would look like if Novo Nordisk bought Metsera. All of that meant that Novo bowed out of the race, and it does mean that the bidding war has ended. So you're seeing Metsera shares fall about 15% in today's trade. Finally, we got a little bit of earnings today. 90% of companies in the S&P 500 have already reported, but Instacart reported earnings this morning, a outlook that at the high end exceeded expectations. They also talked about the fact that they had a lot of growth coming in and a lot of positivity from different partnerships they have, for example, saying that all of that outweighed any of the issues with SNAP benefits being taken away because of the government shutdown. So those shares up 7.6%, John.
Danny, thank you. More from Danny in about 29 minutes' time alongside Matt Miller for Bloomberg Open Interest at 9 a.m. Eastern Time. Let's turn to the Federal Reserve. Policymakers remaining divided ahead of the December meeting. The San Francisco Fed President Mary Daly writing in a blog this morning, we must ask ourselves, are we in the 1970s or the 1990s? We can't ignore the 70s or the post-pandemic inflation run-up, but we can't ignore the rest of history either. The Fed President Mary Daly joins us now for more. President Daly, welcome back to the program. Always good to see you. Let's just start with that question that you ask yourself. What's guiding your assessment of where we are?
So I'm looking at both inflation and productivity. And if you look at inflation, you're seeing that it's been pretty contained so far in the goods prices, which have been directly tariffed. And then you look at the other parts of inflation, you just don't see much of a run-up. So that's good news. And inflation expectations, what people expect, remain very well anchored. Look at productivity, and you see that productivity is rising, GDP growth is rising, while the labor market is slowing. So that tells me there's a little bit of that boost coming from firms looking to do more with less, but that's also causing a slowdown in the labor market. So the 50 basis point adjustment we've made has helped support the labor market, but still keeps policy restrictive so that we can put downward pressure on inflation.
President Daly, what are you looking at to determine whether it's the 1970s or the 1990s?
Well, I'm going to really look at things that improve productivity, to think about the 90s, and it's more than just the stock market valuations for AI companies. It really is about the companies out there who might be using AI, and then asking them, going directly to them and asking them, what's it doing for your bottom line, and how are you using it? And what we're hearing are pretty encouraging but very early signs. They see how it can help their bottom line, how it can improve their productivity, even how they can be supportive of their workers, give them more interesting work, take the less interesting work away. But they all tell us it's early days, so more to come on that. And then on the inflation part, are we in the 1970s, really asking employers and firms, what are you doing with prices? Are you thinking about raising your prices? How are you going to think about losing volumes if you do so in a slowing economy, especially for consumers, from the 50th percentile down? And putting those two things together, I think we'll get a lot of clarity about which direction we're heading. And with policy, been slightly adjusted, we are in a good place to continue to evaluate the information before we make any decisions. We can't know ex ante before the data come out and before we get that information, really what we're facing. We just have to have an open mind about which one it could be, and maybe other periods of history I didn't even mention.
President Daley, how different would the neutral rate be if it were, say, more like the 1970s or more like the 1990s? Just how different would Fed policy be in response to one or the other paradigm?
Well, there's many nuanced ways it could affect the neutral rate, but I can back up from that and just ask what were the policy remedies. If you think we're about to have an inflation run-up, then we obviously would have to hold policy tighter for longer because we wouldn't want that to occur. Honestly, Americans have endured already too much inflation, and we really need to get that back down to 2% to restore price stability as we've committed to. On the other side, if it's productivity, you would start seeing the economy able to run a little bit longer. Maybe if you go back to the debates of the 90s, we saw the labor market slow. Workers were insecure, but the labor market had unemployment that was fairly low, and many at the time were worried that could spur inflation. But Chairman Greenspan held on with his colleagues. They didn't raise rates, and what you saw was, the 90s, which was a booming time, and we ended around target inflation, and we had a productivity boom. So you're trying to balance those two things together, and it means not looking just at headline information, but getting below that information, talking to firms, talking to consumers, talking to workers, really on the ground work like we do at the reserve banks and other places. The Fed is built to do this on the ground work as well as look at the published data.
President Daley, reading the blog post this morning, it seems like you're leaning more toward the 1990s side of things than the 1970s. Is that right?
Well, right now, I'm in the West. I have the 9 states in the Western United States, and it's not just Silicon Valley that seems interested in AI. No matter who we talk to, whether they're, small businesses, medium or large businesses, manufacturing, tourism, et cetera, they're using AI in a way that they say is going to improve their productivity, and they're already seeing parts of it. So when I see that, I'm like, okay, we need to think about that. What really will spur this as an ongoing thing is if they start to change their business processes. So that's what I'm looking at. Now, that means, but I guess a different way to say that is we cannot take our eyes off inflation. Again, Americans have endured high inflation too long. That's our mandate. So while I'm looking for productivity gains and seeing if they're going to continue, I'm also keeping my eye completely focused on inflation to make sure that it doesn't pick up in a way that would suggest we need to do more or we need to hold longer.
President Daley, how would you respond to the criticism that the Federal Reserve as an institution has taken its eye off inflation, that inflation is closer to 3 than it is to 2, and the Fed's been cutting interest rates?
I don't think that if you unpack the inflation data, you really see signs of that. It's true that headline inflation is printing at that level, but you have to take apart that inflation and ask how much of it is the effect of tariffs passing through to goods prices that we expect to be a one-time price level adjustment and not a consistent run-up in inflation. And if you unpack the data, what you see is you don't see inflation running up in services or housing, and importantly, you don't see it spreading into inflation expectations that would be the thing that would continue to run up inflation going forward. We also see a labor market that's softening and wage growth that is moderating, so you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
President Daly, can we just pick up on the cost of labor? I think this is really important right now. Clearly, and it's hard to dispute this, it's in the data, we've had a massive step down in payrolls growth. What's behind that is a little bit more confusing. Is it demand? Is it cyclical? Is it structural? Is it something else like immigration? What's your tell right now? What can you point to that helps tell you it's one thing over the other?
Yes, you look at prices. In this case, the price of labor is wages. If it was simply about supply and firms were still scrambling to find workers to fill what was jobs that were supported by the previous immigrants, you would find wages going up as they bid for workers to try to fill those jobs. But that's actually not what you see. You see wage growth slowing, even in sectors where immigration played a larger role. And so that, to me, says it's a demand shock, a negative demand shock, along with just a coincidental negative supply shock. So you lost workers, but you lost jobs at the same time, or you had job growth slowing. And what we're seeing now is does that continue to net out, right? What if the supply of workers doesn't keep going down, but the demand for workers does? Well, then we'd end up with a rise in unemployment. So have to keep squarely focused on those types of things. We're definitely in a low hiring period, and interrogating that labor market, continuing to watch the information, see what firms do next. That's going to be the important part.
And it's something that a lot of people have said really is the K-shape, the idea that particularly on the lower end, you have not seen wages keep pace with the rest of the income spheres. I just wonder, though, how much we are seeing a massive amount of inflation in asset prices and how that feeds into what you're looking at, especially at a time that may rhyme with the 1990s, and we know it happened after the 1990s. How much do you weigh that? How much do you have to pay attention?
Well, you know, one of the things that you do, so financial market conditions are one input into our decision making, that one of many inputs. You know, we have two goals: price stability, full employment. We're trying to think about what inputs affect those two variables, those two goals. But what I look at is, if you look under the valuations, you know, people are really talking about one of two things. This is going to be a transformative technology. AI is going to change the world to be like electricity or the steam engine. And then the people who are a little more skeptical are saying it's going to be a business as usual technology. Think of computers and the internet. The thing that's true about both of those is they're both productive. You get productivity from both of those. They both help with growth. They both help the pie in the U.S. expand. And so we're not talking about a bunch of ideas with no backing. We're talking about, you know, equity investors, not highly leveraged, going in and making bets really on whether it's going to be transformative or business as usual. But everybody agrees on one thing: it will change productivity.
At the same time, President Daly, some people would suggest that, yes, you will see stocks continue to go up in the face of another rate cut. But at the same time, the transmission mechanism of the additional cuts are slower to take place. It's less efficient in terms of the pass-through, just based on how much lending there is, whether it's in the private lending sphere or beyond. How do you measure these things at a confusing moment?
Well, you know, I guess this argument that we've somehow lost our power, monetary policy doesn't transmit, I simply don't see it in the information. If you go out and you look at what happened when inflation was running really, really high, we raised rates pretty aggressively, and mortgage interest rates rose rapidly, car loan rates rose rapidly, and the economy slowed, inflation came down. Right now, what I'm seeing is we adjust rates, mortgage interest rates come down, not one for one, that's not how it works. Usually is less than 1 for 1, but they come down. You see a little more activity in the housing market, you see a little more activity in the borrowing market more generally, and you see that dynamic work. So I guess the most important thing is just to remember that monetary policy acts with a lag, and right now we're making decisions not just for what's going to happen next week, but what's going to happen in the next 6 months to a year. So that's how we have to think about it with our forecasts, and then how we adjust policy as those forecasts evolve.
How frustrating has it been not to get government data?
You know, I really want the information, the fullest amount of information we can possibly get. But one of the things that I think may be underestimated in public about what the Fed does is we're regularly relying on government-provided data. That's the gold standard of data in the world. We're also relying on private sector surveys, which have been collected for many, many years, and we can correlate them with the government-collected data over time and know exactly how they relate to one another. And then, of course, there's really no replacement, especially at inflection points in the economy, for talking to businesses, workers, communities, and, consumers, asking people what they're really doing. And then, I like to do this. Go to the parking lots of your favorite retail stores and look at how many cars are in the parking lot and what people are buying. That tells you a lot. Airports are full. People are out there. You can go to a sporting event or a concert, see how many people are there. What you see is an economy that is slower than it was. Consumers that are not, they're more picky about what they spend on, but they're still out there participating in the economy, and that's how we get the information we need to make the right decisions that are according to our mandates, but mostly for the American people.
President Daly, you've been working with the Fed or on the Fed committee for a long, long time in these debates. Have you ever seen it more divided than it is right now on the FOMC?
Of course. I mean, if you look at the transcripts and the meeting minutes, and it's helpful, go back and look at the 1990s debates and go back and look at the commentary around the 1970s. It is a misnomer to think people always agree. The right way to think about it, in my judgment, this has been my experience, is that the debate we have, I wouldn't even call it division. I would call it differences of opinion that are really healthy in a debate about trying to make policy in an uncertain time with no truth. We don't have truth. We have forecasts. We have our best estimates. We have taking the evidence and then taking it again and looking through it with different lenses. I see that as a strength of the committee, a strength of the Federal Reserve, and importantly, is delivering the best possible decisions we can make. So I have seen this many times before, and I think it's always at inflection points that you see the broadest amount of disagreement, and it's exactly what I hope people would want from a committee making decisions on inflation and full employment. It really does help us make sure that we're doing the best we possibly can.
So you're happy to confirm on the record you have not seen Governor Myron and President Smith in a fight in the two-day meeting? Can we confirm that, President Daly, today? That hasn't happened.
You always try, and yet I'm not a rookie.
Mary Daly, thank you. As always, good to see you. The San Francisco Fed President, Mary Daly, I'd never accuse you of being a rookie.
Never. Honestly, her comments are really interesting, and it highlights what a tenuous moment this is, really, given the fact that there are all these different overlays. I just wonder how different the neutral rate would be if we're in the 1970s versus the 1990s, and what that does for a Fed that is incredibly divided at an inflection point.
They are really in a difficult moment right now, in a very difficult spot. Mike McKee's going to join us now for more. Mike, you were tracking that conversation. You've got one of your own a little bit later.
Yeah, we're going to talk to Alberto Musalem, who is a voter this year, and I suspect that at least Mary Daly's answer on what happens in December is going to be sort of the template for him as well. We don't know yet. We're going to look at the data and wait until the last minute, because this is a time when they can do that, and we give them something of a pass because we don't have the data either. I had two thoughts on Mary Daly. One is on the productivity question. Yes, AI could produce a big jump in productivity, but when? And right now is when we're talking about the monetary policy moves that will take effect maybe 6 months to a year from now. But how long is it going to take AI to get in there? And two, on the jobs aspect of it, if you are an illegal immigrant, you're not going to come out to seek a job, even if employers bid up wages. And if you're legal, you might not either, for the same reason. And there's also a question about the skills that federal workers who've been laid off have. Are they going to be able to find jobs in the private sector fairly easily? It's a very complicated picture, so I'm not sure whether her arguments are correct or not.
Mike McKee, thank you, sir. Looking forward to the debate, your conversation that you'll have a little bit later, more insight into the debate on the FOMC. Your question's the right one. Look, we've seen a divided Fed before. We've seen dissent before, but this feels particularly unique. Two-way dissent, really difficult moment, a feeling that this low churn dynamic can't continue forever. It's got to cut one way or the other. And we've said a few times, by the time this conversation is complete, one half of the committee won't look very smart. The other half of the committee will look very smart, and I'm not sure which half is which.
Yeah, and to understand that it is a complicated moment is important. I mean, everyone who comes on the show has a completely different view as well. You just wonder how you set policy going forward and how relevant some of these things are going to be going forward. I mean, I'm just trying to wrap my head around it. You just talked about mental gymnastics. It feels like mental gymnastics. You know, the idea of the AI overlay on a cyclical economy that's equally confusing is enough to make anyone's Monday very exciting.
We made the promise a few hours ago we'd tie ourselves in knots.
We did it.
We have. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump pardoned people who were allegedly involved in the attempt to overturn the 2020 presidential election. Those pardoned included Rudy Giuliani, Sidney Powell, Mark Meadows, and several 2020 campaign aides accused of sending false elector lists from three states to Congress in an effort to keep Trump in power. Meanwhile, Robinhood shares are getting a boost up 3.7%. According to the Financial Times, the company plans to give users the opportunity to invest in some private AI firms. The trading platform aims to do so by offering tradable shares in a new fund managed by its subsidiary, Robinhood Ventures, which they say will invest in a portfolio of 5 or more private companies. And 2 Major League Baseball players were indicted over the weekend on charges pertaining to gambling fraud. Cleveland Guardians pitchers Luis Ortiz and Emmanuel Clase were charged with fraud, conspiracy, and bribery. They face allegations of throwing specific pitches during game situations so gamblers could place corresponding bets. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. Thanks for this morning. Up next, Peter Sapina of Wolf Research with media earnings on deck. That conversation up next. Live from New York, you're watching Bloomberg TV.
Crises, 2 essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
If you look at inflation, you're seeing that it's been pretty contained so far in the goods prices, which have been directly tariffed. Look at productivity, and you see that productivity is rising, GDP growth is rising, while the labor market is slowing. So the 50 basis point adjustment we've made has helped support the labor market but still keeps policy restrictive so that we can put downward pressure on inflation.
Just moments ago, that was the San Francisco Fed President Mary Daly weighing in on the debate of the moment at a very divided Federal Reserve. Let's turn to the earnings. Paramount Skydance reporting after the closing bell as investors speculate on its reported bid for Warner Brothers Discovery. Peter Supino of Wolf Research joins us now for more. Peter, welcome to the program, sir. David Ellison on the call a little bit later. What do you want to know?
Well, David Ellison's plans are ambitious, and so there are so many questions, and many of them are as yet unanswered. They shared a lot of strategic perspectives when they closed on the company, but they're all initial, preliminary, high level, and so we can't wait to hear what they have to say about everything from cost reductions to their ways to grow their streaming business, and at the core, what they'll do to invest in the studio, because this sports is an important traffic acquisition tool if your goal is to be everything to everyone every day, or to have something for everyone every day, which is roughly the way Paramount described their streaming strategy. But once you bring them in the front door with the sports, which is sort of the milk in the grocery store analogy, it's the low margin regular traffic driver, you need to be able to sell them something that's really profitable. And that's the trick with Paramount. Their content has had big highlights, especially Taylor Sheridan's work. But there has not been enough breadth of fresh scripted content to keep people coming back historically. And that's why the company only has about 70 million global subscribers, of which about 2/3 come in through other companies.
So, Peter, how much can they raise prices on us?
It was funny listening to Mary Daly a few minutes ago talk about inflation. One part of the economy which has had no problem increasing prices has been streaming video. Today, 3 major streaming services will cost you close to $80 unless you want to accept advertising insertion. And the top 5 streamers will cost you over $100 on a premium basis. So everybody in the ecosystem has pricing power. Paramount Plus has tested the pricing lever quite a bit. They're somewhat inhibited, though, because of those 2/3 of the customers that come through third parties. When you are distributing through a third party, your pricing is not the same as the retail pricing. You have to negotiate with Amazon and Roku and Charter and other distributors to get your net cut. And that's an important long-term strategic limitation for Paramount Plus.
Peter, this was great. Hopefully we can do this again later this week, and we'll talk about the Walt Disney Company as well and take stock of these earnings after the close. That was Peter Supino of Wolf Research. Hulo's killing me. I mean, you're setting me up for this. It is driving me
this might have been intentional.
Absolutely nuts.
Well, yeah, the package. It's like, what happened? Just the bundle. I mean, we're going to be spending like $300 a month soon.
Let's just go back to that, shall we?
100%.
Landman 2. Looking forward to getting into that. There we go.
Coming
there
out
we go.
soon.
Shout out Paramount for that one. Coming up tomorrow, Jeff Curry of Carlisle, Sheila Kolu of Jefferies, Henrietta Trays of Vader Partners, and Omar Aguilar of Schwab Asset Management. From New York City, this is Bloomberg.
Day 1 at the Nitto ATP Final. Top seed Carlos Alcaraz got his campaign off to a winning start with a straight sets win over Alex de Minaur. The Spanish superstar fired 21 winners on his way to his 68th match win this season. Two-time champion Alexander Zverev rallied from 6-3 down in a second set breaker to close out Ben Shelton in his opening match.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to
continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1, this is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2, then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3, then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Good Monday morning, 30 minutes till the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, an end in sight. Democrats concede on health care, setting up a potential breakthrough to end the longest shutdown in U.S. government history.
And an end to that shutdown would help lift the data fog for a divided Fed. This hour, we're going to hear exclusively from Alberto Mosalem of St. Louis.
Meanwhile, on the corporate front, the AI bubble debate rages on as chipmaker TSMC reports a slowdown in sales.
It's one of the stocks we're watching this morning, Matt, because even though they reported a slowdown, shares are still higher. Let me show you what a lot of these tech AI kind of names are doing. TSMC, the ADR up 2.5%, AMD up 3.3%, Qualcomm 1.6%. So it was in line with analyst estimates what TSMC gave, and the stock and its main customers, all of these, are moving higher alongside the broader tech market because tech had such a bad week last week, so there's a little bit of dip buying going on, too.
Yeah, it turns out maybe we cared about a government shutdown. Health insurers like Centene and Oscar are falling as lawmakers move closer to ending that shutdown, but without getting anything that the Democrats wanted in terms of health care extension. You can see Centene actually down 7 2/3%. Oscar Health down further, more than 8%. HCA Holdings, which has already been pummeled, obviously down another 5.5%, Danny.
So a disappointment for the insurers that maybe we won't get the ACA extension, but for the rest of this market, it rejoices. After 40 days of deadlock, the Senate has kick-started the process to end the shutdown. It will reconvene in 2 hours from now. Then the bill would head to the House if passed. President Trump discussed the bill's progress at the White House.
Looks like we're getting very close to the shutdown. We'll never agree to give any substantial money or any money to really prisoners, illegals that come into our country. And I think the Democrats understand that. And it looks like we're getting close to the shutdown ending. You'll know very soon. Thank you very much.
John Harney, an editor for Bloomberg News in Washington, joins us now. John, how close are we to ending the shutdown?
This seems like the end game, the beginning of the end. However, you have 535 lawmakers, so things could still go wrong. Now, the House is still out, as it has been since September. The members are coming back. That will take a day or so. So we could see the government reopen perhaps by Friday.
I mean, the last I heard from Chuck Schumer, he's not for this deal. Elizabeth Warren says it's a horrible deal, and Hakeem Jeffries says his caucus is going to vote against it. So how does the math work?
Well, about 10 Democrats, I believe it was 10 Democrats, split from the Chuck Schumer's ranks to say that they would support ending the shutdown and take this offer that had been on the table by John Thune to vote on several appropriations bills that would fund different departments for an entire year and keep other agencies in operation till the end of January in exchange for a vote on health care subsidies, which led to the shutdown in the first place. So Democrats did not get the subsidies enacted, which would have been their goal. However, they did certainly call attention to health care, to the health care problems health care issues that many Americans face.
All right, John, thanks very much. John Harney there in Washington, D.C. Let's get to tech now, because TSMC reported a 17% rise in sales for October, so an increase, but at the slowest pace since February of 2024. Bloomberg Intelligence head of global tech coverage, Mandeep Singh, joins us here at the desk. So is this a slowdown that we should be worried about?
Well, so for a company like TSMC, which has a diversified business, I mean, we are all focused on AI, but AI is still, about 15% of their overall revenue. So I think what may be in play here is the impact of AI CapEx on the non-AI hardware spend. If anything, this is a lasting trend. We don't know, because there is seasonality in the monthly numbers. So it could happen there, third month of the quarter may actually end up growing 40%, and then, they'll still be over 30%. But with that being said, I think there's a real risk that some of that non-AI spend is getting hurt because of all the AI CapEx, and that could be showing up in TSMC's numbers.
You did see some of that concern really play out last week. A lot of the big cap AI-related names hurt. CoreWeave being one of them fell 22%. They're going to report after the bell today. Considering they're one of these companies that kind of exist in this weird circularity, everyone investing in each other, do those types of earnings matter even more, not just for CoreWeave, but for the hyperscalers too?
I mean, look, when it comes to AI CapEx, we know Microsoft has committed $60 billion to neoclouds. Just to CoreWeave and Nebius, it's like $30 billion. So from that perspective, when I look at the book of business that CoreWeave has and the contract durations, like they have $30 billion in RPO. That's going to get converted into revenue over the next 4 years. So from that perspective, I don't think, there is anything to doubt with a company like CoreWeave, which is a pure play AI CapEx play. Look, these are depreciating assets. So what I'm interested in knowing is what will happen to CoreWeave's margins 2 years from now. And when you have to, write off a lot of these GPUs that have a life of 3 years, that's when, the impact on gross margins is really important. But for now, the revenue and top line looks really strong here.
I look at the S&P broken down in the industry groups over the last 5 trading sessions. IT was the biggest hit, down 4.25%. So last week, communication services, those are the hyperscalers, the second biggest hit. So it was definitely tech stocks that let us down last week. But now I'm starting to think maybe the government shutdown mattered in the trade. Do you think any of that sort of infected the exuberance for AI?
I mean, right now, everyone is focused on what the hyperscalers are going to do in terms of CapEx. And we know 2025 was more than a 50% growth in CapEx. Chances are 2026 will be another year where CapEx from hyperscalers grows in excess of 50%. Now, that's huge when you think about, the numbers we're talking about, $550 billion plus in aggregate revenue in CapEx. So I don't think there's anything to worry about in terms of AI infrastructure right now. but there are pockets that may be getting hit on the non-AI side because everyone is diverting their spending towards AI, and shutdown or not, I think you will see some sort of an impact over there.
I can't help but chuckle at that question because it is kind of ridiculous, right? Like the shutdown's over and AI is rallying.
I know,
It doesn't
but
make-
it's happening.
It's literally happening. So yeah, make of that what you will.
Maybe government spending gets a lift, if shutdown is over.
Mandeep, I love you assigning reason to what feels reasonless. Mandeep Singh, thank you so much for joining us. That's
I will
Mandeep.
say the good news is I'm so happy to get Mandeep's take, but later on we're going to get Cliff Asness's take on this too, because it is seemingly what happened.
Yes.
Right? The government shutdown hit us hard enough to beat down AI, and now we have all of these AI companies, including those that have slowed growth, rising on the end of the government shutdown.
Right. Well, you have a guy who has systematic strategies that has to assign rules to things. How do you do that in today's market, again, when things seem like nonsense? Okay, let's move on to a deal this morning. Metsera, the saga there, shares of the weight loss drug maker tumbled after Novo Nordisk pulled its bid, paving the way for Pfizer to close on its deal with Metsera. Bloomberg managing editor for Global Business, Shelley Banjo, joins us now. Shelley, what a saga it has been. At one point, it seemed like Novo was kind of in the lead for this thing, considering Pfizer was going so far as to sue them. What changed that allowed Pfizer to pull away with it?
Yeah, one Wall Street analyst called it the Real Housewives of Big Pharma. So that's the twists and turns that this has taken over the last week.
That fits too. That's very fitting.
And what changed, to your question, is the U.S. government. So the FTC came in, gave a call to Metsera, which they put in their press release and said, I really don't think that if you go with Novo, you're going to have some problems. So take another look at it.
Wow. So pressure from the government, keeping, I guess, the foreign bidder out. And it makes sense, right? Because Pfizer had done a deal with President Trump first and curried favor with the White House. But does this really help them get on the board when it comes to the obesity drug race? Because it still is Novo versus Lilly, right?
Yes, definitely. And Novo, we could sort of argue that Pfizer needs this more than Novo does, but Novo's not doing so hot itself at the moment, and it does need some of these next generation, second generation drugs here. But with Pfizer, I mean, they have just been hitting it, losing after losing after losing with obesity, discontinuing drugs that aren't working, and they really need a win. And so the question is, is this going to work out for Pfizer? It's a $10 billion bet that it's going to get them back into the game.
All right, fascinating story. Looking forward to more reporting on that out of Shelley's team. She covers corporates for us here at Bloomberg. Let's get a check of what's going on in futures this morning. As we've been saying, talk about an end to the government shutdown, even if we don't completely understand how it would work in the Senate, because anyone could stop it, is really boosting stocks. S&P futures up another 0.9%. We were already up. We finished Friday higher, even though for the week we were still down.
Yeah, the worst week since early April. So some of the other movers on our radar this morning, there were some other earnings. Tyson's, for example, those shares are moving higher by almost 4%. It expects earnings for 2026 to be little change compared to this year, that despite beef prices at a record high.
Gold miner Barrick maintained its full-year production target and raised its quarterly dividend as a result of that and the end of the government shutdown. Shares are up 5%.
Actually, gold is doing better today because of the end of the government shutdown, right? I think gold's higher, which also doesn't make a lot of sense.
It is true. Spot gold is up to over $4,000 now, $4,089 a troy ounce. Instacart finally here providing an upbeat earnings outlook as orders grow at a healthy clip. I don't know what a healthy clip is, but orders are growing.
They're growing, yeah, that's the net sum of that. All right, coming up on the show, U.S. airlines cut flights, a chaotic weekend for travelers, more on the headwinds facing airliners, and maybe what the end of the government shutdown does to them. That's all coming up on Bloomberg Open Interest.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Getting out of high interest, look what's making headlines around the world. Former French President Nicolas Sarkozy will be released from jail after serving 20 days of his 5-year sentence linked to an alleged campaign funding from Muammar Gaddafi's regime. A Paris court approved his release while he appeals the conviction and ordered that he remain in France. Sarkozy, who was held in solitary confinement, called his time behind bars a nightmare. The 70-year-old maintains his innocence with appeal hearings expected next year. Citadel is launching a new stock-picking unit in London as it expands its European footprint. The division will take larger, longer-term stakes in European companies, marking a shift from Citadel's faster trading style. The move comes as multi-manager hedge funds like Citadel race to put record inflows of capital to work. And heavy snow in Chicago is adding to nationwide travel chaos as the government's flight restrictions enter a 4th day. More than 10,000 flights were delayed or canceled yesterday, and airlines warn more disruptions are likely with fresh snow falling. The gridlock comes as the shutdown drags past 40 days, leaving air traffic controllers unpaid and straining the system ahead of the busy Thanksgiving travel window. Danny?
Let's get more on the impact from that travel disruption. We're joined by Bloomberg's chief correspondent for global aviation and transport, Sid Phillip. Sid, I mean, no surprise that this weekend was insane. Government shutdown, the weather. How much does that affect the airlines themselves?
It does affect the airlines because, one, you have all these passengers who are stranded. 2, you've got aircraft and crews that are out of place. And that means you have sort of relocation flights, aircraft are not in the right place at the right time. And that sort of adds chaos to a system which is already sort of, they're having to cut flights and having to sort of make changes on the fly. And that sort of makes things much harder for the airlines.
So there's a snowball effect here, I imagine, right? No pun intended, but I just can't believe things get any better rather than worse over the next few days as we get bad weather in Chicago, it snows there, and the government shutdown, even if we have a solution by Friday, still is going to hurt this week.
It is going to hurt this week. I mean, we're seeing the government already talking about restrictions that will ramp up to 10% by the end of the week. And so the longer the shutdown actually lasts, I mean, we're still not quite sure when the shutdown will actually end. And the longer this lasts, air traffic controllers still aren't being paid. You still have restrictions on flight and the bad weather. So it's all going to sort of snowball into more cancellations, more delays, and more frustration for travelers at the airport.
Enough so that it would extend into Thanksgiving, or if there's an end this week, it could be cleared by then?
It's still to be determined how quickly the government rolls back these restrictions, and also what the other mitigating factors in terms of weather and other things are. So it's still up for debate whether Thanksgiving travel or not will be disrupted, but we will have to sort of see.
Nonetheless, we see airlines doing well. I mean, you can see on the sidebar here, Southwest is up in the pre-market, American Airlines is up in the pre-market, United Airlines is up in the pre-market. So the rally in the shares doesn't reflect the chaos on the ground.
I mean, we did see sort of the shares take a beating while they talked about the restrictions, and so they say sort of a more positive approach, saying that, okay, air travel might be back given the fact that the government shutdown looks like it's ending.
It was a period, though. We saw, for example, on Friday, the latest University of Michigan sentiment survey, where it looked at the lowest since 2021. These airlines have reported people who are willing to pay up for things like business, who are enthusiastic about traveling. A period like this, could that go some way to dent that sentiment?
It could dent sentiment because people who are sort of more willing to travel might hold off and might think twice about booking travel, especially as they watch the chaos unfold. And so we still have to wait and see what the booking trends look like when the airlines sort of give us more of an update as to what the impact of the shutdown and the restrictions were. But in terms of sentiment, it definitely plays into sentiment.
I mean, the airline stocks in general, at least the big ones, right, have all rallied since Liberation Day. So they were higher at the beginning of the year, but they took a huge hit into April, and since then, they're all on the uptrend, at least United, American, Delta. Does this put that at risk?
I mean, United and Delta had great results, and they talked about how they have consumer base that isn't as affected by inflation and higher prices because they are sort of more immune to those things, and they've sort of gone more premium. They've sort of changed their aircraft mix to add more premium seating, and that's why we've seen the low-cost carriers struggle a little more. But in terms of sentiment, yes, there was the airlines also cut their estimates for the year when the Liberation Day tariffs came around because they weren't quite sure what the economy looked like. And then they've sort of been more bullish and more optimistic about the prospects for next year. So that's why airline stocks have been where they are.
All right, Sid, thanks so much for joining us. Sid Phillip is our global aviation correspondent. Let's get a look at some of the other movers on our radar this morning. Crypto-linked stocks are rising amid the risk-on sentiment as the government shutdown inches closer to ending. When Bitcoin rises, when the rest of the CRYP Go universe gains, you see these stocks rally as well.
And apparently that's part of the reason why gold is higher this morning, too. So you see gold-linked stocks also outperform. Maybe there's also an increased chance of a rate cut next month as the shutdown progresses. You also had earnings from Barrick that upped their dividend and share buybacks.
European buyout firm Invest Industrial has agreed to take food label manufacturer Treehouse Foods private in a $3 billion deal, and as a result, Treehouse trades up towards the premium. You can see the gain there, more than 20%.
Coming up on the show, Empower's Marta Norton says that volatility will remain high, so it's a good time to prioritize rebalancing. She's going to join the show next. You're watching Bloomberg TV.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes. changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Morgan Stanley remains bullish on stocks into 2026, despite risks from the Fed and government policy. A note from Mike Wilson says, quote, while overhangs from Federal Reserve guidance and the shutdown have weighed on recent price action, these are temporary headwinds on a way to a solid 2026, driven by earnings growth. Joining us now is Empower Chief Investment Strategist Marta Norton. Marta, great to see you this morning. And I want to pick up on one thing that Mike Wilson said, that the government shutdown was weighing on stocks, because that's been assigned the reason. While we're rallying so much today, does the shutdown matter? Has the shutdown mattered for how you think about equities?
Well, I think what's interesting about the shutdown is that it doesn't really change the cash flows that we know are kind of the enduring drivers of equities. But I think what it did do, especially as it lasted and prolonged over time, was put a lot more uncertainty around how the economy is trending. Of course, we're missing a lot of key economic data. We're keying off of private market data that may or may not be a little bit less powerful than what we would get from the official numbers, and we're building narratives around that. And I think that just introduces a certain amount of volatility. So certainly getting the government reopened would provide some stability that I think the markets could use.
There are a lot of those issues that could cause volatility, and yet we continue to march higher and higher and higher. Okay, I know last week was an exception to the rule, first drop in 4, but how do you see this S&P 500 panning out to year end into 2026? Do we start to get real volatility again?
Well, you know, the argument heading into November was that November was a period of seasonal strength and that we should just kind of ride this wave all the way through to the end of the year. But I think the one kind of fly in the ointment and that narrative is just where valuations stand. And they just don't leave a whole lot of room for anything less than perfection. And of course, we see earnings deliver, and yet the market greeted that with a yawn, and all the sum total of all the straws on the camel's back created the volatility last week. I wouldn't suggest that there's something fundamentally broken. I resonate with the comments that say that earnings are very strong and that the AI super cycle is real. But I think what we have to remember is that when we're dealing with valuations at this level, when we have fundamental moments of doubt, deep-seek types of moments, I think we could see some greater volatility.
All right, Marta, thank you so much. You're going to stick with us. Much more to cover after the opening bell. That is Marta Norton there. A quick check on futures. Less than 5 minutes to go until the start of the opening bell. It does feel like there's relief on at least a measure that would help get rid of the government shutdown. We're higher by 1.5% for the NASDAQ. After that, fell last week, Matt. It's worst week for both the S&P and the NASDAQ since Liberation Week, since the beginning of April.
And I think the most interesting thing is that you see these AI companies like TSMC continuing to rally even after forecasting slower sales, putting out slower sales. Still gains, right, but slower accelerations there, and the government shutdown seems to be the answer to why they are up. Also coming up on our next hour, AQR's Cliff Asness joins us at the table for a wide-ranging interview on markets and the economy. This is Bloomberg.
such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller, looking at some decent gains here in futures on news that this government shutdown may be drawing to a conclusion. S&P futures up 0.9%. NASDAQ futures up 1.5% as somehow the end of the government shutdown gives an extra boost to the AI mega-cap tech stocks. In terms of the opening bell, you've got the CEO of Eni. This is an Italian energy company that has U.S. ADRs. They've been listed on the New York Stock Exchange for 30 years, and so they're here to celebrate. Hopefully, they get some good food as well. Although, would you come from Italy to New York?
I was going to say, I mean, we have just as good food as Italy, I would argue,
yeah.
but yeah.
Go to Carbone.
They probably wouldn't say that.
In terms of the NASDAQ, Extreme Networks, which provides solutions, of course, for networking and data storage. It's all about AI, I'm sure they would tell you. And as a result, their shares are up only 4% this year, but like 260%, 270% over the last 5 years.
Wait, sorry, can I just clarify one thing? If an Italian came to New York, you'd recommend Carbone to them. That feels like a mistake.
That was a joke.
Okay, just making sure. Just making sure.
Where would you send an Italian in
Not
New
to
York?
Italian food, just like anything but Italian
But
food.
pizza. But New York does better pizza than Italy, right?
Okay, the show's gonna get shut down by a group of angry mob of Italians, so we are gonna move on from that. Some stocks to watch this morning. TSMC, they reported their slowest monthly sales growth in 18 months, but it was in sale with analyst estimates. So that's TSMC. Here are all of its main customers, but they're all rallying in what you pointed out, Matt, the fact that the government shutdown is over, and apparently that's better for sentiment, which means it's better for AI and tech sentiment, which took a big beating last week.
All right, health insurers like Centene and Oscar are falling as lawmakers move closer to ending the shutdown without a health care extension. Remember, this is what the Democrats wanted. This is why they refused to sign the Clean CR. They wanted to restore ACA subsidies, and they didn't get that. Or at least they haven't thus far, and as a result, you can see that all of these insurers are getting beaten down even further. Let's bring in Empower Chief Investment Strategist Marta Norton. And you know, these health insurers have been hit so hard, and obviously since One Big Beautiful Bill, they've lost a lot of the largesse of the U.S. government. Is there a certain point where companies like this, you know, become value stocks that you like?
Well, you know what's interesting is really, as we've gone over the course of 2025, most of the sectors, even kind of defensive areas like consumer stocks, look expensive to us relative to their own histories. And when I say expensive, they're in the 9th, 10th decile, so kind of extreme valuations. The area that has been left out on a sector basis has been healthcare. And this cuts across kind of the industries within healthcare, certainly the insurers, but also areas like pharma, biotech, all of those areas left behind, policy concerns, tariff overhangs, drug pipelines, you name it, all sorts of problems there. And so that created what we saw as a pretty good valuation opportunity. We have since seen a lot of that area rally back, particularly as some of those tariff concerns have been straightened out. But on a relative basis, there's still some value. And as you point out, insurers still an area where potentially there's absolute value, though of course absolute problems as well. So if you're looking to add valuation exposure to the portfolio, I think healthcare is one of the places that you could go, and at least sector-wise, you could argue that it's a bit more defensive if you have some concerns over the economy.
Marta, healthcare is also one of these sectors that's kind of like the poster child for the back and forth of what government policy has done to a lot of these companies. It was down a lot, as you were saying, because of the tariff. It gets that relief. Pfizer today won its takeover of Metsera because of the aid from the government. Within this sector, and really more broadly within stocks itself, is there a strategy to say, hey, X-CEO has a good relationship with the White House, therefore that company is a buy?
You know, what's been super interesting, again, another kind of 2025 overarching comment, has looked at the fiscal impact and the one-day reaction to that. If we're looking at tariff announcements, AI announcements, One Big Beautiful Bill Act, the fiscal policy effect has been about a 14 percentage point swing on a one-day, reaction to news, whereas monetary policy, it's been about 2%. So to your point, fiscal policy, Washington has loomed large in markets, and it stands to reason that that's going to continue to be something that we're going to be watching as we go through 2026. Now, how you formulate a strategy around that, I'm not quite sure. I do think awareness around it is step number one.
One of the groups that could benefit more from monetary policy changes than the government stepping into private company management is small caps, right? Yeah. If we continue to get cuts, do you like small caps here?
I think it's hard.
Do we continue to get cuts, and do you like small caps?
That's right. Well, so I guess on the cuts front, just answering that question first, I do think the Fed has one more cut in it, just reacting to how big the reset was when it comes to the jobs market and what we saw from payrolls. In fact, really not seeing anything from payrolls over the course of the summer. I do think that we will expect to see some adjustment there, whether that comes in December or not. I think that's harder to say. We're certainly seeing, that split Fed and concerns around inflation as well, which are very valid. On the small cap front, I think it's hard not to have some space for small caps in your portfolio, just given how cheap they are. But there are so many factors. There's the rate dependency, the economic dependency, the tariff effects that are hurting those companies. So I think as you have exposure, I think it's something that you should moderate, not necessarily go all in on.
And another contour of this market, Marta, that's been really interesting this year is just the prevalence of retail and just the extent that they're participating. President Trump over the weekend said that he would have a $2,000 payment to most Americans funded by U.S. tariff revenues. The last time we saw money given out to people in that way with checks handed out was during COVID. And what resulted in that was a big participation from retail investors. Could this theme just keep playing out? And how does it make you think differently about markets?
Well, the retail theme is very interesting. There's been such a dichotomy between how institutions have behaved, particularly around tariffs, and how retail investors have behaved, and the hashtag buy the dip mentality that has felt like a winning investment strategy. And I do think as you start to give more money, we'll see if that comes to pass, but certainly you will see refunds and kind of tax effects over the course of 2026 as well. It will be really interesting to watch the retail investor. I don't think that mentality is really going to shift. I do think you have support from the retail base. The big question is those more seismic moments of doubt that I was referring to earlier, the deep seek types of moments that not just rattle prices, but make people question the narrative. Those are traditionally really good buying opportunities, but they're a lot scarier than maybe what we've seen thus far. So how retail responds in moments like that, I think will be pretty fascinating.
By the way, I know that the economy is pretty awesome for the top 10% or the top quintile, but is the economy so bad for the bottom 80% that we need to be handing out stimulus checks?
I think that's a question mark. Certainly they're weaker, right? And we see that with people pointing to delinquency data. We see that when we look at what the inflation numbers have been and how difficult that's been to weather. And we see that from a housing market standpoint, how difficult it is to get into the housing market, just given the price appreciation that we've seen there. There's certainly challenges, but I don't know if we can say there's out and out weakness. And so I think that if you're looking for reasons why the economy could get a bit more frothy than maybe it ought to be, it could be stimulus at a time when we don't necessarily need it.
Hey, Marta, this has been fantastic. Thank you so much for joining us to kick off the week. Empower Chief Investment Strategist, Marta Norton. All right, about 8 minutes into your trading day, let's just see how things are shaping up. A pretty even number of winners and losers, but the overall market is up because of who is up, and that is the big cap tech. NVIDIA leads the charge, moving the overall index higher by 18 points. Amazon, Apple, Alphabet, Broadcom, it's all the big tech AI players that are doing so strongly. On the downside, you see a lot of those health insurers, HCA, one of the biggest detractors on the losing column because of the potential we don't get an extension of the ACA tax credits that would hurt them. A lot of consumer-related names also really struggling today. P&G, Walmart, Johnson & Johnson, Home Depot, Coca-Cola. Kind of weird also when you consider the $2,000 checks we were just talking about. Sectors, you'll see a very similar thing. It's kind of the inverse of last week, whereas last week tech was down big. The communication companies were down big. Again, that's a lot of the hyperscalers. Those are what's leading us this morning, up 2% for infotech. Communications up 1.7%, whereas as I point out, a lot of those consumer companies, the worst performers today, Matt.
All right, coming up, we head back to Washington, but this time not to talk about the shutdown. We've got an exclusive interview with St. Louis Fed President Alberto Musalem. We may ask him about the shutdown, but obviously this is going to be geared more towards monetary policy. An interview you don't want to miss on Bloomberg Television and radio. It will be simulcast. This is Bloomberg.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome to Open Interest on Bloomberg TV and Bloomberg as Intelligence on Bloomberg Radio. To our viewers and listeners around the world, I'm Michael McKee, International Economics and Policy Correspondent, and joining me this morning is Alberto Musalem. He is the president of the St. Louis Fed. Thank you for coming in this morning here in Washington. And we have some news in Washington that we may be getting close to the end of the shutdown, which would release data. But just in case that doesn't happen, based on what you know now, what do you think about the economy?
Mike, good morning. Great to be here. I see an economy that has been pretty resilient, where growth has been roughly around potential, around 1.8 for this year, in spite of a lot of uncertainty. I see a labor market that has been around full employment, is around full employment, has been cooling, with demand and supply have been cooling. And I see inflation, which has been closer to the 3% level than to our 2% target.
Well, we know that when the data comes out, everybody will be parsing it carefully. But is it going to add a lot to your knowledge of where the economy is and possibly change any decision you might make?
More data is better than less data, so we will learn. It always has additional value. I do feel that we have a pretty good sense of where the economy is. We have availed ourselves during this period of unofficial data dearth, let's call it that, with private sector data. We have been in close contact with all of our constituents, businesses, households, community leaders in our districts. So I feel we have a pretty good sense of the economy, but I'm very much looking forward to seeing the official data releases because they are the gold standard, and they'll provide additional information.
Well, what are companies in your district telling you?
They are saying that consumption has been resilient. They're saying that growth has been fine. They're saying the labor market has softened a little bit. They see many more applicants per vacancy. They report compensation growth somewhere between 3.5% to 4%. So things look reasonably okay.
But the consumption that remains resilient, obviously at the upper ends you have the stock market, wealth effect driving it. But I know you've been worried about the lower deciles because they're taking on more debt.
That's exactly what's happening. So we estimate that the real consumption growth of the high-income folks and of the low-income folks has been about the same. But, as you said, the higher-income households are consuming from the wealth effects they have in the stock market and home prices, by the way. Lower-income folks are taking on more debt. They're taking on more credit card debt. And that's how the economy has been thus far.
Well, taking on debt to continue consumption, a cynical economist might say, where have we heard that before? And how did that turn out? Are you worried that we're setting up for a problem?
By and large, when I look at consumer finances, if you look at consumer balance sheets, by and large, for the economy, they are okay. Consumer is not over-indebted here. Now, over the past year, we saw an increase in subprime loan defaults. We saw an increase in credit card defaults. Now, over the past year, those have started to stabilize and actually come down some. But, at the lower end of the income spectrum, you always have to worry that, those consumers who live, hand to mouth need to wait until the end of the month to make it, could be strained. Yeah.
Companies, I know, have been telling you and your colleagues for some time that they're waiting for clarity, especially on fiscal policy going forward, which doesn't seem to necessarily be coming. Are any of them saying we're kind of at a point now where we have to raise prices to keep up with our input prices, or we have to cut back on people because our margins are compressing?
Two questions, two answers. Companies tell me that uncertainty has plateaued and that they can understand how to operate in with this new higher level of uncertainty. So some of that is going on. In terms of pass-through of higher costs, companies are experiencing higher costs. Some are related to tariffs, some are related to other things like insurance, which is totally unrelated to tariffs. And companies that are upstream, so earlier in the production process, are successful in passing on those costs to other companies to build products that they build. Companies that are closer to the consumer and selling to the final purchaser of a good are having more difficulty in passing things on because they are facing some pushback from the final buyer.
The labor market, how fragile is it? We've seen a lot of layoff announcements over the past couple of weeks. Is this a gathering trend? Are we going to start talking about the Somme rule again?
I see the labor market as having cooled in an orderly way, both because supply and demand have cooled. The latest challenger job announcements, which you're referring to, I definitely took notice of them, but they don't necessarily mean the labor market, is about to go into a deterioration phase. In the same week that they were announced, as you know, the weekly claims, which are another very good indicator of layoffs, has remained stable so far. So you have to look at all of the data in the labor market and see whether those layoff announcements will actually materialize.
In terms of supply problems in the labor market, monetary policy can't affect that.
The traditional way to think about monetary policy is that it is more effective with respect to cyclical and demand side type of factors. But I think we also need to be thinking, if the economy is going through a structural transition, what role does monetary policy need to play in facilitating that transition? So we have to, in my mind, be thinking about those two things.
Now, there are two arguments that seems to be at the Fed right now. One is that we need to get ahead of a brewing problem, especially in the labor market. And the other is, if you're in a dark room, you want to move carefully and maybe pause. Which one do you think carries more weight?
The way I think about it is I feel we have adequate information to make decisions to cut rates or not to cut rates. For me, it's about the outlook that I happen to have and the balance of risk that I happen to have with the information that I currently have. Going back to your first part of the question, in the past year, the real federal funds rate has declined by 250 basis points. Of that, 150 basis points have been reductions in the nominal interest rate to provide insurance to the labor market and to get ahead of any deterioration in it and to keep the labor market around full employment. And about 100 basis points of the decline in the real federal funds rate has been looking through the rise in expected inflation, mostly due to tariffs. So that's how I think about monetary policy right now.
Well, to the extent that they know, what are companies telling you about monetary policy? Do they say that we're going to have to raise prices or cut employees if you don't cut interest rates?
Not necessarily. I don't hear that from companies. Companies often are more concerned about non-interest costs that are increasing. For example, I mentioned insurance, but raw material costs and other costs to produce things, all the way from building homes to producing manufactured goods. And so I hear more about that than about interest costs being something that needs to be passed on to consumers. So it's very important that we continue to focus on bringing inflation back down towards 2%.
Well, we hear a lot from your colleagues. We heard from Chair Powell about the risk of cutting too fast versus the risk of not cutting soon enough. What about the risk to credibility if you cut but then inflation doesn't go down, and you have to start thinking about raising rates again.
As Chair Powell said, there's no risk-free path, and if we focus too much on the labor market and then cut too aggressively, we can have an undesired outcome on the inflation side. If we focus too much on the inflation side and labor market deteriorates, we're going to have an undesired outcome. And so right now, what our monetary policy strategy document says is that when you have some tension between your two goals, you have to follow a balanced approach, which is to steer monetary policy to attend to both goals.
Well, which way would you steer it in December based on what you know now?
I think, again, it's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative. Monetary policy, in my estimation, is somewhere between modestly restrictive and neutral, probably closer to neutral. If you look at the real federal funds rate, it now is around 1%, and 1% happens to be the long-run neutral rate in real terms for the federal funds rate of the entire committee, the median, I should say, of the entire committee. So I think we need to continue to lean against inflation to make sure we bring inflation back down towards our 2% target while providing some insurance to the labor market. One thing I hear often when I visit with folks in my district is that people are having more month than money increasingly, number one. Number two, I hear that folks are increasingly going to food pantries, including middle-income folks. And I hear that aid institutions are increasingly getting requests for utility assistance, probably related to higher electricity and energy prices. I should say electricity prices. So those three things tell me that it's really important that we bring inflation back towards 2% to allow households to catch up with their real incomes.
We've only got about 30 seconds left. Markets are up this morning. They're cheered by the possibility of a shutdown deal. But when the sun comes up in the east, they've been going up cheerfully lately. Are you worried about the level of asset prices?
Financial conditions are very accommodative of economic activity and of employment. The Fed, the board just released this financial stability report where it says that asset valuations are notable, and it's not our job to opine on particular valuations of markets. But if you look at that report, it suggests that house prices seem elevated relative to historical standards. Stock prices seem elevated, and to me, it's just the flip side of accommodative financial conditions.
Alberto Musalem, thank you very much for joining us this morning, the president of the St. Louis Fed. We'll send it back to you in New York.
All right, Mike, thanks very much. Mike McKee there with St. Louis Fed President Alberto Musalem, who said that he thinks financial conditions are very accommodative and that the economy has been resilient. He sees employment right around full employment. All of these comments lead me to believe you don't really need to cut rates that much.
No, but he is a Fed official who has believed that, who's had a more hawkish bias. You heard the inflationary bias in what he was saying, that yes, there are more lower income people who have taken on more government debt, that middle income people are going to food banks, but he basically said that inflation is the problem and that he could see a reacceleration into the start of next year.
Yeah, very interesting stuff. Consumer balance sheets are okay. The consumer is not indebted, although using a lot more credit cards, and middle-income people going to food banks has got to be a concern. Coming up, Cliff Asness of AQR joins us. He's going to talk about AI exuberance. He'll weigh in on that debate, plus the private capital push and his macro outlook for 2026. This is Bloomberg Open Interest.
cidade estava sitiada.
Isso, ao começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. Scarlett Fu, Paul Sweeney, with you here with the Bloomberg Intelligence Program. Coming up, we're going to check in with some comments. House Speaker Mike Johnson is going to be making in just a moment, presumably about reopening this government. So when he speaks, we will bring that to you. John Harney, Bloomberg News editor, talking to us about the government and about maybe how this government might reopen over the next several days. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Talk to us about these flight delays and, you know, once the government reopens, how quickly do the airports kind of get back to what I guess we would call normal there? Sam Fazeli, he's going to join us as well. He covers all the healthcare stuff for Bloomberg Intelligence in London. We'll get the latest reporting on what's happening in the world of global healthcare. So we got a lot coming up over the next couple of hours. Let's kick it off. Lisa Mateo and a Bloomberg Business Flash.
You got it in this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We got stocks rallying. Optimism over this push toward ending the government shutdown, which would open the door back up to the release of key economic data that really helps the Fed weigh in on its interest rate decision. And speaking of which, you had the Fed's Mary Daly warned against keeping interest rates too high for too long. She pointed to a labor market that's softening and wage growth that's moderating. The Nasdaq up nearly 2%, 442 points. The S&P 500 rising more than 1%, 76 points, and the Dow up 0.3%, or 153 points. The two-year yield 3.57%. That's up 1 basis point. The yield on the 10-year 4.10%, and that is little change. Gold above $4,000 an ounce, and oil right now, WTI crude at $59 a barrel. barrel. To earnings we go. Tyson Foods. They say they expect results for next year to be little change. Its beef segment continues to lose money, but its chicken segment, that's offsetting some of the losses. Its shares are up more than 1%. And Instacart, they reported better than expected growth, provided an upbeat earnings outlook. Its share
appear ready to do what Republicans and President Trump and millions of hardworking American people have been asking them to do for weeks. But as we said from the beginning, the people's government cannot be held hostage to further anyone's political agenda. That was never right. And shutting down the government never produces anything. It never has, if you study history. And so here we are. I want to remind everybody this morning of another critical point that you've heard me here repeat over and over the last several weeks. It's something that I and Leader John Thune and President Trump and every Republican leader have all said repeatedly from the beginning. We have always been open to finding solutions to reduce the oppressive costs of health care under the Unaffordable Care Act. We just made clear that we would not and should not ever do that, that is, negotiate as hostages. And I've also reminded you here every morning at this press conference throughout the shutdown, Republicans have not just been talking about reducing costs and fraud and abuse in so many areas and in healthcare. We've been actually passing new laws to accomplish that urgent mission for the people, and we will continue to do so. So here's where we are by way of schedule, just so you know, you're following. And if you're not at home, if you're waking up to this good news this morning, the Senate's vote late last night of 60 to 40 opens the door now. The Senate is moving forward on an amended House CR, a continuing resolution, that will reopen the government until January 30th. Added to that are provisions to fully fund SNAP provisions through the end of the next fiscal year, which is September 2026, guaranteed back pay for all federal workers who have been made to endure these hardships over the last several weeks. And it also includes passage of 3 appropriations bills, which we're grateful to be moving through the process. That is the Military Construction Veterans Affairs bill, it's the Agriculture bill, and the Legislative Branch bill. The Senate will be back in session this morning to finish their job, and we're certainly praying that they do. They'll need unanimous consent from all senators to fast-track their final vote. As you know, there are some procedural hurdles that one or more could throw in the way, but we certainly hope that they won't do that because so many people across this country are desperate for the government to reopen. At the very moment that they do that final vote, I will call all House members to return to Washington as quickly as possible. We'll give a 36-hour formal and official notice so that we can vote as soon as possible to pass the amended CR bill and get it to the president's desk. As you all know, and he said as recently as last night, I was with him, and he told the press, he said, we want to get the government open. He's very anxious to get the government reopened and to end the Schumer shutdown. We all are. With regard to the travel challenges, I spoke yesterday at some length with Transportation Secretary Sean Duffy, my former colleague and good friend, and he lamented the serious situation that we have with air travel in the U.S. He's bent over backwards, as all members of the administration and the cabinet have done in all of their areas of jurisdiction, to try to keep the government working for the people and to mitigate the pain and the harm. But the problem we have with air travel is that our air traffic controllers are overworked and unpaid, and many of them have called in sick. That's a very stressful job, and even more stressful exponentially when they're having trouble providing for their families. And so Air travel has been grinding to a halt in many places. And as of Sunday, nearly half of all domestic flights and U.S. flights were either canceled or delayed. And it's a very serious situation. So I'm saying that by way of reminder. I'm stating the obvious to all my colleagues, Republicans and Democrats in the House. You need to begin right now returning to the Hill. We have to do this as quickly as possible. Now, we look forward to the government reopening this week so Congress can get back to our regular legislative session. We have a lot of business to do, as you all know, and we will be working in earnest. There'll be long days and long nights here for the foreseeable future to make up for all this lost time that was imposed upon us. I want to close with something that's important. I think it's important to say that this is genuine. I mean this sincerely. We applaud the 7 Senate Democrats and 1 independent senator who did the right thing. They decided to put principle over their personal politics. And my urgent plea of all my colleagues in the House, and that means every Democrat in the House, is to think carefully, pray, and finally do the right thing and help us to bring an end to the pain of the American people. This has gone on too long. Too many people have suffered, and it's long overdue. That's the update I wanted to give you this morning. There are probably lots of questions, but...
All right, that was House Speaker Mike Johnson giving the update on some of the early moves here to end this shutdown, and again, calling for House members to get back to D.C., which could be a little bit more difficult than just saying, hey, come back to the Hill because we got to get voting. They have to deal with the airports and the airlines and the delays like everybody else.
Yeah, the increased flight cancellations, the snow from Chicago snarling everything up.
So the irony there is pretty telling right there.
Absolutely.
Okay,
but it was a victory lap for Speaker Johnson.
Yes, it is. Yes, it is. So hopefully we can get this. I was talking to Henrietta Trez at Veda Partners. She thought maybe by the end of the week, you'd get everything signed, sealed, and delivered and kind of get everything.
So that still means a lot of travel snafus from here on out until the end of the week. But maybe Thanksgiving travel will be spared?
Hopefully. That's kind of the plan. Let's get some more reporting on this. John Harney, Bloomberg News editor, joins us here. John, what's your understanding of kind of the timing here and next steps?
First, the Senate has to begin voting today. They'll meet in about an hour or so, and they'll have to put this up. This new legislation, which will have to then go back to the House up for a vote. Now, as Speaker Johnson pointed out, there are potential obstacles. Rand Paul, the Republican libertarian senator from Kentucky, is eager for a bill related to legalization of hemp, and there's some concern he might hold up the works over that. But if that doesn't happen and things go smoothly, the Senate would then pass this legislation. The House would come back in the next day or so, the members to Capitol Hill, and then they would vote. Although there's a lot of disagreement, unhappiness over this in both parties. A lot of Republicans don't really like the whole idea of health care subsidies being put up for a vote at all. Some Democrats feel that perhaps their party gave up too much. They didn't, like as with most shutdowns here, it ended with the party that started it not really getting what they wanted.
Right. I wonder, John, is that kind of the takeaway here? The rule of thumb is that whichever side is trying to use a shutdown to leverage a policy win just always fails to do so and then has to cave in? I mean, how many shutdowns is it going to take for people to learn this?
Well, there's a no and a yes to that. First of all, the goal was not reached. There were no, the healthcare subsidies were not enacted. That was not actually formally dealt with by Republicans and Democrats. However, and this is a fairly big however, the healthcare, you don't want to call it a crisis necessarily, but for people whose premiums are shooting up, yes, it probably is a crisis. These healthcare problems were put under a spotlight by this standoff, this impasse, and apparently, and there may have been a factor in last week's elections when Democratic candidates did quite well, and President Donald Trump said that the shutdown was a losing issue for Republicans, and polls seem to suggest that that's correct.
John, thanks so much for your reporting. Appreciate it. John Harney, he is editor-in-chief of the Washington Bureau for Bloomberg News, joining us from D.C. Market drivers this morning brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn more. Right now, let's get a sense of kind of what's moving in the market, because we've got a market with a lot of green on the screen here. The S&P's up 1.2% and the NASDAQ's up 2%. So let's get a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. And we're joined by Bloomberg's Denitsa Sokova. Denitsa, what are you looking at today?
Let's start with Monday.com, which is definitely not green today. Slumped as much as 20% in earlier trading. Now it's down about 16%. The ticker is MNDY. Cloud-based software company posted better than expected third quarter earnings. The number that seems to be disappointing for investors is their revenue forecast. It's about $329 billion, which is lower than what analysts were expected. And we're seeing quite the reaction considering the rest of the earnings report wasn't that bad. This has happened before. We had a similar situation in August. A weak third quarter outlook overshadowed the rest of the report. This is, of course, one of the pandemic favorites. This company was very popular. They do those work operating systems, which when everyone was working remotely, they made a lot of sense. And they've been trying to release a lot of AI features and things to kind of boost the proposal. But that hasn't helped investors. The company is down 33% year to date. And BI is saying after a report that the outlook indicates moderating growth and rising competition. So really, really tough day for one of the pandemic favorites.
Yeah, just saying AI in your earnings statement no longer is a guarantee for a bump in your share price the way it was a few quarters ago. Remember when crypto was like the magic word that everyone needed to say?
That's true.
Let's talk about United Airlines.
Yeah, United Airlines was having a great day in earlier trading, but just it's a good proxy of how volatile the negotiations are. And obviously, there are a lot of things going on with holiday travel, weather in Chicago, and airlines have had a pretty bad year. United Airlines is flat on the year. It was up 2%, and now it's actually in the red. Of course, we are getting closer to a resolution in the record-breaking U.S. government shutdown, and there is some optimism there. And obviously, the airlines were rallying on that. But that said, things are not looking well. Now, obviously, there has been a 10% capacity cut in December. Jefferies estimates that that's about 6% reduction for American, Delta, 6% for United. So obviously, airlines have been suffering from that. Of course, government-funded travel is on pause for many of the employees. That's also weighing on travel. And we were just about to see some optimism with things getting resolved. And this was kind of one of the sectors bringing the indices up. But it's not holding for now. Maybe once we have more clarity, we'll get back to rallying.
Treehouse.
Treehouse
What is Treehouse?
So I was Googling. They have pickles, they have coffee, they have all those brands.
Food company,
but they create them. Yeah, they create them. But for example, they're sold in Walmart and things like that. So the European buyout firm Investing Industrial has agreed to buy Treehouse Food. It's a private label food manufacturer for about $3 billion, including that. Wow. The ticker is THS. The stock is up about 24% now. Shares in Treehouse rose as much as 44% in pre-market trading. The company will pay $22.50 for the company, and this is actually a 38% premium to the closing price in September. So when the rumors of that deal kind of started circulating, so clearly much bigger premium for investors, and investors are pretty excited.
Good job.
Private label food is big right now.
It's huge.
Yep, I've been doing a lot more of it. Like I never did it in my life until maybe 5, 6, 7, 8 years.
And have you noticed a difference?
In cost, yes.
Right, in cost, but how about in taste or just in preference?
For most things, no. For some, when I do for some things, like what was it recently? We decided, peanuts. Got to go back to Planters.
Okay, so not everything can be private label, but for the most part,
for a lot of things, it's working well.
Absolutely. Denitsa Sokova, thank you so much. We appreciate it. Cross-asset reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So, Scarlett, what are you looking at today in these markets?
Well, I'm definitely paying attention to the airlines because even as the Senate has kind of pass that procedural vote and can move forward with the actual vote, and things will move on to the House. It's going to be a while before the airlines can get all of their flights back on track. And you wonder what that means for their financials.
Yep.
Because they're going to, I mean, there's a lot of costs involved. They can't collect the usual costs that they do charge people to change their flights. But, you know, down the road, maybe this leads to, as some analysts say, more business flight pricing power in business flights, which is good for their margins.
We're going to check in with George Ferguson, Bloomberg Intelligence analyst. He covers all the airlines, so we'll get his thoughts on this here. We're going to make some moves to reopen this government.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks rallying as the Senate clears that key hurdle toward ending the government shutdown. Tech stocks leading the way after last week's slide. I want to check in with a few Mag 7 companies right now. NVIDIA leading the gains up more than 4%. Alphabet up about 3.5%. And Tesla right now up about 3%. We have some news from Apple planning a series of upgrades to the satellite features on its iPhones and its smartwatches. Checking with Apple shares, they're up nearly 1.5%. Over to the stocks. The NASDAQ up more than 2%, 465 points. The S&P 500 rising more than 1%, 79 points. And the Dow up about 0.3%, 145 points. Over to the yield space. We have the 2-year, 3.57%. That's up 1 basis point. The yield on the 10-year, 4.10%, and that is little changed. The Bloomberg dollar spot index is little changed. Japanese yen weakening by about 0.4% at 154.05 against the dollar. Over to company news. Verizon reportedly looking to raise about $10 billion in the corporate bond market. That's to fund its acquisition of Frontier. Sources saying Verizon selling the debt in as many as 5 parts. And sources also saying Visa and MasterCard close to a deal to settle that 2-decade-long legal row with merchants under which they will cut interchange fees. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, Lisa Mateo, with our Bloomberg Business Flash. Paul Sweeney and Scarlett Fu on Bloomberg Intelligence. We are, of course, live from the Bloomberg Interactive Broker Studio here in Midtown Manhattan. And if you are flying or are scheduled to fly today, good luck to you. It is now day 4 of this government-mandated flight restriction. We also have snow in Chicago, which is adding to the travel chaos. And if you're flying private, some major airports are now limiting access for private jets, too.
Even for the surveillance Gulfstream?
Perhaps, yes. Depends on what airport the surveillance Gulfstream uses.
Okay.
Let's bring in George Ferguson, who's a senior aerospace defense and airlines analyst for Bloomberg Intelligence. George, is all this chaos just a negative for the airlines?
Yeah, I don't think it is. So
no?
I think right now we're still at low levels of interruption to operations, right? But we're, from as near as I can gather over the weekend and on Friday, 4, 5-ish, 6%-ish, seems mid-single digits. If you're the airlines, I think, you can just come in and you start cutting the least profitable flights, the smaller aircraft. And so I think you get a chance to optimize your schedule a bit, and the numbers are still pretty small, so that it doesn't affect you too dramatically. I think you could even see a small margin pop from some of this. I think as this continues, I would start to get more concerned. But right now, I don't think it's absolute chaos for the airlines.
Years ago, one George Ferguson told me about an app I have to get, Flight Radar 24. And it helps you track planes that are in the air and on the ground.
So it has a little icon of the plane and everything?
Yeah, so I use it all day, every day. Every time a plane flies over, I pull it in my thing, and everybody laughs at me. But right now, I'm looking at it, and Newark Airport seems fine. It doesn't seem to be too much of a layup. I mean, trying to get planes out. It seems pretty normal. Yesterday was ugly to look at the airport. George, this goes to the issue of this industry needs more air traffic controllers. Can you put that into context, like how many more, and why is it such a tough problem?
So I don't know that I can give you sort of how many more, but what I can tell you is, recruitment has gotten pretty difficult, I think, for air traffic controllers. It's a tough job. I think during the pandemic, it was one of those jobs that you couldn't do from home, which hurt as well. I think it had sort of more cachet, maybe back in my generation. Current generation might prefer to do a tech job or something like that. And so recruitment has kind of fallen, and it's got the same problem that the rest of aerospace has, and that is that there's a lot of sort of grayish hair. I hate to use that term anymore now that I have it.
Hey, at least we still have it, George.
Yeah, and baby boomers that are in the business, and they're leaving, right? They're the folks that are on the cusp of retirement, many of them, and so they're starting to go away in numbers, and you'll need a backfill, to be able to effectively run the nation's airspace, and so that's the challenge: is getting that young generation interested, excited for a job. Again, it's not a huge paying job. I think a lot of them supplement their income with overtime hours that kick in some more pay, and that doesn't seem to always appeal to people, right? To work harder, and again, for the younger generation, actually not work from home. So
no, this is not a work from home job. Let me ask a dumb question: is this something that we can use AI for?
Ooh.
I think actually in time you will be able to use some AI inside air traffic control to help optimize things. Look, it's not something new to this business. you know, they're kind of sort of perennially running on older technology. But as you bring newer technology to this business, I think you increase the productivity of the controllers. And you know, again, you know, all the great things that are going on in computing speeds, things like that. So I think AI is probably a natural fit. You'll have to do it slowly over time and be sure that you don't have a safety issue. But I think in time, AI can help to optimize some of their workload.
George, has there ever been talk of privatizing our air traffic control system?
I think there's always talk of privatizing. Everybody tries to figure out how you're going to ring fence the fees, who's going to pay for it. So, I mean, frankly, in the U.S., I think it sort of keeps dying. But yeah, so I don't know. I don't know if we'll ever get there.
I mean,
but
to me, it's just to me, and this has always been the case. This is one of those jobs. To me, it's just compensation. If you pay more, you'll attract more bodies, and you'll fix the problem.
And then everyone will pay higher airplane ticket prices, probably.
I don't know, but I mean, this is a fundamental problem for the industry.
George, how do other countries manage this?
Yeah, I mean, so some do privatize. I think it's Canada that privatizes. But I think one of the challenges you really have here, though, is I think most, though, keep it in the public sector. And again, one of the challenges you have here is it's a national asset, and there's more than just airlines using it. So there's this debate I think we have in the U.S. all the time between sort of private aviation and commercial aviation, and how much should private pay, how much should commercial pay? Should we be sort of promoting access to airspace, which gives the U.S., I think, you know, one of their advantages in the aerospace industry? It's actually a very complicated discussion that gets you know, sort of hashed out with the groups like Aircraft Owners and Pilots Association and Airlines for America, other trade organizations. It's a very complex discussion. You'd be surprised how quickly it bogs down.
Yeah, I guess, yeah, it's interesting. So my strategy of just paying more probably not going to fix it, I guess. All right.
It opens the door to more questions.
I guess. George, thanks so much. Appreciate it. George Ferguson, he's a senior analyst. He covers the airlines. He covers all the aerospace and defense companies as well. So if it flies, George covers it, so that's why we like to check in with him. Let's talk about these markets. The markets are ripping today. Buy the rip, I guess. Sell the dip and buy the rip. I don't know what's going on, but people are bidding these stocks up here on the expectation that this government shutdown is in the early stages of writing itself. Ann Berry joins us here, founder and managing partner at Threadneedle. And what do you make of a day like today? It just feels like, you know, geopolitics, domestic politics are front and center here vis-a-vis fundamentals.
Absolutely. I think everything just hanging in the balance as we try to understand what goes on with this government shutdown. The one thing that I will say is once there is resolution, I think there will be resolution. I do think we see these markets move on upwards. I think the nervousness that's been the overhang here, once that's abated, I think there's fundamentally, divorced from fundamentals, I do think there's a sentiment move to the positive overall.
How are you thinking about the issue that plagued investors last week, which was, do we have an AI bubble? Is the spending that we've seen in the AI space sustainable? And have we peaked already on that front?
So I can give you my perspective on this. I do think that we are in an AI valuation bubble. I've thought that for quite a long time. And in full transparency, I've been taking profits in some of my investments in the tech sector as a result of that. I do think valuations will crack, and for a couple of reasons why. It's not just that the CapEx spending and the outlook for 2026 is much higher than originally thought. It's not just the fact that credit is now coming into play into the funding of data centers, backstopped by folks by CoreWeave, backstopped by folks like OpenAI, that's creating concern. I think it's the fact that OpenAI itself, such a key player in this, has alluded to the fact that there needs to be more government intervention in supporting the financing of the sector. And I think the market appetite for that sentiment, for that idea, I think is going to start to get pretty limited. You know, we've seen the government buying stakes in places like Intel. Yes, the share price went up, but from an overall sort of philosophical perspective, there's a lot of caution and nervousness around it. So I think we're at a moment where the market's going to pause and say, hang on a second, are we going to see the return as quickly as we've been hoping for? And I think it's really an open question.
And 2025 is shaping up to be a record year for new issuance in the investment-grade bond market. And one of the big areas, or one of the big issuers, has been technology, not a group you see necessarily in the investment grade market. But a lot of this is to fund AI expenditures, and some people are calling that out as a potential risk. How do you think about that?
I think it's a right risk to call out. Oracle is a case in point, right? So I do think that to me is another data point in the question around not just how much capital is coming in to fund AI investment, but the nature of it. Large equity investments coming from whether it's VCs in some of the massive private rounds that we've seen, whether it's in primary issuance, whether it's these tech companies using their cash flow to take big stakes like the $10 billion NVIDIA is putting in Intel, for example. That's one thing that I think can be forgiven. Again, once investment grade ratings are being put, the hat is being hung on this, that's where scrutiny intensifies. The credit markets tend to be a lot more focused on the details and on the cash flow profile and the return. Now that set of eyes is coming on this, I do think there's going to be a lot more discipline around looking at the actual return profile, and that will bleed over into the equity markets, I believe, in 26 as well.
Yeah, I mean, case in point, Paul, you have Verizon, for instance, kicking off a corporate bond offering to help fund its acquisition of Frontier. And this goes back to that 2024 acquisition where it used a bridge loan originally, but now is replacing that with some more permanent funding. At what point does demand start to dry up here? And I guess this depends in large part on when the Fed continues to cut rates, because people want in while they can to grab these juicy yields.
Well, I think for the moment, it really is company specific. And I think we're seeing a bifurcation in the demand for credit. I think on the one hand, the Verizons of the world seeing healthy demand. These are very strong credits. There's a business model that there's transparency around that folks understand. So I think in terms of the issuance of big blue chip corporates, that's going to continue to be robust for quite some time. Where I think we're going to see a pullback is in some of the lower grade, particularly on the private credit side, where there are real question marks being raised now around the quality of underwriting over the last couple of years. So I think we're going to see that bifurcation. I think we're going to see demand really move towards a flight to quality.
All right, Ann, thank you so much. Appreciate it, as always, getting a few minutes of your time. Ann Berry, she is the founder and managing partner of Threadneedle, joining us from New York via that Zoom thing here. So, yeah, I saw that investment grade data point from an earlier guest we had on surveillance, and they said financials have been a big issue of paper and well received by the marketplace. The marketplace will take whatever they have to offer.
The marketplace doesn't have enough, and there's so much demand. So they're just soaking up whatever comes along, including 40-year bonds from tech companies.
Yes, exactly right, 40-year bonds for technology that changes overnight. S&P 500 up 1.2%. The Dow's lagging a little bit, only up about 0.25%. The Nasdaq is where we see some real outperformance, up 2%.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We got stocks, treasury yields, gold prices, Bitcoin, all on the rise. This is on hopes of ending the longest government shutdown in U.S. history. Let's start with stocks. We have the Nasdaq up nearly 2%, 444 points. The Dow rising about 0.1%, 80 points, but the S&P 500 up more than 1%, 72 points. In the yield space, we have the 2-year at 3.58%. That's up 1 basis point. The yield on the 10-year 4.11%, and that is little change. Over to gold. We have spot gold up more than 2% at $4,086 an ounce. Taking a look at Bitcoin, up about nearly 1% at just above 105,000. Over to company news. Diageo, well, it has a new chief, the maker of Johnny Walker, Guinness. It's named Dave Lewis, who's known for his turnaround at UK grocer Tesco as its new CEO. That starts January 1st. Shares of Diageo, they're up about 4% in London. And UPS, FedEx, they've grounded their McDonnell Douglas MD-11 aircraft fleet. That's on Boeing's recommendation. Comes after that crash involving the jet that killed more than a dozen people in Louisville. Taking a look at UPS right now, their shares down nearly 4%. FedEx down about 2%, and Boeing down about 0.5%. And finally, the Financial Times reporting Robinhood, they plan to offer amateur investors a way to invest in AI startups. The new fund will be managed by its subsidiary, Robinhood Ventures. Robinhood shares up more than 4%.
What could go wrong there?
I know. Exactly. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Mandeep Singh just barely made it under the wire to get here to talk to us today. Then I was going to give him a hard time, but then I remembered he has like 5 other jobs. He's like senior research analyst covering technology. He manages a bunch of people.
He's also updating the AI tech guide, that slide that you're always talking about, you know?
All right, we'll cut him a break here. Mandeep Singh joins us here. He's our senior tech analyst at Bloomberg Intelligence, managing, it's like herding a group of cats when you're managing research analysts, because by definition, they don't want to be managed, Taiwan Semiconductor Manufacturing, I usually don't pay attention to this one. It's chips and stuff like that. That's not a lot of fun. But this is interesting. They reported some numbers, slower growth. And I think for those that are concerned about the growth of this AI juggernaut that we've all been on over the couple of years, you're wondering, does slowing growth at Taiwan Semiconductor mean anything for the industry writ large? Mandeep, what do you think when you saw the Taiwan Semiconductor numbers?
I mean, Taiwan Semi is unique because they give you monthly numbers. So all of our companies report on a quarterly basis. And when I look at Taiwan Semi's quarterly results, they had over 30% growth. Gave a guide where AI would be growing, almost 50% plus over the next 5 years. And so if, this deceleration is happening for a reason, I would attribute it to their diversification of their business, because you have to remember, Apple is more than 20% of their revenue. NVIDIA is close to 20% now. And then they also have some autos revenue, some analog business. So what is happening right now is everyone is putting their dollars in AI CapEx, but then they have to take away spending from elsewhere. And so the non-AI piece of the hardware spend, that seems to be slowing down, although we haven't really seen that even with PC sales. Things seem to be steady, but that could be one reason I can think of in terms of why that monthly number was a slightly weak. And there could be seasonality as well. I mean, this is a monthly number. Could happen that the next 2 months actually are above 30%, and then the overall quarter may still look solid.
Very good point. And just to recap the numbers, a 16.9% increase in October sales, which was on track with analyst estimates, but that is the slowest pace in about 18 months. I keep reading how TSMC is constrained by limited capacity. Yeah. So if it wanted to, it would want to actually have higher sales. It's just physically limited.
Well, limited capacity, again, on the AI side.
Okay.
So, TSMC does $120 billion run rate business in a year. So out of that, AI is still 15%, And so from that perspective, not everything that TSMC manufactures is at the cutting edge. And then you can slice it by leading versus, some of the trailing nodes. So from that perspective, the utilization is far higher in terms of the leading nodes versus some of the other nodes that they manufacture on. And it could happen that, because of the lower utilization, they're not seeing as much customer orders flow in. And look, I mean, it's hard to say for sure, given, the book of their business and how many customers they have. And for some customers, they're still the only game in town,
So TSMC makes custom chips for companies that order it from TSMC. It's a manufacturer overall. We know that all these big tech companies in the US are starting to turn on their own capabilities of making their own chips.
Yeah.
Is that competition or is that out of necessity? I mean, does that take away market share from TSMC down the road?
I mean, look, if Intel is successful in terms of reviving itself on the manufacturing side, and that's what everyone is hoping, with the initiative, with the government taking a 10% stake in Intel, that the fab side really gets a lift in terms of other companies using Intel fabs to manufacture chips. That's when you got to be worried about TSMC. But for now, there is nothing on the horizon where you think an OpenAI or any of these chip companies is going to go to Intel for manufacturing their chips.
And TSMC, market cap 1.5 trillion, stock up 50% this year. Maybe I should pay a little more attention to this one. What do you think? In a related story, NVIDIA, again, more Bloomberg News reporting. These people are everywhere. NVIDIA Chief Executive Officer Jensen Huang said he had asked Taiwan Semiconductor Manufacturing for more chip supplies as artificial intelligence demand remains strong.
Yeah.
So there you go. I mean, that's, hey, is this thing slowing down? Well, not to Jensen Huang.
The Blackwell ramp up is actually accelerating. And if all the hyperscalers are telling you they're raising their CapEx for 2026, and it's going to be another 50% plus year, they need more TSMC capacity. And NVIDIA needs more TSMC allocation because TSMC can allocate to anyone outside of NVIDIA as well. So from that perspective, you can see how much NVIDIA cares about TSMC capacity.
Let me ask a dumb question. I used to cover Taiwan equities when I worked in Hong Kong, and there are two big companies in Taiwan, TSMC and UMC, United Microelectronics. And it feels like TSMC just ran away with it, and UMC is kind of a shadow of its former self. Is there any company in Taiwan that can really compete or even hope to compete against TSMC?
Not right now, and especially when it comes to leading nodes. I think that's where TSMC talking about 2 nanometer. I mean, we have seen why Intel has struggled in the last 5 years because they were not able to make the node transitions, even though they are a leading node manufacturer. So from that perspective, I mean, TSMC, it feels like they have an unassailable moat, and not just in terms of manufacturing, but also their efficiency when it comes to using these semi-cap equipment tools. Like, they are probably the best in terms of the leverage they have shown, in terms of the useful life of these tools that other manufacturing companies haven't been able to show.
All right, got about a minute and a half left. Instead of me asking a dumb question, why don't I just say, hey, what are you and your team working on? What's the next cool thing we're going to be reading about from you guys?
I mean, we are in the process of updating our Gen AI numbers, and they are going up for 2026. And also there's a heavy emphasis on data centers. So our next big report, our dashboard, is going to be on data center utilization, data center capacity additions. Everyone is talking in terms of gigawatts. So OpenAI said they'll be adding 30 gigawatts over the next 5 years. Well, we want to track overall gigawatts from all these vendors, Microsoft, all the hyperscalers.
Do we have a utilities analyst?
We do.
Who is that?
Well, I mean, it's covered by multiple people, Rob Barnett and
now
others.
We got, I mean, those guys become front and center. It seems like. I mean, do we have the grid to power all this stuff?
I mean, everyone has called out power. In fact, right now, the consensus is power is the biggest constraint, even more so than the GPUs, which was the case for the past 3 years. So
it's always going to be something.
Yeah. All right. And how many analysts are covering like technology broadly defined for BI?
We're close to 20 people globally.
20 people
yeah.
globally, right? They're not just stuck in New York. They're everywhere, right?
They're everywhere. You need that, Taiwan,
Asia.
and Asia.
They're in Asia, they're in Silicon Valley, they're in London, they're in New York, they're...
Can I just say, remember when it used to be gigawatts based on what Doc Brown was saying in Back to the Future? Remember he said gigawatt. And that was actually based on the fact that he talked to scientists, or the screenplay writers talked to scientists, and they called it a gigawatt.
All right, there you go. Flux capacitor, I remember.
1.1 gigawatt.
Mandeep Singh, thank you so much. We appreciate it. He's a senior tech analyst. He manages all the tech research globally. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
You know, we were talking about, Scarlett, AI is a theme that's just there. It's not going anywhere. Same thing for, I think, these obesity drugs. That's another thing in the healthcare space.
Huge market opportunity over the long term.
All right, Scarlett Fu and Paul Sweeney, we're live here with you in the Bloomberg Interactive Broker Studio and streaming live on YouTube here. And I'm looking at the news. Metsera shares tumbled after Novo Nordisk declined to further raise its offer for the U.S. maker of an experimental weight loss drug, bringing a bidding war with Pfizer to an end. I like a good bidding war, being a former banker. Sam Fazeli joins us here, Director of Research for Global Industries. He covers all the healthcare stuff for Bloomberg Intelligence. He's based in London. So how good is this Metsera company, Sam, and their drug? How good is Metsera? Because, boy, it seemed like everybody wanted a piece of it.
Yeah, so Paul, before this last week, sorry, I've been off, and you know what happens to your brain when you're off for a few days.
Yep.
Before last week, which is called, we had the Obesity Week, right? Where my colleague Mike Shaw was at. There was a little bit of confusion around how good their data was, how good their assets were in the obesity space. And some questions about, can they really be dosed once a month if people wanted to do that? Do we really know what the side effect profile is like, given the way they've disclosed so far? And of course, last week it cleared most of that up. The side effect profile is the same as most of these GLP-1s. You get some nausea. In some tough cases, you get some vomiting. But those are early on, and they get out of the way. If you can withstand them, you seem to get the benefit. And it seems to work pretty well as a once-monthly drug. But there's always more wood to be chopped. You know what these things are like. So the assets look great. They're competitive. And Pfizer just stood his ground and put the bid up. And of course, I think what clinched it was what we've been going on for ages about, for the past 10 days or 20 days about, is that Novo's deal had the risk of not being able to pass due to competition issues, FTC issues. And it sounds like the FTC had given Metsera a call saying, look, if you go with that, there is a risk it won't close. So do whatever you think is the right thing for your shareholders. And they did in the end. And Pfizer did up its bid.
Right. So Novo Nordisk won in a way in that Pfizer is paying up more. Does that actually work in Novo Nordisk's favor, or is it still as desperate as it was before to look for some new catalysts in the obesity market?
Yeah. I mean, I'm not going to call Novo desperate. I think they have assets in there. I think they wanted to add some more options to their sales reps' bags over time. So I wouldn't call them desperate, but they're obviously, by going after this, they did say that we need more assets in our bag. So, and Lilly wasn't in the game. So it just gives them gives you that flavor that they are. And I think the market's telling you that. Look at the divergence of the share price performance of Lilly versus Novo Nordisk. There's the market's favoring the drugs that Lilly's got on the market today, and to compete, they needed to get some more. So I think this is not the end for Novo at all in this space. There's lots of other interesting obesity assets coming up with different mechanisms. That's the thing that I think the company is now going to have to think about, rather than trying to go after the same mechanism all the time.
So, Sam, all these big cap pharmaceutical companies that you've covered for decades, I kind of always thought they were big diversified portfolios of lots of different drugs and therapeutics, and but boy, when I look at the stocks this year, it seems like there's haves and have-nots. If you have obesity exposure, the stocks are up, and if you don't, they're down. Is that kind of how your world's evolved into over the last several years?
I would just give you one little caveat to that. AstraZeneca. AstraZeneca, I think, is doing fine, and then they have an obesity asset, but it's not their major game. Their big plays in oncology, cardiovascular is there, and they're adding it to it. So, yes, obesity has been the talk of this past 2025. I think it will still be the talk of 2026. But there's a lot more going on in pharma. Neuroscience, diseases of the brain, diseases of mental health are getting much more attention. Cardiovascular, aside from obesity, is getting quite a lot of attention in hard to treat hypertension, etc. I have to tell you, I don't think there's an area, perhaps antibiotics set aside, that is not getting a significant amount of progress across some pharma company somewhere.
Is what happened with Metsera, Novo Nordisk, and Pfizer an unabashed victory for Eli Lilly? I mean, does it just kind of keep on moving forward, or does any of this kind of hurt Eli Lilly's market position?
No, I mean, at the end of the day, there'll be multiple players in this space, as there are now two at least. And I think Eli Lilly is currently very well placed with the assets that they have today to compete, and they're showing that they're competing very, very effectively, and in some cases winning market share from Novo Nordisk.
Hey, Sam, we've got about 30 seconds left. What's you have a little hindsight here. President Trump threatening medical funding at the university level. What's the update there with the status of that?
Yeah, it seems to be that some universities are getting some reprieve from general funding issues, but medical funding is something that I keep scratching my head on. I don't understand why you would want to cut off funding to research and funding to medicine in general, because that is a major driver of economic boom in the US. And it's not just medicine, it's also STEM. I don't understand it, Paul. Maybe someone else has a better
maybe the
understanding
next
of this.
shiny object will take the attention away from that.
Could be.
Could be. So, all right, Sam, thanks so much. We appreciate that. Sam Fazeli, Director of Research for Global Industries and Senior Pharmaceutical Analyst. Folks, he's one of the best in the business, well respected by the companies and investors around the world for his pharma work. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good morning from the Bloomberg Interactive Broker Studio here in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We have a jam-packed second hour of Bloomberg Intelligence for you on this day when it looks like maybe there's an end in sight for the government shutdown. But we're going to start with the AI trade. CoreWeave is going to be reporting earnings later on today. So we have Anurag Rana, Bloomberg Intelligence technology analyst, to give us a preview of that company's results. Most of the tech earnings has been reported, the big tech earnings, but we do have CoreWeave and we do have NVIDIA in a week and a half. Mike McClone, Bloomberg Intelligence senior commodity strategist, will talk to us about gold and gold versus Bitcoin. He pays close attention to those key levels. And then we'll hear from Mary Daly, the president of the San Francisco Fed, on where her thinking is when it comes to interest rate cuts. And Brian Jacobson, chief economist at Annex Wealth Management, will give us his outlook for these markets. But first, let's get a Bloomberg Business Flash from our Lisa Mateo.
You got it. We have stocks climbing alongside with gold and Bitcoin. The Senate advanced a plan to end the longest government shutdown in U.S. history. We'll start with the NASDAQ right now, up nearly 1.5%, 320 points. The Dow, little changed, up about 19 points, and the S&P 500 rising 0.7% or 50 points. The two-year yield, 3.58%. That's up 1 basis point. The yield on the 10-year, 4.11%, and that is little change. Over to gold. Let's go to COMEX Gold, up 2% at $4,090 an ounce. Gold stocks outperforming. We go to Newmont. Their shares up more than 3.5%. Barrick Mining, their shares up 5%. Barrick also boosted its quarterly dividend and expanded a share buyback program. Over to company news now. Taiwan Semiconductor Manufacturing reported slowing growth in monthly revenue, fueling that debate over the AI boom. Still, shares have gained 37% since the beginning of the year. Right now, TSM is up about 2%. Coinbase Global, they plan to launch a platform that will allow select groups of investors early access to new cryptocurrencies before these tokens are made available for trading on its main exchange. Coinbase shares up about 1.5%. And finally, Restaurant Brands International, they agreed to sell a majority stake in the China unit of its Burger King chain as part of a plan to ignite some growth there. Their shares up about 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, thank you so much, Lisa Mateo. Let's take a look at some individual stocks on the move, and let's bring in Bloomberg's Denitsa Sokova. Denitsa, what do you have your eye on?
We're talking about beef and chicken. Tyson Foods said it expects results for next year to be little change. It's all about the pressures from the beef segment, but still we're seeing a pretty positive reaction. It's up 3%. Ticker is TSN. It's based on chicken. Higher demand for chicken has been boosting the company. It's the second largest source of revenue. And we've seen that in a few quarters in a row, and this happened in the fourth quarter as well. It has offset the losses from the beef part of the business. The company also forecasts total sales growth of about 2 to 4%, and that implies revenue that is topping analyst expectations. The beef loss we were talking about is about 400 million to 600 million next year, which is not far from what they had this year. Of course, at the same time, we have the president talking about consumer beef prices jumping to record highs, launching an investigation. But clearly, this is not trickling down, at least to Tyson Foods. And we see different estimates that actually a lot of those producers have been losing money. Analysts and investors have been watching for sign for consumer appetite for chicken to peak. That's one meat that obviously prices have been falling. We had another crisis, but now prices have been falling, and it's definitely helping the company. But if this is the peak of demand, perhaps we're going to see the beef losses starting to weigh more heavily.
Now, I did some more research on the whole beef thing.
Right.
Apparently, they're restocking the herd, but we won't really see it until maybe
That
like
takes
2028.
years.
Yeah,
Yeah.
2028. So my old strategy, just make more chickens. That's easy to do,
Yeah.
apparently, but making more cows is harder.
Can you convince more people to eat chicken, though?
Good question.
Good question. I probably my chicken to beef ratio, I'm going to say, is 5 to 1, if not 10 to 1.
What was it like 10, 15 years ago, though?
Kind of the same.
Yeah?
You know, but but
I don't know. If you own those chains, people are eating more chicken. It's becoming
Yeah.
a bigger thing.
Yeah.
It's
It was
fair.
probably, I'm eating more chicken now than I did, I guess, back in the day. Better for you? I don't know. Or less-
Supposedly,
less-
I mean,
here.
All right, very good.
Or you
We'll
can go
see how-
vegetarian. Remember Beyond
No,
Meat?
Yeah,
no,
tofu.
No, thank you. No, thank you. What else you got for us? Elf Beauty.
We have Elf Beauty. It had a really tough Thursday. It tumbled 35% after the earnings. Today we're seeing a reversal here. Shares rose as much as 10%. The company announced expansion in Ulta Beauty in Mexico. The company has been growing through all those chains, Ulta Beauty, Sephora. There was, of course, a lot of excitement. Ticker is ELF. There was a lot of excitement for the acquisition of Hailey Bieber's brand, and that was kind of a whole new identity. Analysts were so excited. There was like a few weeks of really big rally. But now what we saw after earnings was a pretty big disappointment. The company is down 37% year to date. It's been growing internationally and in the US. So perhaps this expansion in Mexico is one reason investors are really excited. But after this earnings report, it's really hard to get back to even where they were before
All right.
that.
Well, Alex Steele, explain to me, you have to invest in your face.
Yes.
Always.
There you go.
Always. All right, let's talk about Monday.com, which is declining quite a bit.
Monday.com, yeah, it slumped about 20%, lowest since November 2023. The ticker is MNDY. Of course, this is one of the pandemic favorites that has been hit pretty hard now. They've been trying to promote all those AI tools to kind of beef up their proposal. But the company posted still better than expected third quarter earnings. The number that is worrying investors is their revenue forecast, which is about 330 million. This is lower than what the street was expected, and we're seeing that investors have really been punishing this company every time when the outlook has been less than what investors expect. This is what happened in August, and yeah, clearly a pandemic favorite is down 33% year to date. Really big hit.
All right, Denitsa Sokova, thank you so much. We appreciate that. Denitsa Sokova, Bloomberg News. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. One of the most successful IPOs this year in the tech spaces, or anywhere, CoreWeave went public in August of this year, $40 a share. Stock's $105 right now. I couldn't even tell you what they do, but our next guest can.
Something with Neo and cloud.
I'm going to say cloud. I'm going to put cloud on my bingo card here and see. But Anurag Rana, he joins us. He's a senior tech analyst for Bloomberg Intelligence. He works hand in hand with Mandeep Singh, and they run that global tech franchise for Bloomberg Intelligence. Anurag, for me, and maybe for some other viewers and listeners, just remind us what CoreWeave does and what are you going to be looking for when they report earnings?
Yeah, thanks, Paul. So CoreWeave, in a very, very basic way, is a company that's renting out GPUs to people. The most easy way. When Amazon started, back 15 years ago or so, they were renting CPUs or basic computing services. What these guys do is only AI workloads. They have a partnership with NVIDIA. They get NVIDIA's newest chips, and they add that to their, large infrastructure, and people rent that out for different reasons. It could be, Microsoft is renting them out, or Meta is renting them out. Anybody can come out and rent that service from them.
Okay, thank you for explaining that. And just in explaining that, you mentioned a couple of big names like NVIDIA, like Meta, like Microsoft. And with all the concerns about circular financing, the circular deal making, it feels like CoreWeave is sitting in the middle of that. It gets most of its chips from NVIDIA, but most of its sales come from Meta, Microsoft, and Alphabet. So if any one of those companies decides to pull back just a little bit, does CoreWeave get caught up in that completely?
It does, I would say, but I would also guard in one way and saying that, the stuff that's coming from Microsoft, this is a company with, good credit. It's not as if Microsoft is going to say, you know what, I contracted something with you, I'm no longer going to need that. That's really not going to happen. So from that point, CoreWeave has a very good customer that sees the demand in front of them. OpenAI going out and buying 100 billion capacity, 200 billion capacity, it's a completely different game than what CoreWeave has right now with the handful of customers it has. Remember, their backlog at this point is about $30 billion, not the 300 that Oracle has with OpenAI.
All right, so what are you going to be looking for these guys in their quarter here? What's kind of moving this stock? What are you going to be paying attention to?
So this is at this point in the cycle, one of the things we know is there is a lot of demand that's coming in. We have lots of, you could say promises by different vendors to say, I'm going to need capacity. The big question for CoreWeave is, how long does it take them to expand their infrastructure? How much money they're going to spend? How much of borrowing they can do? So it's very much now an execution game is how are they going to convert that into revenue, and bigger part is how much debt they have to take, how much capital expenditure is going to be, what's going to be the cash burn rate. So now we are at the point when it needs to be transferred over from just a headline strong bookings number into all the capex and the cash flow that comes with it.
The other news that I hadn't realized, and maybe I should, is that CoreWeave made an acquisition offer to a company called Core Scientific, but they rejected that $9 billion offer on October 30th. Is there part two to this, Anurag?
So, one of the things is he's been, the CEO of CoreWeave has been very clear about it. I'm not going to pay more money at it. And to be very honest, it makes sense because as Paul mentioned, the stock was IPO'd at $40. It went from 40 to 160. At 160, we were saying, well, why aren't you doing a secondary at this point and, take use of this particular, you could say explosion of the stock. They decided to buy a company using that stock at that time. What the company does, it helps them recognize a lot of the orders that are coming in because they are the ones who go out and expand into the data center space. If they cannot get that deal done, or which has happened now because the owners of that particular company wanted more money, they really don't need to get into that because they themselves are cash constrained. The relationship between them and CoreSites is not going to change because they're going to still go out and get the data center capacity from them. So I think it's more financial issue rather than any of the strategic changes that they're doing in that direction.
All right, Anurag, good stuff. Appreciate it. As always, Anurag Rana, he's a senior technology analyst for Bloomberg Intelligence, ensconced in that little known technology haven of Chicago, Illinois. That's where we
he is ensconced for a while now because of the storm. So
yeah, he's not going anywhere. So anyway, appreciate getting a few minutes of his time there on CoreWeave again. Boy, another great cloud computing / AI stock there. Let's check in on the commodity front here. A lot going on there. As always, we check in with Mike McGlone. He covers all the commodity stuff. He's our commodity strategist for Bloomberg Intelligence. I'll talk about being safely ensconced, the opposite of Chicago, Miami Beach. How about that? But now he's got to deal with all the snowbirds and stuff like that. He can't get any reservations. If he wants
got a perpetual tan.
Yeah, exactly. But he's got to wear a hat. Let's be honest here. Mike, talk to us about gold here. Sitting here, it felt like that 4,000 level was kind of support there for gold. What do you make of that?
Well, to use an option term, Paul, it seems to be pinned at 4,000. That's a good level for now. It's happy there. It ended there Friday. Obviously, it's up this morning about 2% based on some of the latest things with the shutdown and from Trump. But I'm finding gold overall very disconcerting. The velocity of the rally this year was only matched recently in 2008 and 2011. If you use a 40, 50, or 60-month moving average relative to that level. In 2008, initially popped up to 1,000, then dropped down 700 as the market went down. So it was about a third correction. And in 2011, it put in a high that lasted about 10 years. So to me, gold's very concerning that it's going up so much, particularly versus all risk assets. And towards the end of the year, I'm just viewed as it's frightening me what it might mean for risk assets.
Speaking of risk assets, Bitcoin has become kind of like the risk asset of choice, although there's the pre-October 10th and then there's post-October 10th when there was what felt like a massive liquidation event of crypto and Bitcoin specifically. Where do things stand now from here to the end of the year? Because there's this sense that leverage played a big part in that October 10th sell-off, and since then there's been less fundamental demand for crypto.
Well, I love that question, Scarlett. My first thought is quelle surprise. I mean, Bitcoin is, anytime you get a market like this, it always gets leveraged near highs and put in a pretty good peak. But right now, Bitcoin is about do or die between 110,000. It has to get above that level, which is about its 200-day moving average. You see it's dipped below. And 100,000, which is basically that inflection point that's been key support. I think the risks are it's going to tilt lower. But the key thing for Bitcoin is it's been showing pretty significant divergent weakness for almost a year now. It's up maybe, what, 13% in the year. S&P 500 is up 17%. Bitcoin was up 30% in the year. The Bloomberg Galaxy Crypto Index is actually now down on the year as of last Friday. So it's all tilting that way, despite the stock market still hanging in there. I'm afraid that this crypto market going lower and stocks still hanging in there and gold taking off is a sign that the whole bull market's ready to tilt over. And the key thing that's different now is a lot of the stock market's dependent on Bitcoin going up because it's a great leading indicator. And it's already so much ensconced in the stock market.
All right, you've mentioned it before. I'll ask again. Bitcoin versus gold. You kind of look at them together, don't you?
I love that ratio, Paul. I've been watching it since it was first hit 1 and peaked and broke through in 2017. Right now, it takes about 25 ounces of gold per 1 Bitcoin. The high this year was 35. When Mr. Trump got elected, got into 40. It looks like it's bumping up on that 25 support. It looks like it's going to ready to break below. And that's significant because it's a great leading indicator from the stock market. And also that 25 level has been synonymous with that 10-year note yield around 4%. Like they've both bounced. To me, the risk is they're going to both head lower into the year end. I don't know what's going to save it right now, but it looks like it's tilting that lower. And there's 2 key things to indicate that for me. MicroStrategy is heading lower. Its 200-day moving average is moving lower. And stock market volatility, 90-day volatility in the stock market at 10% is very low. It's only room for that is to go back up.
You mentioned MicroStrategy, or Strategy as it's now known. What is your take on these digital asset treasury companies? Because they were all the rage over the summer, and then they have kind of fallen apart. The whole people being enamored with it has kind of fallen apart after October 10th, and you're seeing some of them come back to earth. And the only one that really worked was Strategy, and everyone else is getting caught up in I don't want to say the backflow, but it's not looking good.
Scarlett, I think they're classic signs of a peak. And I think digital assets and treasury in the same sentence is an oxymoron. Treasury should be with treasuries as far as holding them and holding assets for long-term safety and store value. And I think that's a risk of going lower. And I think MicroStrategy has been the leader. The key thing I'm worried about is that lamb factor. Look at me. I made money doing this, and you can too. That's classic signs of peak. And I'm just really worried the whole space can drop easily 80 to 90%, flush them all out, and then we'll reset like we did with the dot-com bubble burst in 2000 to 2002.
All right, last one, Mike, then we'll let you go. I filled up the Beamer this weekend at the Jersey Shore, $2.75 a gallon. Beat that. We got WTI crude oil below $60 here. What's the oil call?
Next year, I think you're going to pay $2 a gallon for it's particularly if the stock market goes down, and crude oil stock is around 60. The key question, does it go to 40 or 80 next? I think it's much likely to go to 40, particularly if the stock market drops a little bit. What's the key indicator for all this? Bitcoin.
There you go. It all comes back to the cryptocurrency. Tom Keene's a bit dog.
That's a bold call there.
And he's been on that call for a long time, and he's been right on that call. All right, Mike, very good. Go back to the tanning bed. Mike McGlone, he's senior commodity strategist for Bloomberg Intelligence. He's down there. He is our Miami Beach office down there. Earlier, San Francisco Fed President Mary Daly spoke with Bloomberg's Jonathan Ferro and Lisa Abramowitz. She said the U.S. economy is probably suffering a downturn in demand and warned against keeping interest rates too high for too long. She was first asked what is guiding her assessment of where we are.
I'm looking at both inflation and productivity. And if you look at inflation, you're seeing that it's been pretty contained so far in the goods prices, which have been directly tariffed. And then you look at the other parts of inflation, you just don't see much of a run-up. So that's good news. And inflation expectations, what people expect, remain very well anchored. Look at productivity, and you see that productivity is rising, GDP growth is rising, while the labor market is slowing. So that tells me there's a little bit of that boost coming from firms looking to do more with less, but that's also causing a slowdown in the labor market. So the 50 basis point adjustment we've made has helped support the labor market, but still keeps policy restrictive so that we can put downward pressure on inflation.
President Daley, what are you looking at to determine whether it's the 1970s or the 1990s?
Well, I'm going to really look at things that improve productivity, to think about the 90s, and it's more than just the stock market valuations for AI companies. It really is about the companies out there who might be using AI, and then asking them, going directly to them and asking them, what's it doing for your bottom line, and how are you using it? And what we're hearing are pretty encouraging but very early signs. They see how it can help their bottom line, how it can improve their productivity, even how they can be supportive of their workers, give them more interesting work, take the less interesting work away. But they all tell us it's early days, so more to come on that. And then on the inflation part, are we in the 1970s, really asking employers and firms, what are you doing with prices? Are you thinking about raising your prices? How are you going to think about losing volumes if you do so in a slowing economy, especially for consumers, from the 50th percentile down? And putting those two things together, I think we'll get a lot of clarity about which direction we're heading. And with policy, been slightly adjusted, we are in a good place to continue to evaluate the information before we make any decisions. We can't know ex ante before the data come out and before we get that information, really what we're facing. We just have to have an open mind.
And that was Mary Daly, the president of the San Francisco Fed, speaking on Bloomberg Surveillance this morning. Let's go now to Lisa Mateo, who's got our Bloomberg Business Flash.
You got it in this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We've got stocks rallying. This on bets that the end to the government shutdown is nearing. And as lawmakers move closer to ending it without securing a health care win, well, we're keeping an eye on health insurers, which are lower. Centene, for example, and Oscar Health also lower. Over to stock market, NASDAQ down up nearly 1.5%, 324 points. The S&P 500 rising 0.7% or 50 points. And we have the Dow. Right now, it's little change, down about 5. In the yield space, the 2-year, 3.58%. That's up 1 basis point. The yield on the 10-year, 4.10%, and that is little changed. To commodities right now, we have to point out COMEX gold up more than 2% at $4,098 an ounce. We have Brent crude at $63 a barrel, WTI crude at $59 a barrel. To earnings we go. We'll start with Tyson's Foods. They say they expect results for next year to be little change. Its beef segment continues to lose money, but its chicken segment kind of offsetting some of those losses. Its shares are up about 2%. And Instacart reported better than expected order growth and provided an upbeat earnings outlook. Its shares are rising about 1%. After the close, we move on to Occidental Petroleum, Paramount Skydance, and Beyond Meat actually delayed the release of its quarterly earnings for a second time. Its shares are down about 5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett, Phil, and Paul Sweeney live here with you in the Bloomberg Interactive Broker Studio. We are streaming live on YouTube. Head over to YouTube.com and search Bloomberg Podcast, and that's where you'll find us here. K-shaped economy, we've been hearing about it for a long time, and I think even though we don't have any government data over the past month or so, we heard about it again, and from some of the companies reporting earnings, whether it's a restaurant company or a consumer products company. I wonder what that means for this economy going forward. Is that just kind of the way it is? Brian Jacobson joins us here. He's the chief economist for Annex Wealth Management. Brian, what does a K-shaped economy mean to you, and is that kind of the new normal for this U.S. economy, do you think?
Yeah, thanks for having me. And I think that, the K-shaped economy, really, if we think back to like 2012, coming out of the global financial crisis, people were talking about that because it was a jobless recovery. So it kind of goes in and out of fashion, it seems like, and maybe it's just a feature. maybe a bug of our system because the K shape, it can give rise to then the X shape, right? And the idea is that with the K, you've got the upper income individuals doing better and lower income individuals not, but then it can also switch. And I think that's maybe what we're going to be seeing, especially maybe on the market side of things, more so than on the economic side or macroeconomic side, because the macro stuff is very much driven by policy decisions, longer term things, demographics, but the market is probably very K-shaped in terms of who's been winning, who's been losing, where's the earnings growth been, where hasn't it been, and perhaps we could actually see that flip in 2026.
So that means if the market, the stock market that is, starts stumbling, the higher end consumer starts pulling back on spending. But where do you see the lower income consumer fitting in then?
Yeah, that would be a challenge, right? Because if the higher income consumer is pulled back, sometimes if you think about, like, let's say somebody buys a yacht, well, who's staffing it, right? If people eat out, who's staffing those places? So if they pull back, doesn't that actually affect everybody? But not necessarily, because I'm not sure that they would pull back enough to really cause many macroeconomic effects here. We still do have positive wage growth for the lowest quartile of households. Now, granted, the data we have is only back to August because we need to get that updated, but from the Federal Reserve Bank of Atlanta, they break out the income growth by quartile. So the top quartile of households had roughly like 4.6% earnings growth year over year in August, whereas the lowest quartile had something closer to about 3.6. So it's still positive. I think that's really the key thing is people look at the K-shaped and they assume, well, they must be doing worse. Maybe it's relatively worse. So as long as that real wage growth stays positive, I think that's the key thing, is that then we would avoid recessionary implications, and maybe we could actually see the market rally. It could flip more from the top-heavy tech more towards the bottom-heavy small caps, more on the value side.
Brian, what's your latest thinking on inflation, particularly potential inflation from tariffs? Doesn't appear that we've really seen it. A lot of folks were calling for tariff-induced inflation. Doesn't appear like we're really seeing it yet. How do you think about it?
Yeah, we're seeing it very gradually seep into prices. So it hasn't been this one-off price increase where you see a dramatic increase in inflation temporarily. I think that's one of the problems that economists that we've had in terms of describing the inflation effects of tariffs, portraying it as though it's like this one-off price increase, because that's actually a process that plays out over time. It's about pricing power from businesses. We know that companies like Amazon have been able to hike prices more than companies like Walmart and Target for the exact same types of goods. So pricing power really matters here. And the inflation effects from tariffs is more of this longer-term process playing out over the course of, say, 18 months, as opposed to over the course of 18 weeks. So I think it's going to become one of these like annoying background kind of aches and pains in the economy, as opposed to being front and center where it's really abrupt.
Or something that just keeps inflation above the 2% target, kind of in the sub 3% range, which is where we're at right now, but never really getting to 2%. I want to get your thoughts, Brian, about the shutdown. Now that it looks like there's some movement and perhaps we could see the government reopen by the end of this week, all those estimates of the shutdown costing the U.S. economy $15 billion a week, how are you thinking about whether that's going to be the final number and what the damage might be to the economy? Or do we all make it back because, folks will get paid and a lot of the stuff that was put off will just happen later on?
Yeah, I think that we will get some of it as a payback, but not all of it, because the longer that it lasts, the more permanent the damage becomes. If you think about the delays in regulatory filings and approvals, also if you are a furloughed employee or even a federal employee who's working but not getting paid, right, you're not necessarily going to go out for 2 dinners in one night when you forewent one while you weren't getting your paycheck. So there's some of it that's permanently lost. And the biggest cost, I think, has been more on the travel area when we saw saw all those delays? Because that's something that's really difficult to measure. When you have roughly, what is it, like 2.1 million people passing through TSA gates on a daily basis, and all of a sudden, 4% of those might be affected. What's the cost of their time, the frustrations and all that? So that's really an economic cost that's difficult to measure and not something that we're going to get back. I think that the markets are liking it right now, but in a way, we're not out of the woods quite yet. This still does have to pass the House. And is this maybe a little bit of buy the rumor, possibly sell the news?
Okay. So we'll keep an eye on that one. Brian, really appreciate your joining us. Brian Jacobson is Chief Economist over at Annex Wealth Management, joining us from Brookfield, Wisconsin. Let's head over now to company news because we do still have companies reporting earnings, and Tyson is the latest to do so. Tyson, of course, reporting results today, and it looks like we had a fourth quarter adjusted earnings per share beat, and Jennifer Bartashis is joining us now. Jen covers she's our senior retail staples and packaged food analyst for us here at Bloomberg Intelligence. And Jen, we think about Tyson, I think about chicken right away, and higher demand for chicken certainly was a factor that helped fourth quarter results. But beef is going to be a problem down the road, isn't it?
Well, it's an interesting thing because obviously Tyson has been doing very well with the chicken business. They've invested in the last couple of years in improving their operations, and we've seen that come through with a better margin, better operating usage, and that sort of thing. But when we look at the guidance for next year, over half of their adjusted operating income is expected to come from chicken. And for a diversified protein company, that's putting a lot of eggs in one basket, so to speak. And so, it's doing well. There's a lot of momentum behind chicken in general, but Tyson is going to be very dependent on the continued success of that segment to hit its guidance for next year.
Talk to us about the cattle herd in this country. How does that work here? I mean, prices are so high, and I thought for like a lot of commodities, when you see a price, move materially higher, it brings on more supply, but I guess it's a little different in the cattle business. What's your understanding?
Yeah, it's a little bit harder in the cattle business. You have to remember that raising cattle it's a capital-intensive activity, and so there have been a lot of things that have held ranchers back from increasing the size of their herds. We've had high interest rates because a lot of them have to borrow in order to rebuild herds. We've had drought conditions, especially in the West and in the South, which make it difficult to commit to raising more animals if your land can't sustain them. And so those are some of the kind of structural impediments that have really held us back from what we would typically at this point have expected to see some rebuilding of those herds already. Tyson says they see a couple of indicators in the Northwest, in the upper Midwest, that there's some heifer retention coming. That means that cows are not being sent to slaughter, but it's not enough to really move the needle. So from our estimate, we're not looking at a meaningful change in supply until 2028. Expect high beef prices to continue.
Yeah, okay, so not great news if you're a hamburger lover, and it's because these consumer beef prices that are at record highs is what prompted President Trump to ask the DOJ to investigate the meatpacking industry. He is blaming majority foreign-owned companies for driving up these beef prices. Jen, how do you think about this?
Well, when we look at this, I mean, this seems like it's more of a political maneuver than actually based on anything from a market perspective at this point. We will see what the DOJ comes up with and what they actually share. But this seems to be looking for a rationalization for high beef prices versus actually understanding what the market fundamentals are. And the other thing you have to remember is that we import a huge amount of beef, especially for ground beef, from Brazil. And we have tariffs on that. So part of the government's own policy is contributing to the higher beef prices, but that's not part of this investigation at all.
All right, so what's next for Tyson? Are these kind of companies, how much did they have in their control? Because they don't have control of herd sizes and bird flus and things like that. The weather, exactly. So how do investors kind of invest in a company like Tyson's?
Yeah, you really have to look at how are they controlling what they can control, and so that comes down to their operations. Are they generating the efficiency they need to out of their plants? Are they operating at capacity? Do they still have excess capacity to fill? It really comes down to operational execution in this kind of backdrop when there are a lot of unknown variables that can impact supply. But ultimately, supply, at least for chicken, does look pretty good. It looks pretty solid. So if all things go well, Tyson should be in a position to be able to hit that guidance.
Before we let you go, Jen, what does pricing for turkeys look like as we get closer to Thanksgiving?
Nice. Yeah, turkey has been hit harder by avian flu than chicken, and so if you're talking about a frozen turkey, you're going to be fine. Those turkeys have been in frozen storage for quite a while. They'll be ready to go. If you're more interested in the fresh bird, your price is probably going to be a little bit higher this year than it was last year.
Oh boy.
Yep.
What a choice.
I'm just looking at the stock here. S&P 500 over the last 15 years, last 5 years, compounded annual growth of 15%. Tyson, 0.5%.
Valley trap.
Absolutely flat there. All right, Jen, thanks so much for joining us. Jen Bartashes does all the retail stuff, all the food stuff, all the supermarket stuff, including Tyson's. So, again, when you have a problem with chickens, it's easier to make chickens than it is to make cattle. So
all this talk makes me want to be a vegetarian at this point.
Yeah, exactly. You can be the.
I mean, that's pricey too. For
we
other
have
reasons.
some of them in this building. I know some here in this building. They're vegan and they're I don't know what they are. They go crazy, but
they don't even have the eggs upstairs.
No. So that's how they roll.
That's the protein of choice these days.
Hey, we've given up a lot of the gains here today. We're still up about 0.75%
But
on the S&P.
the Dow's negative right now.
Yeah, the Dow's negative. The NASDAQ's still holding on to its own, up 1.4%. That's 322 points.
Well, I mean, let's face it, the government shutdown is not going to end right now.
Right.
So that's part of it, right?
I'm understanding from Henrietta Trez, maybe late this week, to get everything signed, sealed, and delivered. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks, treasury yields, gold prices, even Bitcoin all on the rise. This is on hopes of ending the longest government shutdown in U.S. history. We'll start with the NASDAQ. It's up more than 1%, 305 points. The S&P 500 rising 0.6%, 45 points. The Dow right now, it is little change, down about 17. Over to the yield space. We have the 2-year, 3.58%. That's up 2 basis points. The yield on the 10-year, 4.11%, and that's up 1 basis point. Over to COMEX Gold, up more than 2% at $4,100 an ounce, and Bitcoin up about 0.5%, just above 105,000. Over to company news, and we have shares of Novo Nordisk. They're on the rise. They're up about 1%. That's after it withdrew from a $10 billion takeover battle with obesity drug developer Metsera, clearing the way for Pfizer to make its way in there. Metsera shares, they're taking a hit, down 15%. Pfizer is down nearly 2%. And Verizon reported looking to raise about $10 billion in the corporate bond market. That's to fund its acquisition of Frontier, and sources saying Verizon selling the den at as many as 5 parts. And finally, TikTok set to launch a podcast network through a partnership with iHeartMedia. It's going to feature up to 25 new podcasts that are hosted by TikTok creators. iHeart shares, they're down about 4%. iHeartMedia, strategic partner of Bloomberg Media. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. We've got Scarlett, Phil, and Paul Sweeney live with you here in the Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. You know what was one of the big issues in both the New Jersey and the Virginia governor's races was the cost of electricity. It's going up.
Right.
In part due to increased AI usage.
All those data centers need to be powered.
Those data centers going. So let's talk about electricity, where that's going. Ethan Zindler joins us. He's lead for countries and policies research at Bloomberg NEF. He's down there in D.C. Ethan, I was under the impression that the cost of electricity hasn't really budged much in a long time, but I guess that's about the change. What's going on in the world of electricity?
Yeah, so, historically, we have been very privileged in the United States to have some of the lowest electricity rates in most wealthy countries. But that has really begun to change, particularly over the last 5 years or so, as demand for electricity, for the first time in a couple decades, has started to pick up. So in particular, in the so-called PJM interconnection, which is a region that runs from the Midwest through the Mid-Atlantic, we've seen some pretty sharp increases in retail rates in the last several years.
And these are permanent increases, or could they just be the beginning of like a lot of fluctuating prices?
Generally, retail power prices do not come down once they've been ratcheted up. It's quite a process that you need to go through on a regulatory basis just to get the rates raised. And once that's done, generally speaking, they don't come back down.
Ethan, I guess the easy question, or the hard question, but certainly the 30,000-foot question is, does the U.S. have a grid to support all these data centers that people tell us we're going to need, or do we need to invest in expanding, improving the grid?
So fundamentally, there has been underinvestment in the U.S. power grid, both in terms of the large, long distance transmission lines, and also the distribution grid. That's the lines that get the power to your house. That has gone on really for decades now, and to some degree, because electricity demand wasn't growing in the U.S., this didn't matter all that much. But now we are poised for real strong electricity demand. By our estimates, in one of our scenarios, we see electricity demand growing by about 25% over the next 10 years or so, with about 2/3 of that coming from data centers. So there's really no longer any time for us to be able to put off the kinds of investments that we're going to need in the grid to accommodate all that additional demand and supply.
And that's why there's so much talk around nuclear power plants or small nuclear reactors as well. What about green energy? And I know that under this current administration that is not in favor, but what about wind? What about solar? Does that move the needle at all?
Well, certainly, and increasingly batteries, I think, is worth mentioning as part of the conversation, since obviously the wind and sun don't always produce the energy that you need. Batteries can help shift the production of that equipment into other hours. So those technologies remain very much cost competitive in the United States. Obviously, the industry suffered a pretty substantial setback with the passage of the One Big Beautiful Bill earlier this year, which removes some of the subsidies for wind and solar in particular. But nonetheless, those remain cost competitive. And there's another challenge, which is that if you want to build new natural gas-fired generation here in the United States right now, there's not a lot of availability of turbines for the power plants to produce that power. So wind and solar plus storage definitely very much in the game over the next several years.
So, Ethan, what I think we're all learning here as we think about these data centers is, yes, it's location, 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 but it's not like, oh, I want to be in the prettiest neighborhood. It's, I got to be near an reliable energy source. So how do you think about that? Is it like the PJM interconnect? I guess that's a reliable source of energy?
It is, but they are certainly having challenges getting projects permitted in an effective and fast enough time to meet the demand that's out there. So that's definitely a bottleneck. And in fact, some of the tech leaders have been upfront about saying that one of the key limiting factors in the growth of data centers to serve AI demand will potentially be the lack of availability of new power generation and transmission and distribution to accommodate that. So this is something that is potentially going to put the brakes, or at least slow the acceleration on some of the AI build-out that we've seen announced this year.
Ethan, let me ask you a dumb question. If we don't have the capability and the capacity to meet the demand from these AI data centers, what happens? Aside from electricity prices going up, I mean, could the physical grid be overwhelmed to the point where brownouts become a more normal thing?
I mean, that seems probably unlikely, since the primary goal of the regulators and those operating the grid is to make sure that we all continue to have the access to electricity day to day. What it could mean, and I think we're already seeing some signs of this, is that some of the very bold claims from the tech companies about how quickly they're going to build out data centers should probably be scrutinized in the context of how much actual power generation can you get online in order to accommodate that build out. So I think that's where the emphasis should be. Historically, the U.S. has been very good about maintaining reliability, and that's certainly going to remain at the top of the list for both regulators and grid operators.
Ethan, I don't know about you, but in my intermediate to long-term plan, I'm hanging my hat on SMR, small modular reactors. Is that a good strategy?
I'm not sure which hat you're hanging, but you know, these are interesting companies, and there's a lot of attention and a lot of excitement around them, and I think they offer a lot of promise. I would mention that a bunch of them are not new, and so you can look back for 10 or 15 years in some cases to look at their track records. You know, getting a new nuclear technology developed and permitted and online is quite challenging in the United States. And so I think you know, here in Washington, there's a lot of excitement, a lot of enthusiasm, a lot of regulatory potential support from the Trump administration for these technologies. And frankly, from a climate perspective, I think it would obviously be very important for these to work, but they do need to be proven out. And there is some fundamental challenges around getting a nuclear power plant permitted anywhere in the United States, regardless of whether it's small, medium, or large. You are going to face pushback often from communities where they might be located.
So it sounds like coming up with solutions to address the increased demand for energy is going to be a huge part of the 2026 elections, the midterm elections, and of course going forward as well.
Yeah, well, certainly the elections last week demonstrated the fact that electricity as a political issue has certainly arrived. And historically, that's not been the case in the United States, mainly because we have very inexpensive electricity in general. But because retail rates have been rising, we heard a lot more about that on the campaign trail in Virginia, where I live, but also in New Jersey, which has seen some of the sharpest increases in power prices. Governor-elect Sherrill has announced that she plans to have on day one, declare an emergency and scrutinize with much greater certainty how the utilities are acting, and to potentially even sue PJM over the prices that they've seen in that state. So this is very much of a live issue.
All right, Ethan, thank you so much. Ethan Zindler, lead for countries and policies research at Bloomberg NEF. Paul, you live in New Jersey. Has your electricity bill gone way up?
I'm not responsible for that, so I wouldn't know.
It's on auto pay.
Yeah, but I'll tell you what, I read a book several years ago called The Grid, and it basically is a history of the electricity grid in the United States. It is dense. It took an entire summer to read, but now I know all about the grid. How about that?
All right, there you go. The Grid is Paul's summer reading list for this summer. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Paramount Skydance, the former Viacom/Paramount/CBS company, is expected to report higher revenue and profit when it reports third quarter results on November 10th after the close. The question is, does anybody really care? It's all about whether they are going to do a deal to merge with, acquire Warner Brothers Discovery, and how this whole M&A is going to take place within the media landscape over the coming, 12, 24 months. So let's check in with Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. So Geetha, I guess let's get it out of the way. What are you going to be looking for from just an operational perspective when they release results here?
Yeah, thanks, Paul. So I think this is the first time, obviously, that they're reporting there's going to be a big operational reset. So I think what we're really looking to hear is, for Paramount Skydance to kind of articulate its strategy, both in terms of content investments, in terms of technological investments, and really the other big thing is on the cost-cutting lines. So, how much of synergies can we expect? They've already outlined a pretty big figure. Are they going to take that up? and then any guidance that they can provide in terms of their 2026 EBITDA. So, Paul, when they had initially announced the deal, they had guided for about 4.1 billion in 2026 EBITDA. We don't think that's going to be the case anymore. They've made a lot of big deals after, after that happened. So one big deal is they're spending about $1 billion every year for UFC content starting next year. They have some other big content deals, including one with the Duffer Brothers. All of that is going to take a big bite out of, the profit line. And so that'll be interesting to see what they have to say in terms of future forward guidance.
So let's get to the main event here. They made, I think, 3 offers for Warner Brothers Discovery. What's the status of that?
No news so far. So they've made, so what has happened since then is the last we heard was they had made those 3 offers, all 3 offers. The highest one was for $23.50. All of those 3 offers were rejected by David Zaslav and his team at Warner Brothers Discovery. What has happened since is we've had some other bidders show some interest for the Warner Brothers studio and streaming assets. So Netflix was reported to be actually looking at the books for Warner Brothers, kind of suggesting that they might make a bid. And then just last Friday, we had news that Comcast was also interested in the same assets, so the streaming and the studio assets. And again, for both those companies, more so really for Comcast, it makes a ton of sense, right? This is a great, Warner just offers such a great strategic and economic fit. Most of all, of course, of Paramount, Skydance. And the difference between, those companies' interests is that Paramount is actually interested in all of Warner Brothers, including the TV networks. That's not the case for Netflix and Comcast, which are just interested in the studio and streaming part of the business.
What do you think the timing is here? Is this something, again, you've got a board at Warner Brothers Discovery, you've got a CEO that are willing and maybe, more than willing to sell here. And that's usually more than half the battle here. Are you surprised that we haven't seen some more movement here?
Yeah, I would have really expected something more to come out of Paramount. Actually, I'm not really sure what they're waiting for. So we've had all kinds of unconfirmed reports from, Warner Brothers Discovery saying that they're looking to kind of make some announcement on whether they're going to actually sell the company or split it as they had planned. So if they were not going to sell the company, then there is a split. They're splitting their TV networks business, again, away from the studio, and that is supposed to happen sometime by mid-2026. There have been reports that by Christmas, David Zaslav wants to kind of make some kind of decision, but I really don't know. It depends on the bidders and whether they are, going to come in with substantially higher bids, because otherwise I don't think Zaslav is going to agree to sell the company.
How would the math work here? Because I'm just looking at the enterprise value for Paramount Skydance is about $30 billion, and the enterprise value for Warner Brothers Discovery is about $85 billion. So how does that math work?
Yeah, this is the part that is really, really, a head scratcher. So I'm not, there've been all kinds of reports, Paul. I mean, of course, Paramount is much, much smaller. The big expectation is that, David Ellison obviously has a huge family fortune, and he's probably going to be drawing on some of that in order to fund this bid. The other thing is, will he, and there have been, again, reports of this about him approaching different private equity partners for probably helping him to kind of come up with a joint bid. But again, everything right now, very, very unclear. But you're absolutely right in terms of, the amount of money. I mean, we think that just for the studio and streaming portion of the business, David Zaslav is looking for something to the tune of $70 to $80 billion. Wow. So, yeah, they're going to have to cough up a lot of money if they want to get this deal done.
And Comcast is also pursuing a split of its company, aren't they?
They are. So they are separating their cable networks business. And, this is basically MSNBC, the USA Network, a bunch of other channels like Golf Network. They're retaining the NBC broadcast, which is really the crown jewel for them. But the cable network business, as you well know, has been really, really under a lot of pressure, both in terms of cord cutting as well as really declining advertising revenue. The Comcast cable networks don't have a lot of sports on them.
Yep.
And so we've kind of seen EBITDA go down steadily, mid-single digits to high single digits. They're spinning out those cable networks into a new company called Versant, that spin will be completed by year end. Again, we really don't know what's going to happen with this company. Yep. I mean, this has to be kind of an M&A play. So
all right, Geetha,
wait and
so
watch
much.
there.
Yep, absolutely. As always, you're the best. Geetha Ranganathan, she covers the media for Bloomberg Intelligence, right on top of it. Lots of M&A going on in that space. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. Balance of power is coming up right now. The S&P is up 57 points. The Dow up 57 points. The NASDAQ up 350 points. This is Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Jailbreak in the Senate. Welcome to the Monday edition as the Senate moves forward with a plan to end the government shutdown. After a group of Democrats broke from the leadership to vote yes, we're going to get the latest in just a moment from Jack Fitzpatrick at Bloomberg Government. He's live on Capitol Hill on this day 41. We're also going to hear from Hakeem Jeffries, the Democratic leader in the House, set to hold a news conference. We'll bring that to you live here. President Trump is ordering all air traffic controllers back to work, threatening to dock their pay if they don't. We're going to take a look at whether that's even possible and talk it out with our political panel. Rick Davis and Jeannie Shanzano are with us for the hour, and we start on Wall Street. Alexis Christoforous has the read on the Monday trade. Everybody's feeling pretty good, Alexis. What do you have?
Pretty good is right, Joe. Stocks are rallying here as traders bet that an end to the longest ever government shutdown here in the U.S. may be nearing an end. As we've been reporting, 8 Democrats joined with Republicans to advance a federal funding measure in exchange for a future vote on extending enhanced affordable care subsidies. Wall Street likes what it hears, and as a result, we've got the Dow Jones Industrial Average up now 69 points. In the broader market, the S&P 500 is up 59, but get a load of the NASDAQ, up now 355 points, a gain there of 1.5%. Thanks once again to the big tech names, including the Mag 7, the Bloomberg Mag 7 Index, up now better than 2%. Investors are also rushing to the riskiest corners of this market. We have got Bitcoin up now 0.6% at $105,238. We've also got gold on the rise by 2.3% right now, above $4,000 an ounce. Treasuries are losing steam, though. We've got the 10-year yield at 4.11%, the 2-year yield at 3.5%. And in some stock news, we've got drug maker Novo Nordisk deciding to drop out of the running for obesity drug maker Metsera after Pfizer matched its latest offer, and after Metsera said it got a call from the Federal Trade Commission flagging potential regulatory risks with the proposed Novo deal structure. Pfizer's sweetened offer valued at about $10 billion. We've got shares of Novo up now just about 0.1%. Pfizer is down 0.1%, and we've got Metsera off more than 15%. Once again, stocks rallying here. The NASDAQ up 360 points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
And then this thing goes over to the House. Hey, great to see you. If you are with us on YouTube, welcome as always. If not, search Bloomberg Business News Live. Always available as well on Bloomberg Radio, satellite radio, channel 121. You can watch us on Bloomberg Originals as well. So we could get a vote today. This is all coming to form right now. And in the Senate, that is. John Thune knows he's got the votes following the procedural vote, unless Rand Paul does something crazy. And then it goes back to the House. Remember, Speaker Johnson said he'd give you 48 hours to come back. And we've had any number of lawmakers on the air here telling us that they'll be back even quicker. Some never left. And so now that's become 36 hours, whatever. It looks like we're going to have a Wednesday vote in the House. And it is going to need to be perfect for Republicans. We'll walk through the math with Jack Fitzpatrick. Here's the speaker a bit earlier. We're still waiting to hear from Hakeem Jeffries. Mike Johnson here from this morning.
They'll need unanimous consent from all senators to fast-track their final vote. As you know, there's some procedural hurdles that one or more could throw in the way, but we certainly hope that they won't do that because so many people across this country are desperate for the government to reopen. I'm stating the obvious to all my colleagues, Republicans and Democrats in the House. You need to begin right now returning to the Hill. We have to do this as quickly as possible.
Oh, yeah, and there's a travel crisis. Thousands, I think 5,500 was the number I saw, flights delayed or canceled over the course of the weekend. They started turning the screws on Friday. It's going to get worse every day until this ends. So you're going to hear inevitably stories. Just wait. You'll see Nancy Mason, the bus, you'll have the van with the pajamas. They're all going to be driving, big road trip kind of a week to get up to Washington to save the world. But as I mentioned, the math gets to be a problem here. When the House comes back, remember, Speaker Johnson needs to swear in the newest member of the House from Arizona, Adelita Grijalva. That means when that happens, the House will have 219 Republicans and 214 Democrats. So they can only lose 2 votes, and they already have them. Thomas Massey, Victoria Spartz voted against the last funding bill. So presuming they do the same thing, everything will have to go perfect. Republicans need to keep everybody together, no fooling around with Chip Roy. And maybe that will take place. Then it goes to the president, who would sign it, presumably. And as Jack will tell us now, we'll set ourselves up for the next government shutdown in January. Hold on to that last part. Jack is, of course, our expert on all of this from Bloomberg Government Live on Capitol Hill as we wait to hear from Hakeem Jeffries. He just rolled out. Oh, my God. All right. Let's hear from Hakeem Jeffries before we talk to Jack. He just hit the podium. This is live on Bloomberg.
In fact, what Donald Trump and Republicans said is that costs were going to go down on day one. But costs haven't gone down. They're going up. Inflation is going up. Under Republican policies, housing costs are going up. Child care costs are going up. Grocery costs are going up. Electricity prices are through the roof. And now, because of the Republican refusal to extend the Affordable Care Act tax credits, tens of millions of Americans are about to experience dramatically increased health care costs. In some cases, their health insurance premiums will increase by $1,000 or $2,000 per year. That is unacceptable. It will be unaffordable for working class Americans, middle class Americans, and everyday Americans to be able to go see a doctor when they need one. And so House Democrats and Senate Democrats have been fighting hard to address the Republican health care crisis and to lower the high cost of living for everyday Americans in the United States of America. Because the reality is, America is too expensive. And far too many people are struggling to live paycheck to paycheck. They can't thrive, they can barely survive. And that's why Democrats have been waging this fight. And we'll continue to wage this fight. No matter what comes over to us from the United States Senate to the House of Representatives at some point this week. Our position as House Democrats has been crystal clear. We will sit down with any Republicans, anytime, any place, anywhere, in order to find a bipartisan path forward, but we're not down with their my way or the highway approach to governance. That's failed the American people. It's been a disaster for the American people, and the American people know it, which is why last Tuesday, Republicans all across the country got wiped out. One of the most decisive off-year elections ever in modern American history. And so as House Democrats, we know we're on the right side of this fight, the right side of the American people. And we're not going to support partisan Republican spending bill that continues to gut the health care of the American people. And we're going to continue the fight to extend the Affordable Care Act tax credits. And if it doesn't happen this week, next week, this month, next month, then it's the fault of Donald Trump, House and Senate Republicans, who continue to make life more expensive for the American people. Questions?
Some Democrats in your own caucus are suggesting Schumer isn't effective as Senate Democratic leader and should be replaced. You, of course, are critical of this deal. Do you view him as effective, and should he keep the job?
Yes and yes.
Do you trust, in this deal, there is language for President Trump and the Trump administration to
Hakeem Jeffries, the Democratic leader in the House, now taking questions in a news conference live on Capitol Hill. Reporters are off mic, but we're going to stick with this for a moment to get a sense of what he's saying. This is live.
The legislative language, and we'll have a caucus meeting later on this afternoon, and we'll get a presentation from Rosa DeLauro, the top Democrat on the Appropriations Committee. The overwhelming majority of Senate Democrats, led by Leader Schumer, are opposing this bill in the Senate. And they'll articulate, there are a variety of different reasons that the bill is being opposed strongly by Democrats in the Senate, the overwhelming majority of them. And there'll be a variety of different reasons that we articulate in the House. Now, certainly we're going to continue to stand by our hardworking federal employees. By the way, Donald Trump and Republicans, this toxic administration, they fired more than 100,000 federal employees prior to the shutdown that they started beginning. So, of course, there's reason to be deeply skeptical of the administration and their motives as it relates to the hardworking federal civil servants and the federal workforce. And we will continue to be deeply skeptical of their intentions. They spent the whole year implementing the toxic parts, the most toxic parts of Project 2025. After lying to the American people last year, saying they didn't know anything about Project 2025. And part of that has been going after the federal workforce. So we'll see what the language looks like, but it doesn't change the core problem here, which is we need to decisively address the Republican health care crisis on behalf of working class Americans, everyday Americans, and middle class Americans. Thanks. Third row.
All right, Hakeem Jeffries talking with reporters this day after the vote in the Senate that moves along a stopgap funding measure to a potential passage in the Senate as early as today. It does appear that we are getting closer to ending this government shutdown. Hakeem Jeffries, though, obviously does not like the way this is going, and we need to sharpen our focus on what's happening here, remembering 8 Democrats broke from leadership in the Senate to get to that 60-vote threshold last evening. Chuck Schumer still voted no, and he is consistent with Hakeem Jeffries, who just said when asked that he does believe that Schumer is effective and should keep his job, remembering that Hakeem Jeffries, upon the passage of the resolution last evening, said Donald Trump and the Republican Party own the toxic mess they have created in our country, and the American people know it. He will not back the deal that we saw emerge last evening, if we could even call it a deal. They could have done this weeks ago. And so we get back to Jack Fitzpatrick, who's live here and standing outside of that news briefing so he can talk with us, and we do appreciate this. Jack, I guess my question for you is why now? Senators had been telling us, Democrats from both chambers, that a promise of a vote on Obamacare subsidies was not enough. They needed a deal on paper, yet here we are, Jack. What broke this loose last night?
A few things broke this loose. One, Democrats never wanted this to go on forever, and we knew that as we got past November 1st, as the SNAP nutrition aid issues really hit, as more effects of the shutdown set in with delayed flights around the country, Democrats were going to get uncomfortable with that. two, Tim Kaine, a critical vote from Virginia in the Senate, said that before Tuesday's election results, which were very strong for Democrats, he was not able to get Republicans to come on board with protections for federal workers, which were pretty significant in this deal. And then after Tuesday, those conversations became more productive. So you basically got one extra vote because Republicans were willing to concede on something separate than the healthcare issues. Democrats had some skepticism all along about whether they were going to get a whole healthcare subsidy deal during the shutdown. That skepticism ended up building up, and they ended up taking a few smaller wins on other issues, which a lot of people thought was going to happen all along, but there clearly is a lot of anguish among mainstream rank-and-file Democratic lawmakers.
A lot of anguish indeed. So you've got the 8. I'm sure they'll have a name for this group at some point soon in the Senate. And if Republicans keep things together in the House, Jack, Democrats have actually no way of stopping this, right? So it's pretty easy for Jeffries and Schumer to continue opposing this. They won't keep it from passing, right?
I'd be surprised if they kept it from passing. The typical guidance in this building is if you can get 60 in the Senate, you're probably going to be fine in the House. It's going to be close. It's not going to be easy. It probably does not need to be perfect on the Republican side. Remember, there was one Democratic vote in favor of the Republican stopgap measure, Jared Golden from Maine, who's now not running for re-election. I noticed Henry Cuellar, a centrist from Texas, had positive things to say on Twitter last night. You're probably going to pick up some very centrist Democratic votes that makes it easier to lose the most hardline conservatives, but it is still definitely an exercise for the Republican whip team, because when you hear what Hakeem Jeffries has to say, you know a lot of Democrats are not happy about this.
It sure sounds like it. So let's talk about who crossed over. 3 are not a surprise because they had been consistently voting that way. John Fetterman, Catherine Cortez Masto, and Angus King, the independent from Maine who caucuses with Democrats. Now you add Dick Durbin of Illinois, who's actually member of leadership here. That's noteworthy. Tim Kaine of Virginia, teaming with federal workers. Maggie Hassan of New Hampshire. Jeanne Shaheen of New Hampshire. Jackie Rosen of Nevada. The one thing they all have in common is that none are up for re-election in 2026. Is that how we got this group, Jack?
Yes, there's a lot of political pressure on Democrats to continue the fight, and the movement came from the Democrats who were not happy with this fight all along and were facing a little less political pressure. Jeanne Shaheen in particular took the leading role in these conversations on the Affordable Care Act health subsidies. She is retiring. She's a member of the Appropriations Committee. She's kind of a deal striker and a moderate from New Hampshire. You knew all along she was looking for an out, and it was a question of how many people she could bring with her. And again, you didn't see the Arizonans who face more questionable political futures, the Georgians, one of whom faces a tough re-election campaign. If you're up in 2026 and you want to have answers to your voters about how you handled this, evidently those Democrats didn't want to back down, but the ones who face a little less immediate pressure wanted a deal.
This is really, really interesting to watch this all play out. I want to ask about the timeline, Jack, but I realize what the speaker prefers may not be what reality allows here. He basically just told everybody to get moving now, whether you have to get on a plane or in a car, because we have thousands of flights canceled around the country because of the shutdown. Do you think everybody could we get a quorum by Wednesday, or what's realistic?
I think that is realistic. That's kind of the reigning expectation around here, that they should be able to get a unanimous consent agreement to hold the votes in time today in the Senate. Now, granted, that's not a guarantee. If Rand Paul or any other individual member of the Senate wants to hold this up, this could be days, almost a week, that this drags out. But the expectation is you can give people an amendment vote, you can come up with an agreement so that people can be out of here for Veterans Day on the Senate side, and people can work on getting here by Wednesday. So the logical conclusion is by late Wednesday, you could see this government shutdown end, as long as everybody can get here. I don't know about perfect attendance, but enough attendance to actually have the vote in the House on Wednesday.
Man, I wouldn't want to see Rand Paul's notifications, I'll tell you that. We have invited him to join us here again on Balance of Power to talk about what he's thinking. Jack, I need to ask you about health insurance, though, this is how largely we got here, was a fight over Obamacare subsidies. And the President of the United States took to Truth Social over the weekend, and it's a big reason why all the health insurers, or most of them, are lower today, saying hundreds of billions of dollars in federal funding that goes to money-sucking health insurers, his language here, under the Affordable Care Act, should simply be sent directly to the public. So bypass the insurance companies, start mailing checks to people. He says they'll purchase their own much better health care and have money left over. In other words, take from the big bad insurance companies, give to the people, terminate per dollar spent the worst health care anywhere in the world, Obamacare. I bring this up because there was a concerted effort to defund and kill Obamacare during his first term. Are we about to go through this all over again?
That's pretty doubtful. One, there have been bipartisan conversations, not legitimate negotiations, evidently, but conversations in the Senate about how to address these ACA subsidies. And there are Republicans who are interested in some sort of limited extension of the subsidies that Trump is speaking so ill of. So how do you bring along Susan Collins, who was involved in those conversations? How do you bring on the moderate Republicans? Second, there was some conversation among House Republicans about doing another bill through the reconciliation process that bypasses the filibuster. That's how they did their tax cuts. It seemed like a long shot, and senators weren't really interested. So if you have a partisan idea on health care, we've already seen a lack of willpower to get that moving on the Republican side in the Senate. Bipartisan talks are much more liberal and much more favorable to subsidies than what you're hearing from the president right now.
Really interesting. Safe to say, Jack, we're back open by the end of the week? Is that where your head is?
Nothing is safe to say, but it's okay. Looking good in the Senate, and the question is more about timing than the whip count. Probably Wednesday this could end, but be prepared for chaos.
Look, well, we always are here. I was looking forward to running around the track with you today, Jack. It's really interesting, and thank you. That is the latest from our good friend Jack Fitzpatrick. He's standing on Capitol Hill right now talking with lawmakers, and that is where we are in sports. We'll see if we get a House vote by Wednesday. We'll see if we get a Senate vote tonight. All this stuff is very fluid, which is why we're talking about this in real time. Now, I mentioned what President Trump wrote on Truth Social about health insurers. Wait till you hear what he just wrote this morning about air traffic controllers. This is not quite Ronald Reagan, 1981, but he's definitely feeling himself on this, and he's threatening those who have decided to not go to work. We'll have more on that. We're going to talk about it with Sid as we get our heads around the impact on the air traffic control system. Sid Phillips has been great for us covering all of this. First, we want to look at Wall Street. The Monday trade is actually looking pretty good with this idea of a shutdown ending. Alexis Christophers has that for us in New York. Alexis, how's it look?
We have got a nice rally underway here on Wall Street, Joe. The White House now expressing support for the bipartisan deal to end the U.S. shutdown, which makes it very likely the government could reopen within days. Taking a look at the action, we've got the Dow Jones Industrial Average now up 102 points, the S&P 500 gaining about 65, and the NASDAQ Composite, far and away the winner of the day, up 377 points, a gain there of 1.6% against led higher by those Mag 7. We've also got Bitcoin on the plus side, up 0.8%, now at 105,413, and yields are slightly higher. The 10-year yield now at 4.11%, the 2-year at 3.5%. In stock news, Verizon looking to raise about $10 billion in the corporate bond market to fund its acquisition of Frontier Communications. Verizon's bond offering follows recent large deals with companies from Meta and Alphabet, which have helped propel global bond sales to a record $6 trillion. We've also got Tyson Foods saying it expects results for next year to be little changed as its beef segment continues to lose money, even as the Trump administration points to the meatpacking industry for driving up prices. We've got shares of Tyson up 1.2%. And Coinbase Global plans to launch a platform that will allow select groups of investors early access to new cryptocurrencies before those tokens are made available for trading on its main exchange. Shares of Coinbase now up 2.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christophers. That's a Bloomberg Business Flash. Back over to Balance of Power and Joe Matthew.
Alexis Christophorous, many thanks. We'll have more from Alexis on the markets about 20 minutes from now. As we follow the beat on Wall Street here, impacted by Washington once again, there is some enthusiasm, or maybe optimism, I'll say, about the government, say, reopening. Maybe by day 50. It's day 41. And if you're just, crawling out of your weekend here, there is some movement. 8 Democrats managed to move things along in the Senate last night. So it looks like the Senate will have an actual vote on a funding bill. Then it goes to the House. Maybe Wednesday is what we're thinking. Everyone's got to get on a plane, and how that goes, getting everybody back in town. Because air traffic controllers, in many cases, have not been going to work. They have to drive Uber at night, whatever they do to make some money here to keep the paychecks going. A lot of them have been showing up, and apparently they're going to get a bonus. The other guys might see their pay docked. President of the United States on Truth Social. This is a long one, by the way. Thought we'd have a dramatic reading as we get ready to speak with Sid Phillip. I bet Sid spent some time with this post. All air traffic controllers must get back to work now, it says. All caps, 3 exclamation points. Anyone who doesn't will be substantially docked. In air quotes, I'm not sure where we're going with that, the quotation marks. Presumably their pay is going to be cut. For those air traffic controllers who were great patriots, he says, and didn't take any time off for the Democrat shutdown hoax, I will be recommending a bonus of $10,000 per person for distinguished service to our country. Recommending, I don't know. For those that did nothing but complain and took time off, even though everyone knew they would be paid in full shortly into the future, I am not happy with you, all caps. You didn't step up to help the USA against the fake Democrat attack that was only meant to hurt our country. You will have a negative mark, at least in my mind, against your record. If you want to leave service in the near future, please do not hesitate to do so with no payment or severance of any kind. You will be quickly replaced by true patriots who will do a better job on the brand new state-of-the-art equipment, the best in the world, that we are in the process of ordering. All right, I can't read the whole thing. I was going to do it, but it's still, it's very long. So anyone who doesn't get back to work will have the pay docked. If you kept working, you get a bonus of $10,000, and then there's going to be a black mark or something. Yeah, Cece, these are some run-on sentences. I tried to interpret them to the best of my ability. The fact of the matter is, he's angry about the air traffic controllers. Let's see if it makes a difference, because we're supposed to be eliminating 1% a day capacity until we get to 10% cuts by Friday. So I'm not sure how this would help with that. Sid Phillip, Bloomberg chief correspondent for global aviation, finds himself in the middle of the longest shutdown in history. Hey, Sid, what's the union think about this? Are they going to come back?
I mean, the union's been talking about how their workers have asked the second paycheck in a row that they've missed. They got a $0 paycheck for the second time since the shutdown began. And so for air traffic workers, this has been existential, because you can get by with one paycheck missed, but when you get the second missed paycheck, that's when things start getting difficult for your air traffic controllers.
Yeah, boy. Well, we're hearing stories. I mean, the numbers are staggering. I think it was 5,500 flights delayed or canceled over the weekend. So this is life at 5%, I believe.
Yes.
What's life at 10% going to feel like at the end of the week?
Life at 10% is going to be even more disruption. It's going to be more chaos. I mean, we've also had weather. So there was snow in Chicago, and that compounded things over the weekend. And where cancellations today, it's about 1,400 flights, and that's about 5.5%. There's still 25,000 flights in the system, so it's still a drop in the ocean in terms of actual flights. But for the most part, the airlines have been able to accommodate passengers on other flights and other services, and the disruption has been limited to flights being delayed or flights taking a different flight than the one you intended. When you get to 10%, you're going to have more capacity constraints in the system. I mean, it's November, so it's easier for airlines to find accommodation on alternative flights. But once you get to 10%, that's an actual that's going to start making a difference in terms of whether people get rebooked onto alternative flights the same day or have to go onto the next day, and that could lead to serious disruption.
It was August of 1981 when President Reagan fired the 11,000 air traffic controllers who were striking. This was not a government shutdown, right? This was, they were on strike about contract matters. And he was, regarded by many as handling that well. Is this what's in the president's mind right now? Is he thinking back to Reagan, 81, despite the lack of parallels?
So when we were reporting the story on the Newark air issues and essentially the air traffic controller shortages, a lot of people talked about how 1981 was a precipice for the air traffic control industry, where you suddenly had a shortage of air traffic controllers filtering into the system. And that sort of had a knock-on effect until this day, because the air traffic controllers retire out and then there's a fresh batch of replacing those controllers. And the shutdown sort of has an impact on the intake of those new controllers. And at the moment, there's a shortage of controllers. So it would be not the greatest idea to sort of get rid of air traffic controllers who are fully trained and actually capable of directing traffic, especially when you've got a shortage of air traffic controllers in this country.
Yeah. Well, you wonder, too, if they're going to get a raise because he's recommending one. Hey, Sid, thank you. You've been great. We'll be calling Sid Phillip up at World Headquarters in New York. We've got our eyes on Capitol Hill with regard to all of this. Lawmakers, I'm sure, would like to have a say. And we haven't even had a chance to mention yet what's happening on the other end of Pennsylvania Avenue. We thought we would call up Michelle Jamrisco to talk about that, because it's not very often President Trump has, and he's dealing with this shutdown stuff as well, presumably, has a world leader come visit the Oval Office without the press being brought into the room. We kind of just assume that's going to be the case. It's not today, as he has the president of Syria, the guy who had a $10 million price on his head here in the United States, said to be a terrorist until recently. Now he's apparently an ally. Described as once unthinkable in the tip sheets this morning. Michelle Jamrisco covers the White House for us and national security. It's great to see you. Is this an ally of the United States, and what are they talking about?
Well, ally is certainly a stretch, I think, in, in military jargon as well. But yeah, the optics would be strange if we were to if it were to open up to see President Trump next to President al-Shara, because indeed the timeline has been quick. I mean, just last week it was the designated terrorist blacklist designation was lifted by the State Department. That also followed UN Security Council at the U.S.'s urging, taking off some sanctions. Now, al-Shara still has an uphill battle, and the U.S. does, the White House does, in getting Congress to erase some of the comprehensive sanctions that have been in place on Syria. But yes, this is a remarkable turn of events, and it all kind of speaks to the president's effort, of course, in the Middle East and in a lot of these conflict situations to try to be the peacemaker and to bring some sort of deal to the situation. So
is
there's
the idea to have another long-term ally in the region if things work out here, or is this more transactional?
There are things to be had on both sides. So we reported this morning, we had a U.S. official confirm early reporting by the Wall Street Journal that Syria will be signing on to a U.S.-led coalition to defeat Islamic State terrorists. But, again, this is a guy, al-Shara, who used to lead an affiliate of al-Qaeda. So this is someone that, it's kind of a big move, to say the least, to enlist this leader to kind of come to the aid of the U.S. in counterterrorism efforts. So there's that to be had. There's also, what Trump likes to talk about. One of his signature diplomatic achievements in the first term was the Abraham Accords, or he likes to call them the Abraham Accords. But he has been, of course, Trump has been pressuring Syria and others in the region to sign on to that pact, which, of course, would normalize relations with Israel. So that's another big item on the U.S.'s side. And meanwhile, Syria has to like that, al-Shara just only came to power, less than a year ago. He's now earning reprieve from sanctions and from terrorist designations that he didn't have previously. So kind of dovetails with what he was addressing the United Nations about a couple months ago, in terms of trying to get Damascus to be seen as not an exporter of crisis, as he said, but an opportunity for peace in the country and in the region. So we'll see where this goes from here. But certainly a remarkable and stunning turnaround to have him at the White House today.
It's amazing what the president has said about him. This is after they first met in May. President Trump, tough guy. This is a quote, very strong past, fighter.
Right.
What do you make of the decision not to let reporters in the room?
Well,
what would we see if we were in there?
I'll say this is one of those occasions where we shouldn't be surprised either way.
No?
This morning, up until this meeting started, which the White House said it did in the last hour.
It was close to press.
It was close to press, but we didn't know. Maybe at
We
any
never
moment Trump could decide. Let's have the reporters in here. But certainly, you can understand why it wouldn't be open to press, or understand the reasoning behind that. And from the White House's side, it's still very sensitive optics, given all what we just discussed. So, we'll have to see what comes about from this, but it certainly kind of plays into the White House's broader strategy.
Really interesting. We'll let you know if we get a readout on this meeting. I suspect we will, or maybe a truth post, or if there's a news conference with the Syrian president, we'll let you know. Michelle Jamrisco with us live in Washington. Great to see you. Thank you, as always. Look for Michelle's reporting on the terminal and online. I'm Joe Matthew in Washington. We'll assemble our political panel next. Rick Davis and Jeannie Shanzano off the weekend with a government shutdown apparently set to end as soon as this week. We'll get into it straight ahead with our Bloomberg Politics contributors only on Balance of Power.
It's 12:40 on Wall Street. I'm Alexis Christoforous, and stocks are rallying after a group of Senate Democrats broke with their party to help Republicans move forward on a funding bill that would end the longest government shutdown in U.S. history, now in day 41. House Speaker Mike Johnson was asked when he might call lawmakers back to vote on the Senate's new stopgap bill.
It's a great development. It's long overdue. It vindicates our position in this all along. We'll have a lot more to say at a press conference this morning.
House Speaker Mike Johnson spoke to a Fox News reporter who posted the comments on X. Here's how that's all playing out on Wall Street. The Dow Industrials up 156 points. The S&P 500 gaining 75. The NASDAQ up 422 points, now a gain of 1.8%. As for yields, they're slightly higher with the 10-year yield at 4.11% and the 2-year at 3.5%. We've also got the Bloomberg Mag 7 index up now 2.5%. And we've got Bitcoin up better than 1% at $105,688. Another top exec is jumping ship at Tesla. This time it's the head of the EV maker's Cybertruck division. The resignation follows a string of executive exits at Tesla, which is struggling with lukewarm demand and the loss of those key tax credits for buyers. Nevertheless, shares of Tesla up better than 4%. And the tether-backed video sharing platform Rumble will buy the AI infrastructure company Northern Data. It's a deal worth up to $970 million. Rumble also posting a narrower quarterly loss, shares racing ahead more than 10%. And Burger King struck a joint venture deal with a private equity firm to help double its presence in China. That's pushing shares of Burger King's parent company Restaurant Brands up 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
Alexis, thank you. Welcome to the Monday edition of Balance of Power here on Bloomberg Radio. We do this every day live from Washington, connecting the dots to Wall Street. There is a real connection today. People feeling better about what took place last night with a jailbreak in the Senate. As Alexis just said, 8 Democrats. If you're with us on this program, you knew that number already. Looking for 8 brave Democrats, Scott Bessent said just yesterday morning. And yeah, there you go. Look at the baseball cards on YouTube. Search Bloomberg Business News Live anytime, YouTube. You want to watch this program, watch the radio on TV. That goes for all of our radio shows from New York and D.C. throughout the day. Some of these names will sound familiar to you. It's the same 3 that have been voting all along, right? Fetterman, Masto, King, and then we added 4 more. Dick Durbin of Illinois, who incidentally was just speaking on the Senate floor a little while ago as we wait to get the timing on a vote. Tim Kaine of Virginia, Jean Shaheen of New Hampshire, Maggie Hassan of New Hampshire, Jackie Rosen of Nevada. And just like that, the gears start turning. Chuck Schumer was a no. I told you that. And it looks like Hakeem Jeffries is going to be a no when this thing goes next door to the House, presuming the Senate votes on this maybe tonight. That's what we're waiting for. They, I guess, will have an opportunity to do that. Everybody's in town. If you're a House member who stayed in town for the 40-plus days of, I guess, recess or home district work period, whatever we call it, if you stayed in town, you're feeling pretty smart right now because the call just went out. Everyone come back now. And the House will probably vote on Wednesday. As I mentioned, Hakeem Jeffries, not a happy guy this morning. He doesn't like this deal. And it certainly doesn't bring him what he wanted when it comes to extending Obamacare subsidies. With a salute to his colleagues in the Senate earlier, here's the Democratic leader in the House.
I certainly believe that Senate Democrats, the overwhelming majority of Senate Democrats, led by Chuck Schumer, have waged a valiant fight over the last 7 weeks, defeating the partisan Republican spending bill 14 or 15 different times, week after week after week, and continue to oppose this effort of passing legislation that does not address the Republican health care crisis.
The thing is, Hakeem Jeffries and Chuck Schumer, for that matter, can talk tough here and can oppose this, and they can even vote no, but it doesn't appear like they're going to be able to stop its passage, assuming Republicans hold things together. If you are playing along on your home game, do you remember the name Grijalva? Adelita Grijalva, Congresswoman-elect, has not been sworn in yet. When that happens, the House will have 219 Republicans, 214 Democrats. That means Republicans can only lose 2 votes to pass a bill on their own. So everything's going to have to line up here pretty magically. Let's get into it with our panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. I know this is who you want to hear from. And here they are now. Partner at Stone Court Capital, our Republican strategist in Rick Davis, who spent a career in the Senate. Jeannie Shanzano, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, certainly has thoughts here. Jeannie, I'm going to start with you on the jailbreak. Why did this happen now? We could have done this a month ago and had the same result. After all the Democrats who told us a promise of a vote was not enough, how did 8 come together to make this happen?
Yeah, Joe, and I was listening to you talk to Jack Fitzpatrick a few minutes ago, and you were saying there may be a name for these 8, and I've got one to throw your way. They're being called the folders. Yeah, the folders, Joe. I don't know if it's going to actually stick, but that's one I've heard.
Wow.
So I'm sure there are.
Is that how you feel as a Democrat? Did they fold or did they do the courageous thing?
You know, the reality is for shutdowns, they are never about policy. So I think that in their heart of hearts, most Democrats understood that the idea that they were going to get a change in terms of Obamacare subsidies during a shutdown was, you know, wish casting, if you will. And so from that perspective, it is frustrating for sure for Democrats, but it is also realistic because this thing over 40 days has got to come to an end, and policy change was not in the offing. That said, there is a big win here for Democrats, and I want to underscore that. It is always about framing, and the Democrats have framed that they are the party for the working, the average, the middle class. They are concerned about health care. They are concerned about cost. And this is while the president is, I don't know, zooming around on Air Force One, flying close to Commander Stadium, taxpayers' dimes, rebuilding, you know, ballrooms, holding Gatsby parties. So it is about framing. And I think that will hold the Democrats in good stead as they look towards 26. But of course, they're not going to get that policy when they want. So who would have thought they would? You'd have to be crazy because we have a long history of shutdowns. They always end this way.
Well, coming off a big night on Tuesday, the whole narrative, Rick, last week was Democrats are winning. Donald Trump, who we see there at the football game yesterday, called Senate Republicans to the White House to say, you guys need to open the government. This is because of the shutdown and the fact that I was not on the ballot. Now we hear from Elizabeth Warren. Republicans in Congress extended tax breaks for billionaire corporations, but refused to extend tax credits to lower health costs for working people. The deal is a mistake, says Elizabeth Warren. Gavin Newsom, maybe the 28th presidential nominee. Tonight's Senate vote on the federal government shutdown should have been a time for strength. Instead, we saw capitulation and a betrayal of working Americans. Rick, why take this kind of flack when you were winning in elections across the country last week?
Yeah, memo to these Democratic leaders. If it's going to happen, be for it. This is a classic DC axiom. And the real part of it that I like is if it's going to happen, be for it early. And that's what these 8 Democrats figured out. Sooner or later, this is going to end. And we want to be the ones that put a spike to it because at the end of the day, yes, they had a great Tuesday last week. No doubt about it. Across the board. Really put a lot of vigor in their step, proved that the Democrats could win again, probably one of the single most important things. And yet at the same time, you know, they could only press this, you know, government shutdown so far. And with the, you know, ACA subsidies spiking, you know, the air traffic controllers leaving, you know, the fears that the public have about, you know, government shutdown, I'm shocked that only these 8 figured out the game, which is, you know, let's change the topic, take the pressure off the American public, and start focusing on some of these policy issues that Jeannie was talking about, because that is where you have your strength. And regardless of whether you win or lose on them, the last thing you want to do is tell the American public, we're not going to open up government, basically like they've said they were going to do all along. When we have the wind at our back. So I don't know. I mean, maybe it's a political issue for Democrats running for the primary, but kudos to these 8. It's very much the similar crowd that voted with Republicans to kill the last long government shutdown in 2019. So, you know, kudos to them for crossing the aisle. That's what they should have done.
No, God knows it helps when you're not running for re-election. We just got a statement, speaking of the pressure at the airport, Jeannie, from American Airlines COO rather. Our air traffic controllers deserve to be paid. We will never compromise on safety. And American Airlines is now making reductions for future dates, even with the light apparently at the end of the tunnel here. Combined operations saw about 1,400 cancellations and over 57,000 delay minutes, presumably since Friday when the capacity cuts began. Jeannie, President Trump on Truth Social's kind of lashing out at air traffic controllers. He's telling them they must get back to work now. Anyone who doesn't will be substantially docked, he writes. For those controllers who were great patriots, didn't take any time off, I will be recommending a bonus of $10,000 per person for distinguished service to our company, to our country. For those that did nothing but complain, he says, and took time off, even though everyone knew they would be paid in full, I am not happy with you. And says you will have a negative mark, at least in my mind, against your record. What's going on here, Jeannie? Does the president have the power to do that?
It is a classic misreading of the room on Donald Trump's part, and something he's been doing right along this last month, in my estimation. There is no evidence of or world in which you had air traffic controllers staying home because they were protesting politically. You had people staying home because they have rent to pay, they have food to put on their table, they have children to take to doctors, and they too need a modicum of the money that Donald Trump has in which to run their lives, and they were not getting paid. So there is no evidence that people were staying home because they were patriotic, they were unpatriotic, or they were in bed with the Democrats. This is about living. This is about paying their bills. This is about winter coming and having to pay for heat and electricity. And so for him to come out and say this is stunning. And there's so much about this that is just mind-boggling, including the fact if you were going to give $10,000 bonuses, why didn't you say this when the shutdown started so that these people stayed in their role? And so there were no shutdowns or slowdowns at the airport. So Joe, I've got a lot on this.
Yeah. That was pretty good. You know, and maybe next shutdown he will. $10,000. I don't know where he's going to get that. Rick, did Donald Trump think he was invoking Ronald Reagan in 1981? How does he think this is going to play?
Yeah, look, I mean, I think this is pretty simple. Technically, in addition to the Democrats cave in, the Republicans caved, right? They originally weren't going to give these kinds of benefits to furloughed workers and things like that the Democrats got successfully in this CR. Assuming it actually gets to Trump's desk. And so he's got to complain about something. And, you know, the way I read this is I wouldn't have agreed to this deal if you guys hadn't struck and shut down the, national air traffic system, which is basically Duffy's argument, is that, we've had to cut back 20% of these flights by Thanksgiving because you guys aren't showing up for your jobs. So it's just casting blame. I think there's much more to it. And, who knows if any of this stuff's ever going to come to fruition? I take it as on its surface. It's like Donald Trump had to blame someone for agreeing to a deal that he otherwise didn't agree to a week ago.
Boy, for those of you who did nothing but complain. Jeannie, we've got less than a minute. Is this government reopened by the end of the week?
Gosh, I hope so. And I have to disagree with Rick on Sean Duffy. I was a real world fan, and Sean Duffy was much more, he was much more sympathetic and empathetic to those traffic controllers than Donald Trump, than his boss. So, but yeah, hopefully we're open at least by Wednesday or Thursday.
You mentioned Donald Trump's big night at the game. Were you at the Commanders game, Rick? Or no?
No, I was not.
All right. Just the smartest guy in the room. You know who was? Producer James was there. He saw that flyby, shaking the rafters. Air Force One, it was like the lowest flyby in the history of sporting events, with the president, of course, on board. And I mentioned all of this. Rick and Jeannie will be back in our second hour here, of course, on Balance of Power. Thank you both. I mentioned all of this with news just hitting the terminal here. Brian Dable is out as the Giants head coach. Maybe we need to fly over Giants Stadium. We'll talk more about that straight ahead. I suspect Alexis will have more on that coming up as well. In our second hour, we're also going to be joined by a member of the House who's about to be faced with this deal, Greg Stanton, Democrat from Arizona. Straight ahead here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
The government could reopen by the end of this week, but not with Hakeem Jeffries or Chuck Schumer. Thanks for joining us on the Monday edition of Balance of Power. With movement here in Washington, the Senate voting to move forward with a plan to end the stalemate. We'll see how quickly House lawmakers can get back to town after 8 Senate Democrats broke ranks. I'm Joe Matthew alongside Tyler Kendall in Washington, where this is all happening before our eyes here. Tyler, House lawmakers have been told to get back to Washington now.
Right, and we'll see how quickly they can get back once this advances past the Senate. The House will then have 36 hours to look it over and then take their vote. Importantly, though, you mentioned those Democrats that broke and ended up voting for this. The one common theme among them all, none of them are up for re-election next
That's
year.
right. 8 Democrats not running for re-election in a jailbreak. Remembering that Chuck Schumer did not vote for this. Hakeem Jeffries is not going to either, as he told reporters a short time ago. But we are looking at the timeline come together here. Tyler, we could have a vote tonight in the Senate. Looks like maybe Wednesday will be the sweet spot for the House. Then the president would sign the bill, and it would end the longest government shutdown in history.
Right, and the other date that we're, of course, watching for is when that anticipated vote on extending the Affordable Care Act tax credits would take place, because that's going to happen after the government reopens, but it's potentially setting up a fight, a conversation on what the future of healthcare could look like, because we know that was at the center of Democrats' demands, and while they didn't get it in this deal, looks like they're getting a vote on it down the line.
And think about how many Democrats told us that would not be enough. Just as recently as last Thursday and Friday, Democrats said a vote, a promise for a vote. No, we need a deal, we need paper, we need a timeline. And that's not going to be the bill that advances to the House. So we're going to talk to a Democrat from the House coming up here, and Greg Stanton, the congressman from Arizona, former Phoenix mayor, is going to be with us, who may not find this to be palatable either. And this is what it's going to be like the next couple of days, just getting a sense of where everyone's head is.
Right, exactly. And we're going to watch to see how this impacts the pressure points that are already building, including when it comes to air traffic controllers. We're watching stocks closely when it comes to the airlines. Also, of course, how quickly those members that are getting those food benefits are going to start to see their SNAP benefits come through. It's something that, of course, the markets are watching really closely today, which is why we're going to check in with Alexis Christoforous in World Headquarters for a look at the Monday trade. Hey, Alexis.
Thanks so much. And we've got stocks now at their best levels of the session as traders bet the longest government shutdown in U.S. history is nearing an end. House Speaker Mike Johnson expressing confidence today that the votes are there in the House to pass the Senate's funding package to reopen the government. The Dow Jones Industrial Average up 246 points, a gain of 0.5%. The S&P 500 up better than 1% now, or 87 points. We've got the NASDAQ Composite racing ahead 2%, a gain there of 468 points. Investors also looking to the riskier corners of the market. We've got Bitcoin now up 1 1/3%. Also gold on the rise, up better than 2.5%. The New York Giants' latest blown double-digit lead was enough for them to move on from Brian Daboll. ESPN reporting that Daboll has been fired as the head coach of the Giants in the midst of his 4th season at the helm. Offensive coordinator Mike Kafka will reportedly be named interim head coach. President Trump said the hundreds of billions of dollars paid to health insurers under the Affordable Care Act should go directly to the public. That's not sitting too well with some insurance companies. We've got shares of Centene, Molina Healthcare, and Oscar Health all lower. In fact, Oscar Health down now 16%. And Instacart in the news. The grocery delivery company formerly known as Maple Bear, or formerly known, I should say, as Maple Bear, posting better than expected quarterly results. Shares are higher here today, building on earlier gains in the previous session. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's a Bloomberg Business Flash.
All right, Alexis in World Headquarters for us. Thanks so much. As Alexis mentioned, I'm Tyler Kendall here in Washington alongside Joe Matthew, where we are inching closer, it appears, to reopening the government after a record-long closure. But while the Senate has passed this bill on a procedural basis, there's still a lot more that needs to get done before we see final passage. And as House Speaker Mike Johnson outlined earlier, it's definitely not a done deal.
They'll need unanimous consent from all senators to fast-track their final vote. As you know, there's some procedural hurdles that one or more could throw in the way, but we certainly hope that they won't do that, because so many people across this country are desperate for the government to reopen. I'm stating the obvious to all my colleagues, Republicans and Democrats in the House. You need to begin right now returning to the Hill. We have to do this as quickly as possible.
That, of course, easier said than done, knowing that we have a travel crisis and air traffic control crackdown in this country. The FAA each day is removing 1% of capacity. It started at 4% Friday, will be at 10% by the end of this week. So just getting back to Washington is going to be part of the story here. If the timeline holds, from what we understand, we could see a vote as soon as this evening in the Senate. The House would be looking at Wednesday in a best case scenario. But let's talk to Megan Scully about this. She runs our Capital Influence team. I don't think they ever stopped working all weekend because the Senate never went home. It's great to see you. Happy Monday. There's light at the end of the tunnel, and then we can start talking about the January shutdown. But I'll hold off on that for a minute. Do we expect to see voting tonight in the Senate? How quick can John Thune get this done?
So he needs consent from all 100 senators to move this along. We're expecting some folks, including Senator Rand Paul, who typically holds these things up, to do just that, which would then essentially put the brakes on. They have to ride out a clock, take another procedural vote, ride out the clock again. So it could be days instead of hours, but this morning Senator Thune was saying he's hoping it's the hours, measured in hours, not in days.
Have we heard from the White House on where they stand on this plan? Because while it would include the stopgap measure, reopen the government, as Joe mentioned, to January 30th, it also appears to have this pullback when it comes to the firing of federal workers, which of course is a policy that this White House really championed.
Yeah, so we have not heard anything as of yet from the president himself. We are hearing rumblings from the White House that he is on board with this. Senator Thune said that the compromise had been floated with President Trump last night, and that he expects Trump to sign it if and when it eventually makes it to his desk.
What's it like in the leadership offices right now, for Democrats, that is? Because these 8 senators broke ranks, right? Chuck Schumer was still a no, and Hakeem Jeffries just made it pretty clear that he's going to stay a no. They don't like what's going on here, but they've not managed to keep everybody from voting a certain way. There you have on your screen on Bloomberg TV the 8, including Dick Durbin, by the way, in the leadership, who decided to just say, let's get this done. What does this mean for Chuck Schumer now to lose 8 votes like this? A lot of folks are calling for him to step down. We hear this type of thing when voting doesn't go a certain way. But how confused is this in the leadership office?
So I think that it's telling, Tyler said it at the top of the hour, that none of these 8 are up for re-election next November. That is key here. And to me, indicates that there was some game of chess being played as to who was going to step up and kind of hold their nose and vote for this. Senator Durbin, as you mentioned, is a member of leadership. He is not one you would typically see voting with Republicans on an issue. He is, however, an appropriator, and most importantly, he is retiring. So that makes him a safe vote. I think that that was all built into the calculus here. Of course, Schumer got blasted just months ago when he acquiesced to Republicans and kept the government open back in March amid concerns that Trump was too powerful and too popular at that moment. This, though, has been going on for some 41 days, and the calculus is changing, particularly as people go without their food benefits.
So that's the Senate. What are you watching for when this gets over to the House, not just on the Democratic side, but also I'm wondering about House conservatives that weren't able to negotiate some of these spending levels and the bills that are tied to this.
So things like the RIFs, the fired federal workers that you mentioned, some of the spending aspects of this could really cause some consternation, particularly with members of the House Freedom Caucus. We're seeing some tepid support, but that's far from certain at this point. The House majority, the Republican majority, is so narrow that they can only really afford to lose 2 or 3 votes and still get this through if Democrats remain united in opposition. What I'll be curious to see is if they lose some Republican votes, if they pick up moderate Democrats. Now, Democrats should be having an additional vote when this finally comes up, because the representative-elect Grijalva from Arizona, who has long been awaiting her swearing in, will likely be sworn in prior to this vote.
Right, and that would make it so that Republicans can only lose 2 members of the GOP to get this through. It's always a math game. Megan Scully, she leads our Capital Influence team here at Bloomberg News. Thank you, as always. And to extend the conversation, we're going to bring in one of those stakeholders, Congressman Greg Stanton. He's a Democrat representing Arizona's 4th District and also is the former mayor of Phoenix. Congressman, thanks so much for joining us here on Bloomberg. It looks like this package is headed to your chamber later this week. Just to start out, how are you going to vote?
Well, based upon what I know and what I've read about that the agreement contains, I do not plan to support it. We had taken a principled position
throughout the shutdown that we desperately want the government to reopen, but we don't want to do it without also ensuring that people have affordable health care. The shutdown happened at the same time that people were receiving their massive increases in premiums under the Affordable Care Act and many other healthcare entities as well, coming right on the heels of millions of Americans losing their insurance under the One Big Beautiful Bill. It was an assault on Americans' health care, and that is a critically important fight as well. And my analysis of the agreement doesn't indicate that we're going to be able to say that we've truly supported people's health care and lowering health care costs.
So what just happened here, Congressman? Last Tuesday night was framed as a big win for Democrats. The president was upset about losses that had clearly been inspired by the shutdown. Republicans were seen to be taking the blame. By the end of the week, a jailbreak in the Senate. And I'm curious what you make of the timing here and whether you've heard anything about a vote on these Obamacare subsidies, because every Democrat we've interviewed on this program said the promise of a vote was simply not enough.
Well, the promise of the vote was only on the Senate side. Obviously, the Speaker, Johnson, has indicated that he's not going to allow that on our side, so that he was not part of that agreement. That's another big reason why we should not be considering voting in favor of this. We need to ensure that we're going to have a real opportunity to lower health care costs. But let's talk about Tuesday, because the Democrats did win overwhelmingly on Tuesday, particularly in the purple states of New Jersey and Virginia. That wasn't about the shutdown per se. It was about the totality of what the Republicans are doing. These tariffs that are raising costs on the American people, the One Big Beautiful Bill vote that decimated health care for Americans. Mass deportation is unbelievably unpopular. And I think that was a strong statement by those purple states that they are rejecting Trump and they're rejecting MAGA-type politics. And we're going to win the majority in next year's election. We're going to win it going away, because as long as these Republicans just keep doing whatever Trump tells them to do, they don't stand up for themselves. They just roll over and allow him to run everything. The American people are saying that's not the kind of politics we want to see in Washington.
But Congressman, if there was a promised vote in the House that mirrors the one that we're expecting in the Senate on extending the Affordable Care Act premium subsidies after the government reopens, would that be enough to get your vote on board now to reopen the government?
Well, it's too early to say that, because we have to know what exactly the vote would be. What would be in the vote? Would it be the Democratic proposal? We wanted to keep the cost of the Affordable Care Act down permanently, and I know that's a very different viewpoint than the Republicans. So I just think it's too early to answer that, because we don't know what would be in that vote. That wasn't negotiated in this agreement, and that's really a very unfortunate thing.
Congressman, the president on Truth Social is talking about health care and health insurance that's pulling shares of health insurers lower today, saying hundreds of billions of dollars in federal funding that goes to what he calls money-sucking health insurers under the ACA should be sent directly to the public. He says he's recommending to Senate Republicans that this money be sent directly to people so they can purchase their own, in his words, much better health care and have money left over. Do you know what he's talking about, and could he do that without Congress?
Of course we don't know what the president is talking about. And my feeling is, here we go again. The president with his repeal and replace politics as it relates to the Affordable Care Act. As you know, he talked about this incessantly in his first term in office, wanting to repeal it. And then they asked him, well, what would you replace it with? And he had no idea, concepts of a plan or whatever he said. The truth is, the American people support the Affordable Care Act. I was part of the class of 2018 in Congress. We won 41 seats because we ran on protecting and supporting the Affordable Care Act. I cannot believe the president is doing this again. And it's wrong for the American people. It's wrong for health care. But politically, it's good for the Democrats, because we're again going to be running for Congress, and we're going to win overwhelmingly by standing up and defending and supporting the Affordable Care Act. The Republicans would be much better off if they just came to an agreement with us to lower health care costs in America, to support the Affordable Care Act. But instead, they keep following Trump off this health care cliff. And he continues with his talk of repealing and replacing the Affordable Care Act. We don't know what he's talking about, but we do know it's a step in the wrong direction.
But if this is an issue that Democrats do well on, and if this is an issue that requires time to hammer out a deal, I know that you still need to look at what this legislation in front of you this week is going to look like, but why not pass to reopen the government and then use January 30th as the new pressure point so that Democrats can make the conversation about health care and put forward a plan that works and gets agreement to actually enact it for the American people. In the meantime, you have money starting to flow in to alleviate some of those pressure points, like on our air traffic control system and for SNAP food benefit recipients.
Well, we're going to keep fighting to lower healthcare costs for the American people. We want to lower costs overall. We're fighting against these tariffs that are increasing costs for the American people. And we know these decisions of the Republicans, both in the One Big Beautiful Bill and now the decision not to support the Affordable Care Act, not to continue with these tax credits, which make it more affordable. We know how bad it is for the American people. We're going to fight for it now and continue to fight for it. And if it doesn't get done now, we're going to continue to fight for it. This is not a one-off thing or a cynical thing. We believe passionately that we have to lower costs for the American people. And that is why, the reason why we took such a strong step in the last few weeks is because people were receiving their premium increases in the mail at that time. So we wanted to make that point that we need to lower healthcare costs. We need to get the government open. We need to do both. It's not one or the other. And that's the principled position that House Democrats have taken.
I want to ask you about air traffic controllers because someone like yourself has more than a couple of hours to fly when it's time to get back to Washington this week to vote, I guess, at some point in the coming days. The president is threatening to dock, to use his word, dock the pay of air traffic controllers who took time off, as he puts it, for the Democrat shutdown hoax. Those who did not take time off, he's recommending a bonus of $10,000 per person for what he describes as distinguished service to our country. Does he need Congress to do either of those, both of those, Congressman?
Yeah, we saw with the whole Doge thing with Elon Musk and him coming in and trying to unilaterally fire a bunch of employees and do it indiscriminately, and then they had to beg these employees to come back because neither Elon Musk nor Doge actually understood what they did. This has echoes of that. Look, all of the air traffic controllers are heroes, and many of them were not able to work the overtime that they normally worked because they weren't getting paid, so they had to do childcare or some cases had to work a second job in order to have some level of income. Those air traffic controllers are the heroes of this shutdown. In fact, I went so far as to say that I actually supported Secretary Duffy, the Secretary of Transportation, in lowering the number of flights at the 40 busiest airports because safety of the traveling public has to be the highest priority, and these air traffic controllers are.
I wish we had more time with you, Congressman. Greg Stanton, safe travels back from Arizona. We'll see you here in the Capitol. I'm Joe Matthew. This is Bloomberg.
1:21 on Wall Street. I'm Alexis Christoforous. The record-long government shutdown appears to be nearing an end, and that has sparked a broad-based rally on Wall Street. The Dow Jones Industrial Average up 250 points, now at 47,234. The S&P 500 climbing 88, and we've got the NASDAQ Composite up now 468 points, a gain there of better than 2%, led higher by those Mag 7 stocks. The Bloomberg Mag 7 Index up better than 2%. We've also got Bitcoin and gold on the plus side. Bitcoin up 1.2%, and we've got spot gold up 2.7% now at $41.11 the ounce. Brian Daboll is reportedly out as head coach of the New York Giants. That's after the team dropped to 2-8 on the season after squandering a 10-point lead to the Bears in a 24-20 loss this weekend. Daboll finishes his tenure with the Giants with a 20-40-1 record in his 3.5 seasons with the organization. And in stock news, drug maker Novo Nordisk has decided to drop out of the running for obesity drug maker Metsera. That's after Pfizer matched its latest offer and after Metsera said it got a call from the Federal Trade Commission flagging some potential regulatory risks with the proposed Novo deal. Pfizer's sweetened offer valued at about $10 billion. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash.
All right, Alexis from World Headquarters for us today. Thanks so much. I'm Tyler Kendall here in Washington alongside Joe Matthew, where we're tracking any developments around potentially reopening the government, as it seems lawmakers are picking up at least some momentum this week, and it comes as Americans have watched this crisis drag on. We saw consumer sentiment hit a near record low last week, according to a new preliminary reading in November from the University of Michigan. And we have a new data point of our own here at Bloomberg News. A new Harris poll conducted for Bloomberg and released today finds half of respondents in October, Joe Matthews, said the economy wasn't working for them. That was up from 41% in February. As we know, there have been a slew of economic policies that have hit Americans so far this year.
And as you can see on the screen, Republicans weigh in differently than Democrats, and it's frequently independents we're looking at in which way they're breaking here. But it does come down to a very similar conversation to the one that we were having on Friday when consumer sentiment, consumer sentiment came out and the comparisons to the prior administration. I'd love to get Jared Bernstein back in here, to be honest with you, to talk about this. You know, do you want to believe me or your lying eyes type of approach where people are not feeling great, but the president is telling them that the economy is better than their experience. This is something that Joe Biden learned a lot about, trying to get prices back down, and the president is still trying to figure out the job. Yeah, I'd say we definitely do it. Let's invite Jared back on to talk about this because, Tyler, it is something that Democrats and Republicans have in common.
Right, exactly. And both administrations have said that it will take time to see their economic policies work through the economy. I was struck in our story that's on the Bloomberg terminal about this data. It shows how we've seen Trump administration officials at first say that we would see those results by the fourth quarter. We're now seeing them push out those estimates to next year. And the economy, of course, has been critical for this White House because President Trump's potential handling of the economy was the issue, according to all of our Bloomberg News polling in those critical battleground states that really helped propel him to the White House.
That's true, and this is why we're hearing about it more from Democrats these days in some cases than Republicans. We assembled our political panel for their take on all of this. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist and partner at Stone Court Capital. You spoke to this when UMich came out on Friday, Rick, and I guess against the backdrop of what we've seen in the past 24 hours, it's just curious. Democrats outperformed in elections last week. Republicans taking the blame for the shutdown. You add this particular layer here, Republicans are on the ropes when it comes to affordability, specifically as an issue. Why then do these 8 Democratic senators turn around and vote yes on the deal? What do you make of the timing?
You know, I think that, look, we're already at the historically longest government shutdown in history. There's an enormous amount of frustration, grinding of the gears. We've talked a lot about, you know, the flight situations, but also government employees out of work, not getting paid. There are a lot of pressure on these members of Congress, regardless of what the status of negotiations are, who's getting what out of the deal. to say, you know what, we've had enough of this. Let's get government back open. Let's get these people back working. Let's get the air traffic controllers back in the terminals, and we can beat each other up over policy all day long after that. But I really don't think it's much more than just doing your day job, right? Your day job is not to shut down government. Your day job is to make government work. This is the first step in that direction. But they do it with the veil of a very grumpy electorate, right? I mean, a lot of the economic progress that's been made under Donald Trump has been made with, wealthier individuals and corporations, and there are a lot of folks feeling totally left behind. Hey, that sounds just like the Biden administration, where they had some economic progress, but they weren't able to translate it down to the working class. And so, this poll that you have really screams out independent voters are grumpy about the economic situation and their future. And the future is really the thing that barks out in this poll, as does the Michigan Consumer Sentiment Index, in that even though they might be feeling fine right now, and that is borne out by some macro and microeconomic factors, they think the future is dismal economically, and that is causing a lot of disruption. And we saw some of that disruption last Tuesday with a massive vote for Democrats, a big turnout of voters, and a real disruption in the political system.
Well, Jeannie, let's get your thoughts on how American sentiment is being impacted by this government shutdown, and then also go back to this question on a timeline, which mirrors what Joe was asking Rick, because we know that at the heart of Democrats' demands was that they want to see changes when it comes to health care. But realistically, how long is it going to take to hammer out a deal with Republicans on health care, and could Democrats afford to do that while the government shutdown dragged on?
Yeah, I think these 8 folders, as I'm calling them now, Tyler, they decided that they were not going to be able to get there from a policy perspective. And that is in keeping with what we know historically about shutdowns. Shutdowns are never about policy changes or seldom result in policy changes. What they are framing mechanisms for these parties to say, we are the party of X. In the 95-96 shutdown, the GOP was able to say, we are the party of responsible budgeting. We want to deal with the debt. We want to balance the budget. Today, the Democrats can claim the mantle of we are the party focused on affordability and the health care of Americans and making it cost effective. And that's something they hope to take into 26. That said, it's very hard for Democrats in particular to keep a shutdown going on as long as they have, because of course Democrats are a party of government. They want the government to be active. And so to shut it down makes very little sense for most moderate Democrats. And I thought the poll that you're just talking about, the Bloomberg-Harris poll, is fascinating because the numbers, Donald Trump's approval, he's under 18% underwater on the economy, and only a third of Americans in this poll saying the economy is on the right track. And what is Donald Trump doing? He's low-flying over football games. He is avoiding every opportunity to talk about the economy. He's sitting in the White House last week, as we talked about, saying affordability is a con job. Well, these are not the words of somebody focused on making the economy right. And this comes on the heels of both Scott Bessent and Kevin Hassett saying that parts of this economy are in recession. So the question here is, at what point does the president take that seriously and the GOP start to address it? The longer they avoid it, the better politically for Democrats going into 26, but the worse for working class and average Americans in the moment and as we go forward.
We just heard from Adelita Grijalva, a name that has been coming up a bit more now that the government appears to be on the threshold of reopening. The representative-elect would be sworn in to take part in this vote. Just out with a statement here from her district in Arizona, quote, "I am planning to travel to Washington," she writes, after hearing through Leader Jeffries and media reports that Speaker Johnson finally intends to swear me in. I guess that invitation hasn't come directly. "While I'm eager to get to work," she writes, "I'm disappointed one of my first votes will be on a bill that does nothing to protect working people from skyrocketing premiums, loss of health coverage, or do anything significant to rein in what she calls Trump's abuse of power. So I guess that's a no." But Rick, I'm curious your thoughts on the president's post here involving the health insurers because it's moving stocks. You've got Centene, United Health, and others pointed straight down after the president went on Truth Social to say that hundreds of billions of dollars in federal funding that goes to money-sucking health insurers under the ACA should be sent directly to the public, he says. People can purchase their own much better health care and have money left over. I'm sure you'll never forget the thumbs down moment with Senator John McCain on the Senate floor, and I know that Donald Trump has not forgotten it either. What do you make of the fact that still at this point, when we consider the idea of concepts of a plan, that Republicans don't have a better idea? The president has not put forth a formal proposal on health care to replace Obamacare. How are we still having this conversation?
Yeah, the president kind of stepped in it again this last week, talking about, well, what we really need to do is not debate, these ACA subsidies, but to actually reform healthcare in America. And that's a really deep well that gets really dark the further down you go. And the reality is, he got asked the right question, which is, well, you've been talking about this for 15 years. What's your plan? And I guess this was, behind the envelope. Hey, I got a plan. Don't give the money to insurance companies, give it to the individuals who, I guess, unless I'm misreading this, then give it to the insurance companies for health coverage. So, I'm not exactly sure how this Ponzi scheme is supposed to work, but I think it's just a reaction to not having a plan. And all the best advisors in the world, you can imagine, he called them in and says, "What's my plan?" And they're like, "Hey, we don't have a plan." And he's like, "Okay, I got to come up with one." And here you go. I don't know. I think he's trying to deflect some of the incoming that he's gotten on the criticism of the ACA. And by the way, as you pointed out, John McCain went down to the well of the Senate and put his thumb down on what was called at the time skinny reform. It was not reform of ACA. It was a gutting of the ACA, and they're going to leave a lot of people without health care. And so, deja vu all over again, I guess, in the United States Senate and in the White House.
Wow.
Jeannie, we only have about a minute left with you. Healthcare, of course, as Joe and Rick outlined, at the center of this, but also we saw federal workers being fired come to a head during this shutdown. This package would supposedly reverse those federal firings. Is this something that the White House is going to go for when we know that this has really been one of the centerpieces of the agenda while the government's been closed?
Yeah, I was thinking the same thing, Tyler. I can't imagine Donald Trump would. I have not heard yet whether he supports this, but this is diametrically opposed to everything he and Russ Vought, and by the way, Elon Musk and Doge have been focused on since he got into office. So maybe they'll have to swallow this as a part of a way to get the government reopened. It seems that Tim Kaine, critical vote here, this was critical for him and coming on board with Republicans to reopen. But I can't imagine that Russ Vought is looking fondly at this idea, or the president.
All right, our political panel today, Rick Davis and Jeannie Shanzano, both Bloomberg Politics contributors. Thanks so much, as always. We're going to turn from domestic politics to foreign policy next, talk about the oil market after some recent sanctions relief. Stick with us. This is Bloomberg.
1:40 on Wall Street. I'm Alexis Christoforous, and the record-long government shutdown appears to be nearing an end. That has sparked a broad-based market rally. The Senate cleared a key hurdle late Sunday after Democrats provided just enough votes to advance a measure designed to end the impasse. The Senate's next big step will be to send that measure back to the Republican-led House. The Dow Jones Industrial Average now at its best level of the session, up better than 300 points at 47,288. The S&P 500 rallying nearly 1.5%, or a gain there of 95 points. And the NASDAQ Composite up more than 2%, a gain of nearly 500 points, led higher by those big tech names, including the Mag 7, of course, the Bloomberg Mag 7 Index, up now 2.7%. We've also got Bitcoin and gold along for the ride. Bitcoin first, up now 1.3% at 105,869. Spot gold up 2.7%, above $4,100 an ounce. In stock news, Barrick Mining, the Canadian miner, boosting its stock buyback program and quarterly dividend, also reporting third quarter cash flow that beat estimates. We've got shares of Barrick up now nearly 6%. And Diageo, the company behind Johnnie Walker Whiskey and Guinness Beer, named a new CEO. Dave Lewis is going to take the helm there on January 1. And Tyson Foods says it expects results for next year to be little changed as its beef segment continues to lose money, even as the Trump administration points to the meatpacking industry for driving up prices. Shares of Tyson up 1.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
All right, Alexis, thank you so much. With us from New York, Alexis watching Wall Street, and she'll have another update on the markets coming up about 2 p.m. Eastern Time when Bloomberg Business Week Daily gets underway. It is a risk-off session, to steal a phrase here, and we're even seeing oil prices tick higher. Yeah, WTI, West Texas Intermediate, not a lot, but up about 0.5% to crawl back above $60 a barrel. And the idea here is that the government shutdown is making everybody feel a little bit better about something. This can get to be difficult to quantify in the energy market, though, and that's why we wanted to spend some time with Bob McNally, the founder and president of Rapidan Energy Group. Spent some time in the White House dealing with energy matters as a special assistant senior director for international energy on the National Security Council under President George W. Bush. Bob McNally, welcome back to Bloomberg TV and radio. From what we understand here, investors are looking at this a bit differently, at least the settling of prices that you have been forecasting will tip lower here, even lower yet, deepening their bearish stance at this time. Because what, Bob? As you say, it just comes down to barrels, right?
Joe, great to be with you. You know, you're right. The market analysts have been looking over the horizon for signs of this surplus, this tsunami, if you will. Futures curves have been flattening, going into contango. And oil inventories are beginning to rise, especially oil at sea. Now we can track that. Couldn't do that 20 years ago. Now we see it. And so there are incipient indicators that this long expected looseness, oversupply in the market is arriving. And you see oil prices gravitationally, Joe, they want to go lower. They were headed lower fast until President Trump surprised everybody a couple weeks ago by announcing those sanctions on Russia, and they had to have short covering and a sharp little rally in prices. But the gravitational forces, I think, are going to continue to impose themselves, and unless we have a material disruption due to geopolitical risks, I think direction of oil prices is lower.
Well, Bob, I actually wanted to ask you about an exemption to those Russian sanctions. On Friday, the White House announced that Hungary would be granted an exemption. We know that they import a lot of Russian energy supplies. About 90% of Hungary's crude imports come from Moscow. How are you watching that? Is that going to make a dent when it comes to Russia's revenues from barrels reaching the market?
Hi, Tyler. No, it's a real small issue for the global oil market and for Russia's revenues. Look, Hungary is a landlocked country that, as you mentioned, gets just about all its oil and gas from Russia. In the case of oil, from the Druzhba pipeline. I mean, there's just no other options. It can't bring on, oil from the U.S. tankers and so forth that easily. And so it's about 2% of Russia's export volume and revenue. So it's not a big deal for Russia. I mean, by not forcing Hungary to stop taking Russian oil, the Russians are preserving about 2% of their volume and revenue for exports. But in the grand scheme of things, it's pretty small. Hungary is very dependent, needed Russia a lot more than Russia needed Hungary. And the president gets along very well with Viktor Orban. So not too surprising that deal was cut.
Yeah. Bob, we're going to hear from OPEC and from the International Energy Agency both on Wednesday, their analysis and outlooks. Will they agree, and what will they tell us?
Well, Joe, Wednesday is a very big day for the analyst community, the energy analyst community, because the IEA will issue its annual World Energy Outlook, WEO, we call it. And for the first time in 5 years, that flagship influential forecast will include something investors have not seen, a scenario, a forecast where if we assume current policies in place around the world, oil and gas demand continue rising until 2050. For the last 5 years, the IEA has only issued forecasts that show oil and gas demand peaking around 2030 and then either plateauing or falling. So while we may be talking about a glut up here in the front in the beginning couple quarters of next year, what the IEA is going to reveal for folks, again, Rapidan has been of this view for a long time, but is that the medium to long term is looking a lot tighter. Because one thing everyone would agree, Joe, we are not investing enough in oil to supply a world in which demand keeps growing after 2030, as the IEA for the first time says it might, instead of peaking by then. So very big day for the world energy community and the IEA on Wednesday.
Bob, in the final minute we have you, what is the foremost geopolitical risk when it comes to the Middle East and the oil markets? Because today, for example, we have the Syrian president meeting with President Trump at the White House.
You know, the biggest risk remains Iran. There was an excellent Stephen Erlanger, a New York Times report the other day, end of last week, I think, pointing out something we've been advising clients for a while. It's not over. We had the June war. And then people aren't paying attention anymore. But Iran is reconstituting its nuclear weapons systems and its other means of terrorism. And Israel is not in the mood to allow that to continue. And I think if you ask me what is the biggest risk, it is that we have a flare-up again of military conflict in the Gulf, and that unlike June, Iran or others start targeting major Gulf infrastructure. The lion's share of oil and gas production, exports is still in that region. It's not over with Iran, so that's the one that I think I would worry about much more than what's happening in Syria or even Iraq.
All right, Bob McNally, founder and president of the Rapidan Energy Group. Thank you so much for joining us, as always, here on Bloomberg Television and Radio. We didn't get into this part of the conversation, but we know that President Trump has had his sights set when it comes to lowering energy costs, and it appears that the administration is taking aim at another high cost for consumers when it comes to the price of the food industry, in particular consumer beef prices, which have jumped 16% this year, according to the USDA. Tyson's Foods today saying it expects profits to be little changed next year as beef continues to lose money for the company. And now President Trump is directing his Department of Justice to look into allegedly driving up prices when it comes to the meatpacking industry. To unpack all of this, we're joined now by Doug Farrar, principal at Maywood Strategies and former senior advisor to FTC Commissioner Lena Khan. Doug, it's good to see you, and thanks for coming in. Can you just walk us through this? The Trump administration is now trying to launch an investigation, which sounds similar to some of the investigations that we saw launched under the last administration. How feasible is this for an investigation like this to get off the ground?
Well, thanks for having me on. So it's going to be tough. They cut staff quite a bit. Obviously, we know about DOJ. A lot of staff have left the FTC and the DOJ. And when you run functionally a law firm and you take on some of these major investigations, you need a ton of bodies. You need a ton of really sharp lawyers, subject matter experts to really make a case. And this market is definitely one worth looking at. So I think it'll be a challenge, and we'll see if they have the attention span to see it through and the staff to really make a difference.
I need to ask you about what's going on at the FTC, not that you're there any longer, with regard to Pfizer. This story today is remarkable, and Pfizer is a mover because of this. Albert Bourla learned that the board at Metsera had voted unanimously to accept Pfizer's takeover offer, which it was competing with Novo and had been some other companies. Turns out the FTC picked up the phone and called Metsera to warn the company that it would look unfavorably on the corporate structure that would have been included under the Novo deal. And just like that, we've got a merger Monday. Is that legal?
Well, I'm not following it as close as you are, as you said, but I know that the agency said they weren't granting early terminations during the shutdown period, and they've obviously gone back on that. And so I think that that's an interesting data point to look at as you consider what's going on at the FTC right now and how they're examining mergers. But yeah, it's a complicated case.
To what extent, though, is the agency allowed to actually get involved on a direct level like that with a proposed deal?
Typically, agencies don't get involved at a proposal level. It's once an HSR filing's been made, a merger's been announced. Certainly, the agency staff are in communication with firms, for instance, who are thinking about merging in order to ask them to preserve documents and do things like that. But yeah, in general, it's pretty unusual.
A lot of this is coming down to this idea of antitrust going up against big companies. We're seeing affordability really come to the forefront, particularly after Tuesday's recent elections. I'm wondering how you're watching this administration navigate that issue. We saw Democrats come off with a win, but now we have President Trump and the administration announcing some of these initiatives that are geared towards, they say, lowering prices and breaking up competitiveness.
Yeah, it's an interesting question. I mean, he campaigned on breaking up big tech monopolies, on being a sort of fire-breathing populist, and since then he's come in and he's been incredibly friendly to business. If you look at his AI EO, for instance, he's essentially instructing the FTC to be a concierge for AI companies seeking to roll up the market. So this is a big shift, and I do think it's driven by politics. The attention span of this administration is not long, and in order to really make an affordability agenda based on antitrust enforcement, for instance, you have to find good cases, bring them to court, win on appeal, and it takes a lot of work, and they've lost a lot of staff, and it takes a lot of attention, and it makes a lot of people mad. And you go back to the meatpacking industry, some of the meatpacking executives have incredibly cozy relationships with the president. So if he decides he really wants to go after them, is he going to get an angry phone call? Is that going to change things? Maybe there's a donation to the ballroom. Who knows, right? It's kind of an open question.
Interesting. You look at the likes of Goldman Sachs. Listen to what David Solomon is saying about the pipeline right now. We heard a lot about animal spirits when this president went back into the White House. Is that coming to fruition? Are you seeing the pipeline filled in a way that people expected?
I think in the initial phase, people took the rhetoric seriously, right?
Yeah.
I mean, you had Ferguson, Slater, you had President Trump and others, Vance, talk about how they wanted to do a lot of enforcement, but there hasn't been a lot of enforcement, and to the degree there has been, it's been kind of odd with certain merger settlements being a little unusual, very political, outside of the realm of what's normally done in antitrust. So, I don't know whether that'll lead to a merger wave or not, but certainly it doesn't seem like the agencies are going to be as active as they were under President Biden.
A lot of this administration's policies have to do with bolstering domestic manufacturing, protecting U.S. companies. In President Trump's post when it came to the meatpackers, he wrote about cracking down on majority foreign-owned companies that are driving up prices, according to him. In your experience, how much is this about combating international companies versus domestically owned ones?
It's a good question, and I think it's very market-specific. The meatpackers import a lot of meat from abroad. It's countries like Canada, countries further afield like Nigeria, Brazil, and what I think a lot of the ranchers want is country of origin labeling. We're in a Maha moment, right? People want to know what they're eating and where it came from, and American ranchers feel, I think rightly, that if people knew it was American beef, they might even pay more for it. That would empower them to have a more profitable business and fight back against the consolidation of the packers. So I think there's some stuff that they can do on this.
Well, Doug, we should mention the fact that at Maywood Strategies, this is day one, right? You're just getting your new firm off the ground.
That's right, day one. I'm looking forward to working with clients, looking across regulatory and political strategy.
It's interesting to have you on the other side of the glass here, so thank you for coming.
It's great to be here.
To talk to us, and life after the administration, I guess, is the story here.
Indeed.
Doug, thank you so much. Maywood Strategies, former senior advisor to FTC Commissioner Lena Khan. I'm Joe Matthew in Washington, alongside Tyler Kendall, and we've got a whole other round here, Tyler. We likely will know more by 5 p.m. when we join you for the late edition of Balance of Power. Whether we're going to see a Senate vote this evening, it is entirely likely that we will, which will then start the clock on a House vote. They'll have 36 hours to get everybody back in town.
Right, exactly. And keep in mind, House Speaker Mike Johnson still has his work cut out for him, right? Can only, our understanding is, probably lose 2 Republicans, and he doesn't have them all.
That's true. We're still counting votes here, even after what took place last evening in the Senate. We'll break it all down for you coming up at 5 o'clock. In the meantime, Bloomberg Business Week Daily, live from New York, on the way next, right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Yes, indeed, everybody. It's Monday, November 10th, 2025. Carol Masser, Tim Stenivek, and risk trade is back on, Tim.
Yeah, it is. You type in World Equity Indexes on the Bloomberg terminal, WEI, and it's green across the screen. 2% to the upside on the NASDAQ composite, 1.3% to the upside On the S&P 500, we're going to have some more details from Alexis Christoforous in just a minute, but suffice it to say, risk on is the theme.
Absolutely. All right. So stocks are up. Bitcoin is up. The U.S. Senate advancing a plan to end the longest ever government shutdown and remove a significant economic headwind. And I feel like this is a lot of what we're going to be talking about over the next 60 minutes. Yes, that U.S. government shutdown feels like it's nearing an end, but there are more steps to go. So the questions Tim and I are asking, is this real progress? Is it a political win for the Republicans, for the Democrats? And what is really in it for you, me, and the rest of us?
Are we the ones who these members of Congress are supposed to be working for, right?
That's a yes.
Okay. Okay, so all those questions will be asked a little later in the program and answered too. Plus, caught up in the shutdown, the nation's airports, the latest on the snarls, ground stops over the weekend at multiple airports, including those in the New York City area. Oh, and then that snowstorm in Chicago, not helping at all.
I was talking to our Romaine Bostic.
He made it.
He made it.
Barely.
But I think he switched airports. He had to switch carriers.
I didn't know so many of our colleagues go on, weekend trips every weekend.
He's living the life.
Yeah,
anyway,
he really is.
We might talk to him a little bit later on. All right, folks, let's get to it, and let's get a check on the trade as we see stocks near their highs of this session. Over to Alexis Christoforous. She's in for Charlie Pellet. Hey, Alexis.
Hey, we've got a nice big fat rally underway on Wall Street on rising bets that the U.S. government shutdown, now in day 41, could end soon. The Dow Jones Industrial Average up 310 points at 47,295. The S&P 500 adding 91. We've got the NASDAQ Composite sprinting 477 points, a gain there of more than 2%, led higher by, you guessed it, the Mag 7, the Bloomberg Magnificent 7 Index, up now better than 2%. We've also got gold on the rise, up now 2.7%, above $4,100 an ounce, and not to be left out, Bitcoin up nearly 1% at 105,471. We've been talking about it all weekend long. More than 1,700 flights have been canceled across the U.S. today alone as the FAA limits capacity at 40 major U.S. airports. American Airlines saying delays and cancellations this weekend impacted 250,000 customers. Checking the airlines, Delta up now about 0.5%. United Airlines barely budging, but American Airlines down nearly 2%. Now, at the same time, President Trump blasting air traffic controllers, threatening to dock their pay if they don't show up for work once those paychecks resume. He's also recommending a $10,000 bonus for air traffic controllers who remain on the job during the government shutdown. In other stock news, shares of Papa John's up now nearly 11% after reports of a potential buyout by Tri-Artisan Capital Advisors. This all-cash offer of $65 a share would value Papa John's at about $2.7 billion. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
All right, great stuff. Alexis, thank you so much. Well, today the White House expressing support for the bipartisan deal to end the U.S. shutdown, a key development that makes it likely the government reopens within days. We shall see. The Senate is resuming deliberations on its deal with centrist Democrats, but has yet scheduling a vote for final passage, although I'm hearing some talk that it could happen maybe later this evening.
Okay, we'll be tuned to that. Senate lawmakers also still must wind its way through potentially time-consuming procedures, and then the House members must travel back to Washington to vote for the first time since September 19th. That's a little bit of schoolhouse rock.
Yeah.
Is that?
Yeah. But you can leave, I guess,
You can.
when the government shuts down and still get paid. But yeah. Okay.
Oh, okay, Carol Massar, go ahead.
Off my soapbox.
All to you.
All right, let's see what the co-founder and director of economic policy at Veda Partners has to say. She is Henrietta Treyz, certainly a friend to us all here at Bloomberg. She joins us from New Orleans. Henrietta, glad you could join us. We talked to you. The surveillance team does a lot in terms of what's going in and around the Beltway. So is this real progress? Is it a political win? And if so, for whom?
Yeah, we definitely have progress overnight. Very excited about it. I'm optimistic that they will be able to get the House vote done as early as tomorrow. I think there's no better Veterans Day gift to give to our veterans than making sure that the military are paid and all the 700,000 furloughed workers can get their paychecks and some back pay as well. So hopeful that that starts moving forward. For investors, the most important thing is that we're open by Friday, so we might start to get some BLS data from September. I think that that's possible. Staff's still getting briefed. But that's my expectation, and fingers crossed we're there.
Do you think this is a solution?
Yes, I mean, I think that we've got the final package. We're going to have opportunities to keep having these ACA subsidy fights into December, and then we know that there's a January 30th CR, so we'll have the same exact fight all over again. Some of my smartest clients are saying, you know, what are the odds of a continued, you know, round after round of government shutdowns? And I think that if you look at what the two sides are taking away here, the Democrats are mad that they caved, and the Republicans, and in particular President Trump, have suffered quite a lot just on their own personal approval ratings. So it's kind of like playing chicken with a crazy person. You know, they're happy to see what happens, and that's what we walked into this time.
You know, does it seem like Democrats gave in on this? They're not getting what they wanted.
Yeah, to the far left, that's definitely how they view it. They wanted the actual ACA subsidies extended. You can see why. For voters over the age of 60, your ACA premiums are going up $919. It's pretty substantial. The average one for people in their 20s, 30s, 40s is almost $200. So these are, you know, very real benefits for, I think it's 42 million Americans. So definitely something that Democrats wanted to see delivered. But the good news for them is that they got the fight back on the front burner. And when you were standing at a low 30% approval rating, you really don't have much further to drop. So the Democrats getting engaged in this fight and pushing back against what has otherwise been, you know, 10 months of Trump running the board is not all bad. On the Republican side, for President Trump, his disapproval rating has doubled since October. So there's a lot of reason to think that even though the ACA subsidies didn't get extended, Democrats fought the right fight. I think that that's what Schumer and Jeffries believe.
You know, as we watch the political fights that go on in Washington and have for a long time, no matter who's in the White House, at least over the last few administrations, I think it's safe to say, Henrietta, what really struck us all, and I want to go back to those SNAP benefits, that 1 in 8 Americans need food assistance. Why is that? What does that say about lawmakers, Republicans and Democrats, through several White Houses and the job that they have not been doing for the bulk of Americans? I mean, aren't we the world's largest and richest nation?
Yeah, we sure are. And I think it's important to note that 70% of those recipients have full-time jobs. So it's not like these people aren't working. A disproportionate number of them are young people and also old people over the age of 60 or 65. But, you know, if you really want to get into the nitty-gritty, why are people, 70% of these recipients, on food stamps if they have full-time jobs? What is their pay? I think there's some really interesting, you know, conversation that always comes up when we talk about SNAP benefits of what are these giant corporations, Walmart, Target, Dollar General, et cetera, what are they paying their employees that they still also need to have food stamps? So it's really everyone to blame here on this front.
Why is this, though, not something that gets pushed further in Congress with lawmakers?
Well, especially in a year like this one where they're focused on cutting federal spending. I mean, and you look at the One Big Beautiful Bill, there were repeated instances of cutting food stamps back, limiting eligibility, all in the name of saving money, which is, you know, interesting given that it was a $3.5 trillion deficit increasing bill, and they eliminated the current policy baseline, which forces Congress to pay for things going forward. So the decisions around trimming federal spending are very proactive. They're on purpose, and that was across Medicaid and SNAP in the One Big Beautiful Bill. So I don't know that this is necessarily seen as a problem to see the limitations. It's part of making the government smaller, which is what Trump and the Republican conference are trying to do.
Let me throw on top of this, and forgive me, I don't have the details right in front of us, but we were talking about this in the newsroom, that the president is now proposing giving Americans a $2,000 check. Like, how do we do that? I don't understand. We talk about deficit, and if the economy is doing well, why do we have to do that?
Secretary Besson said it could come in the form of tax cuts.
Okay.
But the president also saying today that any extra would go down to pay the debt.
And that's exactly the problem. There is no extra. So the trade deficit, the tariffs is my bread and butter. And I would just say the following. When we did the CARES Act under President Trump's first term at the height of the pandemic, we sent out rebate checks. The president was very happy to send those checks out. They were very popular. They cost $292 billion. The tariffs have thus far this year for IEEPA brought in $89 billion. So if you're going to increase the rebate check from $1,400 to $2,000, and presumably there'll be a qualifying child credit of $500, something along those lines, you now have to spend $400 billion of the $89 billion in revenue that you brought in from tariffs. And why are you sending the rebate checks in the first place? Is it because costs of goods are increased? Is it because of the tariffs? It sure enough is. So you have this really circular logic that's a huge problem, and there is no leftover revenue to reduce the deficit, which is, of course, what bond markets are so focused on.
Hey, Henrietta, just last question on healthcare and whether or not Republicans come to the negotiating table in good faith when it comes to the Affordable Care Act later on. That's what Democrats want to see. Does that can get kicked down the road to January, and do they meet?
I've gotten that question a lot this afternoon from clients. I think yes. When I speak with Republican staff, they say that it's going to take 2 or 3 weeks to hammer out any kind of an agreement on income cap levels, on the Hyde amendments related to abortion, on the phase-in and the duration of any ACA subsidies. I think it's a bridge too far to ask this extremely acrimonious Congress to come together in the 12 legislative days they have before the end of the year to get a solution. I think it's much more realistic that they need a deadline, and so January 30th. That January time horizon is probably going to be more intense around the ACA subsidies getting extended or not.
All right. So, Love, thank you so much. Henrietta, co-founder and director of economic policy at Veda Partners. Henrietta Trey's joining us from New Orleans. All right. That's the latest, Tim, on the U.S. government shutdown. And expectations that we're nearing an end has definitely put the risk on trade on Wall Street.
Yeah, traders rush into the riskiest corners of the market. Stocks climbing alongside Bitcoin as the U.S. Senate advanced a plan to end the longest ever government shutdown. Also removes significant economic headwind. Bonds edge lower. We've got a great guest back with us. Allie McCartney is Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners at UBS. She's got more than $1 billion in assets under management. She joins us here in the Bloomberg Business Week studio. The risk on trade today, sustainable? I mean, it seems like we're seeing the riskiest corners of the market get a bid.
In this kind of trade. So last week was the worst week for the NASDAQ since April, since we began the tariff tantrum. So what happened last week, I think, was a combination of a lull in earnings news. First of all, we had gotten all the good earnings news out, and then everybody waits till NVIDIA. We also had the end of October, which is a fiscal end for a lot of funds. So there was a lot of purging and taking profits. And then for whatever reason, the sentiment in data was really unpleasant last week, and people chose, investors small and large, retail investors chose not to show up, which has been the bid that's been getting the market through, and they chose to focus on things that, given what you just talked about, are not particularly surprising, like the lowest consumer sentiment out of Michigan ever, right? So I think, when I look at everything that you talk about, and I love the way that you talk about it on this show because it's from an economic perspective, but also from a social and human perspective, clearly what's happening is the low-end consumer is getting squeezed. Things are much more expensive. There are probably many of those people who are on SNAP benefits who haven't gotten paychecks in a long time, and they're having a real hard time, and they see in that Michigan sentiment number more hard times. Whereas you look at the 5 or 10% that now spends 50 to 60%. And what are we seeing? Markets are at all-time highs. AI is increasing the productivity of our jobs and our labor. We see interest rates going low, so we can probably have more of a tailwind and more of an ability to borrow. But that same movement in interest rates doesn't give the general population access to a housing market. So we really are like a tale of two cities right now.
Right. Right. I mean, that's the other thing about access to lending. Who really gets it ultimately, right? And I thought it was striking what Henrietta said, that 70% of the SNAP recipients have full-time jobs.
That shocked me. I was very surprised to hear that. That's not the narrative that I think we push on Wall Street or from a government perspective.
We've got one of our reporters on shortly, Mark Niquette. They've got a story out on the Bloomberg. It's Trump's economy now, and Americans don't seem to love it. And they get into how the U.S. economy, Allie, is so increasingly dependent on 3 narrow interconnected A pillars: affluent consumers, artificial intelligence-fueled investment, and asset price gains, making it less stable if any of these pillars weakens. Those are kind of the 3 pillars of the market run-up.
They absolutely are. It is not hugely atypical of sort of the end of a bull market or a boom cycle.
Yeah.
And the question that everybody's asking now is not if, but when, right? These are called cycles for a reason. Portfolios are built the way they are to have things that go down when other things go up. You're not supposed to have Gold rallies 65%, while stocks are up 28%, while bonds are sort of mildly up. So we are in a very strange period where something will have to give. The question is when, and will it be on the federal side? Will it be on the AI side? Because, the thing
What do you think most likely?
The federal side is interesting to me because the AI side, I see that there is a concern and an issue around circularity of investments, circularity of hyperscalers, circularity of financing. But I also see and believe that this is transformative and catalytical, like the steam engine was, like telecom, like electrification of the grid. And this, not surprisingly, is happening quicker than all of those other capital expenditure cycles happen. But it's actually not from a percent of GDP perspective concerning. It actually probably has a lot of room to run. So I think that, the affluent works until it doesn't work. And whether that's because it gets litigated away or redistributed in some sense, again, not a conversation we have in terms of portfolio managers on a daily basis point. But what all this means to me is that every day I have to wake up and ask myself 3 questions with everything I own. Is it time to buy it? Is it time to sell it? Or do I not yet have enough information to make a different decision? And the truth has been that there have been times in the last year, for example, where the answer has been sell a little, or the answer has been buy a little more, or the answer is I need to wait to see what happens with tariff negotiations. But nothing that happened last week in that sort of purge or today in Monday's excitement makes me change any of those 3 issues.
So you're not buying, you're not selling, you're waiting for more info?
We're waiting for more info. The one thing we are taking advantages is given all of the massive uncertainty, long-term, short-term, Wall Street, DC, I'm still happy to buy gold, palladium, silver. Though there's more gold buying this year than we've seen since 2011. It's catalyzed by distrust in the U.S. government, concern about national treasuries, full stop, alienation from the U.S., declining dollar. All of those things are going to continue. And when you look at the other precious metals, they have a lot of the same catalysts, but also with a real demand against a supply constraint. So those are interesting to me. And then to the extent we can get into some of those mega caps or into some financial names at lower prices, those are interesting given all the tailwinds behind them.
You tie it all together, as always. Thank you so much. Really appreciate it. Allie McCartney, Managing Director of Wealth Management and Private Wealth Advisor with Alignment Partners over at UBS. Some headlines.
Yeah, a couple headlines. Parker Hannifin is said to be in talks to acquire Filtration Group. Also, looking at Apple shares right now, they dipped lower on this headline, but now still up. Apple delays the release of the next iPhone Air. This according to the information.
All right, we'll keep tracking that on this Monday. Hey, coming up, the U.S. economy that still includes airline snarls and a U.S. economy that many Americans don't like. We just touched on it with Allie. We're going to dig a little bit deeper. It's all coming ahead on Bloomberg Business Week Daily. Don't go anywhere. We're just getting started on this Monday. This is Bloomberg.
2:21 on Wall Street. I'm Alexis Christoforous. Stocks are climbing on bets the longest government shutdown in U.S. history is nearing an end. The Dow Jones Industrial Average up 325 points at 47,309. The S&P 500 up about 95. The NASDAQ Composite powering ahead nearly 500 points, now at 23,500. Even the Russell 2000 along for the ride today, up about 1 1/3%. We've got Bitcoin higher as well, up now about 1%, above $105,000. We've also got gold rallying 2.7%, now above $4,100 an ounce. Apple is reportedly delaying the release of next year's version of the iPhone Air. That's its thinnest smartphone that's after the first model sold below expectations. All this according to the information. Shares of Apple up 0.3%. Another top exec jumping ship at Tesla. This time it's the head of the EV maker's Cybertruck division. The resignation follows a string of executive exits at Tesla, which is struggling with lukewarm demand and the loss of those key tax credits for buyers. Shares of Tesla, though, up 3.8%. The tether-backed video sharing platform Rumble is going to buy the AI infrastructure company Northern Data in a deal worth up to $970 million. Shares of Rumble up 9.5%. And Burger King has struck a joint venture deal with a private equity firm to help double its presence in China, and that means shares of its parent company, Restaurant Brands International, up now about 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, Alexis, thank you so much. Carol Massar, Tim Stanovic, live here at Bloomberg headquarters in New York City. Well, looking at FlightAware data right now, I know, Tim, you are like glued to it. We're looking at how many delays? 5,300
delays within, into, or out of the United States so far today. Cancellations, Carol, close to 1,900. That's just within, into, or out of the U.S.
Yeah, and we've got snow in Chicago, so that's one of the busiest U.S. aviation hubs. The situation just getting worse when it comes to air travelers as those government-mandated restrictions on flights enter a fourth day. We know we just talked about nearing perhaps the shutdown, U.S. government shutdown ending, but we're not there yet. And we did have American Airlines coming out, and the COO in a statement saying they expect continued cancellations and delays, saying about 250,000 customers are impacted, and they're making reductions for future dates. They note their combined operations are over 57,000 minutes of delay. If you had a delay, you count those minutes, and getting out 10 minutes earlier or 10 or 15 or 20 or 60 minutes later, it's a difference.
It certainly is, especially on a Monday going into a work week. With an update, Bloomberg News chief correspondent for global aviation, Sid Phillip, joins us here in our Bloomberg Business Week studio. The delays that we and I kept getting updates on my phone this weekend, Sid, about ground stops at LaGuardia, Newark, and John F. Kennedy on Saturday. The delays that we're talking about right now, how much of those are about snow in Chicago versus staffing issues?
It's a combination. So we've seen, obviously, Chicago has been really affected by this. I mean, 25% of flights into and out of Chicago are about delayed, and 15% are canceled. So it is pretty bad in Chicago, and that sort of snow. But we also have sort of issues across the U.S. air system, and that's largely on account of the cancellations that are in effect at the moment, as well as the air traffic control shortages that are causing ground stops and delays. So it's a couple of issues that are sort of lining up, and that's sort of having an impact on aviation. And that's sort of this weekend was actually really bad for aviation in terms of cancellations. There were more than 10%, and that's because of the weather and other things. But we are seeing this sort of issue continuing as long as this air traffic control shortage continues. And
you know, it's interesting. I went and looked at airline stocks as it seemed like we were maybe making progress to the government shutdown ending. We know that there are steps to go before that happens, but I looked at the S&P Super Composite Airline Index. There are about 9 members. 7 are still down on the day. I mean, what does it take, though, for ultimately this to clear out? It's not like the government reopens and, whoo, everything's fixed, is it?
Exactly. I mean, that's the other issue, the fact that one is going to take a while for the airlines to ramp back up to their services. They're going to have to get sentiment as well, because, I mean, this shutdown and this restriction has had impact on sentiment for flyers.
Would you book a flight?
I'm holding off. We got to go somewhere on Thursday night. And I don't know how I'm going to get there. Maybe I'll drive.
I'm flying tomorrow, so let's hope that goes off well. But it is something that on people's minds. I mean, I've had people texting me who I haven't spoken to in years, asking me, should I get onto a plane? Should I buy a ticket for Thanksgiving? And the simple answer is you don't really know, but there will be an impact. There will be some sort of airlines will be able to ramp back up depending on when the shutdown ends and when they can actually get back to staffing levels.
Well, speaking of staffing, the president weighed in a post on social media earlier today. He said that all air traffic controllers must get back to work now. Anyone who doesn't will be substantially docked. He said that he will be recommending a bonus of $10,000 per person for distinguished service to our country for those who did not take time off during this time. That's not the part that got my attention. The part that got my attention was, if you want to leave service in the near future, please do not hesitate to do so. You will be quickly replaced by true patriots who will do a better job on the brand new state-of-the-art equipment. The replacement very quickly, the government has been trying to get air traffic controllers for years. This is a job that is very tough for the government to fill.
Absolutely. I mean, it takes years to train air traffic controllers. So it's not just about losing staff who are qualified and capable of training for actually manning these skies. You also have the training of air traffic controllers, and they are in the midst of ramping up hiring, but it is a slow process, and you need those instructors to be, the air traffic controllers to be well qualified and ready to handle the airspace. So it isn't quite as simple as replacing someone who's not willing to work. So it will take a long time for ramping up air traffic control staffing. I mean, remember, we were already facing air traffic controller shortages, and we had that sort of outage in Newark. We had multiple issues with staffing. So it's not going to be as easy as replacing people with whoever they want to.
Yeah, we've done some great reporting here at Bloomberg about what it takes. You've been on that reporting about what it takes in terms of, you know, taking on those jobs, being trained for those jobs, and the stress there, and, you know, the crises that air traffic controllers often have to deal with. It's not an easy situation. All right, Sid, thank you so much. My guess is we will still continue to come out to you over the next couple of days.
Yeah, if his flight's canceled tomorrow, then you're stuck here with
He's
us.
around. He's available. Bloomberg News Chief Correspondent Global Aviation, Sid Phillip, joining us here in studio. Hey, we're going to stay on the economy and the factors impacting it, because certainly the airline shutdown will have an impact on the economy, even if it's short term. We want to get to this as we heard from Fed Bank of St. Louis President Alberto Musalem. He expects the U.S. economy to bounce back strongly early next year, underscoring the need for officials to approach additional interest rate cuts very carefully. He spoke with Bloomberg's Mike McKee and BTV's Open Interest.
It's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative.
All right, that is Fed Bank of St. Louis President Alberto Musalem earlier on Bloomberg with our own Michael McKee. Hey, the Biden economy, the Trump economy, some may debate what's what, but the calendar says the longest government shutdown in the U.S. is happening during President Trump's second term, following the second longest shutdown, which happened during President Trump's first term. And that shutdown is creating a dearth of U.S. economic data at a time when the Fed's dual mandate is being tested once again. And as Bloomberg's Mark Niket and Lauren Dzenski report, President Trump has been back in office long enough for Americans to expect at least glimmerings of the economic golden age that he promised when he was on the campaign trail. Instead, warning signals are flashing. So with more on the economy Americans don't seem to love, we turn it over to Mark Niket. He is Bloomberg News Real Economy team reporter who's out there in Columbus, Ohio. Mark, you know, this economy, we don't have a lot of data on it. We've listened to CEOs on earnings call, and we all know, we talk about this a lot, that not all Americans are experiencing the same U.S. economy, hence the K-shaped economy. What did you guys find out when it comes to the U.S. economy and how Americans really feel about it?
Like we said in our piece, there's kind of warning signs about it. We have, you know, certainly good signs of economic growth, for example, but it's kind of being driven by AI-related investment. Like you said, we're seeing strong consumer spending, but a lot of that's being driven by wealthier households who have benefited from the stock market rally, and lower income folks are not benefiting as much and certainly pulling back on their spending. And ultimately, we just saw that, you know, the U.S. economy seems to be working for some voters, but not for others. And certainly we're seeing that reflected in the consumer sentiment data that shows you know, low confidence in the direction of the economy, and even political surveys that suggest that you know, President Trump's approval rating and his handling of the economy has kind of declined since he's been in office.
Well, you and the team also saw with some Harris poll data for Bloomberg, and I'm wondering what it found, whether or not the U.S. economy is working for respondents under President Trump.
And we kind of saw the dichotomy in that polling as well. We saw overall that a majority of adults don't think the U.S. economy is working for them, but we saw higher income folks, folks making $100,000 a year and more, thinking that the economy is working for them, or certainly more people who have money think the economy is working for them than people who are lower income. So again, sort of the K-shaped economy where, you know, if you're at the upper spur of the K, you know, things are great and you're doing well. But if you're in the lower spur of the K, you don't have as favorable a view of the economy.
Yeah, we've got a chart up there right now, and the question is the U.S. economy working for you under President Trump? And for those who are listening on radio, it's split into colors, yellow, red, purple, and is the U.S. economy working for you? Those who are making a lot more money, higher income, the majority, the red, are saying, no, I'm sorry, that's under, I'm sorry, reduced. The top line is for those not making a ton of money. So that red is showing predominantly, no, not working. And you go to the bottom line, and that's incomes over 100,000. And you can see in yellow, which represents yes, that they are saying that it is working better. What about when you go Democrats, Republicans versus independents?
Yeah, it's kind of what you would expect. The Republicans tend to think the economy is working for them more, or at least they support the president's policies and think the president's policies are working and helping the economy. Democrats, not so much. But what's interesting in that polling is you're seeing increasingly independents thinking the economy is not working for them or not approving of President Trump's economic policies, which could be, again, a warning sign for Republicans heading into the midterm elections next year.
Well, just very briefly, manufacturing. You go through a host of data in this story. Manufacturing and the resurgence that the president talked about on the campaign trail, is that materializing?
Not in the data so far. We haven't had jobs data since August, but what the data we had up until then showed that manufacturing had lost jobs for the last 4 months, about 42,000 jobs, which is the longest losing streak since the pandemic. Institute for Supply Management's index of manufacturing has been in contraction for 8 straight months. So this manufacturing renaissance that the president has talked about and promised has not materialized. In fact, it's going the other direction, where manufacturers in particular are kind of paralyzed by Trump's tariffs and not willing to move forward with investments and hiring, even if they're incentivized to do so from the one big beautiful bill that was passed in July.
I have to say, one of the things I love, and we talked about it earlier this hour, just moments ago, Mark, is how you talk about these 3 narrow interconnected A pillars: affluent consumers, artificial intelligence, field investment, and asset price gains, which has really, you know, been supporting the U.S. economy. But if any of them weaken, we know that there could be problems. And we certainly saw signs of this, questions of what is going on with AI and whether that continues. That has certainly weighed on the trade last week. Mark Niquette, Bloomberg News Real Economy team reporter, thank you so much. This is Bloomberg.
2:40 on Wall Street. I'm Alexis Christoforous, and stocks are rallying after Senate lawmakers took a critical step towards a potential deal to end the historic U.S. government shutdown, which is now in day 41. We've got the Dow Jones Industrial Average near its best level of the session, up 340 points. The S&P 500 gaining 98. The NASDAQ Composite running ahead, 513 points, a gain there of 2.25%. Brian Daboll is reportedly out as head coach of the New York Giants midway through his 4th season with the team. That's after another meltdown this weekend when the Giants blew a late lead against the Chicago Bears to lose 24-20, bringing their record for the season to 2-8. Offensive coordinator Mike Kafka has been named interim coach. And Apple shares briefly turned negative after the information reported the company is delaying the release of next year's version of the iPhone Air after the first model sold below expectations. Shares of Apple bouncing back a bit, now up 0.4%. And Coinbase Global plans to launch a platform that will allow select groups of investors early access to new cryptocurrencies before those tokens are made available for trading on its main exchange. Shares of Coinbase Global rallying 4%. Once again, stocks higher across the board. The NASDAQ up 518 points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's your Bloomberg Business Flash.
2-8, man, that is just painful for the Giants. Oh. I'm just saying.
Yeah, I know when to keep my mouth shut.
I know. Why? Well, okay. All right. What could go wrong here? Hey, listen, when Magna International reported earnings on Halloween, shares of the auto parts manufacturer rallied as much as 7% intraday in response to third quarter sales and adjusted EPS beats. Magna Management also raised its fiscal year sales forecast thanks to strength in North America and China. There was a lot going on. Company based in Canada, biggest automotive supplier in North America, everything from automated driving control modules, powertrains, lighting, mirrors, complete engineering systems, so much. It is a great, great, great read on the auto economy.
Back with us is Swami Kotagiri, president and CEO of nearly $14 billion market cap auto parts maker Magna International. The stock up close to 18% so far this year. I want to start with kind of where we left off when we spoke to you back in April. This was just after the president's so-called Liberation Day tariffs. You liken them and the additional cost to drawing upon the playbooks from past rotating UAW strikes, COVID, the great financial crisis, the chip crisis, all rolled together. We were pretty shocked about those comments because you said it was big. Is it still that big of an impact? Has it been that big of an impact?
Hi, good afternoon. Thanks for having me. Yes, there has been a lot of dynamic challenges in the industry, as you know, and when you spoke to me last, it was fresh, at that time. As we sit here and look at it, I think our annualized tariff impact is roughly in the range of $200 million, but we continue to work with our team, with our customers, with our supply base in mitigating as much as possible, adhering to the USMCA compliance. All in all, I think we have been able to, with a lot of self-help, a lot of work with our customers, we've been able to bring down that impact to roughly 10 basis points, which means about $30 million for Magna this year.
So I will say our BI team reacted to our Bloomberg Intelligence team, Swami, reacted, and they said they believe that your company's continuous cost-cutting and operational excellence could further release margin gains in 2026. And they talk about in the U.S., major customers are benefiting from a more profitable sales mix with higher sales of pickups and SUVs offsetting lower EV production, which should enhance Magna's program economics for upcoming 2026 launches. Do they have it right?
Yes, they do. There's a lot of hard work, and thanks to the team, there's been a lot of traction in our operational activities, including some of the activities that you mentioned, cost restructuring, optimizing our operations. We have really worked through about 40 divisions in terms of restructuring, consolidation, bringing things together. And when the mix and the volume become stable and it comes through, you see profitability going to the bottom line. And that has been our focus: cost reduction, margin expansion, and free cash flow generation. We've talked about 150 basis points over the last 3 years. And I'm glad to say we have an additional visibility of 35 to 40 basis points going into 2026. So this is a journey. It's never going to stop. You're an in an industry that we need to constantly work on improvements. We call them continuous improvements, and we're starting to see the result of that.
But you did talk about demand destruction in the short term when we talked with you in April, right after Liberation Day. Has it played out as bad as you expected, and where are we today? Your top customers are a who's who of the global auto industry. So where are we today in that demand destruction? Are we done?
I wish I could have that crystal ball, but you know, the way I look at it is we peaked out as our industry in North America about 17.5 million units. Interestingly, I was looking at the data, go back 20 years in 2004, 2006 timeframe, North American production volumes were somewhere between 15 to 16. We are still at 15 to 16 million units today. I think the volumes held up this year, but I always like to stand back a little and see where was Magna. Magna 20 years ago was a $20 billion company. Today we are a $40 billion company. And it's the result and the efforts of the team to continue to gain CPV and to diversify our customer base. And that's where our focus is, right? And to your point, though, I hope this is the trough. If you look at the average age of the fleet, it's pretty high. The inventories are pretty normal. So I like to say, you know, there is elasticity of demand that's going to come back looking forward if there is no more externalities like we have had in the last 4 years.
Your company is based in Ontario. We are curious about the U.S. and Canada trade negotiations, or lack thereof. Given the impasse between the U.S. and Canada, how is that affecting your industry and you specifically?
Yeah, as you know, auto industry is a very interdependent ecosystem, and it's pretty complex in North America. So it has been challenging, but I would like to look at Magna really as a global company. We have tens of thousands of people in Mexico, in Canada, and in US. And obviously, we are following the footprint of our customers, looking at the economics, looking at transportation, looking at logistics. And that is the competitiveness that ultimately lets you be the player that you are, right? So the focus has been on it. Whatever the policy is, if there is certainty and visibility to the policy going forward, I think it's just going to be a tailwind to everybody, the OEMs and the supply base in all.
But Swamy, is it broken, the U.S., Canada? I mean, it's been so intertwined, really, the North American, you know, global auto supply chain. But is it, especially the U.S. and Canada, is it changed forever?
Again, I'm not an international trade policy expert speaking from a
but you have a
perspective.
great vantage and a great window on how it has worked and how it feels today.
It's definitely been strained, right? There's no question about that. But I've lived in this industry for 26 years, and what we're talking today is going to impact maybe 27 or 28. So we're always looking at what we're doing today impacts 3 or 4 years down the road. What we're doing today has been planned and decided 3 or 4 years ago. So I tend to think a little bit in longer cycles. You know, I'm still hopeful that the policy is going to get to a point where it's mutually beneficial to everyone.
The president in the past, the president of the U.S., has talked about his back and forth in his conversations with executives at North American auto companies. Have you had conversations with the president or his team?
We have had, obviously, a seat at the table in being able to communicate facts, their possible impacts, the challenges of the industry, and what could benefit. I always say we are able to give an opinion, one of the opinions. I hope it's a dot on the chart. And definitely we have talked to all 3 regions, right, expressing what is the jobs that we have, what is the investments that we've made, and how it could impact, right? Definitely that is the conversation that's always ongoing.
All right, we're going to continue our conversation with Swamy Kotagiri. He is Chief Executive Officer of Magna International, joining us on this Monday. We're going to talk about the EV market. Curious to see his view on that and how it might be shifting some of their strategy and what they are seeing in terms of demand. That when Bloomberg Business Week continues on this Monday.
I'm looking at the equity market right now. Risk on day continues. The S&P 500 up 1.5%. The NASDAQ Composite up 2.3%. The Dow up 0.8%. More with Swamy Kotagiri of Magna International when we come back.